Namaste and a very warm welcome to the Deep Dive. I'm your guide, James, and I'm truly excited to embark on this learning journey with all of you today.
Hello, everyone. I'm Jennifer. It's wonderful to be here.
Today, we're going to explore a fascinating and, I think, crucial aspect of the financial world.
Wow.
Financial derivatives.
Hmm.
Now, these words, financial derivatives, they might sound a bit daunting, perhaps, like a complex mathematical formula even.
They can seem that way at first, definitely.
But I promise you, by the end of this session, you'll understand their essence, their power, and their practical application.
Yes, and if you're preparing for your CFA exams, or maybe you just have a keen curiosity about how the intricate machinery of financial markets truly operates,
And this is for you?
then this deep dive is precisely for you. We often find that terms like derivatives, well, they can feel a bit intimidating, can't they?
Especially if you're approaching finance without maybe a prior background in subjects like accounting or economics.
Exactly. But please don't you worry at all. Our mission today is basically to demystify these concepts, to explain everything step by step using simple, relatable examples. Things you might encounter in your daily lives here in India.
Right.
Our goal isn't just for you to memorize definitions. We want you to build a robust and intuitive foundation in the subject.
A foundation that will really serve you well in all your future financial endeavors.
Absolutely.
That's absolutely right. Think of us as your friendly teachers, dedicated to guiding you towards those wonderful aha moments.
Those moments of clarity.
Exactly. Today, we have drawn excellent insights from your study sources to help us clearly understand what exactly are derivatives, how do they function,
What are they based on? Or as we say, what are their underlying assets?
and crucially, where are these instruments actually traded? So are you ready to unfold this knowledge with us?
Let's dive in.
All right, let's patiently unpack this together.
What exactly are derivatives?
Okay, let's begin with something incredibly familiar, something we all do almost every day.
Good place to start.
Imagine you're heading to your local vegetable market, your sabzi mandi. You want to buy some fresh vegetables for tonight's dinner, maybe some bright green fundi or some plump, earthy aloo.
Okay, got it. Standard shopping trip.
You pick what you need, you ask the vendor for the price, you pay for it right then and there, and you take your vegetables home immediately.
Instant transaction.
The vendor gets your money, you get your vegetables instantly. This kind of transaction, where the exchange happens right now at the current market price, is what we call a cash market or spot market transaction.
Spot market? Okay.
The price you pay in that very moment for immediate delivery, that's known as the spot price or cash price.
Yeah.
It's all about the here and now, no waiting involved.
Makes sense. Immediate exchange, immediate price. Spot.
Precisely.
Now, let's consider a slightly different scenario. This one involves a bit of, foresight and planning for the future. Imagine you are a farmer, perhaps in Punjab, and you've just planted your wheat crop. You know that you'll have a large harvest, let's say, about 3 months from now.
Right, the harvest is coming later.
You've put in so much effort, naturally, and you want to ensure you get a fair and stable price for your hard-earned produce, even if the general market price for wheat happens to fall by the time your harvest is ready.
Yeah, you want to lock in a good price now.
Exactly. So what might you do? You could look for a buyer today, right now, who is willing to agree to buy your wheat 3 months later
Okay.
at a specific price that you both fix today.
So the price is fixed now, but the exchange is later.
Precisely. This agreement, this binding promise for a future exchange at a predetermined price, this is the fundamental concept of a derivative.
Okay, derivative.
Its value doesn't stand alone. Its value is derived. That means it comes from or is based on the future price of that wheat. It literally takes its value from something else.
Interesting. So it depends on the wheat price later on.
Yeah.
So, my dear students, let's think about this for a moment. If you decide to buy something right this moment, like your train ticket for today's travel to another city, is that a cash market transaction or a derivative transaction? What do you think?
Good question. Immediate use or future agreement?
Pauses briefly.
Yeah.
And yes, if you thought cash market transaction, you are absolutely correct. You pay for it right now, and you get to use it right now. It's an immediate exchange. Very good.
Well done.
Moving on, let's deepen our understanding. Defining a derivative and what that word derived actually signifies. At its very essence, a derivative is a financial contract. And the most critical defining characteristic, the one thing you must absolutely remember, is that its value is derived.
Derived.
Or, to put it simply, it's based on the performance or price movement of something else.
Right, something external to the contract itself.
This something else is extremely important, and we give it a special name, the underlying
The
assets.
underlying asset, okay.
It's like the foundation, the source or the roof from which the derivative draws its entire value. Without an underlying asset, a derivative simply cannot exist.
It needs that connection. To help you grasp this idea of derived even more clearly, let's use an example from something many of us in India love and understand deeply, a cricket match.
Ah, cricket. Always a good example.
Imagine the final score of a cricket match. Let's say one team scored 280 runs. Is that score just an arbitrary number that appeared out of nowhere?
No, definitely not.
No, certainly not. That score is completely derived from all the individual runs scored by each batsman throughout the innings, isn't it?
Every single run counts.
Every single run, every four, every six, every wide, every no ball, they all contribute and add up to create that final score. The score doesn't exist independently. It totally depends on the player's performance, ball by ball, over by over.
Makes perfect sense. The score comes from the playing.
Exactly. In finance, a derivative's value is just like that. It doesn't possess an inherent value of its own. Its value depends entirely on the performance, price fluctuations, or value of an underlying asset.
So that underlying asset could be many things.
Oh, yes, incredibly diverse. It could be individual company shares, perhaps of a big Indian conglomerate like Reliance Industries, or a group of stocks, like those that make up the Nifty 50 index.
Right, the index itself.
Or even broader, more abstract things like interest rates, different global currencies, valuable commodities such as crude oil or gold, or even something more specialized like a credit index that tracks the health of corporate debt. Lots of possibilities.
So, class, when we say a derivative's value is derived, what does that specifically mean it relies upon for its value? Try to recall that important term we just used.
What's that key element?
Pauses briefly. Precisely. It means its value depends on, or is based on, the performance of an underlying asset. You've grasped this fundamental concept beautifully. Excellent.
Very good.
Now, a very natural question arises. Why do we even need to complicate things with these future contracts? Why can't we just buy everything in the simple cash market?
Yeah, why the extra layer?
Well, the truth is, derivatives actually open up new avenues and expand the opportunities available for participants in the market. They offer sophisticated tools to manage money and investments. Specifically, they help you to create, modify, or manage your exposure to an underlying asset.
Exposure. Let's make that term very simple and relatable. Exposure fundamentally means how much you were affected by the price changes of something.
Okay, how much risk do you have to price changes?
Exactly. Imagine you run a small Kirana shop in your neighborhood. You know that next month you'll need to purchase a large quantity of cooking oil to keep your shelves stocked for your customers.
A common scenario for small businesses.
You're quite worried that the price of cooking oil might suddenly go up a lot before you buy it, which would significantly, eat into your profit margins.
Yes, higher costs hurt profit.
So, how can you protect your shop's profit from this potential price risk? Derivatives allow you to do exactly this to manage or offset such financial market exposure.
Ah, so it's like protection.
Precisely. This protection, or the act of offsetting potential losses from adverse price movements, is often called hedging. It's like building a financial safety fence around your business to protect it from unexpected price swings or, storms.
Hedging, okay, that's a key term.
Absolutely. Furthermore, derivatives allow you to gain a large position in an asset with a relatively small amount of money paid up front. This is called leverage.
Leverage, using a small amount to control a large amount.
Yes. While it can be a powerful tool to amplify potential gains, it's crucial to understand that it also magnifies potential losses. So great care is needed.
Right. Risk goes both ways.
And additionally, derivatives even enable you to take positions that benefit from prices going down, which isn't always easy to do in a regular cash market.
Okay, interesting. So if our shopkeeper uses a derivative to protect against potential future price increases for their cooking oil, what is that common purpose called? What's the specific financial term for that kind of protection?
What's that key action?
Pauses briefly. That's absolutely right. It's called hedging. You're all understanding these core concepts very well.
Fantastic.
The core features of derivative instruments.
Okay, now that we have a solid understanding of the basics, let's delve into the core features of these derivative instruments.
Let's get into the specifics.
Derivatives, though diverse, generally fall into two major types based on the commitment level of the parties involved.
Okay, two main types.
The first major type is called a firm commitment. This means that both parties entering into the contract must complete the transaction on the agreed future date.
Must complete. No backing out.
Exactly, regardless of what happens to the market price of the underlying asset. It's a definite binding promise for both sides.
Let's take a concrete example straight from your study materials to clearly illustrate this firm commitment.
Okay, an example helps.
Imagine your friend, let's call her Amy, agrees today to sell you 1,000 shares of Airbus Company, the aircraft maker, for €30 per share.
Right.
But the actual transfer of shares is set to happen in 6 months. So fixed price today, delivery later.
Got it. Price is 30, exchange in 6 months.
Now, when those 6 months pass and the delivery date arrives, even if at that time the shares are only worth, say, €25 each in the open market,
So the price has fallen.
Amy still has a legal obligation to deliver those shares to you, and you are obligated to pay the agreed €30,000 share.
Even though they're worth less now.
Yes. More commonly in financial markets, especially for large institutions, rather than actual physical delivery of shares, the parties might simply cash settle the difference.
Cash settle. How does that work?
In this case, Amy would pay you the 5,000 difference, because 30 minus 25 is €5 per share loss for her, times 1,000 shares, that's €5,000. She pays you because the shares she was supposed to deliver are now worth less than the agreed price.
So you just exchange the difference in value in cash.
Exactly.
Yeah.
This arrangement effectively transfers the price risk from Amy the seller to you the buyer.
Okay. So forward contracts are like this.
Yes. Key examples of these firm commitments include forward contracts, like Amy's example, futures contracts, which are similar but traded on exchanges, and swaps. In all these, both parties are unequivocally obligated to perform their part of the deal.
Right. Firm commitment means obligation for both.
Correct.
Now, the other major type of derivative is called a contingent claim.
Contingent claim. Sounds different.
It is. To understand this, think of it like holding a special pass or a ticket for a movie. You have the right to watch that movie.
Okay, I have that.
But you don't have to go if you change your mind or if, a more interesting plan comes up. You've paid a small amount for this right, but you are not obligated to exercise it.
So it's a choice, not an obligation.
Exactly. The prime example of a contingent claim in the world of derivatives is an option.
Options.
With an option, one party, the buyer of the option, has the crucial choice or right to proceed with the transaction or not.
The buyer has the choice. What about the seller?
The other party, the seller of the option, is obligated to fulfill the contract if the buyer chooses to exercise their right.
So the seller must act if the buyer wants them to.
Correct. The buyer holds the power of choice.
So, to reiterate this crucial distinction, my dear students, with a firm commitment, both sides are obligated to perform no matter what. It's a definite mutual promise.
Both must act.
But with a contingent claim, specifically an option, one side, the buyer, has an option or a right to perform, but critically, not an obligation. They have flexibility.
Right, or choice, not obligation.
And a key feature of options is that the buyer pays a premium, a small, non-refundable fee for acquiring this right.
You pay for the choice, like buying the movie ticket itself.
Exactly. This premium is influenced by many factors, such as how volatile the underlying asset is, the time remaining till the option expires, and the strike price.
Strike price? What's that?
That's the agreed-upon price at which the asset can be bought or sold if the option is exercised. Its relation to the current market price is very important.
Okay. And there are different kinds of options.
Yes, for instance, a call option gives you the right to buy the underlying assets. A put option gives you the right to sell the underlying asset. Each serves different purposes, for managing risk or for speculation.
Right to buy, right to sell. Got it. Okay, class. If you must complete a transaction in the future, like repaying your education loan on a specific date, or maybe submitting your university assignment by a strict deadline,
An obligation you can't avoid.
is that situation more like a firm commitment or a contingent claim?
Think about the choice involved, or lack thereof.
Pauses briefly. Indeed, it's very much like a firm commitment because you are undeniably obligated to repay or to submit. There is no choice involved there. You have correctly understood the difference.
Excellent distinction.
Now, every financial contract, and derivatives are no exception, involves different key players and uses specific terms.
Yes, the language of finance.
In any derivative contract, you will frequently hear the term counterparties. This is simply the financial world's way of referring to the other legal entity, the other person or company on the opposite side of your contract.
The other party in the deal.
Exactly. So if you enter a derivative agreement, the entity with whom you are directly dealing is your counterparty.
Simple enough. My counterparty is the one on the other side. What else?
Every contract also has a defined maturity or expiration date.
Maturity. Okay.
This is simply the final date when the transaction is scheduled to close or settle. Think of it like a fixed date you have set for a major family event, perhaps a wedding.
Ah, like saving for a wedding.
Exactly.
Hmm.
By which you need to have all the funds ready. That fixed future date is your maturity date.
Makes sense. A deadline for the contract.
We also frequently discuss the contract size or notional principal or notional amount. This is a very important concept.
Notional principle. Sounds theoretical.
It kind of is. It isn't necessarily the actual amount of cash you exchange, but rather the theoretical value upon which the payments or calculations in the derivative contract are based.
Okay, so it's used for calculations, not necessarily exchanged.
Right. And what's truly powerful about this is that it allows you to create large exposures to an underlying asset with a relatively small cash outlay or initial investment.
Ah, this sounds like the leverage we mentioned earlier.
Precisely. This is the essence of leverage in derivatives. It's akin to putting down a relatively small initial deposit for a very expensive item, say a new tractor for your farm or a large piece of machinery for your business.
You control the big item with just a little money up front.
Exactly.
Hmm.
You effectively control the potential gains or losses associated with the big item with just a little money up front, thereby amplifying your potential returns.
But, and this is crucial, it also amplifies potential losses, right?
Absolutely crucial to remember that. While leverage can magnify profits, it can also significantly magnify losses if the market moves against your position. Understanding this amplified risk is paramount.
So, handle leverage with great care.
What do we call the other person or company on the other side of a derivative contract, the one you are directly engaging with?
That term for the other side?
Pauses briefly. That's right, they are your counterparty. You're certainly grasping these key terms. Very good.
What do I call?
We have already talked about how derivatives are incredibly useful for hedging, which, as we discussed, is crucial for managing risk in businesses and investments.
Yes, the protection aspect.
But, my dear students, derivatives offer other, even deeper benefits, too. They're not just for protection.
Indeed, James. What's truly insightful here is that derivatives can be remarkably effective tools for portfolio diversification.
Diversification, spreading your investments around.
Exactly. This simply means spreading your investment risk across different types of assets or markets, rather than putting all your financial eggs in one basket, as the saying goes.
Okay, how do derivatives help with that?
Well, they assist with this because they allow you to gain exposure to various assets or broad market movements without the logistical complexities or high costs of buying the underlying assets directly.
Right, easier than buying everything individually.
Another significant advantage is that they typically have lower transaction costs compared to purchasing the actual underlying asset in the spot market.
Cheaper to trade.
Generally, yes. Also, they can be more liquid, meaning they are generally easier to buy or sell quickly in the market without significantly impacting their price.
More liquid. Easier to get in and out of the position.
Correct. Imagine you, as an investor, want to gain exposure to the overall performance of the large Indian stock market, specifically the Nifty 50 index.
Okay, tracking the top 50 companies.
If you attempted to do this directly in the spot market, you would theoretically have to buy individual shares of all 50 companies that make up that index.
That would be a lot of work. And expensive.
It would involve numerous separate transactions, multiple brokerage fees, and considerable time and effort. Quite expensive and cumbersome.
So what's the derivative alternative?
Instead, you could simply use a derivative on the Nifty 50, like a Nifty futures contract. It's much simpler, significantly more cost-effective, and far quicker to gain that broad market exposure.
One contract instead of 50 trades. Much easier.
Much easier. Furthermore, derivatives facilitate price discovery.
Price discovery, finding the true price.
Yes, the process by which buyers and sellers collectively determine the true market price of an asset. Futures prices, for example, reflect the collective expectations of thousands of market participants about future supply and demand, providing valuable forward-looking information.
So they help tell us what the market thinks prices will do.
In a way, yes. They incorporate expectations about the future.
Okay. Can derivatives help an investor spread their risk across different types of investments, and what is that benefit commonly called? Think about ensuring you don't have all your money tied to just one type of asset.
That's spreading of risk.
Pauses briefly. Yes, they absolutely can, and it's called portfolio diversification. Excellent understanding.
Very well put.
What can derivatives be based on? The underlyings in detail.
Okay, so far we know that derivatives get their value from an underlying asset.
Yes, that connection is key.
But what kind of things can actually serve as these underlying assets? Let's explore some of the most common categories.
Right. What forms can the underlying take?
One very widely used underlying is equities, which, as we know, simply refers to stocks or shares of companies.
Shares in companies. Okay.
Derivatives can be based on an individual stock, such as shares of a major Indian company like Infosys, or on a basket of stocks, or even on an entire stock index like the FTSE 100 in the UK, or our very own highly influential Nifty 50 here in India.
Individual stocks, groups of stocks, or the whole index. Got it.
What's particularly insightful here is the pervasive use of options on individual stocks.
Options on stocks are very common, yes. You know how companies are always keen to motivate their employees to perform exceptionally well and contribute directly to the company's success.
Right, they want employees invested in the company's future.
Exactly. Many companies, especially larger, well-established ones, frequently offer stock options as a significant part of employee compensation packages.
Employee stock options, right?
These options grant employees the right, remember our contingent claim concept, to buy a specific number of company shares at a fixed, predetermined price known as the strike price at some point in the future.
So they can buy shares later at today's agreed price.
Correct. If the company performs well and its stock price rises above that strike price, these options become very valuable for the employees.
Because they can buy cheap and the shares are worth more.
Precisely. Providing them a direct financial incentive for stronger corporate performance and aligning their interests with those of the shareholders. It's a smart way for companies to conserve cash compensation initially while still rewarding future success.
Makes sense. It ties employee reward to company success. Are there other similar things?
Yes. Beyond employee incentives, companies also issue warrants. These are quite similar to options. They also give the holder the right to purchase shares at a fixed price in the future.
Like options, but not just for employees.
Right. They are often issued directly to the public, perhaps as part of a larger financing deal, or sometimes granted to employees too, but they function as a long-term option to acquire shares directly from the company itself.
Okay, warrants are another type of equity derivative. Class. Why might a company choose to give stock options to its employees instead of just offering them a higher salary? What's the strategic benefit for the company in doing this?
Why use options for compensation?
Pauses briefly. That's absolutely right. It's primarily to provide strong incentives for them to work towards achieving stronger corporate performance and, consequently, higher stock prices. It makes employees feel like they have a direct stake in the company's growth, like true partners.
Well explained.
Beyond stocks, fixed income instruments like bonds are another incredibly widely used underlying asset for derivatives.
Bonds, okay. Debt instruments.
And interest rates themselves, while not tangible physical assets, are a hugely important underlying for a vast array of derivatives, especially for businesses and governments looking to manage their borrowing and lending costs.
Absolutely. Interest rate risk is massive. What's truly remarkable is how many derivatives, including forwards, futures, and especially options, are commonly based on interest rates.
So you can have a derivative based just on where interest rates go.
Yes, and interest rate swaps are a prominent example of a firm commitment derivative, meaning both parties are mutually obligated.
Interest rate swaps,
Yeah.
swapping interest payments.
Essentially, yes. Let's consider a common business scenario. Imagine you own a growing manufacturing business, and you've taken a large loan to expand your factory. Your loan has a floating interest rate.
Meaning the rate changes periodically?
Right, the rate you pay changes every few months based on market conditions, perhaps linked to a benchmark like the repo rate here in India. While this might be cheaper initially, it makes your monthly payments unpredictable.
Yeah, hard to budget if your loan payment keeps changing.
Exactly. As a business owner, you want stability. You desire a steady, predictable payment each month, a fixed interest rate to help with your budgeting and financial planning.
So how does a swap help?
An interest rate swap allows you to effectively convert your floating rate exposure to a fixed rate exposure, or vice versa, without actually renegotiating your original loan agreement with the bank.
Oh, so you don't change the loan, you just add the swap contract.
Correct. You simply exchange interest payments with another party, typically a financial institution. You agree to pay them a fixed rate, and they agree to pay you the floating rate that you owe on your loan. Effectively, you've swapped your variable payment stream for a fixed one.
Ah, clever. So your net payment becomes fixed.
Precisely. Or you could do the opposite if you preferred floating. It's an incredibly powerful tool for managing financial risk and achieving certainty in cash flows.
Very useful for businesses. Now, you mentioned benchmarks, like LIBOR.
Yes, you might have heard about LIBOR rates in the news. These were historically globally significant survey-based benchmark rates used for setting prices on trillions of dollars worth of financial products.
Survey-based, not actual trades.
Largely, yes. And due to concerns about their reliability and potential for manipulation, they are now being phased out.
Replaced by what?
They're being replaced by risk-free rates, RFRs, based on actual transparent market transactions. For example, the Secured Overnight Financing Rate, SOFR, is now widely used in the U.S.
SOFR in the U.S.
And the Euro Short-Term Rate, EUROSTR, in Europe. Think of them like different standard measuring scales used in different regions, ensuring fairness, accuracy, and transparency in financial dealings.
Like having a reliable measuring tape instead of just guessing.
Exactly. The shift from LIBOR to RFRs represents a significant regulatory push for greater market integrity.
Good to know. Class, what is an interest rate swap typically used for by companies, particularly when they have a floating rate loan? What's their primary goal in entering such a swap?
What are they trying to achieve?
Pause briefly. Indeed, it's often used to convert from a floating interest rate exposure to a fixed interest rate exposure, or the other way around. It helps companies achieve much-needed predictability in their debt payments. Very well understood.
Spot on.
Okay, next up. Currencies. For anyone involved in international business or even just planning a family trip abroad, currency risk is a very significant factor.
Oh yes, exchange rates fluctuate constantly.
The value of one country's currency against another's can change dramatically and unexpectedly, directly affecting your costs or profits. Because of this inherent volatility, derivatives are extremely frequently used to hedge or strategically manage this currency risk.
What's truly fascinating here is the practical, real-world application of currency derivatives. Let's consider a UK-based company that imports handcrafted textiles from India.
Okay, UK buyer, Indian seller.
This UK company sells its finished goods in British pounds, GBP in the UK, but it has to pay its Indian supplier in Indian rupees, INR.
Right, they earn pounds but pay rupees.
If, before they have to pay their supplier in 3 months, the Indian rupee suddenly strengthens significantly against the British pound.
Meaning 1 pound buys fewer rupees.
Exactly. Then the UK company will end up losing money because those rupees will now cost them many more pounds than they initially planned.
Yeah, their costs just went up unexpectedly.
So, to protect against this precise scenario, they might enter a forward contract today to buy a specific amount of Indian rupees at a fixed exchange rate in the future, say in 3 months, perfectly matching their payment date.
A forward contract again, but for currency this time.
Yes, this offsets the risk of unfavorable changes in the exchange rate. It provides certainty, ensuring they know exactly how many pounds they will need to pay for their rupees, precisely matching the terms of their import contract.
So they lock in the exchange rate now for the future payment.
Exactly. This is a very practical and common use of currency derivatives in global trade and finance, offering stability in an otherwise volatile global economy.
Very practical indeed. Class, if an importer in India needs to pay in US dollars in, say, 3 months for some goods they've bought, and they are worried the US dollar might get much more expensive against the Indian rupee by then.
A common worry for importers.
What kind of derivative might help them manage this risk? What contract can lock in a future exchange rate for them?
What tool provides that certainty?
Pauses briefly. Excellent. A forward contract to buy US dollars at a fixed rate in the future. That's exactly right. It gives them price certainty and eliminates the currency fluctuation risk.
Perfect.
Next, let's turn our attention to commodities. These are raw materials, the basic building blocks of countless products we use every single day.
Like oil, gold, wheat.
Exactly. Ranging from crude oil for fuel to gold for jewelry, or agricultural products like wheat and sugar for our food. We generally categorize them into 2 broad types: soft commodities, which are typically agricultural products or livestock, like corn, sugar, or coffee,
Things that are grown or raised.
and hard commodities, which are natural resources extracted from the earth, such as crude oil, gold, silver, or aluminum.
Things that are mined or extracted, okay.
It's vital to understand that while cash markets for commodities often involve the physical delivery of these goods, for example, if you buy rice in the spot market, you get physical rice.
Right, you got the actual stuff.
Commodity derivatives are widely used to manage the price risk of these commodities without having to take physical delivery. This is a crucial distinction.
Ah, so you don't end up with barrels of oil in your office.
Exactly. For instance, let's consider an airline. One of their largest and most unpredictable running costs is often jet fuel, which, as you know, is derived directly from crude oil.
Yes, fuel is a huge expense for airlines.
If crude oil prices suddenly surge, the airline's operating expenses will increase dramatically, severely impacting their profits.
It's a big problem for them.
So, to manage this risk, the airline might purchase oil futures contracts. This doesn't mean they're arranging to take physical delivery of thousands of barrels of oil at their airport.
Definitely not practical.
Rather, it's a financial contract that helps them offset the impact of rising fuel costs. It's very much like trying to fix your household electricity bill rate to avoid future shocks to your monthly budget, even if you don't actually own a power plant.
Ah, like fixing your electricity price. That makes sense. You're locking in a cost financially, not taking delivery of electricity generators.
Precisely. It's about financial stability. What's truly innovative here, class, is how derivatives are constantly adapting to global megatrends, such as the rapid adoption of electric vehicles.
EVs, yes, big changes happening there.
With the massive surge in EV production, the demand for rare earth metals like lithium is increasing exponentially.
Lithium for batteries, right.
Recognizing this, the London Metal Exchange, LME, a major global market for industrial metals, actually introduced a lithium futures contract in 2021.
Futures on lithium, interesting.
This contract is cash settled, meaning no physical lithium is exchanged. You won't receive a bag of lithium at your doorstep.
Okay, cash settled again, just the financial difference.
Instead, the value of the contract is based on the weekly spot price of battery-grade lithium. This remarkable adaptability highlights just how flexible and innovative derivatives are, continually evolving to meet new economic needs and risks in dynamic markets.
Fascinating how they adapt. Building on that, an important concept in commodity derivatives is contango and backwardation.
Contango and backwardation, what are those?
Contango is when the futures price of a commodity is higher than the current spot price. This often reflects costs like storage or financing the commodity until the future delivery date.
So, future price spot price equals contango.
Okay, backwardation is the opposite, where the futures price is lower than the spot price. This can happen due to high immediate demand for the commodity, making the spot price really high relative to future expectations.
Future price spot price equals backwardation.
Got it.
High current demand.
Understanding these pricing structures is crucial for traders and hedgers as they reflect market expectations about supply, demand, and costs, influencing trading strategies far beyond just simple price risk management.
So the relationship between spot and future prices tells a story.
Okay.
If an airline buys oil futures contracts, are they typically planning to take physical delivery of enormous quantities of oil, or are they usually using it for a different primary purpose?
What's the main goal for the airline?
Pauses briefly. That's absolutely right. They are usually using it to manage price risk and hedge against rising fuel costs, not to take physical delivery of the commodity itself. They are interested in the financial outcome, not the physical barrels.
Exactly. Financial hedging.
Beyond the more common underlyings we've discussed, derivatives can also be based on credit risk.
Credit risk, the risk of someone not paying back debt.
Precisely. This might sound a bit intricate, but let's simplify it. For example, a credit default swap, or CDS.
CDS, heard of those. Often in the news during crises.
Yes. A CDS allows an investor or even a bank to manage the risk of loss if a specific borrower defaults on their loan or bond. It's essentially like an insurance policy against someone not paying back their debt.
Insurance on a bond or loan defaulting.
The value of a CDS is based on a spread, specifically the annual percentage payment, usually expressed in basis points, that the protection buyer pays to the protection seller.
So the cost of the insurance reflects the risk.
Exactly. A wider spread indicates that the market perceives a higher risk of the reference entity defaulting on its debt. So you can gain or reduce exposure to the credit quality of an issuer entirely separately from directly trading the actual bond itself.
Allows very specific risk management.
Very granular. And surprisingly, my dear students, derivatives can be based on even more unusual and innovative things.
Even more unusual, like
Our study sources mention weather.
weather derivatives. How does that work?
Maybe hedging against a very cold winter for an energy company or a very dry season for a farmer. Also, cryptocurrencies like Bitcoin.
Ah, crypto derivatives are becoming big now.
And even longevity, which refers to how long people live.
Longevity. Seriously, why?
Well, for large insurance companies or pension plans, longevity risk is critically important. If people live much longer than expected, these companies have to pay out pensions or life insurance benefits for a significantly longer period than they had originally planned, impacting their financial stability.
Ah, so they can hedge against people living longer than expected. That's quite something.
It is. While these types of derivatives are less common and often more complex to price, they powerfully highlight the vast adaptability and innovative nature of these financial instruments to address an incredibly wide range of unique, real-world risks across various industries.
Truly shows their flexibility.
Class, what specific kind of risk does a credit default swap primarily help financial intermediaries like banks manage? What exact risk are they aiming to protect against with a CDS?
What's the core risk covered by a CDS?
Pauses briefly. Precisely. It helps manage the default risk of an issuer. That's the risk that a borrower will fail to repay their loan or bond. Very good.
Excellent.
Where do derivatives trade?
The markets.
Okay, now that we have a solid understanding of what derivatives are and the diverse range of things they can be based on,
We know the what and the why.
the very natural next question that arises is, where do these powerful financial contracts actually trade?
Right.
Where does the buying and selling happen? Right? The marketplace. There are two primary types of markets where these instruments are bought and sold.
Two main types, okay?
The first and often the oldest is called the over-the-counter or OTC market.
Over the counter, OTC.
What's truly insightful here is to think about the OTC market in this way. Imagine you have a very special occasion coming up, perhaps a grand family wedding or a significant festival, and you want a bespoke, one-of-a-kind outfit.
Okay, something unique, made just for me.
You wouldn't just walk into a ready-made clothing store, would you? No, you'd go to your trusted local tailor. You describe precisely what you want, the exact fabric, the unique design, the perfect fit.
Every detail customized.
Everything is custom-made just for you, according to your specific measurements and preferences. This is precisely like the OTC market for derivatives.
Ah, so OTC means customized contracts.
Exactly. Contracts in this market are initiated directly between derivatives end users, which could be large corporations, institutions, or even individual investors, like our Kirana shopkeeper from earlier.
The ones who need the specific derivative.
And financial intermediaries, typically big banks or specialized investment firms who act as dealers.
So it's a direct negotiation between two parties.
Yes, the absolute key feature here is customization and flexibility. You can tailor the contract to perfectly match your specific, unique needs, even if those needs are highly non-standard.
Sounds great. Are there downsides?
There are trade-offs. Generally, OTC contracts tend to have less transparency, meaning the specific details of the individual trades are not publicly known.
Less visibility for the wider market.
And they carry more counterparty risk. You rely directly on that one tailor, or in this case, your specific counterparty, to deliver. If they run into financial trouble and can't fulfill their side of the deal, you have a direct problem.
Right, the risk that the other side defaults.
Precisely. This means you bear the credit risk of your specific counterparty. Furthermore, OTC contracts may be less liquid.
Less liquid. Harder sell if I want out.
Yes, it can be harder to quickly find another buyer or seller if you wish to exit your custom-made contract before its maturity. It's not a standard product everyone wants.
Okay, so flexibility comes with less transparency, more counterparty risk, and potentially less liquidity.
That's the trade-off, generally speaking.
Class, if a company needs a derivative contract that must be specially designed and perfectly customized for their unique financial situation, perhaps to match a very specific payment schedule for a complex business loan, which market would they most likely go to? The OTC market or the ETD market?
Where do you go for custom-made?
Pauses briefly. You've got it. They would likely go to the OTC market for that high degree of customization. That's where you find bespoke, tailor-made financial solutions. Very good.
Exactly right.
The second major type of market is the exchange-traded derivative, or ETD market.
ETD, exchange-traded.
These markets are much more formal, organized, and standardized. Think of well-established, organized exchanges like the National Stock Exchange, NSE, right here in India, where you buy and sell stocks and futures.
NSE.
Or the Chicago Board Options Exchange, CBOE, in the US, which specializes in options. These are central marketplaces.
Okay, so like going to a big department store instead of a tailor.
That's a great analogy. Building on our clothing analogy, imagine you go to a large, well-known retail chain, a big store like Shoppers Stop or Westside. You want to buy a shirt.
Okay, ready-made shirt.
You pick a ready-made shirt from the rack. It comes in standardized sizes, small, medium, large, extra large. The price is clearly displayed, and it's incredibly easy to buy or sell or even exchange if it doesn't fit. This is exactly like the ETD market.
Standard sizes, clear prices, easy to buy and sell.
Precisely. Contracts traded here are rigorously standardized. Terms like the exact contract size, the specific type of underlying asset, and the maturity date are all preset and dictated by the exchange itself, not negotiated between individual parties.
So everyone trades the exact same contract type.
Yes, because they are so standardized, they offer significantly more liquidity, meaning you can buy and sell them very easily and quickly without much impact on the price.
Easier to get in and out, unlike the custom OTC contract.
And greater transparency, as all information on transactions, prices, and volumes is publicly available and visible to all participants.
Everyone sees the prices and trades.
They also typically have lower trading and transaction costs because everything is streamlined and automated by the exchange.
Efficiency leads to lower costs. Makes sense. What about counterparty risk?
That's a crucial difference. To mitigate counterparty credit risk, the risk that the other side might not fulfill their promise exchanges employ a vital mechanism. They require collateral or a margin deposit from both parties.
Margin, like a security deposit.
Exactly. Required right at the beginning of the trade and often adjusted daily throughout its life based on price movements. This acts like a financial safety net, ensuring both parties can meet their obligations because the exchange holds these funds.
So the exchange itself reduces the counterparty risk.
Yes, significantly. The exchange effectively guarantees the performance of the contracts traded on it.
Big advantage for ETDs.
Class, which type of derivative market is specifically known for its highly standardized contracts and much greater transparency, making it easier for a large number of participants to trade frequently?
Standardized and transparent.
Pauses briefly. That would be the exchange-traded derivative or ETD market. You are grasping these differences brilliantly.
Very well done.
Now let's talk about a very important development in derivative markets, especially the OTC market.
Okay, what happened?
After the global financial crisis of 2008, global regulators realized that the counterparty risk in the vast and often opaque OTC markets was a really significant problem.
Yes, the crisis highlighted that risk dramatically. If one big player failed.
It could trigger a dangerous chain reaction, threatening the entire financial system, because everyone was interconnected through these OTC contracts without a central safety net.
A domino effect.
So, in response, regulators introduced something absolutely vital to make the system much safer: central clearing.
Central clearing.
Yeah.
What does that involve?
What's truly insightful here is the transformative role of the central counterparty, or CCP.
CCP, central
Yeah.
counterparty. Okay.
Under central clearing, for many types of previously bilateral OTC trades, a CCP now steps in between the two original parties.
So a middleman.
A very important middleman. Imagine, my dear students, that you and your friend want to exchange something valuable, but perhaps you both don't fully trust each other to follow through perfectly on the promise.
A trust issue between the two parties.
A trusted third party, like a very reliable bank or a dedicated financial institution, steps in the middle. You give your item to this trusted bank, your friend gives their item to the bank, and the bank ensures both exchanges happen smoothly and securely.
The trusted intermediary guarantees the exchange.
The CCP does exactly this for many derivative trades. It effectively assumes the credit risk from both sides.
It takes on the risk that one party might default.
Yes. This profound process is called novation. Through novation, the original bilateral contract between Party A and Party B is legally extinguished.
The original contract disappears.
Yes, and in its place, two entirely new independent contracts are instantly created. One between Party A and the CCP, and another between Party B and the CCP.
So A deals with the CCP and B deals with the CCP. They don't deal directly anymore.
Exactly. This legal substitution is absolutely fundamental because it means each original counterparty is now exposed solely to the CCP's creditworthiness, not each other's. This dramatically simplifies risk management for individual participants.
You only need to worry about the CCP's stability, not your original counterparties.
Right. The CCP provides crucial clearing and settlement services, ensuring all transactions are verified and all payments are made correctly and on time. This significantly reduces individual counterparty risk for participants.
Makes the OTC market much safer for those trades that are centrally cleared. Are there any downsides?
Well, it's important to acknowledge that while CCPs reduce individual risk, they do, by their nature, concentrate systemic risk within themselves.
Meaning if the CCP itself failed, it would be a huge problem.
Potentially, yes. It could impact a vast number of market participants simultaneously. This is why regulators now impose extremely stringent capital requirements, rigorous stress tests, and robust recovery plans on CCPs. They are very heavily regulated to prevent failure.
Balancing the reduction of individual risk with ensuring the overall stability of the CCP.
Exactly. It's a constant balancing act. Okay, class, what is the single most important role of a central counterparty, CCP, in a derivative transaction, especially concerning financial risk? What specific risk do they take on behalf of the market participants?
What key risk does the CCP manage?
Pauses briefly. Precisely. The main role is to assume the counterparty credit risk from both sides, thereby providing a vital safety net for the entire market. This makes the system much more secure and resilient.
Well summarized.
Let's look at two quick real-world scenarios from your study materials to bring these market choices to life and help you understand when which market is most appropriate.
Okay, applying the concepts.
Remember, Heightus Capital, the investment fund that believed healthcare stocks would significantly outperform the broader market. They purchased an option on a stock index.
An index option, right, standard product.
This type of trade, because it's based on a standardized contract with preset terms and conditions, would most likely be traded on an ETD market, such as the CBOE mentioned in the source material. It's a ready-made, efficient solution for their specific investment view.
Standardized index option ETD market. Makes sense. What about the other examples?
Now, consider Esther Inc., the company we discussed earlier, with a floating rate loan that wanted to fix its interest expense to gain budgetary certainty.
Yes, the interest rate swap example.
They entered into an interest rate swap. This swap was tailored specifically to perfectly match the exact payment dates and the remaining maturity of their original unique loan.
Highly customized to their specific loan.
Because of this high degree of customization, it had to fit their precise, unique loan terms. It would undoubtedly be traded in the OTC market.
Custom swap is OTC market. Clear.
And even though it's an OTC contract, it would still very likely go through central clearing with a CCP, as regulatory requirements increasingly mandate for many standard types of OTC derivatives like interest rate swaps.
So OTC traded, but centrally cleared for safety.
Exactly. Similarly, for Montau AG, a German company that needed to hedge its currency risk for an export deal with Korea, which involved payments in Korean won.
The currency hedging example.
An OTC forward contract was the most appropriate choice due to its specific customization to match their exact payment date and amount.
Custom currency forward, OTC.
These examples vividly illustrate that choosing between ETD and OTC markets is all about matching the financial tool to your specific need. Standardization for general, broad market exposure, or customization for unique, tailor-made situations.
Fit the market to the specific need.
Class, if a derivative contract needs to perfectly match a company's specific loan payment dates and remaining maturity, making it a very unique and precise instrument, would it be better suited for an ETD market or an OTC market?
Unique and precise. Where do you go?
Pauses briefly. Indeed. It would be far better suited for the OTC market because of the crucial need for customization. You are truly thinking like a keen financial analyst now.
Excellent application.
Outro.
Wow. We have truly covered an extensive amount of ground today, haven't we?
We certainly have. A real deep dive into the world of derivatives.
From defining what financial derivatives are, to patiently understanding their basic features like firm commitments and contingent claims.
The obligations versus the rights.
And then meticulously exploring the diverse range of things they can be based on whether it's stocks, interest rates, currencies, or commodities.
So many different underlyings.
We also distinguish between the highly customized OTC market and the standardized ETD market.
Tailor-made versus ready-made.
And finally, we learned how central counterparties play a vital role in making these markets safer for everyone. We aim to take it step by step, using relatable examples from our daily lives here in India. That's absolutely right, James. Our primary aim today was to simplify these often complex financial concepts for all of you. using familiar, everyday examples so that you can build a truly strong and intuitive foundation.
And hopefully we achieve that.
Remember, financial knowledge is not just about memorizing facts. It is incredibly powerful when it is understood clearly, applied practically, and used with wisdom.
Well said.
It's not exclusively for large institutions or professional traders. A solid understanding can genuinely help anyone manage risks and identify opportunities, whether in personal finance or broader business contexts.
Absolutely. And here's where it gets really interesting, my dear students.
Yeah.
So the next time you encounter financial news, perhaps related to global trade imbalances or a major company's quarterly earnings, or even just the price fluctuations of gold or oil,
Things you hear about every day.
I hope you'll pause for a moment. You might then look a little deeper and begin to see how derivatives might be quietly yet powerfully at work behind the scenes.
Hmm. Helping to manage risks, or perhaps even creating vast opportunities that you might not have recognized before.
Exactly. What new possibilities does this deeper understanding of these sophisticated financial tools unlock for you in your future studies, or even in managing your own finances and investments? Something to think about.
Keep exploring, keep learning, and keep asking questions. There is always more to discover in the dynamic world of finance, and with this deep dive, you are now well on your way to being truly well-informed and confident in your financial understanding.
Thank you so much for joining us on the deep dive today. We genuinely hope this session was both helpful and engaging for all of you.
We hope you found it valuable.
Until next time, keep diligently digging for knowledge. Namaste, dear students, and a very warm welcome to the deep dive. I'm James.
And I'm Jennifer. Welcome, everyone.
Our mission here, as always, is really to help you, cut through all the information overload out there and get straight to the heart of important topics. Think of us as your personal guides, helping you navigate these, sometimes complex subjects with a bit more ease and clarity. Today, we're embarking on a truly crucial journey into the world of financial derivatives.
Yes.
Now, I know for many of you, especially those of you just starting your CFA journey, maybe with very little or perhaps no prior finance background, these words might sound a bit intimidating.
They can, yes.
But please don't you worry at all. That's exactly why we are here sitting with you, virtually as your teachers.
Precisely. Our goal today is quite simple, really.
Yeah.
We want to demystify these complex financial instruments, make them truly relatable, and help you build a really strong, unshakable foundation. We promise to go slowly, step by step, just like we would in a classroom setting. We are here to support your learning every single step of the way, patiently answering your maybe unspoken questions as we go.
That's absolutely right. So consider us your friendly teachers for this session. I'll be your guide, bringing enthusiasm and working to make explanations simple.
And I'll provide the deep, insightful analysis, trying to connect all the dots for you.
Together, we are going to create a truly interactive and supportive learning environment right here, right now, as if we were all sitting together, maybe discussing finance over a cup of chai.
Indeed. Our journey today will take us through two main families of derivatives. First, we will explore what are called firm commitments,
Okay.
which include instruments like forwards, futures, and swaps. Then we will delve into contingent claims, where we will focus on options and credit derivatives. Finally, we will compare these two families to understand the unique characteristics. Our true mission, dear students, is to carefully extract the most important nuggets of knowledge from your CFA study materials, presenting them in a way that truly sticks with you and, makes sense.
And to make things even easier to understand, we're going to use simple, everyday Indian examples. We want you to feel completely comfortable with these concepts, almost like you're learning something new from maybe a family elder who explains things from their own life experiences.
Absolutely. So keep your minds open, listen actively, and don't hesitate to think along with us. Imagine this as your own personal finance tutorial.
Okay.
Let's begin our deep dive, shall we?
What are derivatives? The big picture.
All right, students, let's start at the very, very beginning. What exactly is a derivative? When we hear that word, it sounds a bit technical, doesn't it?
It does.
But at its core, a derivative is simply a financial instrument that derives its performance from an underlying asset, index, or other financial variable. Let's break this down slowly and carefully. Imagine a bustling cricket match is going on.
Right.
The score of that match, whether India is winning or losing or by how many runs they are ahead, that score is what we call the underlying asset or the underlying variable.
Right. A main thing.
It's the main thing, yeah, the primary event. whose value or outcome determines something else. Now, imagine you and your friend make a friendly bet, a simple agreement, where the amount you win or lose depends directly on the final cricket score. You are not playing in the match. You are not scoring the runs yourself. But the value of your agreement changes based on the match's outcome.
Okay, I see.
That agreement, whose value depends or is derived from the cricket score, that is what we mean by a derivative. It's a financial product whose value is derived from something else, that underlying. The agreement itself is not the match, but it changes value based on the match. Do you see how its value comes from something else? It's not.
Yeah.
It doesn't have a standalone value.
That's a wonderful and very clear analogy, James, and you've truly highlighted the key point, the derivation. The derivative instrument itself doesn't have inherent value in isolation. Its value is intrinsically linked to something else. Now, within this world of derivatives, your CFA material introduces us to two main families, two big categories that are fundamentally different in how they work.
Okay.
And it's based on how much commitment is involved.
Commitment, right.
The first family is called a firm commitment. Think of this as a very strong, unbreakable promise. In financial terms, it means a predetermined amount is agreed to be exchanged between counterparties at settlement.
Predetermined amount.
Yes. The most important part here, the true nugget of understanding, is that both sides of this agreement are obligated to perform their part of the deal.
Both sides. Okay.
No matter what happens to the underlying asset's price. There's no escaping this promise once you've made it. It's firm.
Okay.
Let's use an Indian example to make this very clear. Imagine two neighbors in a village, Mr. Sharma and Mr. Gupta. Mr. Sharma runs a small atta chakki, a flour mill, and he knows he'll need 100 kilograms of wheat in 3 months' time.
Right. Needs the wheat.
Exactly. And Mr. Gupta is a farmer who knows his wheat harvest will be ready around the same time. Today, they meet, shake hands, and agree on a price, say 25 per kilogram for 100 kilograms of wheat.
Okay. 25 agreed today.
Yes, agreed today. They decide that Mr. Sharma will buy the wheat from Mr. Gupta in 3 months at this 25 per kilogram price. Now, the key insight here is that both Mr. Sharma and Mr. Gupta are committed to this deal.
Both committed.
Both. If in 3 months the market price for wheat shoots up to 35, well, Mr. Gupta still must sell to Mr. Sharma at 25, even though he could get more in the market.
Oh, okay. Even if he loses out.
Exactly. And if the market price falls drastically to 15, Mr. Sharma still must buy from Mr. Gupta at 25, even though he could buy cheaper elsewhere.
So he has to pay more.
Yes. They are both firmly committed to their agreement. That's the essence of a firm commitment.
Excellent, Jennifer. That makes it so clear. The idea of must perform is very powerful here. Okay, now the second big family is quite different, you said.
Yes, quite different.
It's called a contingent claim. The word contingent itself means dependent on something else, right?
Exactly.
Here, one party has the option or the right to decide whether and when the trade will settle. It's not a mutual obligation for both parties.
Not mutual, no.
Instead, one party has a choice, while the other party is obligated to perform only if the first party chooses to exercise their right.
Okay. So one has a choice.
One has a choice. Let's go back to our wheat example with Mr. Sharma and Mr. Gupta.
Yeah.
This time, imagine Mr. Sharma, the flour mill owner, is a bit more cautious.
Okay.
He pays Mr. Gupta, the farmer, a small amount of money today. Let's say 500. In return for this 500.
Like a fee.
Exactly, like a small fee or deposit. In return, Mr. Sharma gets the right, but crucially not the obligation, to buy 100 kilograms of wheat from Mr. Gupta at 25 euro per kilogram in 3 months.
The right but not obligation. Got it.
Precisely. So what happens in 3 months? Well, if the market price of wheat goes very high, say 35 euro per kilogram, Mr. Sharma will choose to exercise his right and buy the wheat from Mr. Gupta at the agreed upon 25.
Makes sense. He saves money.
He makes a good profit, yeah. He buys at 25 and the market price is 35. But what if the market price of wheat drops drastically to 15 per kilogram? In this situation, Mr. Sharma will choose not to buy from Mr. Gupta, because he can simply buy the wheat cheaper from the open market for 15.
Right. Why pay more?
Exactly. His only loss in this scenario is the 500 he paid initially to Mr. Gupta to get that right, this right to choose, where one party pays for the flexibility and the other is obligated only if the choice is made. That's a contingent claim.
Okay.
The key nugget here is the power of choice for one party.
Choice. Okay, that's clear.
All right, students, a quick thought for you now. So if both parties in a financial agreement must perform their part, is it a firm commitment or a contingent claim? Think about Mr. Sharma and Mr. Gupta's very first agreement. The one where they shook hands on a fixed price for wheat no matter what. What was that?
Excellent thinking. That would indeed be a firm commitment because both Mr. Sharma and Mr. Gupta were obligated to that deal. Remember that key distinction. It's truly fundamental to everything else we will learn about derivatives.
Firm commitments, promises, promises.
Wonderful. Now that we understand the big picture, let's dive deeper into that first family. Firm commitments. Your CFA material explains that forwards, futures, and swaps all fall into this category.
Right. Forwards, futures, swaps.
They are all based on that strong mutual obligation we just discussed.
Okay.
These firm commitments share some common features. They always involve a specific contract size, like 100 kilograms of wheat or 100 ounces of gold.
Specific size.
They have a specific underlying, which is the asset or index whose value they derive from, like gold, oil, or an interest rate.
Got it.
There will be one or more exchanges of cash flows or the underlying on a specific future date or dates.
Okay, future date.
And critically, these exchanges are always based on a pre-agreed price. No matter what happens in the market, the price you lock in today is the price you deal at in the future.
That pre-agreed price is key.
The customized promise.
Let's start with forward contracts, our first type of firm commitment. A forward contract is often described as an over-the-counter OTC derivative. Now, what does over-the-counter mean, students? It simply means it's negotiated directly between two parties, like our Mr. Sharma and Mr. Gupta discussing wheat.
Right, like a private deal.
Exactly, a private deal, not traded on a big public exchange like the National Stock Exchange, NSE, or Bombay Stock Exchange, BSE, where thousands of people buy and sell. It's, like a handshake agreement.
Okay, OTC.
In a forward contract, these two counterparties, that's what we call the two parties involved in the agreement, agree that one, the buyer, will purchase an underlying asset from the other, the seller, in the future at a pre-agreed fixed price.
Simple enough.
Because it's a direct negotiation, forwards offer immense flexibility and customization. You can tailor the exact quantity, quality, delivery date, and even the payment terms to your very specific needs.
That sounds good.
It does, but this flexibility comes with a trade-off, and this is a key insight. Higher counterparty risk.
Counterparty risk.
Yes. This is the risk that the other party might not fulfill their promise.
Yeah.
Perhaps they go bankrupt, or maybe they just refuse to honor the deal when the time comes.
That could be a problem.
It's a real risk because there's no central body guaranteeing the trade, unlike some other derivatives we'll see.
Okay.
Let's use another Indian example to truly cement this idea. Imagine a small kirana shop owner in a bustling market. He has received a very large order for a specific rare brand of basmati rice for a grand wedding function happening in 2 months.
Okay, big wedding order.
Big order, yeah. He knows he needs exactly 500 kilograms of that specific rice. Instead of waiting and hoping the price doesn't skyrocket, he calls his regular supplier directly.
Smart move.
They agree today that the supplier will deliver 500 kilograms of that specific rice in 2 months at a price of 40 euros per kilogram. This customized direct agreement between the kirana shop owner and his supplier is a forward contract.
Makes sense. Customized.
It's flexible because they can agree on the exact type of rice and the precise delivery date. But yes, there's always that small risk. What if the supplier has trouble sourcing the rice and backs out? Or what if the shop owner finds a better deal elsewhere and tries to back out?
Right, that's the counterparty risk again.
Exactly. It's higher in these forward contracts.
That's a perfect illustration, James. It highlights the bespoke, the custom-made nature of these contracts. Now let's understand the payoff profile of a forward contract.
Payoff profile.
The term payoff profile simply describes how the contract's value changes based on the underlying asset's price at maturity. For forwards, this profile is linear and symmetric.
Linear and symmetric. What does that mean exactly?
What does that mean in simple terms? Well, imagine a seesaw. If one side goes up, the other goes down by the exact same amount, right?
Okay, yeah.
Similarly, for a forward, your gain or loss is directly proportional to the change in the underlying price. If the price goes up by 10, your profit increases by euro per unit. If it goes down by 10, your loss also increases by 10 per unit.
A straight line graph.
Exactly. It's a straight line when you plot it on a graph.
Yeah.
Symmetrical. From the buyer's perspective, if the market price of the underlying, which we call ST for spot price at time T, at the maturity date is higher than the pre-agreed forward price, F0T, the buyer benefits.
Right, they buy cheaper.
Yes, because they get to buy to something at a lower price than its current market value. Conversely, the seller benefits if the market price, ST at maturity, is lower than the pre-agreed forward price,
Yeah.
F0T.
They sell higher.
They get to sell something at a higher price than its current market value.
Hmm.
Also, very importantly, with a forward contract, the payoff equals profit because typically no upfront payment, no premium is made when you enter the contract.
No upfront cost.
Usually not. You only exchange money at settlement.
Okay.
Let's look at an example from your source material. Example 1. Forward gold purchase to illustrate a loss for the buyer. Imagine Procam Investments, an investor, agrees today to buy 100 ounces of gold at a forward price, F0T, of $1,792.13 per ounce to be settled in 3 months.
Okay. Buying gold forward.
No. At the contract's maturity, after 3 months, the actual spot price of gold, ST, in the market is $1,780.50 per ounce.
Oh, the price went down.
It went down. So, to calculate Procam's payoff, we take the spot price at maturity, ST, minus the forward price, S0T. So that's $1,780.50 minus $1,792.13.
That's negative.
Exactly. The result is $11.63 per ounce. Since Procam agreed to buy 100 ounces, their total loss is 100 multiplied by $11.63, which comes to $11,163.
So a loss of over $1,000.
Yes. Procam, as the buyer, must pay this $11,163 to the financial intermediary, who was the seller, to settle the contract.
Right.
Think of it like a jewelry shop in Mumbai that agreed to buy gold at a certain price for an upcoming wedding season. If the market price of gold falls by the time they were supposed to buy, they would be losing out on that agreement because they committed to a higher price.
Happens all the time, I suppose.
It's a common way businesses manage future costs, yes. It's also worth noting that forward contracts can be settled in 2 ways, either through cash settlement or physical delivery.
Cash or physical?
Yes. Cash settlement, as we just saw with Procam, means only the net difference in cash is exchanged. Physical delivery means the actual underlying asset, in this case the gold, is physically delivered and paid for at the agreed price. Forwards can be either, depending on what the 2 parties agree upon.
Okay, depends on the agreement. All right, dear students, a quick thought for your understanding. If you enter a forward contract to buy something, and its price in the market increases significantly by the time of maturity, do you gain or lose from that contract? Think carefully about what you agreed to.
That's right. You would indeed gain. You get to buy it at the lower pre-agreed price, and its market value is now higher, so you can buy it cheaper and maybe sell it dearer. Now, let's try another scenario, similar to question set forwards Q2 from your material.
Okay, calculation time.
Okay, let's say an investor agrees today to buy 1,000 barrels of oil at a forward price of $64 per barrel in 2 months. So the F0T is $64.
Got it. $64 forward price.
If at maturity, the actual spot oil price, ST, is $58.50 per barrel, what is the investor's total gain or loss? And is it a gain or a loss? Take a moment to calculate this in your mind.
Price went down again?
The investor, as the buyer, hoped the price would go up, but the price actually went down. So the payoff per barrel is ST minus F0T, which is $58.50 minus $64.
Which is negative $5.50.
Right, negative $5.50 per barrel. Since it's for 1,000 barrels, the total loss for the investor is 1,000 multiplied by $5.50, which is $5,500. So it's a loss of $5,500 for the investor. Well done if you got that right.
So forwards can lead to gains or losses? Depends on the market.
The standardized promise with daily settlement.
Now let's shift our focus to futures contracts. Futures contracts are, in many ways, very similar to forward contracts, but they have some crucial differences that make them incredibly popular in organized financial markets.
Key differences.
The biggest difference, a true distinguishing feature, is that futures contracts are standardized and are traded on organized exchanges.
Standardized and exchange traded.
This standardization means everyone trading a particular futures contract agrees to the exact same terms, the same contract size, the same maturity dates, the same underlying asset. There's no custom tailoring here like with forwards.
So less flexibility, maybe?
Less flexibility in terms, yes. But this shift from direct over-the-counter negotiation to exchange-traded means significantly increased liquidity. It's much easier to buy and sell futures contracts quickly, almost instantly, because there's a ready market.
Liquidity is good?
Very good.
Yeah.
And very importantly, it offers far better protection against default or counterparty risk because of the organized market, strict rules, and a central clearing facility.
Less counterparty risk, too.
Much less. Think of it this way. Imagine you're at a large supermarket. You can buy standardized food packets like biscuit packets,
Yeah.
which are all the same size, same quality, and easy for anyone to buy or sell. Those are like futures. On the other hand, the custom-made mythi you order from your local sweet shop, made just for you. That's more like a forward contract.
Nice analogy. Biscuits versus mythi.
One is uniform and easy to trade. The other is custom-made and private. The key insight here is standardization leads to liquidity and reduced risk.
That's a very helpful distinction, James. It truly emphasizes the practical difference. Now, let's discuss the most important, truly defining feature of futures contracts, the daily settlement of gains and losses, also famously known as mark-to-market, MTM.
MTM. Heard that before.
Yes, this is a critical concept for your CFA studies and a key nugget to grasp. When you trade futures, you don't deal directly with the other party. Instead, a central entity called a clearinghouse steps in.
A clearinghouse. Like a middleman.
Exactly, like a central guarantor. The clearinghouse acts as the central counterparty to every single trade, essentially guaranteeing that trades will be fulfilled. So if you're a buyer, the clearinghouse is your seller. If you're a seller, the clearinghouse is your buyer.
Okay, so they take the risk.
They manage the risk. This fundamentally eliminates that counterparty risk we worried about with forwards. Now, how do they manage it? Through MTM. At the end of each trading day, the clearinghouse determines a settlement price for all futures contracts. All contracts are then marked to market at this price.
Mark to market.
Yeah, meaning if your contract has gained value since the previous day, the clearinghouse immediately credits your account with that gain. Real money.
Oh, daily profit.
Or loss.
Uh,
If it has lost value, they immediately debit your account.
okay. Daily settlement.
To put it in very simple terms, imagine a cricket scoreboard that updates not just at the end of the match, but after every single ball bowled.
Wow, every ball.
If your team scores a boundary, your points go up immediately on the scoreboard, and those points are real money in your account. If they lose a wicket, your points go down. Futures are like that. Your gains or losses are settled daily, sometimes even intraday, in your account.
So, no big surprises at the end.
Exactly. The true nugget here is that MTM isn't just an accounting process. It's the fundamental mechanism that virtually eliminates counterparty risk in futures, making them incredibly liquid and reliable compared to forwards. It prevents large losses from accumulating and helps manage risk for all participants.
That daily settlement sounds very efficient, doesn't it? But how do they ensure people can actually pay if they have a daily loss?
Good question.
To ensure everyone can cover these daily gains or losses, when you enter a futures contract, you don't pay upfront for the entire value of the asset like buying a house. Instead, you must deposit a required minimum sum into a special account called the initial margin.
Initial margin. Okay.
This is like a security deposit you pay when you rent a house or a flat in India. You don't pay all the rent up front, but you put down a deposit to show you're serious and to cover any small damages or missed payments initially. It shows your commitment.
Right, a good faith deposit.
Exactly. The exchange also sets a maintenance margin, which is a minimum balance you must always hold in that margin account.
Maintenance margin. Okay, a minimum level.
Yes, a floor.
Yeah.
Think of it like ensuring your mobile phone balance never falls below a certain amount. Otherwise, your services might get temporarily stopped or limited until you top up. It's the floor below which your account balance should not drop.
That's an excellent comparison, James. Very relatable. Now, if your margin account balance falls below this maintenance margin because of daily losses from the MTM.
Below the floor.
Yes, below the floor. You get what's called a margin call.
Margin call. Sounds serious.
It is, well, it requires immediate action. It's essentially a polite but urgent request from the clearinghouse to immediately deposit more funds to bring your account balance back up, not just to the maintenance level, but all the way back up to the initial margin level.
Back to the starting deposit level.
Yes, back to the initial margin. It's like your electricity company calling you to say your bill payment is due, and you need to pay immediately to avoid disconnection. Or if your mobile balance drops too low, you get an SMS notification to top up immediately to continue your services. The amount you need to deposit to bring it back to the initial margin is sometimes referred to as variation margin.
A variation margin.
Got it. Let's illustrate this with a simplified example, drawing from example 2 and 3. Gold futures contract from your material. Let's say Prochem Investments buys a futures contract for 100 ounces of gold at $1,792.13 per ounce. The initial margin required to open the position is $4,950.
Okay, $4,950 initial margin.
And the maintenance margin is set slightly lower at $4,500.
$2,500 maintenance, okay.
On day 1, imagine the gold futures price increases by $5 per ounce. Prochem makes a gain of $500 on 100 ounces multiplied by $5.
Good day for Procam.
Yes, this $500 is immediately added to their margin account balance via MTM, so it goes from $4,950 up to $5,450. Since $5,450 is well above the maintenance margin of $4,500, there's no margin call. Everything is fine.
Okay.
Now, let's say on day 2, the gold futures price drops significantly by $10.88 per ounce. Procam's account loses 1,088 cents, 100 ounces, multiplied by $10.88.
Ouch. Bad day.
Bad day. Their balance falls from $5,450 down to $4,362. This $4,362 is now below the maintenance margin of $4,500.
Below the floor. Margin call time.
Exactly. Procam gets a margin call. They need to deposit funds to bring their account back up to the initial margin of $4,950. The amount needed is $4,950 minus $4,362, which means Procam must deposit $588.
So they have to add $588.
Yes, that $588 is their variation margin. This mark-to-market and margin process happens every single day until the contract matures or is closed out. It's a continuous balancing act.
It's quite dynamic, isn't it? Very different from the forward contract.
Very different.
To further manage extreme volatility, futures contracts can also have price limits or circuit breakers. What are those?
Good point. Price limits set a maximum allowable daily price change. If the price tries to move outside these limits, trading might halt temporarily to prevent sudden, uncontrolled swings.
Like speed bumps.
Sort of, yes. Think of these as traffic rules on a busy road. There's a speed limit, and if traffic gets too fast or chaotic, police might temporarily halt it or slow it down, a circuit breaker, to prevent accidents and restore order. It's about maintaining stability in the market.
Okay, safety measures.
Yes. These mechanisms are there to ensure market stability and protect all participants. Now, for the final settlement at maturity, futures contracts are conceptually similar to forwards. The final gain or loss is based on the difference between the original futures price and the underlying spot price at maturity.
Okay, similar ending calculation.
Yes, but the key difference, the true nugget here, is the timing of the cash flows due to that daily mark-to-market.
Right, the daily adjustments.
With futures, you've been settling your gains and losses day by day, while forwards typically have one large settlement at the very end. This daily settlement fundamentally alters the risk management profile. Both forwards and futures can also specify either cash settlement or physical delivery at maturity, depending on the specific contract.
Okay, so students, what would you say is the single most important difference between a forward contract and a futures contract, especially in terms of how gains and losses are settled and managed? Think about that daily scoreboard versus the final scoreboard.
Excellent. The critical difference is that futures contracts require daily settlement of gains and losses mark-to-market through the clearinghouse, which significantly reduces counterparty risk.
Right.
Whereas forward contracts are typically settled only at their maturity date and carry higher counterparty risk. That's a huge takeaway. Now, let's try one more quick check, similar to question set futures Q1.
Okay, another question.
If a futures contract buyer's margin account falls below the JA, they must immediately deposit funds to return the account balance to the JEST. What are these two blanks, students? Take a moment to recall.
Below the back up to the end.
That's right. If the account falls below the maintenance margin, they must deposit funds to return it to the initial margin. Very good. You're getting the hang of it.
A series of promises.
All right, let's move on to our third type of firm commitment, swaps.
Swaps, okay.
A swap is a fascinating financial agreement where two parties exchange a series of cash flows in the future.
A series.
Yeah.
Multiple payments.
Yes, exactly. Unlike forwards, which usually involve a single exchange, or futures, which net out daily to a final single settlement value, swaps involve multiple ongoing exchanges over a period of time. This is their unique characteristic.
Okay, ongoing exchanges.
In most common swaps, one of these cash flow streams is usually variable or floating, meaning it changes based on a market reference rate, MRR, like a fluctuating interest rate.
Floating rate.
And the other cash flow stream is usually fixed. So one party is the fixed rate payer, and that's the floating rate receiver, and the other is the floating rate payer, and that's the fixed rate receiver.
So they swap fixed for floating or vice versa.
Exactly. It's essentially trading one type of payment obligation for another. Let's use an everyday example from our Indian homes. Imagine one family pays a fixed rent for their apartment every month.
Okay, fixed payment.
But their electricity bill keeps changing based on how much electricity they use. That's a variable payment.
Agreeable, right.
A swap is like these two families agreeing to exchange these payments. Family A pays the fixed rent for Family B, and in return, Family B pays the variable electricity bill for Family A. They are essentially swapping their payment obligations to manage their cash flows differently.
Ah, I see. Swapping rent for electricity bill payments. That helps visualize the regular, ongoing exchanges beautifully, James.
Good.
Swaps share similarities with forwards in that they are firm commitments. Both parties are obligated to their series of payments.
Still a firm commitment.
Yes. Their initial value is often zero, meaning no money exchanged up front when you enter the contract. And their terms are typically negotiated directly between counterparties, making them primarily OTC instruments, just like forwards.
Okay, so often OTC like forwards.
Interest rate swaps are by far the most common type of swap you will encounter. In these, parties exchange fixed interest payments for floating interest payments.
Fixed for floating interest.
Yes. It's a powerful way for companies or financial institutions to manage their interest rate risk. For example, if a company has a loan with a floating interest rate, they might enter a swap to effectively convert their floating rate payments into fixed rate payments, bringing predictability to their costs.
Oh, managing loan risks.
Exactly. A crucial term in swaps is the notional principal. This is a large amount of money, like say 200 crore.
Big amount.
Yes, but it is used only for calculating the periodic interest payments. The actual notional principal itself is usually not exchanged between the parties. It's just a reference amount for the calculation.
So they don't actually exchange the 200 crore.
Usually not, no. The nugget here is that this allows parties to gain exposure to large amounts of an asset or interest rate movement without needing to exchange the full principal amount, which is a powerful feature for risk management. You get the economic effect without the huge cash outlay.
I see. Leverage without the principal exchange.
Precisely. Let's look at example 4. Fileton Investments swap from your source material. Imagine Fileton Investments enters a 5-year interest rate swap for GBP 200 million. That's the notional principal.
Okay, 200 million pounds.
They agree to receive a fixed rate of 2.25% semi-annually, and in return, they will pay a 6-month market reference rate, MRR.
Receive fixed, pay floating.
Exactly. Let's calculate the first exchange if the 6-month MRR is set at 1.95%. Remember, payments are semi-annual, so we need to divide the annual rates by 2.
Right, divide by 2.
First, the fixed payment Fileton receives. We take the notional principal, GBP 200 million, multiply it by the fixed rate of 0.0225, and then divide by 2 for semi-annual payments. That comes to GBP 2,250,000.
Okay, 2.25 million pounds received.
Next, the floating payment Fileton owes. We take the notional principal, GBP 200 million, multiply it by the MRR of 0.0195, and then divide by 2 for semi-annual payments.
Yeah.
That comes to GBP 1,950,000.
Okay, 1.95 million pounds owed.
Since these are exchanged, they're usually netted against each other. The net payment is GBP 2,250,000, what Fileton receives, minus GBP 1,950,000, what Fileton owes.
The difference is 300,000.
Exactly, which results in a net amount of GBP 300,000. In this case, the financial intermediary who took the other side pays Fileton GBP 300,000, and this exchange will happen every 6 months for 5 years.
Wow, okay. A series of payments.
To connect it to India, imagine a large manufacturing business in India that has taken a significant loan with a floating interest rate from a bank. If they're worried that interest rates might go up, making their loan payments unpredictable and higher.
Which can happen.
Yes, they could enter into an interest rate swap. They could agree to pay a fixed rate to another party and in return receive floating rate payments that match their loan. This effectively converts their floating rate loan into a fixed rate loan, giving them predictability in their payments, which is a big deal for financial planning.
That's a great practical application, Jennifer. Like other derivatives, the mark-to-market value of a swap, even if it started at 0, can deviate from 0 over time as market conditions, especially interest rates, change.
True.
While many swaps are OTC and rely on negotiated credit terms, centrally cleared swaps, similar to futures, with margin provisions, are also becoming more common to reduce that counterparty risk we talked about.
Yes, the market is evolving towards more clearing for swaps too.
This evolution makes swaps more secure for participants.
Indeed.
Yeah.
Now for a quick check for understanding, students, what is the key difference between a forward contract and a swap contract in terms of the number of cash flow exchanges? Think about it.
Forward versus swap. Number of payments.
Good thinking. The main difference is that forwards usually involve a single exchange of cash flows at maturity, whereas swaps involve a series of exchanges of cash flows over a period. This recurring nature is what sets swaps apart.
Multiple payments for swaps. Got it.
Contingent claims the power of choice.
All right, dear students. Now we transition to the second major family of derivatives, contingent claims. Remember our Mr. Sharma and Mr. Gupta wheat example, where Mr. Sharma paid a small amount to get the right, but not the obligation to buy wheat.
Yes, the one with the choice.
That's the core idea here. The key nugget for contingent claims is the presence of choice for one party.
Choice is key.
To reiterate, in a contingent claim, one of the counterparties has the right to determine whether a trade will settle based on how the underlying value performs. And the most common type of contingent claim that you'll encounter, and a very important one for your CFA studies, is an option contract.
Options, yes. Very common.
The right, not the obligation.
Precisely, James. Let's define options clearly. An option contract is an agreement between a buyer and a seller, and it specifies an underlying asset, a contract size, a pre-agreed exercise price, also commonly called the strike price,
Exercise price or strike price, okay.
and a maturity date. The key distinction, the central insight of options, is this. The option buyer has the right, but not the obligation to transact the trade. They get to choose whether to go through with it or not.
The power of choice again.
Exactly. Conversely, the option seller has the obligation to fulfill the transaction if the buyer chooses to exercise their right. Because the buyer has this precious choice, a crucial point is that the payoff to an option buyer is always zero or positive.
Zero or positive, never negative.
Never negative payoff for the buyer, meaning you cannot lose more than you initially put in. The buyer's maximum loss is limited to the initial upfront payment they make to get this right.
Limited loss.
This upfront payment is called the premium. The auction buyer pays this premium to the seller when the contract is initiated.
Okay, the buyer pays a premium.
Think of it very simply. It's like buying a ticket for a special cricket concert. You pay a small amount for the ticket. That's your premium.
Right, the ticket cost.
Now, if your favorite cricket star or band announces they will perform and you're excited, you choose to go and enjoy the concert. It's like exercising the option. But if your favorite artist cancels or you have other plans, you choose not to go to the concert. In that case, you only lose the ticket price, the premium you paid. You don't owe anything more.
Just lose the ticket money.
Exactly. The concert organizer who sold the ticket had the obligation to provide the concert if you chose to attend. The power of choice lies with the buyer.
That's a perfect analogy, Jennifer. It makes the right, not obligation, crystal clear.
Now let's introduce the two primary types of option contracts.
Okay.
First, we have a call option. A call option gives the buyer the right to buy an underlying asset at the pre-agreed exercise price on or before a specific maturity date.
Call is the right to buy.
Yes. A call option buyer benefits most if the underlying asset's price rises significantly above the exercise price.
Benefits from price going up. For an Indian example, imagine you believe a new biotech company in Mumbai, let's call it Binomial Limited, is about to launch a revolutionary product, and its shares are going to skyrocket. High hopes. Instead of buying the shares directly today, which requires a lot of capital, you could buy a call option on Binomial's shares. You pay a small premium for this right.
Okay, buy a call option.
If the company's shares perform very well and the market price goes up, say from 100 to 150, you can buy those shares at your lower pre-agreed exercise price. Say you're on 20 using the option.
Buy at 120 when the market is at 150.
Exactly. Then you can immediately sell them in the open market at the higher current price, 150, making a profit. This gives you exposure to the upside without committing to buying the shares up front.
Leverage again.
Yes. Now let's look at the numbers. The payoff formula for a call option at maturity, CT, is VEX 0 STX.
Max 0.
Here, ST is the spot price of the underlying at maturity, and X is the exercise price. The max 0 part simply means that if ST, the market price, is less than or equal to X, your exercise price, the payoff is 0.
Right, you wouldn't exercise then.
Why would you? Because you wouldn't exercise a call option to buy something for more than its current market value, would you? You'd simply buy it cheaper from the market. Otherwise, if ST is greater than X, the payoff is STX.
The difference.
Your total profit from a call option, however, also needs to account for the premium you paid up front. So the profit formula is paid AX0, STX C0, where C0 is the premium paid.
Profit, payoff minus premium.
Exactly. It's crucial to remember this difference between payoff, what you gain on the option itself if exercised, and profit, which includes your initial cost, the premium. Payoff is not always profit.
Very important point. Let's use example 5. Hydus Capital call option purchase from your material to see this in action step by step. Hydus Capital buys a call option on an S&P 500 healthcare index. The option premium, CODO, paid upfront is $24.85 per unit.
Okay, premium $24.85.
The exercise price X is $1,240 per unit. Let's consider two scenarios for the index's spot price at maturity.
Okay.
Two scenarios.
Yeah.
Scenario 1. What if ST is $1,280 at maturity?
Price is above the exercise price.
Yes. The spot price, $1,280, is higher than the exercise price, $1,240. So highest capital will exercise the option.
Makes sense.
The payoff is max, 0, $1,280, $1,284, which simplifies to max, $0, $40. So the payoff is $40.
Payoff $40.
Now, the profit is the payoff minus the premium. $40 payoff, $24.85 premium, $15.15.
Yeah.
So highest capital makes a profit of $15.15 per unit.
Okay, a profit after premium.
Scenario 2. What if ST is $1,220 at maturity?
Price is below the exercise price.
Correct. Here, the spot price, $1,220, is lower than the exercise price,
Okay.
$1,240. So highest capital will not exercise the option because they can buy the index cheaper in the market. They let the option expire worthless.
Let it expire.
The payoff is max, 0, $1,220, $220, which simplifies to max, $0, $20. Since you can't have a negative payoff from an option buyer's perspective, the payoff is $0.
Payoff is 0.
Now, the profit is the payoff minus the premium. $0 payoff, $24.85. Premium equals $24.85. In this case, highest capital's entire loss is just the premium they paid.
Loss limited to the premium.
Exactly. Do you see how the loss is limited to the premium? This is a key benefit for the option buyer.
That's very clear. Okay, to give it an Indian touch and connect it to your practice questions, let's consider a call option on the Nifty Y50 index. Imagine Nifty 50 is at INR 15,200 today.
Okay, Nifty 15,200.
And you buy a call option with an exercise price of INR 16,000 for a premium of INR 1,500.
Exercise 16,000, premium 1,500.
Got it. Now, if Nifty goes to INR 16,500 just before maturity, calculate your payoff and profit.
Okay, ST is 6,500, X is 16,000.
Your payoff would be max 0, 16,500, 16,000, which equals max 0, INR 500. So the payoff is INR 500.
Positive payoff.
Yes, but now your profit is the payoff minus the premium. INR 500 payoff, INR 1,500 premium equals INR 1,000.
Still loss overall.
Exactly. So even with a positive payoff on the option, you can still have an overall loss from the transaction due to the premium paid. This is a very important point for your CFA exams. Don't forget the premium.
Crucial point. Premium matters.
The second primary option type is a put option. A put option gives the buyer the right to sell an underlying asset at a pre-agreed exercise price on or before a specific maturity date.
Put is the right to sell.
Yes. A put option buyer benefits most when the underlying price falls below the exercise price.
Benefits from price going down. Opposite of a call.
Correct. For our Indian example, imagine you own a valuable plot of land and you're worried its value might fall significantly due to some new government regulations or market changes.
Worrying about land prices falling.
Yes. You could buy a put option on this land. You pay a small premium for this right. If the land's value falls drastically, say from 50 lakh to 30 lakh,
Big drop.
you can still sell it at the higher pre-agreed exercise price, UA 45 lakh, using your put option. This acts like an insurance policy, protecting you from a big loss. You're insuring yourself against a price drop.
Like insurance. That's a great example of the protective nature of put options.
Right.
The payoff formula for a put option at maturity, PT, is max 0 XST.
X minus ST this time.
Yeah, the order is reversed. Here, if the exercise price X is greater than the spot price ST, meaning the underlying price has fallen, you exercise the option and sell at the higher X. Otherwise, if ST is greater than X, the payoff is 0 because you wouldn't sell for less than the market price.
Makes sense.
And similar to calls, the profit formula for a put option buyer is AAM, X0, XST, P00, where P0 is the premium paid for the put. Again, remember to subtract that upfront premium to get the true profit or loss.
Always subtract the premium for profit.
Always. Now, let's briefly consider the seller's perspective for both call and put options. We focused on the buyer so far.
Okay, the other side.
The call seller, also called the writer, receives the premium upfront. Their maximum gain from the option is this premium, which they keep if the option is not exercised.
Max gain is the premium.
Yes. However, they face potentially unlimited downside risk, because if the underlying price rises very, very high, they're obligated to sell the asset at the lower exercise price, potentially incurring a very large loss.
Unlimited risk for call seller. Wow.
Potentially, yes. The put seller also receives the premium up front. Their maximum gain is also this premium. For the put seller, however, the loss is limited, which is an important insight.
But put seller loss is limited. Why?
Why? Because the underlying asset's price cannot fall below 0, can it?
Right. Price can't be negative.
Exactly. So their maximum loss occurs if the underlying price drops all the way to 0. In that scenario, they're obligated to buy it at the exercise price, X. They effectively buy it for X, and it's worth 0. Their loss is X minus the premium they received.
Okay, limited but still potentially large loss.
Correct. This brings us to an important nugget about the one-sided nature of counterparty credit risk for contingent claims.
One-sided risk.
Yes. Once the option buyer pays the premium, the option seller has no credit exposure to the buyer. The buyer has fulfilled their financial obligation by paying the premium.
Buyer paid, so seller is safe from buyer default.
Right. However, the option buyer does face the counterparty credit risk of the option seller. If the option buyer exercises the option and the seller defaults on their obligation, meaning they can't deliver the shares or can't buy the shares as promised,
Oh.
the buyer loses out. This is a crucial difference from futures, where the clearinghouse guarantees both sides. Here, the buyer relies on the seller's creditworthiness.
So buyer takes seller's credit risk. Important point.
Very important.
It's a very important distinction, Jennifer. Just briefly, options also have different styles. European options can only be exercised exactly at their maturity date.
Only at the end.
American options can be exercised anytime until their maturity date or at maturity.
Anytime.
Okay. Just remember, these names, European and American, don't refer to geography. They simply describe when the option can be exercised.
Got it. Not about location.
And finally, a quick mention. The value of an option before maturity has two parts: intrinsic value and time value.
Intrinsic and time value.
Intrinsic value is the in-the-money part, how much profit you'd make if you exercised right now. For example, for a call, if the spot price is greater than the exercise price, the difference is intrinsic value.
Okay, the immediate exercise value.
Time value is the extra value the option has because there's still time left. Time for the underlying price to move favorably, giving the option a chance to become even more profitable.
Value of time remaining.
Exactly. This time value declines, it decays as the option gets closer to maturity, eventually becoming 0 right at maturity.
Time decay. Okay. All right, students, a simple check for understanding here. For a call option buyer, if the underlying price at maturity is less than the exercise price, will they exercise the option or let it expire worthless? And what will be their profit or loss in that situation? Think about what we just discussed.
ST less than X for a call buyer.
Excellent. They will absolutely let it expire worthless because it's not profitable to exercise. And their profit or loss will be a loss equal to the premium paid. They've just lost the initial cost of their ticket.
Lost the premium. Okay,
Whatever.
very good. You're really thinking like option traders now. Let's try another one. Similar to question set options Q2. A put option seller receives a $5 premium for a put option with an exercise price of $30.
Okay, selling a put. Premium $5, strike $30.
What is the seller's maximum profit and maximum loss under this contract? Take a moment to think about it from the seller's perspective.
Seller's max profit. Seller's max loss.
Okay, for the seller, the maximum profit is always the premium they received if the option expires worthless, which happens if the price goes up or stays above $30. So the maximum profit is $5.
Right. Keep the premium.
Now, for the maximum loss, a put option seller loses if the underlying price falls. The worst case scenario is if the underlying price drops all the way to 0. In that scenario, the seller is obligated to buy the asset for $30, which is now worthless. Their loss would be $30 what they pay minus the $5 premium they receive. So the maximum loss is $25. Did you get that, students? Fantastic job.
Max loss is strike minus premium for a put seller.
Good.
3.2 credit derivatives. Insuring against default. Let's move on to another very important type of contingent claim. Credit derivatives, specifically credit default swaps, CDS.
CDS. Heard a lot about these.
Yes, they became quite famous. Or infamous, maybe. These contracts are a bit different from options on stocks or commodities because they are based on a credit underlying. This means their value depends on the default risk of a debt issuer, like a company or a government that has borrowed money.
Risk of someone not paying back debt.
Exactly. A CDS allows an investor to manage the risk of loss from an issuer defaulting separately from actually holding the bond itself.
Manage risk without owning the bond. How?
Think of it like this. Imagine you've lent some money to a friend for their business. You're worried your friend's business might default on the loan, but maybe you don't want to ask for the money back just yet.
Okay.
So you go to an insurance company, who would be a CDS seller,
Mm-hmm.
and pay them a regular premium. If your friend's business defaults on the loan, the insurance company pays you, covering your potential loss or concern.
Like buying insurance on someone else's loan.
Essentially, yes. You don't own the loan to your friend through this arrangement, but you're protected against their default. That's essentially what a CDS does. It allows you to buy insurance against someone defaulting on their debt.
That's a very relatable example, Jennifer. In a CDS contract, there are two main roles, just like in an insurance policy.
Two sides, yes.
The credit protection buyer. This party pays a periodic fixed CDS spread, which is like the premium for the insurance, to the seller. They are the ones seeking protection against default, much like buying an insurance policy.
Buyer pays for protection.
Exactly. They essentially benefit if the credit quality of the underlying issuer worsens, meaning the company becomes more likely to default. We say they are short credit risk because they profit from deterioration in credit.
Short risk.
The credit protection seller. This party receives those periodic payments, the CDS spread. In return, they are assuming the risk of loss from a potential default. Their position is similar to holding or being long risk in the underlying bond itself.
Seller takes on the risk.
Meaning they benefit if the credit quality of the issuer improves or stays stable. They are essentially betting that the company will not default.
Long risk. Got it.
What triggers a payment from the seller to the buyer? It's called a credit event.
Credit it.
This is a predefined event, such as the issuer going bankrupt, failing to pay their obligations, or undergoing a major debt restructuring. When a credit event occurs, the contract terminates, and the seller pays the buyer a contingent payment. This payment is typically equal to the loss given default, LGD, multiplied by the notional amount of the swap.
LGD times notional.
Yes, for our Indian listeners, LGD refers to the percentage of the loan amount that is actually lost by the lenders if a company defaults. For example, if a company defaults on a 100 crore loan and only 30 crore is recovered, the LGD is 70% or S&E crore. The nugget here is that CDS allows you to isolate and trade just the credit risk itself.
Isolate the credit risk. Interesting. Exactly. So referring to Exhibit 11, CDS contract with credit migration and credit event from your source. Imagine the protection buyer pays a fixed spread, say 100 basis points BPS per annum.
Okay, 1% per year.
If the issuer's credit spread widens in the market, meaning the market perceives the issuer as riskier, example, it goes from 100 BPs to 250 BPs, the buyer's CDS contract gains mark-to-market value because they are paying a lower fixed spread while the market spread for that risk is higher.
Gains value if risk increases.
Yes. However, the real trigger for the large payment is the credit event itself. If the issuer defaults, the contract ends, and the seller pays the buyer a payment equal to the LGD percentage multiplied by the notional amount. It's a very powerful risk transfer mechanism for specific credit exposures.
Okay. All right, dear students, a simple check for understanding about CDS contracts.
Oh.
Who pays whom in a CDS contract normally during the life of the contract, and who pays whom if a company actually defaults? Take a moment to remember.
Who pays regularly? Who pays on default?
Very good. Normally, the buyer pays the seller regularly. That's the spread or premium like your insurance payments. But if a company defaults, the credit event happens, the seller pays the buyer a contingent payment based on the loss given default. Excellent work.
Well done.
Comparing the cousins. Firm commitments versus contingent claims.
Wow, okay. Now that we've explored both families of derivatives in detail, let's bring them together and compare them. We've seen forwards, futures, and swaps are firm commitments.
The obligations.
And options and credit default, swaps are contingent claims.
The choices.
Let's recap the fundamental difference, the very core distinction that ties everything together. A firm commitment means there's a definite, unbreakable obligation for both parties to perform under the contract. Remember Mr. Sharma and Mr. Gupta's first wheat deal? Both had to do it.
Yes, obligatory.
Whereas a contingent claim gives a right to one party, the buyer, with the other party, the seller, having an obligation only if that right is exercised. Remember Mr. Sharma buying the right to buy wheat.
The choice.
That's the key. One is a binding promise for both. The other offers a choice to one.
That's the perfect summary, James. And this fundamental difference leads to distinct payoff profiles, which is a key nugget for your understanding.
Payoff profiles again.
Firm commitments, forwards, futures, swaps. These have a linear payoff profile. What does linear mean again? It means the gain or loss for the holder of the contract is directly proportional to the change in the underlying asset's price.
Straight line.
Exactly. Imagine our seesaw again. If the underlying goes up by 10, your profit goes up by a consistent euro per unit. If it goes down by 10, your loss also changes by a consistent euro per unit. It's a straight line when you plot your profit loss against the underlying price. The risk and reward are perfectly symmetrical.
Symmetric risk-reward.
Contingent claims, options, and some aspects of credit derivatives. These have a nonlinear or asymmetric payoff profile. This is the true power and insight of options.
Nonlinear or asymmetric?
Yes. For an option buyer, as we discussed, their payoff is limited on one side. Their maximum loss is just the premium paid, but their potential gain is theoretically unlimited for a call option or very large for a put option.
Limited loss, large potential gain.
Right. When you plot this, it doesn't look like a straight line. It often looks like a hockey stick or a curved shape. This shows that the risk and reward are not symmetrically distributed. You pay a small amount for the chance of a large gain, with your downside strictly limited.
It's a hockey stick shape. I remember that.
Let's look at Exhibit 12. Long forward and long call option payoff profiles from your source to visually compare this key insight. Both a long forward position and a long call option position benefit from an increase in the underlying price. But notice how their profit curves are different.
Okay, comparing forward and call payoffs.
The forward profit is a straight diagonal line showing that symmetrical risk and reward. For the call option, the profit line starts flat at the maximum loss, the premium paid, and then only starts rising once the underlying price goes above the exercise price plus the premium.
Right, flat then up.
The call option gives you protection on the downside. Your loss is limited to the premium, but you pay a premium for that safety and to get that hockey stick-shaped payoff. This is why someone would choose an option to limit their potential loss while still participating in potential gains.
Pay for protection.
Exactly. Similarly, Exhibit 13, long forward and short put option payoff profile shows another comparison. A short put option, meaning you sold a put, also benefits from a rise in the underlying price similar to a long forward.
Okay, forward versus short put.
However, the profit for the short put seller is limited to the premium received regardless of how high the price goes. This contrasts with the potentially unlimited profit potential for the long forward position as the price keeps rising.
Short put profit is capped at the premium.
Correct. So the choices you make in derivatives always depend on your market view and, critically, your risk tolerance. Do you want symmetrical risk and reward, or do you want to pay for limited downside, or maybe cap your upside for a premium?
Lots of choices depending on your goals.
Absolutely, Jennifer. And that brings us to real-world application, which is what your CFA exam is all about. These concepts are not just theory, they are tools for real financial decisions. Let's use the practice problems involving Binomial Limited, a Mumbai-based biotech company, to see how these derivatives are used.
Okay, practical examples.
Question 1 scenario. The Viswan Family Office, VFO, owns 10,000 Binomial shares. They are worried about a potential price decline for tax reasons, but cannot sell the shares for 6 months. The question is, which derivative is best suited to reduce exposure to a decline in Binomial's stock price in the next 6 months? Your options are a short put, a long call, or a short futures position.
Own shares, worried about price drop, can't sell, need protection.
The correct answer here is C, a short futures position. Why? Because a short futures position is a firm commitment that offsets the long position in the shares directly at a pre-agreed price.
Offsets directly. If VFO owns shares, a long position, selling futures means they agree to sell those shares in the future at a set price. If the share price falls in the market, they lose value on their actual shares, but they gain on the short futures position because they agreed to sell at a higher price. This provides a very precise and exact hedge.
Locks in the price.
Exactly. A short put, option A, means selling the right to sell, which doesn't protect them. A long call, option B, would benefit from a price increase, not a decline, so it's not suitable for reducing downside exposure. This is a classic hedging scenario where the firm commitment of a futures contract offers certainty.
Okay, futures for precise hedging here. That makes sense. Now let's consider question 2 scenario. VFO's market strategist believes that Binomial's share price will rise over the next 6 months, but they also want to protect against a decline.
So bullish but cautious.
Exactly. Which derivative position is best suited for VFO to manage its existing Binomial exposure based on this view? The options are a long put, a short call, or a long futures position.
Wants upside, but protection downside.
Here, the correct answer is A, a long put position. Why? Because a long put option grants VFO the right to sell their shares at a pre-agreed exercise price if the price falls.
The insurance policy again.
Yes. It offers valuable downside protection, like an insurance policy, while still allowing them to fully benefit from any upside price movement in the shares they own. If the share price rises, they simply let the put option expire worthless, losing only the premium they paid. But their shares appreciate nicely.
Best of both worlds, kind of.
In a way, yes. Neither a short call, which caps upside, nor a long futures position, which locks in a price, removing upside potential beyond that, would provide the specific type of downside protection while allowing for full upside participation. This truly illustrates the flexibility of contingent claims for asymmetrical risk management. You pay a small amount, the premium, to limit your risk, but keep the upside.
Great example of using options. Excellent point, Jennifer. And now for a bit of a trickier one. Question 3 scenario. Assume that Binomial shares rise significantly over the next 6 months. Which statement about VFO's derivative strategies, a forward sale versus purchasing the right to sell, a long put, is most accurate in terms of profitability?
Okay, price went up a lot. Forward sale versus long put. Which is better?
The answer is C. We do not have enough information to determine whether a forward sale or the right to sell Binomial shares will be more profitable in 6 months.
Not enough info. Why?
Because, as your source highlights, the profitability depends on specific calculations. With a forward sale, if shares rise significantly, VFO would actually make a loss on the forward because they committed to selling their shares at a lower pre-agreed forward price, while the market price is now much higher.
Right, loss on the forward if price goes up.
With a long put, if shares rise significantly, the option will expire worthless, and VFO's loss is limited to the premium they paid up front.
Loss is just the put premium.
So whether the loss on the forward F0TST is greater or less than the put premium paid, P0, depends entirely on the exact prices and premium involved. We can't say which is more profitable without those numbers.
Depends on the numbers, how much the price rose, what the forward price was, what the put premium was.
Exactly. So, you see, choosing the best derivative always depends on the exact market conditions and your precise objectives. There's no single best answer without the specific numbers. It requires analysis.
Very important insight, James. It's not always a straightforward answer, which is why understanding the nuances and doing your calculations is key. Now, one final check for understanding. Students, if you want to benefit from a decrease in the underlying price, and you specifically want to use a contingent claim, meaning you want the power of choice, would you consider buying a call option or a put option?
Benefit from price decrease using an option.
That's right. You would absolutely consider buying a put option. A put option gives you the right to sell at a higher price if the market price falls, allowing you to profit from the decline. Fantastic work, everyone.
It's really good. Outro. Wow, what a journey we've had today. We started by defining what derivatives are, those fascinating financial instruments whose value is derived from something else. We then delved deep into the two main families. Firm commitments, like forwards, futures, and swaps, where both parties are obligated. And contingent claims, such as options and credit default swaps, where one party has the precious right to choose.
The choices.
Yeah.
Indeed, James. We've seen how these instruments, despite their initial complexity, are incredibly valuable tools for risk management, allowing businesses and investors to hedge against adverse price movements or even speculate on market trends.
Right.
Understanding the basics of these instruments, from their distinct payoff profiles, linear versus nonlinear, to how margins work, is absolutely crucial for your CFA journey. It's the strong foundation upon which all more advanced concepts are built.
We truly hope this deep dive has helped clarify these foundational concepts for you, dear students. Please don't worry if it doesn't all click instantly. Finance, like any deep subject, is a journey of continuous learning.
It takes time.
It does. Revisit the material, practice with examples, and don't be afraid to think through the scenarios yourselves. Every question you ask yourself, every calculation you try, strengthens your understanding piece by piece. Be patient with yourselves.
Absolutely. And to leave you with a thought to ponder, dear students. We saw today that both firm commitments like forwards and contingent claims like options can give you exposure to an underlying asset. But if you had to choose between a firm commitment or a contingent claim to manage a specific risk in your own family business,
Personal choice.
which one would you lean towards and why? Think deeply about the difference between the obligation versus the right and the premium you pay versus the fixed commitment you make. What trade-offs would you be willing to make for your own business? This will help you understand their real-world implications.
That's a wonderful thought to carry forward and maybe discuss with your own families. Thank you so much for joining us on the deep dive today. We hope this session has been insightful and valuable for your CFA preparation. Until next time, keep learning, keep growing.
Excellent. Bahut Aik. Keep learning, keep growing. Namaste. Welcome, everyone, to the deep dive. We're really glad you could join us today. We're diving into a topic that often sounds a bit complicated in finance: derivatives. Now, I know that word might seem intimidating, maybe a little scary, but please don't worry. Our aim today is to, break it down, make it simple, step by step, like building with blocks. This deep dive is really for you, especially if you're preparing for your CFA exams and maybe, just maybe, you don't have a finance background. That's perfectly all right. Our mission is simple: to build a really strong foundation for you. We'll look at the basic ideas, the benefits, the risks too. We must talk about the risks and how these things called derivatives are used every day. And please, there's no need to rush. We will go slowly, using simple examples you can relate to.
That's right. And our plan for today is quite clear. First, we'll try to really understand, what derivatives are, what is their basic nature. Then we'll explore why they're so useful in finance. What problems do they solve? After that, very importantly, we have to discuss the risks involved, because every financial tool, especially powerful ones, has challenges. We need to be aware. And finally, we'll see how different people, different entities, we call them issuers and investors, actually use these derivatives in their daily financial life. So listen carefully, think along with us, and maybe ask yourself little questions as we go, just to check your understanding. Is it clear?
Okay, so let's start right at the beginning. What exactly is a derivative? At its heart, it's actually quite simple. A derivative is just a financial contract. The key thing is, its value is derived from something else. It depends on an underlying asset, or maybe an index. Think of it like this: an everyday example. Imagine there's a big cricket match coming up next month, a very important one, maybe India playing Australia. Now, you don't buy the match itself, do you? No, you buy a ticket, or maybe you make a booking. The value of your booking, your ticket, well, that depends entirely on the cricket match, doesn't it? If it's the final, your ticket might become very valuable. People might even offer you more money for it. Your booking isn't the match, but its value comes from the match. It's derived from it. Similarly, in finance, derivatives let people handle exposure that could be a risk they want to avoid, or maybe an opportunity they want to capture related to an asset like gold or shares, without actually having to buy or sell that asset right now in the cash market. So let me ask you this, my dear students. If you buy a contract today and its value goes up or down only because the price of gold changes, what would you call that contract? Are you buying actual gold, or is it something else, a derivative perhaps?
Exactly. That's the core idea. And you mentioned the cash market. Let's just quickly clarify that. Think about when you go to your local sabzi mandi, the vegetable market. You want to buy, say, 10 kilograms of potatoes. You pay the money, you take the potatoes home immediately. That's a direct transaction. That's the cash market. Simple, immediate exchange. Now, derivatives are different. They offer flexibility. Imagine you run a small kirana shop, a local grocery store. You know you'll need those 10 kilograms of potatoes in, say, 2 months. But you're worried. What if the price of potatoes shoots up by then? Instead of buying the potatoes now and finding space to store them, which is a hassle, right? You could make an agreement with your supplier today. You might pay a small fee, maybe, to agree on a price for those potatoes to be delivered and paid for in 2 months. Whatever happens to the market price then, your price is fixed. That agreement, that contract to buy later at a fixed price, that's acting like a derivative. You're not handling the potatoes now, just managing the future price risk.
So here's a thought. If you, as a shopkeeper, can fix the price for the rice you need next month without actually buying and storing all that rice today, are you using the cash market, or are you using something like a derivative?
That Kirana shop example makes it very clear. It shows the practical side. So, okay, let's dig deeper into why these derivatives are so widely used. What are the main benefits? Well, one of the biggest ones is managing and transferring risk. This is really key. Derivatives give people the power to control or shift financial risks without actually trading the underlying thing itself. This is super helpful when there's a timing difference. What do we mean by timing difference? It's simply when a business decision is made today, but the actual transaction, the buying or selling in the cash market, will happen much later, weeks or even months later. Let me give you a proper example. Imagine a German company. Let's call them Montau AG. They make specialized machines. They've just signed a big contract. They will deliver a machine to a company in Korea, Jun Inc., for 650 million Korean won KRW. Big money. But here's the catch. Jun Inc. will only pay them after 75 days. Now, Montau AG, being a German company, has its costs, salaries, materials, everything in euros, EUR. So they will receive KRW, but they need EUR. See the problem? What happens if, during those 75 days, the Korean won becomes weaker compared to the euro? When Montauk converts the KRW payment back to EUR, they might get far fewer euros than they expected. This could wipe out their profit or even cause a loss. This uncertainty is what we call foreign exchange risk, or FX risk. It's a common headache for international businesses. So how can derivatives help Montauk AG? Well, they can use something called an FX forward contract. They can enter this contract today. It allows them to agree on a fixed exchange rate to sell their expected KRW and buy EUR exactly 75 days from now. By doing this, they lock in the rate. Boom. The uncertainty is gone. They know exactly how many euros they will get. The risk of loss from a weaker one is eliminated. It's a bit like, a family planning a big wedding in India next year. They know they need lots of specific flowers. But flower prices can jump up unexpectedly, right? To avoid that risk, they could sign a contract now with a flower supplier, fixing the price for the flowers they need next year. That contract acts like a derivative, giving them price certainty. So thinking about Montauk AG again, why did they use that FX forward? Was it mainly to make their profit stable and predictable, or were they trying to, make a bet on the currency? What do you think?
That's a perfect illustration, really. Managing risk, creating stability, that's a core function. Now let's look at another major benefit, price discovery. It's quite interesting, actually. Derivative prices often act like clues, giving us hints about where the prices in the underlying cash market might be heading in the future. We call this the price discovery function. Think about the Indian stock market. Every morning before the main market opens in Mumbai, many traders and analysts are keenly watching the prices of Nifty futures or Sensex futures. These are derivative contracts based on our main stock indices. If the Nifty futures price is up significantly before the market opens, it often suggests that the actual stock market, the cash market, is likely to open higher too. It gives a sense of the market's mood. Similarly, analysts watch things like interest rate futures. These can give clues about whether the Reserve Bank of India, the RBI, might increase or decrease interest rates at its next meeting. The futures prices reflect the collective expectation of the market. And sometimes this price discovery can be incredibly dramatic. Remember April 2020, during the first big COVID lockdowns. The price of a major type of crude oil futures, contract West Texas Intermediate, or WTI, actually went negative. Yes, negative, for the first time ever. It meant sellers were literally paying buyers to take the oil away. How could that happen? Well, global demand for oil had just collapsed because the economy shut down. But oil production couldn't stop instantly. So storage tanks, especially at a major hub in the U.S. called Cushing, Oklahoma, were completely full, overflowing. Refineries didn't want the physical oil delivered because they had nowhere to put it. That extreme negative futures price was a shocking signal. It screams that there was a massive problem in the physical oil market, no demand, no storage. It forced producers worldwide to cut production very, very quickly, a very powerful signal. So let's think, if the price of futures contracts for electricity units suddenly went very high, what might that tell us about the expected supply or demand for electricity in the coming months? What could it signal?
Wow, that negative oil price story really drives home how derivatives can reflect underlying realities, sometimes brutally. Okay, let's move to the third key benefit. Operational advantages. This means derivatives can often make financial transactions, simpler, easier to execute, more liquid, and very importantly require less money up front compared to trading directly in the cash market. Think about simplicity first. Let's say you want to bet on the price of gold going up. If you buy actual physical gold, you immediately have headaches, don't you? How to transport it safely, how to insure it, where to store it securely. It's a lot of physical hassle. But if you use gold futures, a derivative, you're just dealing with the price. No physical gold to worry about. Much simpler operationally. Then there's liquidity. Derivative markets are often very liquid. This just means it's easy to buy or sell quickly without your trade causing a big price jump or fall. Why are they often more liquid? Well, partly because you need less capital to trade them compared to the underlying asset. Which brings us to the big one. Load upfront cash. Let's use an example company, say Procam Investments. Imagine Procam wants exposure to the price of 100 ounces of gold. Option A is the cash market. They can buy 100 ounces of gold directly right now. If gold costs, say, USD 1,770 per ounce, that's USD 177,000 they need to pay up front, that's a huge amount of cash to tie up. Now, option B is the futures market. Procam could instead buy a gold futures contract representing 100 ounces of gold. To do this, they might only need to deposit an initial margin, maybe something like a USD 4,950. Look at the difference. USD 4,950 versus USD 177,000. It's a tiny fraction of the cost. This means ProCam can get exposure to the gold price. They benefit if it goes up, they lose if it goes down, with much, much less cash tied up initially. It's a bit like booking a train ticket here in India. You pay a small booking amount now that's like your margin to reserve your seat for the future journey. You don't pay the full fare right away. And one more point here. Taking short positions. That means setting things up so you profit if the price falls. Doing this in the cash market can be complicated, sometimes expensive. Derivatives make it much, much easier to bet on prices going down. So let me ask you, if you wanted exposure to the gold price, but you didn't want the hassle of storing physical gold, and you didn't want to pay the full USD 177,000 upfront, which would you prefer? Actual gold or that gold futures contract?
That capital efficiency point is really significant, isn't it? And it connects directly to our fourth benefit, market efficiency. Because derivatives are flexible, often cheaper to trade and require less capital, they actually help make financial markets work better. They help ensure that prices reflect the true fundamental value of assets more quickly. You see, if an asset's price in the cash market gets out of line, maybe a stock becomes too expensive or too cheap compared to what the company is actually worth. Derivatives offered a lower-cost way for smart investors to step in and correct that mispricing. Because it takes less capital to use derivatives and transaction costs are often lower, these corrections can happen faster and more easily than if everyone had to trade only in the more cumbersome cash market. So in a way, the existence of active derivative markets helps keep the underlying cash markets more honest and efficient. Prices adjust more quickly to new information. So how exactly do derivatives help lower the cost and increase the speed of correcting mispricings in the market?
Okay, so we've heard a lot about the good things, the benefits. Managing risk, price discovery, operational ease, market efficiency sounds great. But, and this is a very big but, especially for you preparing for your exams, we must understand the risks. Derivatives are powerful tools, and powerful tools can be dangerous if not handled correctly. The first major risk is high implicit leverage. We just talked about lower upfront cash as a benefit, right? That small margin deposit. Well, that's the source of this risk, too. It's a double-edged sword. Because you put down only a small amount initially, even small changes in the price of the underlying asset can lead to very large percentage gains, or crucially, very large percentage losses compared to your initial investment. Let's go back to ProChem Investments and their gold futures contract. Remember, they put down about USD 4,950 as margin for exposure worth around USD 177,000, or maybe a bit more based on the futures price, say USD 179,213. Now, imagine the gold price moves down by just a little bit. Let's say minus 0.649% from the futures price they entered at. A drop of live 0.649% on USD 179,213 is about USD 1,163. If we add their small financing cost, maybe USD 61.88, their total loss is around USD 1,224.88. Now, here's the leverage part. That loss of USD 1,224.88 is huge compared to the initial financing cost of roughly USD 62 they used to get the position. It's almost 20 times bigger. A tiny downward move in gold caused a massive percentage loss relative to the capital effectively risked up front in the derivative. That's the magnification effect. Small underlying price moves can blow up into huge percentage changes in your derivative position's value, both gains and losses. It's like betting on a cricket match. You put down maybe 100 rupees, but the outcome depends on the whole match, worth maybe lakhs in total excitement or stakes. If your team loses, even by one run, your 100 rupees might be completely gone. Huge percentage loss on your small bet. Now, to control this, there are safeguards. Exchanges use marking to market, daily settling gains and losses every day, and they use margin calls. If your position loses money and your margin account drops too low, they demand more cash from you immediately. And collateral is often involved too. These are meant to prevent defaults. But the underlying leverage is still there. So why is this implicit leverage considered such a big risk, even though it could also lead to big gains?
That amplification is key to understanding the risk. And that leads us to the next potential downside, lack of transparency. The thing is, some derivatives can be really complex, especially when they're bundled together or structured in intricate ways. This complexity can make it very difficult for everyone involved, even sometimes experienced managers, to fully understand the true risks hidden within a portfolio. A good example is something called structured notes. We mentioned them briefly. These are products often sold by banks. They typically combine a basic debt instrument, like a bond, with one or more derivatives embedded inside. They can be very complicated, often come with high fees, might be difficult to sell if you need your money back early, that's low liquidity, and it's not always clear exactly how they work or what risks you're taking. It's a bit like buying one of those fancy mixed sweet boxes, Mitai Kadava for Diwali. It looks nice on the outside, but do you know exactly what's inside each piece? What ingredients, what combination? You might get a pleasant surprise, or you might find something you really don't like. So, why might one of these structured notes be less transparent, harder to understand, than a simple standard derivative contract, like a future or an option?
That myth-eye box analogy is quite apt, isn't it? You don't always know what you're getting. Okay, risk number 3, basis risk. Basis risk happens when the derivative you're using to hedge, to protect yourself, doesn't perfectly match the actual thing you're trying to protect. There's a mismatch. Because of this mismatch, the price of your derivative might not move exactly in line with the price of your underlying exposure. So your hedge might not work perfectly. It might leave you partially exposed. For instance, let's say you have a portfolio of shares in several specific Indian IT companies. You're worried about the whole market going down, so you decide to hedge using a derivative based on the broad Nifty 50 index. But what if there's some bad news that specifically affects the IT sector? Your IT shares might fall sharply, but the Nifty 50 index, which includes banks, energy companies, etc., might not fall as much or might even stay flat. In this case, your Nifty 50 derivative hedge wouldn't fully protect you against the losses on your specific IT shares. That gap, that imperfect protection, is basis risk. So think about this. If you try to protect yourself against rising wheat prices by using a derivative based on the price of rice, what kind of risk are you likely facing?
Yes, that mismatch is the core of basis risk. Very important. Now let's talk about liquidity risk. This risk pops up when there's a mismatch in the timing of cash flows, specifically between the cash needed for your derivative position and the cash flow from the underlying transaction you are managing or hedging. We talked about daily settlement in futures markets, right? Where gains and losses are paid out every single day. This is where liquidity risk can bite. Imagine you've used futures to hedge a large payment you expect to receive in 3 months. Now, if the futures market moves sharply against your position today, you'll have a loss on the futures contract. The exchange won't wait 3 months for your expected payment to arrive. No, they will issue a margin call today, demanding you deposit more cash immediately to cover that futures loss. If you don't have that cash readily available, maybe your main funds are tied up or the payment you hedged is delayed, you might be forced to close out your futures position at a loss. You face a cash crunch. Even if your overall hedge strategy was sound for the long term, it's like, imagine you're building a house. You have to pay your workers every week. That's the daily settlement. But you're expecting a big payment from the person buying the house only when it's finished in, say, 2 months. That's your underlying transaction. If that final payment gets delayed for some reason, but you still have to pay the workers this week, you have a liquidity problem. You need cash now, even though you expect money later. So how can those daily margin calls in futures markets create liquidity risk for someone using them to hedge?
That house building example makes the timing mismatch very clear. Okay, next risk, counterparty credit risk. This is a fundamental risk in almost any financial deal. It's simply the risk that the other side, the person or institution you made the deal with, will fail to meet their obligations. They might go bankrupt or just refuse to pay or deliver what they promised. Now, the level of this risk depends quite a bit on the type of derivative and, very importantly, where you trade it. Let's compare. First, think about buying a call option. You pay a premium up front. After you've paid that, you generally don't owe the seller anything more. Your risk is mainly that the option expires worthless. The counterparty risk you face is from the seller. Will they deliver the shares or cash if you exercise the option? But the seller faces almost no credit risk from you once they have your premium. Now compare that to a forward contract, say, to buy currency in 75 days like Montauk AG. Here, both sides have obligations in the future. The buyer must buy, the seller must sell. So both the buyer and the seller face counterparty credit risk from each other. Each side worries that the other side will be able and willing to fulfill the contract later on. Now, where you trade makes a huge difference to this risk. If you trade exchange-traded derivatives, like futures on the NSE or BSE here in India, the exchange itself steps into the middle. It acts as a central counterparty, or CCP. This massively reduces counterparty risk. The exchange guarantees a trade to both sides. They have strict rules like daily settlement and margin requirements to ensure everyone can meet their obligations. It's like having a very strong referee ensuring fair play, and that promises are kept. But if you trade over-the-counter OTC derivatives, these are private deals made directly between two parties. The terms are customized, there's no central exchange guarantee. Therefore, the counterparty credit risk is generally much higher in OTC deals. You really need to trust the specific institution you are dealing with. So why is the risk of the other side defaulting generally much lower for futures traded on an exchange compared to a private OTC agreement?
That explanation of the CCP's role is vital. Okay, the final risk we'll discuss today is broader. Systemic risk.
This isn't just about one contract or one company failing. Systemic risk is the danger that the failure of one or more large institutions, or widespread problems in a particular market segment, often amplified by derivatives and leverage, could trigger a cascading series of failures throughout the entire financial system, like dominoes falling. History gives us stark warnings. The 2008 global financial crisis is a prime example. The complex interplay of mortgage-backed securities and related derivatives, like credit default swaps, played a significant role in amplifying losses and spreading panic across global markets, leading to the failure or near failure of major financial institutions. It showed just how interconnected everything is and how problems fueled by derivatives in one area can threaten the stability of the whole system. Because of events like 2008, financial regulators around the world are now extremely focused on monitoring and controlling systemic risk. They've introduced major reforms.
One key reform is mandating central clearing for many types of derivatives, like swaps, that used to trade only OTC. Forcing them onto exchanges with CCPs reduces counterparty risk and makes the system more transparent and resilient. So how does the widespread use of derivatives, especially with high leverage by many large players, contribute to this dangerous systemic risk for the entire financial market?
Right, we've defined derivatives, seen their benefits, and carefully considered the risks. Now, let's look at who actually uses these instruments and how they use them. We can broadly group users into two categories: issuers and investors. Let's start with issuers. Who are issuers? Generally, these are companies that are not primarily in the finance business. Think manufacturers, service providers, maybe airlines or exporters, companies making things or selling services. Their main goal when using derivatives is usually to offset or hedge risks that arise naturally from their core business operations or their financing activities. They want to reduce the ups and downs of volatility in their earnings, their assets, their liabilities. They seek stability. Let's bring back Montaut AG, our German machine maker selling to Korea. Remember their problem. They were getting paid in Korean won but needed euros. They faced FX risk. Without hedging, their profit margin would bounce around unpredictably based on the KR-weir exchange rate. Very stressful for planning and reporting. But by using that FX forward contract, the derivative, they locked in the exchange rate and achieved a stable profit margin of 11%. Predictable. Stable. This perfectly shows how issuers use derivatives to protect their bottom line, their earnings, from market volatility. Like that potato chip company using derivatives to fix potato prices ensures their profits aren't wildly swinging just because of potato market fluctuations. Now, related to this, there's a very important accounting concept for issuers: hedge accounting. Companies generally want to show smooth, predictable earnings to their investors. They don't like big, unexpected jumps or falls in reported profits. Hedge accounting provides special rules that allow companies to match the timing of gains or losses from their hedging derivative with the gains or losses from the underlying item they are hedging. This helps smooth out the reported earnings in their financial statements. How does it work, roughly? Often, the gain or loss on the derivative isn't immediately put into the main profit and loss statement. It might be held temporarily in a separate part of equity called Other Comprehensive Income, OCI. It only gets moved to the main income statement when the underlying hedged item, like Montaut's KRW revenue, is also recognized. This matching avoids artificial volatility in reported profits just because the derivative and the hedged item are valued at slightly different times. It's also worth noting why issuers often prefer the over-the-counter OTC market for their hedges, because their risks are often very specific. A particular amount of currency needed on a very specific date may be linked to a specific project. They need customized contracts. OTC markets allow them to tailor the derivative amount date-specific features to perfectly match their unique exposure, which isn't always possible with the standardized contracts on exchanges. And there are different types of hedge accounting designations, depending on the risk being managed. One is a cash flow hedge. This is used for variable cash flows like floating interest payments on a loan or like Montaut's future KRW sales revenue. The goal is to make future cash flows predictable. An interest rate swap converting floating to fixed rate is a classic example. Another is a fair value hedge. This hedges the risk of changes in the value of an existing asset or liability on the balance sheet. For example, hedging the value of fixed-rate bonds you own against interest rate changes, or a farmer hedging the value of grain already harvested and stored. And a third is a net investment hedge. This is specifically for hedging the currency risk of owning a subsidiary or operation in a foreign country, like an Indian company hedging the value in GBP of its UK subsidiary against INR GBP fluctuations. So, thinking about companies like Montaut AG, why is hedge accounting so important for them? What does it help them achieve when they report their financial results?
That's a great summary of the issuer's perspective: risk reduction, stability, and the role of hedge accounting. Now let's switch sides and look at investors' use of derivatives. Who are investors in this context? We're talking about individuals managing their own money, but more often, professional entities like mutual funds, pension funds, hedge funds organizations managing large pools of capital with the goal of achieving growth or specific investment returns for their clients or beneficiaries. Their reasons for using derivatives are usually quite different from issuers. First, investors use derivatives to replicate cash market strategies, but more efficiently. They want the same exposure as buying stocks or bonds directly, but maybe using less capital or achieving it with better liquidity. Remember Procam Investments wanting gold exposure. They used gold futures, got the exposure to gold price moves, but without buying physical gold and using much less upfront cash. That's replication. Second, investors use derivatives to hedge portfolio value. Similar to issuers hedging specific risks, investors might hedge their overall fund against broad market downturns or currency risks.
For instance, an Indian fund manager holding a lot of U.S. technology stocks might worry the U.S. dollar will weaken against the rupee. They could use FX derivatives to hedge that currency risk, protecting the rupee value of their U.S. investments. Third, and this is often where more sophisticated strategies come in, investors use derivatives to modify or add exposures in ways that might be difficult or impossible with just cash instruments. This includes easily taking short positions to bet on falling prices, or implementing strategies like the covered call we mentioned earlier, SCSI investments, holding shares and selling a call option on them to potentially enhance returns in a flat or slightly rising market. They collect the option premium. A crucial point for investment funds. Their prospectus, which is like their official rulebook given to investors, must clearly state if they can use derivatives, which types they can use, and for what purposes, hedging, seeking returns, etc. And their accounting is usually different from issuers too. Investors typically mark their derivative positions to market every single day.
The daily change in value goes directly into the calculation of the fund's daily net asset value, NAV, the price per unit of the fund. They're less focused on the smoothing effect of hedge accounting. Their business is investment performance, so daily value changes are reported directly. This focus on active trading and daily valuation also means investors often prefer the standardized, highly liquid exchange-traded derivative markets over the OTC markets. They need the ease of entry and exit, the transparency, and the reduced counterparty risk provided by exchanges for their frequent trading. So can you name two main reasons why an investor, like a mutual fund manager, might choose to use derivatives in their portfolio?
Okay, that distinction between issuers and investors is really helpful. Now, let's bring some of these ideas together by looking at that complex example we mentioned earlier, the structured note. This really highlights how derivatives can be embedded and sometimes hidden. Remember the product? It was called the Baywhite Financial LLC 80% Principal Protected Structured Note. Let's break down what that actually means for someone buying it. First, that phrase, 80% principal protected. What does it promise? It says that when the note matures, typically after several years, the investor is guaranteed to get back at least 80% of the money they initially put in. So if you invested, say, 1,000 rupees, Baywhite promises to return at least 800 rupees. The remaining 200 rupees, or 20%, is considered at risk. You could lose that part. Second feature, it's linked to an index. This means any extra return, the additional amount you might get above that 80% protection, depends on how well a particular stock market index performs. In this specific case, it was linked to the S&P 500 Healthcare Select Sector Index, SIXV, and the payoff was specific. You only got returns if the index performed better than 5% above its starting level. Below that, you got nothing extra. So if you bought this note, what exactly does that 80% principal protected feature mean for the money you invested?
All right, that principal protection sounds safe, doesn't it? 80% back, guaranteed. But here's where we need to look under the hood, as they say. That structured note isn't just one simple thing. It has a derivative hidden inside. Let's look closely at how that additional amount is calculated. The greater of 100% of the returns on the SIXV index in excess of 5% above the starting spot price, or zero. Think about that payoff. You only start making money if the index goes above a certain level, 5% higher. If it stays below that or falls, you get zero additional return. Your potential upside starts only after crossing a hurdle. This exact payoff structure is zero return up to a point. Their full participation above that point is precisely the payoff profile of a call option, a long call option. So what Baywhite Financial has done is bundled two things together. One, something like a bond or deposit that ensures you get 80% back, and two, a call option on the SIXV index, which gives you the potential upside if the index performs very well, goes up more than 5%. It really is like that combo meal analogy. You buy one product, the structured note, but you're actually getting a combination of a debt instrument for the safety part and a derivative, the call option, for the potential extra return. It's bundled together. So that additional amount feature where you only get returns above that 5% hurdle acts just like which type of derivative.
So it's a bond plus a call option packaged together. That definitely makes it seem more complex. Now, let's revisit credit risk in this context. The note says 80% principal protected. But who is making that promise? It's Baywhite Financial LLC, the issuer. Here's the critical point. Even though only 80% is promised back, you, the investor, are exposed to the credit risk of Baywhite Financial for the entire 100% of your investment. Think about it. If Baywhite Financial gets into serious trouble, if they go bankrupt before the note matures, that protection promise might be worthless. You could lose everything, including the 80% that was supposed to be safe. It's like relying on your local shopkeeper's promise to give you credit next month. The promise is only good if the shopkeeper is still in business next month. If the shop closes down, the promise means nothing. The credit risk lies with the promiser. Compare that again to buying a standard exchange-traded call option. Your credit risk there is mainly with the exchange's central counterparty, CCP, which is usually very heavily regulated and financially strong due to all the margin requirements and guarantees. Much safer, typically. So, if Baywhite Financial LLC faced severe financial difficulties, what would likely happen to the value and the protection offered by this structured note?
That's a crucial distinction about where the ultimate credit risk lies. And finally, let's touch upon liquidity and transparency again, specifically for these notes. As a general rule, structured notes like this Baywhite example are significantly less liquid, meaning harder to sell quickly at a fair price, and less transparent than the individual components, like a standard bond or an exchange-traded option, would be if you bought them separately. Why? Well, exchange-traded options are standardized. They trade constantly on public exchanges with visible prices, lots of buyers and sellers. It's usually easy to get in or out. Structured notes, however, are often customized, issued by one bank, and don't typically trade on an active public market. If you want to sell it before maturity, you might have to go back to the issuing bank, and they might offer you a price that's not very attractive. There isn't a competitive market to ensure a fair price. And remember the cost. This Baywhite note was issued at 102% of face value investors paid a 2% premium upfront. If you try to sell early, you'll almost certainly lose that premium and maybe more because of the lack of liquidity and transparency.
So for you as future analysts, when you see a product like this, you need to be critical. Compare the upfront cost, that 2% premium, plus the risk you're taking, the 20% not protected, with the cost of just buying a similar call option on the exchange. And always factor in the extra credit risk relying on Baywhite and the poor liquidity you get with the structured note compared to exchange-traded alternatives. Hashtag outro.
All right, we have certainly covered a lot of ground today. We've gone from the basics right through to some quite complex examples. I hope you're feeling more comfortable now. We started right at the beginning, didn't we? Asking, what is a derivative? Using that simple cricket ticket booking analogy. Then we explored the really important benefits, how companies like Montauk AG use them to manage tricky risks like currency changes, how they act like signal flags, remember the negative oil prices showing huge market stress, and how they make trading easier and cheaper getting gold exposure with just a small margin. But we also looked honestly at the risks, that powerful hidden leverage, the double-edged sword, the potential lack of transparency, especially in complex products, and specific risks like basis risk, the mismatch, liquidity risk, the cash flow timing, and counterparty credit risk, will the other side pay up? And that big one, systemic risk. Finally, we saw how different players, the issuers like companies and the investors like funds, use these tools for different reasons, and how something like a structured note can bundle derivatives and other instruments together, sometimes hiding the complexity. Please remember, building a really solid understanding takes time and practice. It's like learning a new language or a difficult subject in school. You need patience. But you are doing well. Keep at it.
That's a perfect summary. It leaves me one final thought, something for you to ponder as you continue your studies. We've seen how derivatives can dramatically amplify returns, requiring little capital. But they can also amplify losses just as dramatically. They are incredibly powerful. So here's the challenge for global regulators. How do they balance the need for these efficient tools, which help manage risk and make markets work better, with the undeniable potential for these same tools to create instability and even systemic crises if misused or if too much risk builds up? It's a constant balancing act, isn't it? Encouraging innovation versus ensuring stability. How do they make sure the game stays fair and safe for everyone involved? Think about that tension. We'll definitely pick up on more finance topics in our next deep dive. Until then, take care and keep that curiosity alive. Keep learning.
Namaste, and a very warm welcome to all our diligent students joining us for another enriching deep dive right here.
Welcome, everyone.
Today, we're really embarking on a fundamental journey. Think of it like this. We're laying the very few
These are the absolute basics you'll need.
Yes, the foundational concepts for understanding the sometimes complex world of finance. Our topic today is arbitrage, replication, and the cost of carry in pricing derivatives.
Now, those might sound like big words.
They might, and I understand that for many of you, maybe especially if you're CFA students just starting out, these terms might sound a bit, well, daunting, like a complex equation perhaps. But I promise you, our mission today, our goal, is to patiently and very clearly demystify these ideas. We'll break them down step by step, just as we would in a classroom.
Nice and slow, nice and clear.
Exactly. So please just settle in, listen with an open mind, and let's explore this together.
Indeed. And to all our wonderful learners, this particular deep dive, it's incredibly crucial. Really it is.
It really is.
It's not just about memorizing definitions, you see. It's about understanding the very heartbeat, the pulse of how financial markets operate. And more specifically, how the prices of these things called derivatives are determined. At its core, it's really all about ensuring fair prices.
Fair prices, yeah.
And preventing what the market often calls riskless profit opportunities from, hanging around for too long.
Right.
So over our time together today, we'll unpack 3 core interconnected ideas. First, arbitrage. This is all about how clever investors find and crucially eliminate those fleeting chances for guaranteed profit.
Like finding free money, almost.
Kind of. Second, replication. This is a really powerful concept. It shows us how to get the exact same financial outcome using different, often simpler building blocks.
Oh, okay.
And finally, the cost of carry. This helps us understand why an asset's price today might be different from its price for delivery way off in the future.
Ah, okay. Makes sense. And we are absolutely committed, my dear students, to using simple, everyday language and plenty of relatable Indian examples to make sure every concept really clicks into place for each one of you.
Crystal clear, that's the goal. Okay, so let's begin our exploration. Let's start with this fascinating concept of arbitrage.
Arbitrage, okay.
Now, in simple terms, arbitrage is like finding a hidden gem. It's the possibility of making a profit, and this is key, a guaranteed profit, without taking on any risk whatsoever.
Zero risks.
Zero risk. Imagine someone giving you a free lunch, absolutely free.
Yeah.
How does this magic happen in the financial world?
Right, how?
Well, it occurs when you can take advantage of tiny, maybe momentary price differences for the exact same asset, or for identical cash flows, perhaps in different places or even at different times. And this brings us to a foundational principle in finance. It's known as the law of one price.
Ah, yes, very important. Very important. And this law, it's quite intuitive, actually. It simply states that if 2 assets, or maybe 2 streams of cash flows, are identical in every single way, features, risk, timing, they must trade at the same price in an efficient market.
They have to.
They have to. If they don't, even for a moment, then that small difference, that little gap, it creates an arbitrage opportunity.
An opening.
Exactly. Let me give you a very simple, everyday example, my dear students, just to help this sink in.
Good idea.
Imagine you wake up early, you head to your local mandi, that bustling wholesale vegetable market,
Yes.
and you find a vendor selling a fresh, crisp bunch of coriander, let's say, for just 10 rupees, a good price.
Okay, 10 rupees.
Now, you happen to know that just a few streets away, maybe in a fancier, upscale neighborhood market, the exact same quality coriander is being sold for 15 rupees.
Ah, price difference.
Right. So if you can quickly buy it for 10 rupees from the mandi and immediately take it to the other market and sell it for 15 rupees.
Before anyone else notices.
Exactly. Before anyone else notices, and without any real effort or risk in between, that 5 rupee difference.
Yes.
That's your riskless profit. That's
Yes.
arbitrage in action. It's spotting those tiny price mismatches and acting instantly.
That's a wonderful analogy, truly relatable. Now let's build on that. Let's elaborate on how these arbitrage opportunities, these little gaps, typically show up in the more sophisticated world of derivatives pricing.
Okay.
We generally classify them into 2 main types. The first type occurs when you have identical assets trading at different prices, just like your coriander example, but with financial assets.
Right.
Let's consider a concrete example based on our source material. Imagine 2 zero-coupon bonds. Let's call them Bond A and Bond B.
Okay, Bond A and Bond B.
They are issued by the same, very reliable bank, so there's no difference in credit risk. Both bonds mature in exactly 1 year, and both promise to pay exactly EOR 100 at that maturity date.
Yeah.
Identical in payoff and risk.
Got it. Identical.
But here's the catch.
Right.
Right now, today, at time 0, Bond A is available for EOR 99. while bond B, identical bond B, is priced just slightly higher at EUR 99.15.
Ah, there's the gap. 15 cents difference.
Exactly. So how would a smart investor and arbitrager generate a riskless profit here? It's actually quite straightforward once you see it.
Okay, how?
At time t equals 0, today, you would immediately sell bond B short.
Okay, sell short. What does that mean exactly for our students?
Good question. Selling short means you borrow bond B from someone who owns it. Maybe your broker lends it to you. Then you immediately sell that borrowed bond in the open market at its higher price of EUR 99.15. You receive that cash.
So you sell something you don't technically own yet.
Precisely, with the promise to return it later.
Yeah.
So you get EUR 99.15 cash in hand. Simultaneously, at the exact same moment, you buy bond A for EUR 99.
Using some of the cash from selling bond B.
Exactly. You use the EUR 99 of the EUR 99.15 you just received. So what's your immediate cash flow? You spent EUR 99, but you received EUR 99.15.
You're left with EUR 0.15 instantly.
Instantly. A riskless cash inflow. A profit of EUR 0.15 right away at time 0, with no money out of your own pocket initially.
Wow. Okay.
Now, let's fast forward. Let's go to time t, the maturity date, 1 year from now.
Okay, 1 year later.
You already own bond A, right?
Okay.
It matures, so you receive EUR 100 from it. You now have EUR 100 in cash.
Right.
But remember, you sold bond B short. You owe that bond back to whoever lent it to you.
Ah, yes, the promise to return it.
Yes. But since bond B also matures day at EUR 100, you can simply use the EUR 100 cash you receive from bond A to effectively buy bond B from the market or just settle the obligation, since it's worth EUR 100 at maturity to cover your short position.
So the EUR 100 from A pays off the debt from B.
Exactly. At maturity, the cash flows from the bonds perfectly offset each other. Receive EUR 100, pay EUR 100, net zero at maturity.
So the only profit was?
That initial EUR 0.15 you pocketed right at the beginning, completely risk-free, you locked it in on day 1.
That's quite clever, but why doesn't everyone do this all the time?
Ah, good question. Why does this type of profit disappear so quickly in real financial markets?
Yes.
It's because of the very nature of arbitrage. As soon as a few sharp investors notice this price difference, and trust me, they look for these things, they would all rush to do the exact same thing.
Sell the expensive one, buy the cheap one.
Precisely. Sell bond B, buy bond A. Now think about supply and demand. All this selling pressure on bond B would drive its price down from EUR 99.15.
Okay.
Simultaneously, all the buying pressure on bond A would push its price up from EUR 99.
Ah, they move towards each other.
Exactly. This buying and selling pressure continues relentlessly until the prices of bond A and bond B converge. Maybe they both meet at EUR 99.07 or some single fair price.
And then?
And then, the moment they trade at the same price, the arbitrage opportunity vanishes. Poof. Gone.
So arbitragers are like market cleaners, tidying up the prices.
That's a great way to put it. They act like the market's policemen, constantly correcting these little mispricings and ensuring the law of one price holds.
That's a perfect explanation of how those market forces work. Great. Now, here's where it gets even more interesting, I think, with the second type of arbitrage.
Okay, the second type.
This happens when an asset with a known future price does not trade at its present value, PV. Okay. Before we dive into the example, let's quickly refresh our memory for all our students on what present value, or PV, really means.
Good idea. Always good to review basics.
Think about saving for a very important family event. Let's say your younger sister's wedding is coming up in 2 years.
Okay, a common scenario.
And, you estimate you will need, let's say, 5 lakhs rupees at that time for the wedding expenses.
Right, 5 lakhs in 2 years.
Now, if you want to put money into a fixed deposit, an FD, today, and let's say the bank offers a certain interest rate, how much do you need to deposit today so that it grows to exactly 5 lakhs rupees in those 2 years? That amount you need to deposit today, that today's amount, is the present value of the future, 5 lakhs.
It's the value today of money you'll receive in the future.
Exactly. It's the current worth of a future amount of money discounted back using an interest rate. So PV is always going to be a smaller number than the future value, right? Because money today is worth more than the same amount of money tomorrow thanks to interest.
Precisely. You've hit upon a key financial concept there. Time value of money.
Yes.
And in finance, if you know for certain, absolutely certain, that an asset will be worth a specific amount in the future.
Like our bonds maturing at year 100.
Exactly. Or like a forward contract price. Then you could discount that known future price back to today's value using a risk-free interest rate.
Okay.
And if the current spot price of that asset, the price for immediate delivery, isn't equal to that calculated discounted future value, then boom,
Arbitrage again.
arbitrage again. The market is out of sync. Opportunity exists.
Okay, let's see an example.
Let's consider an example involving gold, as detailed in our source material. This makes it very clear.
Gold. Okay.
Imagine today's spot gold price, we call this S0, is USD 1,770 per ounce.
S0, 1770. Got it.
Now, suppose you can enter into a forward contract today. This contract obliges you to sell gold in 3 months at a pre-agreed price, we call this ST, the future price, of USD 1,792.13 per ounce.
So you lock in a selling price for 3 months later.
Exactly. You know, you could sell it for 1792.13 in 3 months. Let's also say the annualized risk-free interest rate, R, in the
Yeah,
market.
can we guard 2%?
And just for simplicity in this first example, we'll assume there are no costs for storing the gold, and crucially, you can borrow money at this same 2% risk-free rate.
Okay, simple assumptions for now.
Right. So here's the step-by-step arbitrage strategy an investor might use. Pay close attention, my dear students. At time t equals 0, which is today, step 1, you would borrow USD 177,000. You borrow this at that 2% annual risk-free rate, specifically for 3 months.
Okay, borrow $177,000. Why that specific amount?
Because step 2, with that borrowed money, you immediately buy 100 ounces of gold at today's spot price of USD 1,770 per ounce.
100 ounces times $1,770 per ounce is exactly $177,000.
Precisely. The borrowed amount exactly covers the cost of the gold. You've used exactly the borrowed amount.
Okay, so no cash out of pocket yet.
Correct. Step 3. Simultaneously, at the same time, you enter into that forward contract to sell 100 ounces of gold in 3 months at the agreed-upon future price of USD 1,792.13 per ounce.
So you've got the gold and you've already locked in a price to sell it later.
Yes. Notice, at time 0, your net cash flow is effectively 0. Borrowed money came in, went straight out to buy gold. You haven't spent anything from your own funds.
Right, locked and loaded.
Lock and loaded. Now, let's fast forward. Time t in 3 months. This is when the forward contract matures and your loan needs to be repaid.
Okay, payoff time.
Step 1. First, you fulfill your forward contract. You deliver the 100 ounces of gold you bought earlier. In return, you receive USD 179,213. That's simply 100 ounces multiplied by the agreed forward price of USD 1,792.13 per ounce.
Okay, cash comes in, $179,213.
Step 2. Second, you need to repay your initial loan principal plus the interest that is accrued over the 3 months.
Right, the borrowing wasn't free.
Exactly. Your original loan was USD 177,000. For 3 months, which is 0.25 years or a quarter of a year, at a 2% annual rate, we need to calculate the interest. The total amount to repay would be USD 177,000 multiplied by 1.02 raised to the power of 0.25.
Okay, that calculation.
It comes out to approximately USD 177,878.44. So you simply use a portion of the cash you received from selling the gold, the 179,213, to repay this loan amount.
All right, so you received 179,213. You paid back 177,878.44. What's left?
Exactly. What's your riskless profit then, my students? It's the cash you received from selling the gold, USD 179,213, minus the total amount you had to repay for the loan, USD 177,878.44.
See, that's carry the one.
It leaves you with a profit of USD 1,334.56 in total.
Wow, over $1,300.
Yes. Or a tidy USD 13.35 per ounce of gold. Remember, this is achieved with no initial investment and no risk.
So why did this profit exist? What was the mismatch?
Excellent question. The profit exists because the current spot price of gold, USD 1,770, was actually below the present value of that known future selling price, USD 1,792.13.
The PV connection.
Yes, if you were to discount that future price of USD 1,792.13 back 3 months using our 2% risk-free rate, remember our PV calculation,
Yes.
you would get approximately USD 1,783.28. So the market should have priced gold at 1783.28 today based on its known future price. But it was actually trading lower at 1770.
So it was undervalued in the spot market relative to the forward market.
Exactly. That difference, that gap between 1770 and 1783.28, that was the arbitrage window.
And just like the bonds, this won't last long.
Not at all. Just like our bond A and bond B example, this kind of arbitrage opportunity wouldn't last. As soon as other investors spot this disparity,
They'll jump in.
they'll rush to borrow money, buy gold in the spot market.
Yeah.
What does that do to the spot price?
Pushes it up. More demand.
Exactly. Pushes the spot price up from 1770. Simultaneously, they would all be entering forward contracts to sell gold to lock in their profit.
Right.
What does that do to the forward price?
More sellers. Pushes the forward price down.
Correct. Pushes the forward price down from 1792.13. This activity spot price rising, forward price falling would continue until the spot price equals the present value of the forward price.
Until S0 equals ST times 1 plus R to the power of minus T.
Precisely. Until that equilibrium is reached and that easy profit margin completely disappears, arbitrage is that constant force pushing markets towards efficiency. It links the spot and future prices through the risk-free rate.
That was an incredibly clear illustration. Fantastic. So my dear students, to summarize these two critical conditions that underpin no arbitrage pricing, please remember these points. They are very important. Firstly, the law of one price, identical assets or assets producing identical cash flows must, at any given time, trade at the same price. No two prices for the same thing.
One price only.
And secondly, if an asset has a known future price, its current spot price must be exactly equal to that future price, but discounted back to today using the risk-free rate. The spot price must reflect the present value of the known future price.
These two rules keep everything in balance.
They do. They are absolutely fundamental to keeping markets fair and preventing that free lunch we talked about.
No free lunches in efficient markets.
Right. Now, for a quick moment of reflection for everyone listening, have you ever spotted a similar, maybe tiny discrepancy in the everyday world? Perhaps comparing prices for the exact same item at two different stores, or maybe even online versus in a physical shop. That, theoretically, could lead to a quick, riskless gain, even if it's just a few rupees. Think about how quickly those opportunities disappear if they become widely known.
Like your coriander example, if everyone knew, the prices would equalize fast.
Exactly. This is precisely what arbitrageurs do in financial markets, but often at lightning speed and, of course, with much larger sums of money involved.
Excellent thinking, everyone. Now that we firmly understood how arbitrage pushes prices towards fairness and efficiency, let's move to our next, closely related and equally powerful concept. This is called replication.
Replication.
Replication is essentially a strategy. It's where you recreate the exact same financial outcome, the exact same profit or loss profile, or the same stream of cash flows as a more complex financial instrument, like maybe a forward contract or another derivative.
But you do it differently.
Yes, you do it by using a different, simpler combination of instruments. These simpler building blocks are typically the underlying asset itself, like the gold or the stock, and either borrowing or lending cash at the risk-free rate.
So you build the same result using basic parts?
Precisely. Let me give you an Indian example to clarify this, my students. A non-finance example first.
Good idea.
Imagine you have a craving for a very specific, very famous type of laddu. You know, that delicious Indian sweet. But it's from a sweet shop that's quite far away, maybe in another city altogether. Now, instead of traveling all that distance, just to buy it directly from the famous shop.
Which could be costly and time-consuming.
Right. What if you managed to get the exact, authentic recipe and all the precise ingredients, the right type of flour, the ghee, the sugar proportion, everything?
Okay, you have the blueprint.
You then go home, gather all your ingredients, and carefully replicate that same famous laddu right there in your own kitchen, if you follow the recipe perfectly.
The taste should be the same.
Exactly. The taste, the texture, the entire experience should be identical to the one from the famous shop, even though the method you used to acquire it, making it yourself versus buying it, was entirely different.
Ah, I see the connection.
In finance, replication is precisely about achieving that same payoff, the same end result, as a complex financial instrument, but using simpler, more basic building blocks like the asset and cash.
That's a truly wonderful example. Makes it very clear. And the beauty of it is, as you said, if you can perfectly replicate the payoff of, say, a forward contract using a combination of the simpler spot asset and borrowing lending, then in an efficient market, the price of that forward contract must be the same as the cost of setting up that replicating portfolio, right?
Absolutely has to be.
Because if they weren't the same price,
This what?
arbitrage, someone would buy the cheap one and sell the expensive one for a riskless profit.
Exactly. Smart investors would jump in immediately and correct it. Replication and arbitrage are two sides of the same coin, ensuring prices align with underlying value.
Okay, so let's focus on a specific example. Let's talk about replicating a long forward commitment.
Great. A long forward.
Now, just to remind everyone, a long forward commitment simply means you've entered into an agreement today to buy a specific asset. Let's stick with our gold example at a set price on a future date. You're long because you benefit if the asset's price goes up in the future. And you're committed. You have to buy it.
Precisely. You're obliged to buy at the agreed price. So how do we replicate this position? How do we get the same outcome without actually entering into that forward contract?
Right. How?
Well, using our basic building blocks, you can simply do this. Today, at time t equals 0, you borrow money at the risk-free rate. Then you use that borrowed money to immediately buy the underlying asset, in our case, 100 ounces of gold in the spot market.
So borrow and buy today.
Yes, and then you simply hold on to that physical gold until the future date, time t, when the forward contract would have matured.
Okay, so borrow, buy, and hold.
Let's revisit our gold example to make this absolutely crystal clear. But this time, crucially, let's assume the market has already adjusted itself. There's no arbitrage opportunity left.
Okay, prices are fair now.
Yes. Let's say the spot gold price, as 0, has risen to USD 1,783.28 per ounce. Remember this number.
Yes, that was the fair present value we calculated earlier from the forward price.
It's exactly. This figure is the fair present value of that forward price of USD 1,792.13 in 3 months, given our 2% risk-free rate. This is the market's no arbitrage spot price.
Okay.
Now, let's crucially compare the payoffs of 2 scenarios. And please watch closely, my students. You'll see how identical they are. Scenario 1. You enter a long forward commitment. Let's say a company, Procam Investments, decides to enter a forward contract today to buy 100 ounces of gold in 3 months at the fair forward price of USD 1,792.13 per ounce.
Okay, the standard forward contract.
Now, let's see what happens in 3 months, depending on the gold price then, ST.
Yeah.
If at time t, the future spot price, ST of gold, turns out to be, say, USD 100-900 per ounce.
Gold went up. Good for the long position.
Yes. Procam's profit would be 100 ounces multiplied by USD 1,900, the market price, minus USD 1,792.13, their agreed-upon buying price.
Yeah.
That comes to a profit of USD 10,787.
Back clear profit.
However, if at time t, the future spot price, ST of gold, is lower, say USD 1,700 per ounce.
Gold went down. Bad for the long position.
Right. Procam still has to buy at 1792.13. Their loss would be 100 ounces multiplied by USD 1,700 minus USD 1,792.13. This results in a loss of USD 9,213.
Okay, so profit if price goes up, loss if price goes down. Makes sense for a long forward.
Now for scenario 2. You borrow and purchase to replicate the forward. Instead of using the forward contract, Procam does our replication strategy.
Borrow, buy, hold.
Exactly.
Yeah.
1. They borrow USD 178,328 today. Where did this number come from?
That's 100 ounces times today's fair spot price of 1783.28.
Perfect. They borrow exactly enough to buy the gold today at the 2% risk-free rate. 2. With this borrowed money, they immediately buy those 100 ounces of gold at today's spot price. 3. They then simply hold on to this physical gold for 3 months.
Okay.
At time t, in 3 months, they will sell that gold at whatever the market price ST is then and use the proceeds to repay their loan.
What's the loan repayment amount?
Good question. The original loan was USD 170,328. For 3 months at 2% annual rate, we calculate the future value. USD 178,328 multiplied by 1.02 raised to the power of 0.25. This equals approximately USD 179,213.
Wait a minute, that repayment amount, 179,213, that's exactly the forward price from scenario 1.
Precisely. That's not a coincidence. That's the no arbitrage relationship at work. The future value of the fair spot price equals the fair forward price.
Amazing. Okay, so what are the profits or losses here?
Let's look. If ST is USD 100-900, gold price went up. Procam sells the gold for 100-1,900 equals USD 190,000. They repay the loan of USD 179,213. Their profit is USD 190,000 minus USD 179,213, which equals USD 170,000.
Yeah.
They still have to repay the loan of USD 179,213. Their loss is USD 170,000 minus USD 179,213, which equals USD 9,213.
And exactly the same loss as scenario 1.
Yes. What is the absolutely crucial takeaway here, my students? Look closely. The profits or losses in both scenarios, entering the actual forward contract versus doing the borrow, buy, and hold replication strategy, are absolutely identical, no matter what the future gold price is.
That's the power of replication.
That is the power of replication. It demonstrates how the simple act of borrowing money to buy the underlying asset and holding it can perfectly replicate the exact financial outcome of a long forward commitment.
And because the outcomes are identical.
Their costs today must be identical to prevent arbitrage. This is why, in an efficient market, the forward price must equal the future value of the spot price, adjusted by the risk-free rate. If it didn't, you could simply choose the cheaper of these two equivalent ways to get the same payoff and make risk-free money. The market won't allow that.
Absolutely fascinating how these pieces fit together. It's like seeing the hidden mechanics of the market. Now let's look at another very important replication strategy, one that's key for managing risk. Combining a long asset position with a short forward position. What does this combination achieve?
Ah, yes, this is a classic hedging strategy. In this strategy, you do two things simultaneously today. First, you buy the underlying asset in the spot market, so you go long the asset, you physically own it.
Okay, own the asset.
And second, at the very same moment, you enter a forward contract to sell that same asset at a fixed, pre-agreed price on a future date. That's your short forward position. You're committing to sell something you already own at a known price in the future.
So buy it now and simultaneously agree to sell it later at a fixed price.
Exactly. Let's use our gold example again from example 3 in the source with Procam investments. Suppose Procam buys 100 ounces of gold today at the fair spot price, S0, of USD 1,783.28.
Okay, buying at 1783.28.
At the very same moment, they immediately enter a forward contract to sell those 100 ounces of gold in 3 months at the fair forward price of USD 1,792.12. Again, we're assuming no storage costs for now, just focusing on the core idea. Let's trace the cash flows for Procam very carefully. At time t equals 0 today, Procam's cash flow is an outflow. Money goes out. It's Mavis USD 178,328 because they are buying the 100 ounces of gold in the spot market.
Right, investment costs. At time t equals t, in 3 months, Procam's cash flow will be an inflow, money comes in. It's plus USD 179,213. Why? Because they are delivering and selling the 100 ounces of gold via their forward contract at that pre-agreed price. They get exactly that amount, regardless of the spot price on that day. So the selling price is locked in. It doesn't matter if gold is 1,900 or 1,700 then.
This doesn't matter at all. They get 179,213 because that was the forward contract price they agreed to.
Okay, so they spent 178,328 today and are guaranteed to receive 179,213 in 3 months. What kind of return is that?
Let's calculate it. We have USD 179,213 as the future value received, and USD 178,328 as the present value of the initial investment over a period of 3 months, which is 0.25 years. The equation is future value, present value, 1 plus RT.
So 179,213 equals 178,328, 1 plus R, 0.25.
Exactly. Now, if you solve this equation for R, the annualized rate of return, guess what you'll find?
Let me guess. Based on everything we've seen, is it 2%?
Spot on. You'll find that R equals 2.0%. And what's truly significant about this, my students, it's exactly the risk-free rate we've been using throughout our examples.
Wow. So by buying the asset and selling it forward simultaneously, they just earned the risk-free rate. Guaranteed.
Absolutely guaranteed. The key takeaway here is profoundly important for understanding risk management. This long asset plus short forward strategy effectively hedges your spot position.
Hedges, like protects it.
Exactly. By buying the gold today and immediately locking in a future selling price with the forward contract, you've completely eliminated all the price risk associated with holding the gold. You don't care if the gold price goes up or down anymore.
Because your selling price is fixed.
Right. You are now guaranteed to earn the risk-free rate of return on your initial investment, regardless of where the actual gold price goes in the future. This only works, of course, as long as that new arbitrage condition holds, F01 plus RANT.
So you've turned a risky investment owning gold into a risk-free one.
Precisely. You've essentially transformed a potentially risky asset position into a perfectly risk-free investment that just earns the risk-free rate. This is absolutely fundamental to how hedging works in real markets. Companies do this all the time to manage price risks.
That's truly brilliant. It really shows the power of combining these instruments. So, my dear students, let's pause and think again. If we can perfectly replicate a forward contract using the spot asset and borrowing lending, and we can also use a long spot position combined with a short forward to completely eliminate risk and lock in the risk-free rate, what does that tell us about the fundamental relationship between spot prices and forward prices when there's no arbitrage?
What does it imply?
It suggests, doesn't it, that these prices are not just related. They are intrinsically linked, almost fused together by the risk-free rate, like two sides of the same coin.
Absolutely. Tied together by the time value of money and the principle of no arbitrage.
And they are constantly being adjusted by market forces, by arbitrageurs and hedgers to prevent anyone from making easy, guaranteed money. It highlights the incredible efficiency, the interconnectedness of financial markets. Wonderful insights, everyone. I hope that's becoming clearer now. Now that we've firmly grasped the powerful concepts of arbitrage and replication, let's move to our third foundational concept for today: the cost of carry.
The cost of carry. Okay.
Until now, we've mostly looked at a fairly simple relationship, right? Where the forward price, F0t, equals the spot price, S0, multiplied by 1 plus RT.
Yes, focusing mainly on the risk-free rate.
Exactly. But that simple formula kind of assumes there are no other costs or maybe benefits associated with simply holding the asset over time. But in the real world, as you can imagine, owning assets often comes with much more than just the opportunity cost of your money.
Real world is usually more complicated.
It is. There can be direct expenses and sometimes even direct benefits to holding something. To make this idea really concrete, let me use another everyday Indian example. Imagine you run a small kirana shop, your friendly neighborhood grocery store.
Okay, the kirana shop owner.
Now, running that shop, it's not just about the cost of buying the goods, the rice, the flour, the soap from the wholesaler. That's just the start.
Right, there's more to it.
You also have to pay rent for your shop space, right? You have electricity bills for the lights, maybe for a refrigerator to keep milk and drinks cool. You probably have a helpful assistant you need to pay a salary to.
All necessary expenses.
And sometimes, sadly, you might even incur a loss from items that spoil, maybe fresh fruits or vegetables, before you can sell them.
Yes, spoilage is a real cost.
So all these things, the rent, the electricity, the salary, the spoilage, these are very real, tangible parts of your cost of carrying the inventory in your shop. They add to your overall cost of doing business.
It's the total cost of holding those goods until they're sold.
Exactly. And ultimately, they influence the price at which you need to sell your goods just to break even, let alone make a profit. It's the total burden of ownership over time. That's the essence of cost of carry.
That's a perfect analogy, James. The cost of carry in finance truly encapsulates all these various expenses and benefits associated with holding an asset. It's the net amount costs minus benefits related to owning an underlying asset for a specific period.
Let's break down its crucial components systematically.
Okay, the components.
First, we have the most universal component, the one we've already discussed quite a bit, the opportunity cost. This is represented by the risk-free interest rate, right?
Right, the interest you lose by holding the asset.
Exactly. It's the interest income you forego by having your capital tied up in the physical asset, instead of, say, lending that money out safely at the risk-free rate. This opportunity cost always applies, no matter what asset you hold, unless the risk-free rate is 0, which is rare.
And as we saw, if the risk-free rate R is positive, it generally makes the forward price greater than the spot price.
Yeah.
Why? Because the person holding the asset until the future date is missing out on earning that risk-free interest, and the forward price needs to compensate them for that loss. A higher R means a greater difference.
Okay, opportunity cost makes the forward price higher.
Generally, yes. Second, there are other costs of ownership. These are direct, often physical, tangible costs associated with holding certain types of assets. We denote these as C for total cost, or C if expressed as a rate.
Like the rent and electricity for the kirana shop.
Exactly like that. For financial assets, these might be minimal, but for physical commodities like gold, crude oil, or agricultural products like wheat or cotton, these can be substantial. Think about storage fees. Maybe you need to rent a secure go-down or warehouse.
Yes, storing wheat needs a proper go-down.
Right. And insurance premiums to protect against theft, fire, pests, or other damage. Maybe even transportation costs if you need to move the asset. These are direct additional costs you incur simply because you're holding the physical item.
And how did these affect the forward price?
Like the opportunity cost, these direct costs also generally increase the forward price relative to the spot price. The owner needs to be compensated for paying these storage and insurance bills over the holding period. The more expensive it is to store and insure something, the higher its future price will tend to be, all else being equal.
Okay, so opportunity cost and storage costs both push the forward price up.
Correct. But then third, and importantly, we have the benefits of ownership. These are inflows or advantages you get simply by holding the asset. We denote these as I, for total income benefit, or I, if expressed as a rate.
Ah, the good things about owning it.
Exactly. For example, if you own shares in a company like Reliance or Infosys, that company might pay you a dividend. That's a portion of their profits distributed to you, the shareholder. That's a direct cash benefit.
Right, dividends.
Or
If you own a government bond or a corporate bond, you typically receive regular interest or coupon payments. Again, a direct cash benefit from ownership.
Okay. Any benefits for commodities?
Yes. For some commodities, there's a unique non-cash benefit called a convenience yield, which is quite interesting. We'll discuss that in more detail shortly. But the key point is, these are tangible benefits you receive because you own the asset.
And how do these benefits affect the forward price? Do they push it up too?
No, quite the opposite. These benefits effectively reduce the forward price relative to the spot price.
Oh, reduce it. Wow.
Because the person who is holding the physical asset is receiving these benefits, the dividends, the interest payments. This makes it less costly or more advantageous for them to hold the asset compared to someone who just agrees to buy it in the future via a forward contract. The forward price has to reflect the fact that the actual owner is getting these perks during the holding period.
Ah, I see. The forward buyer doesn't get the dividends while waiting, so the forward price is adjusted down to reflect the benefit the spot holder receives.
Precisely. It's all about netting out the costs and benefits. So the cost of carry is really opportunity cost plus other costs benefits.
Okay, net cost R plus CI, roughly speaking.
Exactly. And this net cost determines the relationship between spot and forward prices. So the general formulas we see, like S0T plus PV/RT for known cash amounts, or S0T, E0EOR plus CIT for continuous rates, just incorporate all these elements.
Right.
So thinking about the relationship, if the total costs, opportunity costs plus other costs, are greater than the total benefits, then the forward price will be higher than the spot price, S0TOAO. This situation is often called contango in commodity markets.
Costs outweigh benefits, most forward higher contango.
Okay, but if the total costs are actually less than the benefits, maybe due to high dividends or a strong convenience yield, then the forward price will be lower than the spot price, S0T0. This situation is known as backwardation.
Benefits outweigh costs, macward lower, backwardation. Okay.
And only if the costs and benefits perfectly balance out will the forward price be exactly the same as the spot price.
Excellent. That comprehensive breakdown of the cost of carry components, opportunity cost, other costs and benefits, and how they net out is very clear. Now that we understand the what and the why, let's see how these components specifically apply to different asset classes that our students will encounter. Let's start with equities, or stocks.
Okay, equities. For stocks, the application of cost of carry is usually quite straightforward. Let's consider a non-dividend paying stock first. This is a company that does not distribute any of its profits back to shareholders as dividends.
So no benefits of ownership in terms of cash flow.
Exactly. In this case, the only relevant component of the cost of carry is the opportunity cost, the risk-free rate. There are typically negligible storage or insurance costs for holding a stock electronically. So the forward price calculation is simple. It just reverts to our basic formula. F0T equals S0 multiplied by 1 plus R, raised to the power of T, or S0ERT, with continuous compounding. The forward price will naturally be higher than the spot price if the risk-free rate R is positive, simply reflecting that opportunity cost of tying up capital.
Makes sense. Simple case.
Now, it gets slightly more interesting for a dividend-paying stock. Let's take the example of Unilever, UL, from our source material, example 4. Dividends are a clear benefit of ownership, right?
Yes, cash in your pocket just for holding the stock.
So let's say Unilever spot price, S0, is EUR50 today, and the relevant risk-free rate, R, is 5% per annum. Now, suppose Unilever announces it will pay a quarterly dividend of EUR 0.30 in 3 months' time, and then another EUR 0.30 dividend at times my T, which is 6 months from now, when our forward contract matures.
Okay, 2 dividends coming before the forward expires.
Right. We need to account for these future benefits when calculating the fair forward price today. How do we do that? We calculate the present value, PV, of these dividends today.
Discount them back like we did with the wedding example.
Exactly. The PV of the first EUR 0.30 dividend, due in 3 months or 0.35 years, is EUR 0.30 multiplied by 1.305, raised to the power of -0.25. The PV of the second EUR 0.30 dividend, due in 6 months or 0.5 years, is EUR 0.30 multiplied by 1.05, raised to the power of -0.5.
Okay, calculate those 2 PVs.
Adding these two present values together gives us the total present value of the expected dividend stream, PV0I. In the example, this comes out to approximately EUR 0.5892. This represents the value today and the dividends the spot holder will receive.
Got it. PV of benefits is 0.5892.
Now, the forward price formula incorporating benefits is S0t, EO0 minus PV0I, multiplied by 1 plus R raised to the power of T.
Ah, we subtract the PV of the benefit from the spot price before growing it at the risk-free rate.
Precisely. So it's EUR50, the spot price, minus EUR.5892, the PV of dividends, multiplied by 1.05, raised to the power of 0.5 because it's a 6-month forward.
Okay, 50, 0.5892, 1.05.
0.05. 0.5.
This calculation gives us a forward price of approximately EUR50.6310. So what's the key insight here compared to the non-dividend stock?
The key insight, my students, is that the dividend, being a benefit of owning the stock, actually reduces the forward price compared to what it would be otherwise. If there were no dividends, the forward price would just be 50. 1.05, 0.5 equals EUR51.23. But because of the dividends, valued at 0.5892 today, the forward price is lower at 50.6310.
Because the person holding the stock gets that benefit, so the future price doesn't need to compensate them as much.
Exactly. The benefit received by the spot holder lowers the effective cost of carry. Now let's quickly touch upon a stock index, like the Nifty Y50, which is very relevant for us here in India.
Ah, yes, the Nifty Y50. Many people track this.
Indeed. The Nifty Y50 is essentially like the overall scorecard for the performance of the top 50 large companies listed on the National Stock Exchange here. It's a basket of stocks.
Right, represents the broad market.
And when we talk about an index dividend yield, it simply means the average dividend income you'd expect to get from owning the entire basket of shares that make up this index. It's usually expressed as an annualized percentage rate. Let's call it I.
Okay, average dividend rate for the whole index.
Let's use example 5. Suppose the spot NFTY 50 index level today is INR 15,200. The estimated annualized index dividend yield I is 2.2%. And let's say the relevant Indian rupee risk-free rate is 4% per annum. We want to find the fair price for a 3-month forward contract on the Nifty Y50.
Okay, S0, 15200, I will 2.2%, R will 4%, T equals 3 months, or 0.25 years.
Right. Now, for indices, and often in derivatives pricing for continuous flows like yields, we commonly use continuous compounding with the exponential function E. The formula becomes SCOT multiplied by E raised to the power of R minus I multiplied by T.
Okay, S0 is S0E, RAT. Notice the minus E in the exponent.
Exactly. The dividend yield I directly reduces the effective growth rate from R to R. Plug in our numbers. 15,200 multiplied by E raised to the power of R.04 about 0.022 multiplied by 0.25.
So E raised to the power of 0.018, 0.25.
Yes. This calculation gives us a forward price of approximately INR 15,268.55.
Which is higher than a spot price of 15,200, but not as high as it would be if there were no dividends, which would be a 4040.25 equals 15352.76.
Exactly. The key insight remains consistent. The dividend yield I, being a benefit of effectively holding the index, acts to reduce the forward price compared to a zero dividend scenario. The higher the dividend yield, the lower the forward price will be relative to the spot price and the risk-free rate. It pulls the forward price down.
That's a super clear explanation for how cost of carry, especially benefits like dividends, applies to equities and indices. Great. Now let's switch gears completely and look at foreign exchange, or FX. This is a different beast altogether, isn't it?
It is quite unique, yes. Unlike a stock or a commodity, when you're dealing with FX, you're always dealing with 2 different currencies simultaneously.
Right, like rupees and dollars, or euros and yen.
And crucially, each of those currencies has its own prevailing risk-free interest rate in its own market.
Ah, so 2 interest rates to consider.
Exactly. And just to be clear on terminology, when we quote an exchange rate, say AUD/USD 1.3335.
That means 1.3335 Australian dollars equals $1.
Correct. We call the currency in the numerator, AUD here, the price currency,
Right.
And the currency in the denominator, USD here, the base currency. Keeping this straight, price versus base, is important for understanding the cost of carry in FX.
Okay, price currency, base currency. Got it.
So for FX forward pricing, the effective cost of carry isn't really about storage or dividends. Instead, it boils down to the difference in the risk-free interest rates between the 2 currencies involved.
The interest rate differential.
Precisely. More specifically, using standard notation where F is foreign price currency and D is domestic base currency, the key driver is RFSR, the foreign risk-free rate minus the domestic risk-free rate. This interest rate differential is what determines the relationship between the spot FX rate and the forward FX rate.
Okay, let's see how this works with an example.
Let's use example 6 from the source, which looks at the AUDSD exchange rate, and we'll illustrate it using replication, which ties back to our earlier discussion.
Okay, AUD/USD.
The spot AUD/USD rate, S0FD, is 1.3335, Remember, this means AUD 1.3335 equals USD 1.
Got it.
Now, let's say the 6-month Australian dollar risk-free rate, RF, the rate for the price currency, is very low, just 0.05% per annum.
RF, 0.0505%.
And the 6-month US dollar risk-free rate, euro, the rate for the base currency, is 0.20% per annum.
RA equals 0.20%. So the USD rate is higher than the AUD rate here.
Yes, that's important. Now let's see how we can replicate entering into a forward contract to exchange these currencies in 6 months, and why the interest rates matter so much.
Imagine an arbitrager or someone wanting to create a synthetic forward position. Here's what they could do at time t0 today.
Okay, the replication step.
They could borrow USD 1,000, the base currency, at the US dollar risk-free rate of 0.20% for 6 months.
Borrow base currency.
Okay.
2. Immediately convert that borrowed USD 1,000 into Australian dollars, the price currency, at the current spot rate. So USD 1,000 multiplied by 1.3335 gives them AUD 1,333.50 here.
Convert base to price currency at spot. Okay.
Then, lend that AUD 1,333.50 out at the Australian dollar risk-free rate of 0.05% for the same 6-month period.
Lend price currency. Okay, borrow base, convert, lend price.
Exactly. Now let's fast forward to time t in 6 months.
What happens now?
First, they will receive their Australian dollar loan proceeds back with interest. The initial AUD 1,333.50 euro will grow at the AUD risk-free rate, using continuous compounding for rates. AUD 1,333.50 euro multiplied by AUD raised to the power of 0.0005 multiplied by 0.5 equals approximately AUD 1,333.83.
Okay, they get back 333.83 AUD.
Yeah, at the same time, they also need to repay their initial US dollar loan with interest. The original USD 1,000 will have grown at the higher USD risk-free rate. So USD 1,000 multiplied by was raised to the power of 0.0002 multiplied by 0.5 equals approximately USD 1,001.
Okay, they owe 1,001 USD.
Now, for no arbitrage to exist, the amount of Australian dollars they received, AUD 1,333.83, should be exactly enough to obtain the USD 1,001 they need to repay their loan when exchanged at the fair forward rate.
Ah, so the ratio should give us the forward rate.
Exactly. The implied no arbitrage forward rate, S0SD, must be AUD 1,333.83 divided by USD 1,001. If you calculate that ratio.
1,333.83 1,001. It's about 1.3325.
Precisely. It comes out to approximately 1.33225. This is the fair forward AUD USD rate for 6 months.
And does this match the formula?
Let's check. The fundamental formula for FX forwards using continuous compounding is F0 FD equals S0 SDT equal 0.0002. That's a 1.3335. E over 0.000 is 020. That's 1.3330. 0.000425.
Matsu. E to the power of a number 0.0005 is slightly less than 1.3335. Yes, it comes out to 1.3325.
Perfect match. This demonstrates that the replication strategy locks in the same rate derived from the interest rate parity formula.
So the key insight here for our students.
The key insight, my dear students, is that it's the difference in interest rates between the two currencies, RFUR, that truly drives the forward FX rate away from the spot rate. This relationship is a cornerstone of international finance, often called covered interest rate parity.
Okay. And you mentioned premiums and discounts.
Yes. Look at our AUSD example. The AUD interest rate, 0.05%, was lower than the USD rate, 1.20%, so RER is negative. And the forward rate, 1.3325, was lower than the spot rate, 1.3335.
Lower forward rate than spot.
When the forward rate for the price currency is lower than the spot rate, we say the price currency, AUD in this case, is trading at a forward premium against the base currency, USD. You get fewer AUD per USD in the future than today.
Okay. Lower interest rate currency trades at a forward premium. Makes sense. You need less of it in the future to compensate for its lower interest earnings.
Exactly. Conversely, if the foreign price currency's interest rate, RF, is higher than the domestic base currency's rate, R, then RF is positive. In this case, the forward rate will be higher than the spot rate. We say the price currency is trading at a forward discount. You'll need more of the price currency per unit of base currency in the future.
Higher interest rate currency trades at a forward discount. Got it.
Let's quickly look at the KR-WEUR example, example 7, to confirm this. Spot KR-WEUR equals 1,300. KRW rate RF, equal 0.75%. EUR rate on 0.25%.
Here, RF 0.75 is much higher than RF, near 0.25, so R referred is positive 1%.
Right. For a 75-day forward, the formula is F0 check 0 KR-WEUR T equals in 5 up the actual EUR at T, equal 0.075. You need 1,005,365. The exponent is positive.
Correct. The result is approximately 1,302.67. Since the forward rate, 1,302.67, is higher than the spot rate, 1,300, the Korean won, the price currency with the higher interest rate, is trading at a forward discount against the euro. It takes more one to buy €1 in the future.
Okay, that confirms the rule. Higher interest rate, more discount. Lower interest rate, lower forward premium. Exactly. Now let's bring this home with an Indian example for y'all to think about.
Please do.
If the Indian rupee interest rate, say on government bonds, is significantly higher than the US dollar interest rate, maybe INR rate is 7% and USD rate is 4%. My students, would you expect to pay more rupees or fewer rupees for $1 US in the forward market, say 6 months from now, compared to today's spot rate?
Okay, INR rate, 7% is higher than USD rate, 4%. Rupee is the price currency here, usually in India. USDNR, usually it's quoted USDNR, so INR is base. Let's rephrase. If rate is in USD, then INR is price currency. Let's assume in USD quote for this example. So INR rate, RARD, USD rate. What happens to in USD forward rate?
Since INR, the price currency INR has the higher rate. It should trade at a
Forward discount, meaning the forward in USD rate should be higher than the spot rate. It will take more rupees to buy $1 in the future.
Perfect. You've got it. Because the rupee earns higher interest, holding rupees is more attractive than holding dollars over that period, just based on interest. To prevent arbitrage, where everyone borrows USD, converts to INR, earns high interest, converts back, the forward rate must adjust so that you get fewer dollars back per rupee in the future compared to spot. The higher interest earned on the rupee is offset by the loss on the forward exchange rate. That's interest rate parity in action.
That was a truly excellent and very thorough explanation for foreign exchange. Super clear. Finally, let's turn our attention to our last major asset class for today, commodities.
Commodities, yes. Things like gold, crude oil, agricultural products like wheat, sugar, cotton.
Now, these commodities, they have some truly unique costs associated with them, things we don't typically see, or at least not to the same extent, with purely financial assets like stocks or bonds.
That's right. We touched upon them briefly. There are very real physical storage costs, renting warehouses or tanks. There's insurance needed against loss, theft, or damage. And for some, like grains or fruits, there's even the risk of spoilage. These are significant costs to carry.
But you also mentioned earlier that commodities can have a very special kind of benefit too, something unique.
Oh, yes. The convenience yield. This is a fascinating and sometimes quite subtle concept, specific mostly to physical commodities.
Convenience yield. Okay, what exactly is it?
It's defined as a non-monetary and implicit benefit that comes from actually holding the physical commodity inventory, especially when inventories of that commodity are low or there's uncertainty about future supply.
Non-cash benefit. How does that work?
Right. It's essentially the premium, the extra value that market participants, maybe manufacturers, producers, refiners, place on having the physical asset readily available for immediate use in their production process, or to ensure their supply chain runs smoothly. They might prefer owning the physical asset right now, even if it means paying a slightly higher spot price compared to what a purely financial calculation based on interest and storage costs might suggest.
Okay. Can you give an everyday example?
Let's go back to your sabzi example.
Yeah.
You urgently need fresh tomatoes and onions for tonight's dinner to make a quick curry, right?
Yes, I need them now.
Now, maybe a large online supermarket offers a slightly lower price per kilo if you order for delivery tomorrow.
Mm-hmm.
Or perhaps a wholesaler offers an even lower price if you buy a large quantity for delivery next week, but you need them now for dinner tonight. So you might still prefer to go to your local sabziwala, your trusted neighborhood vegetable vendor, and buy them immediately, even if his price is slightly higher than the delayed delivery options. Why?
Because of the convenience, the immediate availability.
Exactly. That immediate benefit, that value you place on having the physical vegetables in your hand right when you need them, that's very much like the convenience yield in commodity markets.
Yeah.
It's a value of having the physical good on hand, ready to use, avoiding potential stockouts or production disruptions.
Ah, okay. So it's a benefit of holding the physical stuff. How does it affect the forward price then? Does it push it up like costs?
No, remember, it's a benefit of ownership. And benefits, as we established, act to reduce the forward price relative to the spot price.
Right. Benefits pull the forward price down.
Exactly. The convenience yield effectively offsets some of the other costs of carry, like storage and interest costs. If the convenience yield is high enough, it can even outweigh all the costs, leading to that backwardation situation we mentioned where F0 is 0.
Okay, so convenience yield acts like a negative cost or a positive benefit?
That's a good way to think of it.
Yeah.
Let's look quickly at example 8, which is our gold example again. But this time, let's explicitly add storage costs.
Okay, gold with storage.
We start again with the fair spot gold price of USD 1,783.28 and the risk-free rate of 2%. Now let's assume there's a storage and insurance cost that amounts to USD2 per ounce, and this cost is payable at the end of the 3-month forward contract period.
Okay, a future cost of $2.
First, just like we did with dividends, we need to find the present value of this future storage cost. PV0C USD2 multiplied by 1.02 raised to the power of minimal 0.25 because the cost occurs in 3 months. This equals approximately USD 1.99. This is the value today of that future cost.
PV of cost is 1.99.
Now, the forward price formula that incorporates costs but assumes no benefits like convenience yield for now is S0 plus PV0C multiplied by 1 plus R raised to the power of T.
Okay, so we add the PV of the cost to the spot price before growing it forward, unlike dividends where we subtract it.
Exactly. Cost increase the base you grow forward, benefits decrease it. So the calculation is USD 1,783.28, our spot price, plus USD 1.99, the PV of storage cost, multiplied by 1.02, raised to the power of 0.25.
Okay, 1783.28 plus 1.99, 1.02 at 0.25.
This gives us a forward price of approximately USD 1,794.33.
Which is higher than the forward price we calculated without storage costs.
Yeah.
Which was 1792.1.
Correct. The key insight is clear. Storage costs, being a positive component of the cost of carry, increase the forward price. The forward price must compensate the holder of the physical commodity for bearing those storage and insurance expenses over the 3 months.
Makes perfect sense. Costs push the forward price up.
Now, one final important point on convenience yield. Sometimes in real commodity markets, you might observe a forward price that is significantly below the theoretical no arbitrage price you'd calculate just using the spot price, the risk-free rate, and all known direct costs like storage.
So the actual market forward price is lower than SEO plus PV costs, 1 plus RT.
Yes. When you see that when the market forward price is surprisingly low, maybe even below the spot price, backwardation, it's often a very strong indication that there's a substantial convenience yield being implicitly valued by the market.
Meaning the benefit of holding the physical commodity now is considered very high by market participants.
Exactly. Maybe inventories are very low, or there's a fear of supply disruption. The market is effectively saying, we value the immediate physical availability of this commodity so highly that it outweighs the financial costs of storing it and the lost interest, driving down the future price relative to what pure financial math would suggest. A high convenience yield signals scarcity or strong immediate demand for the physical good.
Wonderful. That really clarifies the role of storage costs and the unique concept of convenience yield for commodities. So we've now seen how this umbrella term cost of carry encompasses the opportunity cost, the risk-free rate R, other direct costs like storage and various benefits like dividends or interest, or this special convenience yield, often included implicitly with an I or treated separately. And it's the net effect of all these the costs minus the benefits that ultimately shapes the relationship between an asset's spot price today and its forward price for delivery in the future. They are the true drivers of the carry aspect, determining whether the forward price is higher, contango, or lower backwardation than the spot price.
Perfectly summarized.
Yeah.
Exhibit 10 in the source material actually provides a nice table summarizing these components for different asset classes.
Right. Now, just for a quick final thought for all our diligent students listening, let's say you're looking at a particular commodity, perhaps a certain type of grain like basmati rice, and you know it has both very high storage costs, needs special climate control maybe, and potentially a significant convenience yield. Maybe it's harvest season and millers need it urgently. Can you immediately say whether its forward price will be higher or lower than its spot price just based on knowing both factors exist? What do you think?
Can you tell just from that?
No, right. You cannot immediately say. You need more information. You need to know the net effect. Which factor is stronger in the current market conditions? Are the high storage costs outweighing the convenience yield? Or is the urgent need for physical rice making the convenience yield dominate the costs?
It's a balancing act.
It's a careful balancing act. You need to quantify both sides, the total costs and the total benefits, to determine whether the net cost of carry is positive, leading to contango, or negative, leading to backwardation. The market price constantly reflects that evolving balance.
So, my dear students, we have truly covered quite a lot of ground today in our deep dive into the fundamentals of derivatives pricing. We began with arbitrage. We understood it as that powerful, almost invisible force that ensures financial markets remain efficient by quickly eliminating any fleeting opportunity for riskless profit.
The market's self-correction.
Exactly. It's the market's constant self-correction mechanism. Then we explored replication. This showed us the elegant simplicity, really, of how we can recreate complex financial positions using simpler building blocks, the underlying asset and cash. And this proved why identical payoffs must, and indeed do, have identical costs in an efficient market.
Build it yourself for the same price.
Precisely. And finally, we delve deeply into the cost of carry. This beautifully explains all the various expenses, like interest foregone, storage, and benefits, like dividends, convenience yield, associated with holding an asset over time. And it's this net cost of carry that fundamentally shapes the difference between its spot price today and its forward price for future delivery.
Putting it all together.
Yes. These three concepts, arbitrage, replication, and cost of carry woven together, they form the absolute bedrock of pricing derivatives. They are fundamental to understanding the very efficiency and fairness of our modern financial markets.
Absolutely. And remember, my dear students, these foundational concepts, yes, they might feel a bit challenging at first exposure. That's perfectly normal.
Very normal. Take your time.
But they are truly crucial for your CFA journey and really for any serious understanding of how finance works. They are the keys, the building blocks to unlocking a much deeper understanding of how the world's financial gears turn. So please keep practicing these ideas, keep reviewing them in your notes.
Revisit the examples.
Yes, revisit the examples, and don't hesitate to listen to this deep dive again or read through the materials as often as you need for it to really sink in. Build that strong foundation. And now, just before we wrap up, a final provocative thought, something for all of you to perhaps mull over, think about after our discussion today.
Okay, a takeaway thought.
Now that you understand arbitrage and the cost of carry, the next time you happen to see the current price of gold, maybe in the newspaper or online, versus the price of a gold futures contract for delivery, say, 3 months from now, what new questions will you ask yourself about why there's a difference between those two prices? What factors might be causing it?
Thinking beyond just the numbers.
Yes. Or maybe something closer to home. When you are comparing two different savings schemes or investment options, beyond just looking at the headline interest rate they offer, what other hidden costs, like fees or lock-in periods, or maybe benefits like flexibility or insurance, might you now consider, based on our discussion of cost of carry today? How might those subtly influence your effective return? Think about how these real-world financial decisions tie back to the fundamental principles we explored in our deep dive. Thank you all so much for joining us today on the deep dive. It's always a pleasure guiding you through these concepts.
Indeed, keep learning, keep exploring, be curious, and we wish you all the very best for your ongoing studies. Namaste.
Namaste, and a very warm welcome to the deep dive. We are so incredibly pleased you decided to join us today for what promises to be a truly enriching session. This deep dive has been meticulously crafted especially for you, our aspiring finance students, particularly those of you embarking on your exciting CFA journey who might be feeling a little unsure about finance or accounting fundamentals. Please, don't you worry for a moment. We are here to illuminate every concept, patiently and clearly, step by step.
That's absolutely right. Our core mission today is to gently, yet thoroughly, introduce you to forward contracts. These are financial instruments that might initially sound a tad complex, but I promise you they're built on very logical and intuitive ideas once we peel back the layers. We will meticulously break down how their value is determined at different stages of their life and truly clarify what mark-to-market means in practice. From there, we will thoughtfully explore the crucial role interest rates play in shaping special forward contracts, especially those involving foreign exchange and future interest rates themselves. Our source material is indeed rich with profound insights, and we are committed to extracting every significant nugget of knowledge for you, ensuring it's easy to digest and remember.
Yes, think of us not just as hosts, but as your dedicated mentors and guides in this fascinating world of finance. We'll use simple, relatable language and, as always, connect complex financial terms to everyday Indian examples just as we would in a real classroom setting to ensure everything clicks into place. So please, settle in comfortably, maybe grab a cup of chai and your notebooks, and let's truly begin this foundational deep dive. All right, let's begin our exploration by truly unpacking the foundational concept. What exactly is a forward contract at its very essence? Let's simplify it. At its core, a forward contract is essentially a formal private agreement that you enter into today. This agreement is a promise to either buy or sell a specific asset at a fixed price on a future date that you both agree upon. Imagine it like a written promise, a pact that both parties are legally bound to fulfill. It's a remarkably simple yet profoundly powerful idea in the world of finance.
And you've hit the nail on the head. The profound reason this agreement holds such importance is that it allows both the buyer and the seller to lock in a price right now.
This ability to fix a price today significantly diminishes the uncertainty they might otherwise face regarding future price fluctuations. Think about a business, perhaps a large Indian textile company, that knows it will need a certain quantity of cotton in 6 months. Without a forward contract, they'd be at the mercy of volatile cotton prices in the future. That could severely impact their profit margins. But by entering a forward contract, they secure their input cost. This doesn't just reduce uncertainty, it offers a critical strategic advantage. Predictable input costs, which allows them to set their product prices and profit margins with much greater confidence. Imagine an airline locking in its future jet fuel price. This doesn't just save them money if prices unexpectedly surge, it stabilizes their entire operating budget, allowing for far more precise financial planning and less volatile earnings. That, my dear students, is the real power of these seemingly simple agreements, moving from reactive guessing to proactive strategic management.
That's such a clear explanation. It immediately makes the abstract concept practical. Let's use an even more relatable Indian example. Imagine you are planning a very significant family event, say a grand wedding, that is scheduled for next year. Today, you visit a wedding hall owner, a trusted local business. You have a conversation, and you both agree to book the hall for a specific date next year. But here's the crucial part. You agree to fix the price for the hall now, today itself. This fixed price that you both agree upon today is precisely like your forward price. The actual market price for wedding halls next year, closer to your wedding date, might be much higher due to demand or perhaps a little lower. Who knows, right? But because you've entered into this forward contract, you've locked your cost in. And here's a foundational concept that's vital for your CFA journey.
When you first make this agreement, at what we refer to as time T0, the contract itself has a value of 0. No money changes hands immediately. It's just a promise, a commitment on paper. This zero value at infection is a very, very important principle that underpins how we think about derivatives. You must remember this.
That analogy of the wedding hall is excellent. It truly connects the dots. And it brings us to a fundamental distinction in finance that often confuses students: pricing versus valuation. When we refer to the price of a forward contract specifically, that fixed agreed-upon future exchange rate, often written as F0T, this price is set at the very beginning of the contract and it remains constant throughout its entire life. It doesn't change. However, the value of that contract, which is what we call its mark-to-market or MTM value, changes dynamically as time progresses and as underlying market conditions shift.
That's where the confusion can come in. So if the price is fixed, why does its value fluctuate? It almost feels counterintuitive at first glance.
That's a very perceptive question, and it's a critical insight. The value changes because as days and weeks pass, and the spot price, that is, the current market price of the underlying asset today, right now, changes. Well, what might have seemed like a perfectly fair deal at the contract's inception can quickly become very favorable or very unfavorable to one of the parties. This dynamic situation, reflecting how much the contract is currently worth if you were to settle it today, is what we call valuation. And this valuation is profoundly driven by a fundamental principle in finance, a cornerstone really, known as the no arbitrage principle. This principle essentially states that the initial forward price is set in such a way that no one can possibly make a guaranteed, risk-free profit by simply entering into this contract and simultaneously performing some clever, risk-free offsetting transactions in the market. It's designed to prevent easy money from being made without taking on any risk. It's like no free lunch, The no arbitrage principle isn't just an abstract rule, it's the invisible force that constantly keeps financial markets honest and efficient. Any slight deviation from fair value, any theoretical free lunch, is immediately spotted and exploited by sharp market participants. This rapid exploitation drives prices back to equilibrium, effectively baking the fair value into the asset. Understanding this principle is crucial because it's the fundamental assumption underlying almost every pricing model you'll encounter in finance. It ensures that the prices we derive are, in theory, the only prices that make sense in a rational market.
The no arbitrage principle. It's truly like the fundamental law that keeps the financial universe in balance. So let's revisit that idea of the value at initiation. You mentioned that at time T0, the exact moment a forward contract is first created, its value is always precisely 0. This, my dear students, is a very, very important concept for you to internalize for your CFA studies and beyond. It's non-negotiable, 0 at the start.
Indeed, it's a bedrock principle. It simply means that when both parties sign the contract, neither the buyer nor the seller has immediately gained or lost any money. They haven't exchanged any value yet. They've merely made a commitment for the future. Consider the example given in our source material involving AMY Investments. They entered into an agreement to purchase 1,000 Airbus shares at a forward price of EUR 30 per share,
with settlement due in 3 months. At the very moment they sign this agreement, the value of that contract to both AMY Investments, who is the buyer taking the long position, and the financial intermediary, who is the seller taking the short position, was absolutely zero. Zilch. It was purely paper agreement, a future promise, not a transfer of current value. This concept is vital because it separates the act of entering the contract from the valuation of the contract as market conditions change.
So, my bright students, a quick check for understanding. If you were to enter into a brand new forward contract today at this very moment and nothing else has happened in the market, what would be the value of that contract for both you as one party and the other party involved? Would it be a positive amount, a negative amount, or precisely zero? Take a moment to think about it. The answer is always zero for a newly initiated contract, isn't it? Now, let's fast forward to the very end of the contract's life. When the agreed-upon future date finally arrives, what happens at maturity?
Certainly. When the forward contract finally reaches its agreed-upon future date, which we term its maturity or time t, its value at that precise moment is straightforwardly determined. It's simply the difference between the spot price of the underlying asset at that exact moment, we refer to this ST, and the forward price that you initially agreed upon. It's a direct comparison. Market price versus your contracted price. Simple as that.
And how exactly do we calculate that difference for each party? Because one person's gain is the other's loss, right? It's a zero-sum game at that point.
Precisely. It's a zero-sum game at maturity. For the buyer, who is said to hold the long position, the value at maturity is calculated as the spot price at maturity, ST, minus the forward price, F0T. So the buyer gains if the market price at maturity is higher than their agreed-upon fixed price. Makes sense, yes. Conversely, for the seller, who is in the short position, it's the forward price, F0T, minus the spot price at maturity. The seller gains if the market price at maturity is lower than their agreed-upon fixed price. Notice the perfect symmetry. One's gain is indeed the other's loss.
Let's make this crystal clear with another everyday Indian example. Imagine you go to your trusted vegetable vendor in the morning. You agree today to buy 1 kilogram of fresh potatoes from him for 20 next month. This euro is your fixed forward price, F0T. Clear. Now, imagine a month passes, and it's the day you go to pick up the potatoes. If the market price, ST for potatoes in the local market, is 25 per kilogram, you, as the buyer, will be quite pleased, won't you? Because you bought them cheaper than the current market rate. Your gain is 25, the market price, minus 20, your fixed price, which is 5 hure. The vendor, who is the seller, would consequently have a loss of euro. See how it's perfectly symmetric. Now, what if on that day the market price, ST, is 18 per kilogram? What happens then? In this scenario, you as the buyer would incur a loss of euro. That's 18 minus 20. And the vendor would have a gain of euro. That's 20 minus 18. The gain for one is exactly the loss for the other. Very straightforward at maturity.
This simple analogy perfectly illustrates the core mechanism. We saw this principle vividly in the Viswan family office, VFO example, provided in our source material. VFO had agreed to sell 10,000 shares of Binomial Limited for INR 300.84 per share, with maturity in 6 months. If the spot price at maturity, ST, was INR 200.87 per share, then the buyer of the shares would have suffered a loss of INR 13.84 per share, that's INR 287, INR 300.84, because they were committed to buying at a higher fixed price when the market price was actually lower. Are you following? But VFO, being the seller, would have experienced a gain of INR 13.84 per share, INR 300.84, INR 287. On the flip side, if the spot price at maturity was INR 312 per share, the buyer would have gained INR 11.16 per share, INR 312, INR 300.84, and VFO, the seller, would have incurred an equivalent loss of INR 11.16 per share. It's a very clear demonstration of the symmetric nature of gains and losses at maturity, which is fundamental to understanding forward contracts.
So, my dear students, a quick but important check for your understanding here. If you were the seller in a forward contract, meaning you've agreed to sell an asset at a fixed price, and on the maturity date, the market spot price for that asset turns out to be lower than the price you initially agreed to sell it for, will you, as the seller, have a gain or a loss from this contract? Take a moment to think about it. You agreed to sell high, the market is now low. Okay. Game. Right. Okay, let's transition smoothly to the next crucial aspect. We've established that a forward contract begins with zero value and then its value crystallizes at maturity. But what happens in between these 2 points? Why does its value, what we call mark-to-market or MTM, actually change before maturity? It doesn't simply sit at zero until the very last day, does it?
That's a profoundly important question. And the answer is no, it absolutely does not stay at zero. The value of a forward contract changes continuously from the very moment it's created until it expires. There are 2 primary drivers for this dynamic change. Firstly, there's the simple passage of time, because every day, the future settlement date draws closer. Secondly, and far more significantly, are the changes in the spot price of the underlying asset. If the current market price of the asset suddenly moves up or down, your fixed future agreement immediately feels more or less valuable. And thirdly, changes in the general risk-free interest rate also play a substantial role, which we'll delve into shortly. This concept of fluctuating value during the contract's life is known as mark-to-market, or MTM.
Think of it like a live cricket match scoreboard. The score, the run rate, the target, everything keeps changing with every ball bowled, doesn't it? Every boundary, every wicket, every dot ball, it all affects the immediate situation, how the game is unfolding. Similarly, the value of your forward contract keeps fluctuating with every passing moment and every change in the market price of the underlying asset. This constantly fluctuating value throughout the life of the contract is precisely what we mean by mark-to-market, or MTM. It's the current estimated worth of your contract if you were to settle it right now, today.
To be more precise, for an underlying asset that does not generate any cash flows such as regular dividends from a stock or rental income from property, the MTM value, which we denote as VTT, at any point in time, steep band before the maturity T is calculated using a specific and very important formula. This formula essentially compares the current spot price of the asset with the present value of the original forward price, F0T, that you agreed upon. This future fixed price is discounted back to today using the prevailing risk-free rate for the remaining time until maturity, which is TOT.
That sounds like we're bringing a future value back to today's terms. Can you give us the formula and then perhaps a simple walkthrough with some numbers? That always helps to cement understanding.
Absolutely. The formula for the mark-to-market value of a simple forward contract for the long position, the buyer, is VTT, V equals cent S0T, multiplied by 1 plus R raised to the power of minus T. Let me say that again slowly. VTT equals St minus S0T times 1 plus R raised to the power of minus T minus T. Now let's put some numbers to this to make it tangible. Imagine you entered into a forward contract to buy an asset for a fixed price of F0T of 1,000, and this contract matures in 1 year. So T1, the initial spot price, S0, was also 1,000. Let's say the risk-free rate R is 5% per annum. Okay, now 6 months have passed, so T is 0.5 years, half a year, and the remaining time until maturity, TT, is also 0.5 years. Still with me. During these 6 months, let's assume that the current spot price of 0 has risen to 1,050. So to calculate the MTM value for the buyer at this point, VTT, current spot price, minus the present value of the forward price. VTT equals 1,050 minus euro 5 divided by 1 plus 0.05 raised to the power of 0.5. First, let's calculate the present value of the original forward price. 1,000 divided by 1.05 to the power of a 0.5. That comes out to roughly 975.90. So the present value of your fixed future payment is 975.90 today. Now plug this back into the MTM formula. VTT equals 1,150 minus 975.90, which equals 74.9. This 74.0 represents your current gain, your MTM value, if you were the buyer and were to settle this contract right now. It captures both the increase in the spot price and the time value of money on your fixed future obligation. This formula essentially compares what the underlying asset is worth in the market today, that's your Saint, with what your fixed future obligation or right, your F0T, is worth today after bringing it back to present value terms. The difference between these two gives you your gain or loss if you were to settle the contract right now.
I see. So it's like comparing what you can sell or buy for now versus what your future fixed price is truly worth in today's money. For example, imagine you agreed to buy a plot of land for, say, 50 lakhs in 1 year. Today, if similar plots are selling for 52 lakhs, you might feel good because you locked in a lower price. That's the same part. But you also need to remember that 50 lakhs a year from now is worth a little less today because of the time value of money due to inflation or alternative investment opportunities. That's the present value part. This formula meticulously takes both factors into account, the current market price and the present value of your fixed future price. It's quite elegant, actually.
Precisely. Now let's talk about the impact of spot price changes on MTM. This is perhaps the most intuitive factor influencing the MTM value. If you are in a long position, meaning you are the buyer in a forward contract, and the underlying asset's current spot price goes up after you enter the contract, you will immediately see an MTM gain. Why? Because you agreed to buy it at a lower fixed price, and now the market value of that asset is higher. It's like buying a ticket for a cricket match for 500, and then before the match, the demand surges and similar tickets are selling for 800. You instantly have a paper gain of 300, right? Conversely, if the spot price falls, you will experience an MTM loss. The exact opposite is true for a short position, meaning you are the seller. If you agree to sell at a fixed price and the market price goes down, you gain.
We saw this vividly illustrated in example 2 from our source material, involving the Binomial shares. Remember the V's1 family office, VFO? They agreed to sell 10,000 Binomial shares for INR 300.84 per share. Let's imagine that immediately after they signed this agreement, the share price instantly jumped from its initial spot price of INR 295 to INR 325. Boom. The forward contract seller, which was V's1 family office, would immediately face an MTM loss. Let's quickly calculate. Assuming no time passed, the value of their short position would be F0T minus Saint, so INR 300.84, minus INR 325, which equals negative INR 24.16 per share. Why a loss? Because they had committed to selling at a lower fixed price of INR 300.84, while the market price suddenly became much higher at INR 325. So they were committed to selling something for less than its current market value, which represents an immediate theoretical loss. This is why MTM is so critical for risk management. It shows you your exposure in real time.
That's a very clear illustration. So, my eager students, a quick check for your understanding. If you are a buyer in a forward contract, meaning you hold the long position, and the current market spot price of the underlying asset suddenly drops significantly below your agreed forward price, will you have an MTM gain or an MTM loss? Consider your position carefully. You agreed to buy high. The market is now low, so loss, correct?
Now let's discuss another important factor, which sometimes feels a little less intuitive at first. The impact of risk-free rate changes on MTM. This often requires a moment of thought.
Indeed, it does, and it's a crucial one to grasp for your CFA exams. An increase in the general risk-free rate during the life of a forward contract will generally, now listen carefully, decrease the MTM value for a seller's position, the short position, and conversely increase it for a buyer's position, the long position.
Why does this happen? Can you explain the underlying logic behind this seemingly inverse relationship? It feels a bit backwards initially.
Certainly. The key here is the concept of present value. A higher risk-free rate means that the present value of that fixed future forward price becomes smaller. Remember, present value tells you what a future amount of money is worth today. If general interest rates in the economy go up, it means you can earn more by investing your money today. So a fixed amount of money you are due to receive in the future, or an amount you have to pay in the future, is considered less valuable in today's terms if rates rise. Follow. Let's make it concrete. If you are the seller in a forward contract, you are expecting to receive a fixed amount, the forward price, in the future. If the general risk-free rate increases, the present value of that fixed amount you'll receive decreases, because you could have invested your capital elsewhere at a higher rate and earned more. This effectively reduces the attractiveness of your fixed selling price from a present value perspective, and therefore reduces your MTM gain or increases your MTM loss. For a buyer who has to pay a fixed amount in the future, a higher risk-free rate makes that future payment's present value smaller, which is beneficial for the buyer, hence an MTM gain.
This is exactly what example 3 in our source materials showed for the V's1 family office, VFO. VFO was the seller, short position, of Binomial shares in a forward contract. When the risk-free rate in the market doubled from 4% to 8% during the contract's life, their MTM gain on the Binomial contract actually declined from INR 12.9 to INR 10.111. This directly shows how a higher risk-free rate reduced the present value of their fixed selling price and thus decreased their MTM gain. It's a very practical demonstration of the formula at work.
So, my bright students, a quick check for your understanding. Why would an increase in the general risk-free interest rate make a fixed amount of money you are due to receive in the future less valuable in present terms? Think about how much you'd need to put in a fixed deposit today to grow to a certain amount in the future if rates were much higher. You'd need to put in less, wouldn't you? That's the key.
So far, my friends, our discussions have focused on forward contracts for relatively simple assets, assuming they don't involve any extra income or costs during their holding period. But in the real world, this is rarely the case. Think about shares that pay dividends, or raw materials like wheat or oil that incur significant storage fees. This brings us to a very important concept called cost of carry. Have you heard of this?
Yes, the cost of carry is a truly critical adjustment, and it's something you'll encounter frequently in more advanced finance topics. Simply put, it represents the net of all costs and benefits associated with owning an underlying asset or an index over a period of time. It captures whether holding that asset costs you money, like storage fees, insurance, or financing costs for borrowed capital, or generates income for you, like dividends from stocks or interest payments from bonds. Basically, what does it cost or pay you just to hold it?
Let's make this relatable with an Indian example. Imagine you own a small shop, a Kirana shop in your neighborhood. Your daily sales are like the benefits or income you receive from owning the shop. That's the good part. On the other hand, paying your monthly rent for the shop, your electricity bills, and the salaries for your staff are all costs associated with running it. These direct costs and benefits profoundly impact the overall profitability of your shop, right? Similarly, for a financial asset, these embedded costs and benefits significantly impact how a forward contract on that asset is priced and how its value is determined throughout its life. The market will always account for these realities.
Absolutely. When the underlying asset generates cash flows, such as dividends, which we categorize as income or I, or incurs costs like storage fees, which we categorize as C, both the initial forward price, F0T, and the mark-to-market value during the life of the contract must be adjusted. We meticulously account for the present value of these future costs and benefits. It's all about fairness.
So how do these adjustments change our well-known formulas? Can you give us the updated versions and perhaps a numerical example? It's getting a bit more complex now.
Certainly. Let's take it step by step. The adjusted forward price formula for an asset that pays income IDR and incurs costs, C, becomes S0T equals 0, PV0 IR plus PV0C, multiplied by 1 plus R, raised to the power of T. Let's break this down. S0 is the current spot price. PV0I is the present value of any income you expect to receive from the asset during the contract's life, discounted back to time 0. You subtract this income because if the asset gives you income, the forward price should be lower to compensate the buyer for not receiving that income directly. Makes sense? PV0C is the present value of any costs you expect to incur from holding the asset, also discounted back to time 0. You add this cost because if the asset costs you money to hold, the forward price should be higher to compensate the seller who bears those costs until delivery. The entire adjusted amount, S0 PV0Y plus PV0C, is then compounded forward by the risk-free rate, R, for the contract's tenor, TP. This makes perfect economic sense, doesn't it? If the asset gives you income, the forward price should be lower. If it costs you money to hold, the forward price should be higher.
Okay, that handles the initial pricing. And what about the MTM formula during the contract's life? How does it adapt to these costs and benefits?
Good question. The adjusted MTM formula for the long possession, the buyer, is VTT plus PVTI plus PVPC F0T multiplied by 1 plus R raised to the power managed ETT. Here the current spot price is first adjusted by any remaining future cost or benefits from the current time T until maturity T. PVTI is the present value of income remaining from time T to T, and PVTC is the present value of cost remaining from time T to T, both discounted back to time T. This ensures we are comparing the current value of the asset, including its remaining cash flows or costs, with the present value of the original fixed forward price. Let's consider a practical example, like example 4 in the source about Unilever shares. Suppose a company, Hydas Capital, entered a forward contract to buy 1,000 shares of Unilever UL in 6 months. The current spot price, S0, is 2,500. Unilever is known to pay a dividend of 25 euros per share quarterly. Let's assume one dividend payment of 25 euros will occur in 3 months, halfway to maturity. The risk-free rate, R, is 5% per annum. First, let's calculate the original forward price, F0T, at time T00.
The present value of the dividend, PD0I, is 25 divided by 1 plus 0.0, raised to the power 0.25, which is about 24.7. So F0T, S0 PV0I times 1 plus euro I is 2,500 euro, 24.70 times 1 plus 0.05, 0.5 euro, 2,475.30 times roughly 1.0247, which comes to about 2,536.43. This would be the original forward price, adjusted lower due to the dividend. Now let's say 1 month has passed. The current spot price is 2,550. The remaining time until maturity, TT, is 5 months, or about 0.4167 years. The remaining dividend payment is still the one occurring in 2 months from now. So when you PVTI, the present value of that 25 dividend discounted back 2 months, PVTI divided by 1 plus 0.5 to the power 212, which is about 24.80. Now calculate MTM, VTT minus the PV of F0T, VTT minus the PV of S0T, VTTI minus the PV of F0T, ATTI minus the P1,550 euro minus 2,536.43 divided by 1 plus 0.0 raised to the power 5012, VTT at 2,525.20 and I'm in 2,535 euro 0.60, I flow 2,525 to euro 1 euro hour 39.60. This 39.60 euro is the MTM gain for the buyer after 1 month, considering the spot price increase and the impact of the upcoming dividend.
Our source, with example 4 involving Unilever, implicitly highlighted this. Because Unilever pays dividends, the calculation had to factor in the present value of these future dividends. It clearly showed how benefits, like dividends, reduce the forward price and impact the valuation.
Right. So My thinking students, here's a challenging thought for you to ponder. If an asset underlying a forward contract, like a bulk commodity, has significant storage costs involved, perhaps you need to rent a large godown or warehouse. How would that affect the forward price you'd agree to compared to an identical asset with no storage costs, assuming everything else at the spot price and risk-free rate is the same? Think about who bears those costs and how they would want to be compensated in the agreement. The price would be higher, wouldn't it, to cover those costs? Now, let's pivot from single assets to something even more dynamic and relevant in our interconnected world. Foreign exchange, or FX, forward contracts. These are a little special, aren't they? Because they invariably involve two different currencies. For example, our Indian rupees and the US dollar. And naturally, each currency typically has its own distinct risk-free interest rate. This dual currency aspect introduces an exciting layer of complexity and opportunity.
Absolutely. This is where the concept of interest rate parity comes into play, which is crucial for your CFA studies. The core concept here is that the relationship between the spot FX rate, that is, the current exchange rate you see today, like maybe 83 for $1, and the forward FX rate, the agreed upon future exchange rate fundamentally reflects the difference between the two countries' risk-free interest rates. This isn't magic. It's a very intuitive economic principle based on the no arbitrage condition we discussed earlier. If you could earn more by borrowing in one currency, converting, investing in another, and then converting back via a forward contract without risk, well, everyone would do it until that opportunity disappeared. The rates have to align.
Let's use a simple Indian example to cement this. Imagine you're planning a grand family trip to the USA next year, and you know you'll need US dollars. Today, the exchange rate might be, say, 83 for $1. This is your spot rate as zero. An FX forward contract is like agreeing today on the exact exchange rate you will get for your Indian rupees when you convert them into US dollars next year for your trip. That's your F0 goatee. The difference in interest rates between India and the US plays a direct role in how this future forward rate is set. If Indian interest rates are much higher than US interest rates, it will significantly impact that future forward rate you agree upon. It's all about what your money can earn in each currency over that period.
Precisely. This leads us to the important concepts of forward premium and forward discount. If the foreign currency, for instance, let's take the euro in a USD/EUR quote, where UR is typically the base currency has a lower risk-free interest rate compared to the domestic currency, say the USD, then that foreign currency, euro, is said to trade at a forward premium. This means you would need fewer units of the price currency, USD, to buy 1 unit of the base currency, UR, in the future via the forward contract than you would today in the spot market. It effectively becomes relatively cheaper to buy the lower interest rate currency in the future. Conversely, if the foreign currency has a higher risk-free rate than the domestic currency, it trades at a forward discount. The currency with the higher interest rate will trade at a discount in the forward market.
So the one with the lower interest rate gets a premium, and the one with the higher rate gets a discount. That's a very neat rule of thumb to remember for your CFA Level I, isn't it? Lower rate equaled premium, higher rate equals discount.
Absolutely. And the mathematical representation of this is quite elegant. The formula for the FX forward price, assuming continuous compounding for simplicity, which is common in derivatives, is SEO FDT, E FDT equals SED, multiplied by E raised to the power of R for O times T. Here, SEO FD is the spot exchange rate, units of domestic per unit of foreign, or vice versa, depending on the quote convention. F stands for the foreign currency and D for the domestic currency, and R is their respective continuously compounded risk-free rate. E is the base of the natural logarithm, about 2.718. T is the time to maturity in years. This formula precisely captures that interest rate differential. The MTM formula during the life of the contract is similarly structured, again using continuous compounding. VTT, RCT, or CC minus SE HTT, multiplied by E raised to the power of FE times CT. Notice how the interest rate differential is present in the exponent for both pricing and valuation, reflecting its continuous impact on the contract's value. Let's do a quick numerical example for the FX forward price. Suppose the current spot exchange rate, S0 for USD/INR, is 83.0. This means 1 USD costs 83 INR.
The risk-free rate in India, watered domestic, is 5.0% per annum, continuously compounded. The risk-free rate in the USA, RC at foreign Farron, is 2.0% per annum, continuously compounded. We want to find the 1-year forward rate, T1, F00 OFDT, F00 USD/NR1, ARC23 1.0T, F00 USD/NR1, F0 USD/NR1 equals 83.0003. Now, e to the power of negative 0.03 is approximately 0.970446. So F0 USD/NR1 and F400 USD/NR1 equals 83.00, 0.970446, which is roughly 80.55. So the 1-year forward rate for USD/NR will be approximately 80.55. Notice how it's lower than the spot rate, U3. This is because the foreign currency, USD, has a lower interest rate, 2%, than the domestic currency, INR, 5%. So the USD is trading at a forward premium against the INR. You need fewer rupees to buy a dollar in the future because you'd earn less interest holding the dollar compared to holding rupees.
This sounds a bit like magic, but it's truly just a beautiful application of mathematics and economic equilibrium, isn't it? It all has to balance out. Our source material, in example 5, involving Rookpoint Investors LLC, clearly demonstrated this. They entered a long USD-EUR forward contract. If the USD risk-free rate, which was considered the domestic currency's rate in that specific example, instantaneously rose, increasing the interest rate differential in the calculation, it actually led to an MTM gain for Rookpoint. Why? Because Rookpoint was buying EUR, lower rate currency in that scenario, let's say, and selling USD, higher rate currency. A rise in the USD interest rate made the future USD they were effectively selling more valuable relative to the EUR, leading to a gain on their long EUR position. It shows how rapidly shifts in relative interest rates can affect the value of an FX forward contract.
Right. So, my thoughtful students, here's a question for you to ponder and solidify your understanding. If India's interest rates are significantly higher than Japan's interest rates, and you are considering a forward contract for Indian rupee against Japanese yen, say INR JPY, would you expect the Indian rupee, the higher interest rate currency, to trade at a forward premium or a forward discount against the Japanese yen, the lower interest rate currency? Think carefully about which currency is relatively more attractive to hold for its interest rate. Higher rate means discount, yes.
All right, let's gracefully shift gears once more and dive into the fascinating world of interest rates themselves. Unlike assets like shares, where there's typically one market price at a given moment, interest rates don't simply have one single rate. You know how banks offer varying interest rates for fixed deposits of different durations, for example? One rate for a one-year FD, a different one for 3 years, and yet another for 5 years. We see this all the time. This very common phenomenon, where distinct interest rates exist for different times to maturity, is elegantly called the term structure of interest rates. It's like a map of rates over time.
Yes, James, this term structure is an incredibly important concept, particularly in fixed income and derivatives. It means we need a very precise way to understand and work with these different rates across different time horizons, because they are the essential building blocks for pricing and valuing more complex interest rate products. You can't just use a single interest rate for all calculations. You need the correct rate for the correct maturity. Accuracy is key.
So, how do we acquire these precise different rates for different maturities? We usually start with something called spot rates, or more precisely, zero rates. Can you elaborate on what these are and why they're so fundamental?
Absolutely. To price interest rate derivatives effectively and to understand the term structure, we first need to derive these spot rates, or zero rates. A zero rate, also known as a zero coupon yield, is simply the annual yield on a hypothetical bond that pays no periodic interest payments, no coupons, only a single lump sum payment at its maturity date. These are the most basic, pure interest rates for a given maturity, stripped of any complexities like coupon payments. Think of them as the building blocks.
But as most of us know, most government bonds, the ones we typically see trading in the market, do pay coupons, right? They give interest periodically. So how do we get these clean, theoretical zero rates from those coupon-paying bonds?
That's a crucial question, and it leads us to a widely used financial engineering technique called bootstrapping. It sounds complicated, but the logic is quite simple. We often bootstrap these zero rates from existing government bonds that do pay coupons. It's a methodical, step-by-step process. You start with the simplest bond first. For instance, you take a one-year bond that pays a single coupon and matures in 1 year. You use its price and cash flows to find the implied one-year zero rate, Z1. Pretty easy. Once you have that one-year zero rate, you then move to a 2-year coupon bond. You know its price, its future coupon payments. You know the discount rate for the 1-year coupon payment. That's Z1 you just found. By subtracting the present value of the first coupon from the bond's price, you are left with the present value of the final payment, coupon plus principal. This allows you to solve for the 2-year zero rate, Z2. You continue this iterative process, using the zero rates you've already found for shorter maturities to derive the zero rates for longer maturities, one by one. It's like building a ladder, rung by rung, using the previous rung to step up to the next.
That makes perfect sense. Let's imagine we are looking at fixed deposits, or FDs, that banks offer in India. You might have offers for FDs of 1 year, 2 years, and 3 years, all with different annual interest rates. These are effectively like your yields to maturity for coupon bonds. To find the zero rates for these, it's like figuring out the exact effective interest rate if you were to invest for only 1 year, only 2 years, or only 3 years, with no intermediate interest payments as if they were zero coupon FDs. Our source gave a fantastic example 6, which explicitly walked us through how to derive the 1-year Z1, 2-year Z2, and 3-year Z3 zero rates from observed annual fixed coupon government bond prices and yields. This meticulous process of using coupon bonds to derive zero rates is what we call bootstrapping, and mastering it is invaluable for your CFA studies.
And arising directly from these derived zero rates is another absolutely key concept, the discount factor. The price equivalent of a zero rate is called a discount factor, d phi I. It's calculated as 1 divided by 1 plus psi raised to the power of I, where I is the period in years for which the zero rate z applies. So the formula is d phi 1 plus xi. Think of a discount factor like this. If you want to receive exactly 1 in the future, say in 3 years, and the 3-year zero rate, Z3 is 4%, the discount factor tells you how much money you need to invest today to get that euro. It's the current price you pay for that future single rupee. For example, if the 3-year zero rate is 4%, then Z3 equals 0.04 and I is 3. DF3 passes 1 plus 0.043 with 1.804. F03 through all to 1.124864 is 0.889. This discount factor of 0.889 means you would need to put 0.889 in a bank today, earning that 3-year zero rate of 4% compounded annually to end up with exactly euro in 3 years. It is, in essence, the present value of 1 unit of currency that you will receive on a future date, or it can be interpreted as the current price of a zero coupon bond that will pay euro maturity, the inverse of compounding.
So it tells you precisely how much money you need to put in today to get 1 rupee in the future. For example, if you know you need 1 lakh for your child's higher education in exactly 5 years, and you know the 5-year zero rate, the discount factor for 5 years, DF5, tells you exactly how much money you need to put in a zero coupon fixed deposit today to reach that euro lakh goal. You just multiply euro lakh by DF5. It simplifies future planning immensely.
Exactly. It's a fundamental and very practical tool in finance. Now, for a quick check for understanding, my sharp students, if you have a 2-year zero coupon bond that is designed to pay exactly 100 euro at its maturity in 2 years, and the prevailing 2-year zero rate, Z2 in the market, is 4% per annum, would you pay exactly 100 for this bond today, or would you pay less? And more importantly, can you explain why? You'd pay less, right? Because of the time value of money. You'd pay the present value, which is 100 times DF2, or 1.042.
Building on our solid understanding of zero rates, we now arrive at a truly fascinating and powerful concept, implied forward rates, or IFR. This represents something quite special, a break-of reinvestment rate. What does that phrase, break-up reinvestment rate, truly signify? It sounds like predicting the future.
It does, doesn't it? But it's rooted in logic, not prediction. It means it's the specific interest rate for a future period that makes 2 different alternative investment strategies yield the exact same total return over a longer horizon. It's the rate at which you would be completely indifferent between choosing one path over the other. No preference because the outcome is the same.
Okay, that sounds like a clever financial puzzle. Can you tell us about these 2 investment strategies that must yield the same return?
Certainly. Let's outline them clearly. The first strategy is where you invest your money for a shorter period today using the current spot rate for that period, say ZA for period A. Then at the end of that initial period A, you take all your accumulated proceeds, principal plus interest, and immediately reinvest them at this implied forward rate for a subsequent future period, say period BA. The second strategy is simpler. You invest your money for the entire longer period B directly today using the current spot rate for that longer period, ZOB. The implied forward rate, IFR, is the hypothetical interest rate for that future segment of time, from A to B, that ensures the total money you receive from these 2 options over the same final duration B is precisely identical.
I think I have a perfect, relatable Indian example for this, something we all might consider. Imagine you have $10,000 to invest. You have 2 choices for a 2-year investment. Option 1, you put your $10,000 into a 1-year fixed deposit, FD, today at the 1-year rate, Z1. After 1 year, you take the money out, including the interest earned, and then immediately put that entire amount into another 1-year FD for the 2nd year. Option 2, you could simply put your $10,000 into a single 2-year FD today at the 2-year rate, Z2. The implied forward rate, IFR, for that second 1-year FD, the one starting 1 year from now, is the specific interest rate that makes the total money you get from option 1, the 2 separate 1-year FDs, exactly equal to the total money you get from option 2, the single 2-year FD. It's about ensuring there's no arbitrage, no free lunch between sequential short-term investments and a single longer-term investment. You would be completely indifferent between the 2 pathways because they yield the same return.
That's a truly perfect analogy. It captures the essence beautifully. The no arbitrage condition, which is the cornerstone of all rational financial pricing, dictates that these 2 strategies must have equal returns. This equality is precisely what allows us to mathematically derive the IFR. The general formula for calculating implied forward rates, assuming discrete compounding like annual rates, is 1 plus ZA raised to power A multiplied by 1 plus IFRA BA raised to power BA equals 1 plus ZRA raised to power B. Let's break down these terms carefully. VA represents the spot or zero rate for the shorter period, A, e.g. a 1-year zero rate, Z1, so A1. ZB represents the spot or zero rate for the longer period, B, as your 2-year zero rate, Z2, so B2. IFRA BA is the implied forward rate that starts at time A and lasts for BA periods. So if A is 1 year and B is 2 years, BA is 1 year, and IFRA BA would be the 1-year forward rate 1 year from now. We often call this IFR 11. Let's use the numerical example provided in our source material, example 7, which used the 1-year and 2-year zero rates derived earlier. Assume Z1, the 1-year zero rate, is 4.0% or 0.04, so A1.
Assume Z2, the 2-year zero rate, is 4.25% or 0.0425, so BQ2. We want to find IFR 11, 1-year rate 1 year from now. Here, BA equals to 1, using the formula. 1 plus C1, 1 plus IFR 11, 1 plus IFR 11, 1 plus IFR 1 plus IFR 11, 1 plus IFR 11 plus IFR 11, 1 plus IFR 11 is 1 plus IFR 11, 1 plus IFR 1 plus IFR 11, plus 1 plus IFR 11, that's 1 plus IFR 11, 1 plus 0.68065. And divide both sides by 1.0401, plus IFR 65, 1.04, 1 plus IFR 11, and 1.011, 1.0445. Just we calculate that VFO example number. The source used 4.499%. Let me check my math. 1.0860604, 1.0450006. Right, let's use the source number for we'll see 1 plus IFR 11, 1.01 plus 0.044999. Using the source as more precise number from example 7, likely 4.4436%. Originally needing to do this. IFR 1 is 0.044999. Using 0.044499 and 4.499, not originally putting into this. IFR 1 approach 7.044499, 1.044999, or 4.499%. As he stressed that the market expects 1-year rates to be slightly higher, around 4.5% 1 year from now, compared to today's 4.0%.
That numerical walkthrough truly makes it concrete. So the implied forward rate is essentially the market's expectation of a future spot rate embedded within the current term structure. It's derived, not explicitly quoted.
Exactly. Now, here's an extremely important detail that many students, especially those starting their CFA journey, often overlook, leading to errors in calculations. When you are dealing with market reference rates, MRRs, or other interest rates that have different periodicities, meaning they are quoted for different time intervals, like 3-month rates compounded quarterly or 6-month rates compounded semi-annually, you must first convert them all to a consistent compounding period before you can accurately apply the IFR formula. For instance, convert them all to quarterly effective rates, or annual effective rates, or continuously compounded rates. This ensures you are comparing apples to apples, avoiding compounding mismatches. Very important.
Why is that conversion so critical? Why can't we just use the rates as they're quoted? It seems like extra work.
Because if the compounding periods are different, the stated annual percentage rates, APRs, aren't directly comparable. An 8% annual rate compounded semi-annually is effectively different from an 8% annual rate compounded quarterly in terms of the actual interest earned over a year. You wouldn't compare a simple interest rate with a compound interest rate without adjusting, would you? The conversion formula helps us translate between different compounding frequencies to find equivalent effective rates. The general conversion formula is 1 plus APRN raised to power m equals 1 plus APRN raised to power n. Here, APRM is the annual percentage rate compounded m times per year, and APRN is the equivalent annual percentage rate compounded n times per year. The source material provided an excellent illustration of this, calculating the IFR 3M, 3 meter, a 3-month MRR, 3 months from now. This involved carefully converting a 6-month MRR, which means it's usually compounded semi-annually M2, into an equivalent quarterly rate, N4, before applying the IFR formula. Without that meticulous conversion, the answer would have been incorrect. Let's quickly walk through an example of periodicity conversion.
Suppose you have a 6-month MRR of 4.0%, meaning 4.0% per annum, compounded semi-annually. So M2 APRM 0.04. We want to find the equivalent quarterly rate, N4, let's call it APR4, using the formula 1 plus P1.02, 2, 1 plus APR4 to 2 feet, so 1 plus APR44, 1 plus APR44, 1 plus APR442, 1 plus APR44, 1.01 plus APR44, 1.009504, or 1 plus APR44, APR4, 1.009950, 1 plus APR44, 1.009950, APR4, 1.0099950, 4.0398, or 3.98%. So an annual rate of 4.0% compounded semi-annually is equivalent to an annual rate of 3.98% compounded quarterly. You see, the difference is small but crucial for precise calculations, especially in financial derivatives. Always convert first.
So, my bright students, a final check here on this vital point. Why is it absolutely necessary for accuracy and to avoid arbitrage to convert interest rates to a consistent compounding period, whether quarterly, annually, or otherwise, before using them in the implied forward rate formulas? Think about what would happen if you didn't make that adjustment. You'd be comparing mismatched rates, leading to wrong conclusions and potential arbitrage. This brings us in our journey to a very specific and incredibly practical type of forward contract, the Forward Rate Agreement, or FRA. This is an over-the-counter OTC derivative, meaning it's typically a private agreement negotiated directly between two parties, unlike standardized contracts traded on an exchange like futures. In an FRA, two parties agree today to apply a specific interest rate to a hypothetical future loan for a defined period. It's like locking in a future borrowing or lending rate.
Yes, James, and this is a powerful tool for managing interest rate risk. Let's imagine you are a small business owner in Mumbai, and, with certainty, that you will need to take a business loan of 50 lakhs in 3 months to expand your shop. Your main worry is that general interest rates in the market might increase significantly by then, making your loan more expensive and impacting your expansion plans. That's a real risk, isn't it? An FRA allows you to fix the interest rate for that future loan today, even though you won't actually draw down the loan for another 3 months. It gives you immediate certainty on your future borrowing costs, effectively hedging your interest rate exposure.
So how does an FRA actually work in terms of its mechanics, and how is it settled? Because it sounds like you're fixing a rate for a loan that doesn't even exist yet. How does that cash change hands?
That's where the beauty of it lies. In an FRA, there is typically a fixed rate payer, who is also called the FRA buyer, or the long position, and a floating rate payer, often referred to as the FRA seller, or the short position. The fixed rate payer agrees to effectively pay interest based on a pre-agreed fixed rate, which is typically the implied forward rate at the contract's inception, that very IFR we just discussed. In return, they receive interest based on a floating market reference rate, MRR, that will be determined in the future, closer to the start of the hypothetical loan period. The seller does the opposite. They pay the floating rate and receive the fixed rate.
So it's not like an actual loan where you exchange the principal amount of 50 lakhs. This is a key distinction, right? No actual loan is made.
That's a very important detail, and a common point of confusion for new students. It's crucial to remember that only the net difference in these calculated interest payments is actually exchanged between the parties. The notional principal, that hypothetical loan amount like our 50 lakh example, is never actually exchanged. It's purely fictional, used only for calculation. It's merely used as a basis for calculating the interest amounts. Think of it like you and a friend making a friendly wager on future petrol prices. If the price goes up beyond a certain point, your friend pays you the difference based on a hypothetical quantity of petrol, say 100 liters. If it goes down, you pay them. You don't actually exchange barrels of petrol, only the cash difference based on that hypothetical amount. Similarly, in an FRA, it's a cash-settled agreement on an interest rate difference, not a principal exchange. This is why derivatives are so capital efficient. You only need to post margins on the potential gain-loss, not the full notional amount.
That analogy makes it much clearer. And how are these FRAs settled in terms of timing? Because you mentioned it's at the beginning of the interest period. That's unique, isn't it? Most interest is paid later.
Indeed, their settlement mechanism is quite unique. FRAs are typically cash-settled at the beginning of the interest period, during which the reference rate applies. This is often called settlement in advance. This means that once the floating MRR is determined at the start of that period, the calculated net payment amount, the difference between the fixed and floating interest, based on the notional principal and the length of the period, is immediately discounted back to that earlier start date. This is done because the payment is made up front, even though the hypothetical interest would accrue over the future period. The formula for the net payment, if paid at the end of the period like a normal interest payment, would be net payment and actual MRR fixed FRA rate, notional principal, number of days in period 360 or 365. The day count convention depends on the currency. Here, actual MRR is the market reference rate observed at the settlement date for the interest period, and fixed FRA rate is the agreed-upon fixed forward rate. Then this net payment is discounted to get the cash settlement PV at the beginning of the period. Cash settlement PV equals net payment, and 1 plus actual MRR, number of days in period 360 or 365. You use the actual MRR that's set for the period as the discount rate, because that's the prevailing market rate at the time of settlement. Our source gave us an excellent example with Yangtze Bank and a CNY forward rate agreement. Yangtze Bank used an FRA to hedge or offset an underlying floating rate liability they had. Let's say Yangtze Bank had a loan on which they had to pay a floating interest rate, like linked to MIBOR or something. To manage this risk, they enter an FRA where they agree to pay a fixed interest rate and receive a floating rate, effectively becoming the fixed rate payer or FRA buyer. If the MRR, the floating rate, turns out to be lower than the fixed rate they agreed to pay on the FRA,
Yangtze Bank would have to make a net settlement payment to the financial intermediary on the FRA. Oh dear, a payment. However, this payment on the FRA would then be precisely offset by a lower interest payment on their original underlying floating rate liability because the market rate went down. This example beautifully demonstrates the practical application of FRAs in managing financial risk for large institutions like banks by effectively converting their floating future interest expenses into fixed ones. It removes the uncertainty.
So, my diligent students, a final check for understanding for you here. If a business enters an FRA where they agree to receive a fixed interest rate, meaning they are the floating rate payer FRA seller, and on the settlement date, the actual market reference rate, the floating rate, turns out to be lower than their fixed rate, will they make a payment to the other party or will they receive a payment from the other party on this FRA? Think about it. They receive fixed, pay floating. Fixed is higher than floating. So they receive a payment, correct. Hashtag tag, 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 outro. What a profound journey we've undertaken today. We started with the very basics of forward contracts, understanding how they always begin with zero value, how their worth dynamically changes with shifts in spot prices and interest rates, and how their pricing elegantly adapts for elements like dividends or even different currencies. Quite a lot, wasn't it?
And we then, gently but thoroughly, moved into the fascinating and crucial world of interest rate forwards. We demystified how zero rates are carefully derived from existing coupon bonds through bootstrapping and what those implied forward rates truly represent for future investments, essentially, the market's expectation of future spot rates. We also saw how a forward rate agreement can be an incredibly powerful yet simple tool for institutions like banks to manage their complex interest rate risks.
Remember, my dear students, these concepts are absolutely foundational. They are the bedrock upon which a strong and comprehensive understanding of finance is built. Just like building a magnificent multi-story building needs a solid, unshakable foundation, your finance knowledge needs these basics to be rock solid. Please do not rush this learning. Go back to your notes, diligently practice the numerical examples given in our source material, and try to think of more everyday Indian examples to connect these abstract financial ideas to your own experiences. The more you revisit these ideas, the clearer and more intuitive they will become. Repetition and application are your best friends on this journey.
Indeed. And here's a thought for you to ponder and carry with you as you continue your studies, a question that connects these private agreements to the broader financial ecosystem. How do you think these forward contracts, which are often private agreements negotiated directly between two parties and are not publicly traded on exchanges, how do they contribute to the transparency and stability of the larger global financial market? Especially when we consider the very large notional principal amounts involved in many of these contracts. Does this hidden market add risk or help manage it? Think about the role of such bespoke instruments in a world that often values transparency, something to consider for next time.
Thank you so much for joining us on this deep dive. Keep learning, keep asking questions, and we'll enthusiastically see you next time for another insightful session. Good morning, dear students. Welcome back to another deep dive. I'm James.
And I'm Jennifer.
Today, we have a very important topic, especially for those of you who are just starting your journey into the world of finance.
Or perhaps preparing for your first finance examinations, yes.
Exactly. We are going to explore two very important financial instruments, futures contracts and forward contracts.
That's right. And our goal today is really to help you, our students, understand these, well, sometimes complex ideas.
We'll use simple, everyday examples, breaking down how their value and price are decided.
And also understanding why their prices might sometimes be different. That's key.
Don't worry if you are completely new to finance. We promise we will go slowly, step by step.
Just like we do in our classroom, making sure every concept is clear and easy for you to understand.
Think of us as your friendly guides on this learning journey.
We've gathered all the important information for you from, various sources in our own research.
And we will unpack it together, making sure we explain everything properly.
Our main aim today is not just to compare the value and price of forward and futures contracts.
Well, though we will do that.
Yes, but also to truly understand why their prices can sometimes be different.
This deep dive should give you a very strong foundation.
Explaining the what and the why behind these crucial financial instruments, hopefully helping you feel more confident.
All right, let's begin then. Let's start by understanding some common ground, some basic principles that apply to both of these contracts.
Good idea.
You see, both futures and forwards belong to a bigger family of financial agreements called forward commitments.
Forward commitments, what are these?
Well, simply put, a forward commitment is just an agreement to buy or sell something. We call it an asset in finance.
Like gold or shares or even wheat.
Exactly. To buy or sell it at a price that you decide today, but the actual buying and selling will happen on a future date.
Okay, so the price is fixed now, but the action is later.
Precisely. Imagine you want to buy a new bicycle, but you only have enough money next month. You talk to the shopkeeper today, fix the price of the bicycle, say 5,000 rupees,
Right.
and promise to buy it exactly 1 month from now at that fixed price. That simple promise, that is a forward commitment.
Ah, I see. A very practical example.
Whether it's a simple private agreement like this, which we call a forward contract, or a more formal futures contract, some core principles remain the same.
And these principles are really the foundation, aren't they? The bedrock of how these instruments work.
Absolutely. The first principle is preventing arbitrage. Now, what is arbitrage? Sounds a bit technical, maybe.
It does, but the idea is simple.
Think about our local Kirana shop, the small grocery store down the street.
Yes.
If you could buy a large bag of rice from one Kirana shop for, say, 500,
Okay.
and then, at that very same moment, walk right next door to another Kirana shop and sell that same bag of rice for 600.
Instantly. With no risk.
Exactly. Without any effort or risk, that 100 profit would be arbitrage. It's a profit made without any risk at all, simply by finding a price difference and exploiting it.
Like finding free money lying on the street.
Pretty much. But in the real world of finance, prices of these contracts are constantly adjusted by, clever market participants to prevent such easy, riskless profits from happening.
The market is very efficient, usually. Meaning it quickly closes these kinds of loopholes. They don't last long.
So, dear students, just to check, what do we call a profit made without any risk just by exploiting price differences?
Very good. That's arbitrage. It's like finding a small gap and slipping through it to get something for free. But in finance, as James said, these gaps close very, very quickly.
Okay, the second important principle is replication.
Replication, making a copy.
Sort of. This is a bit like making a perfect duplicate. Imagine you want to create the same financial outcome of a forward commitment.
Meaning ending up with the same profit or loss at the end.
Yes, exactly. But using simpler financial tools instead of the forward contract itself. You can actually do this
How?
by combining what we call a cash position and either borrowing money or lending money at the risk-free rate.
Okay, let's make this clear with an example. Suppose you want to be in the same position as someone who has agreed to buy a gold coin in 1 year.
Right.
Instead of signing a forward contract, you could do this. You buy the actual gold coin today. That's your cash position, holding the actual asset itself.
Okay, buy the gold now.
But perhaps you don't have all the money now to buy it. So you borrow the money needed to buy that gold coin today,
Borrow the cash.
and you borrow it at a special rate, which we call the risk-free rate. Now, what is this risk-free rate?
Good question. It's a theoretical rate, really.
Imagine you deposit money in a very, very safe government bank, like a fixed deposit in a nationalized bank here in India. The interest you earn on that fixed deposit, which has almost no risk of losing your principal money, is similar to the risk-free rate.
It's the return you get for just letting time pass without taking any real risk.
Exactly. So by holding the gold coin now, your cash position, and borrowing the money to buy it at the risk-free rate, you can actually replicate the exact same financial outcome as having entered the forward commitment to buy gold in 1 year.
It's a powerful idea in finance, this replication. It helps us price things.
It certainly does.
It's a very clear explanation. And finally, the third principle, cost of carry.
Cost to carry.
Think of it simply. If you buy a sack of potatoes today but only plan to sell them next month, you will have some costs, won't you?
Oh, yes.
But-
Storage, for one. They might spoil.
Right. Perhaps you need to pay for storage space, maybe even insurance to protect them from damage or theft. These are your costs of carry.
So the expenses involved in just holding something.
Exactly. In finance, cost of carry represents all the benefits you might receive and all the costs you might incur from owning an asset over a period of time.
Benefits, too.
Yes. For example, if you own gold, your primary cost of carry is likely storage. Gold doesn't really give you any income while you hold it.
Yeah.
But if you own a company's share, a stock, you might receive dividends. That's a benefit, like getting a share of the company's profits just for being an owner.
Ah, okay. So that reduces your net cost.
Precisely. So for a stock, the cost of carry would be your financing costs. Maybe the interest you pay if you borrowed money to buy the stock, minus any dividends you receive.
These costs and benefits, they must impact the future price, right?
Absolutely. They greatly impact what the future price of that asset should be compared to its current price. So students, when we talk about owning an asset for some time, what do we call the expenses and benefits involved?
Excellent. That's the cost of carry. Now, James, while these three foundational principles preventing arbitrage, replication, and cost of carry are common to both forwards and futures,
Yes.
futures contracts have some very distinct characteristics that truly make them different. And this is where we start seeing the divergence.
Okay, let's hear them.
The most defining feature of futures, I would say, is that they are standardized.
Standardized. What does that mean in practice?
It means they have fixed sizes for the contract. Like one contract always represents a specific quantity. They have predetermined maturity dates, maybe March, June, September, December each year, and specified qualities for the underlying asset.
For example?
For example, a futures contract for gold might always be for exactly 100 troy ounces of gold of a certain minimum purity, say 99.5% pure, maturing on the third Wednesday of certain months. Very specific.
Okay, so no flexibility there.
Not much, no. This is very different from forward contracts, which can be highly customized agreements made privately between just two parties.
Like our bicycle example earlier, tailored exactly to their needs.
Exactly. Forwards are flexible, bespoke. Futures are standardized, one size fits many.
Got it. What else?
Another key difference is that futures are exchange-traded derivatives, or ETDs.
Exchange traded, meaning?
It means they are bought and sold on organized public exchanges, just like how you would buy or sell shares of a company on the stock market, like the Bombay Stock Exchange, BSE, or National Stock Exchange, NSE, right here in India.
Ah, so it's public, transparent.
Yes. This public trading platform brings transparency and also liquidity.
Liquidity.
Meaning it's generally easy to buy and sell these contracts quickly without causing a big change in the price. Lots of buyers and sellers are usually present.
Okay. Standardized and exchange traded.
And one more crucial point for now. At the very beginning, when a futures contract is first made, we call this its inception.
The starting point.
Yes, its initial value is zero. This is a very, very important point to remember. No money is actually exchanged between the buyer and seller for the contract itself when they enter the agreement.
Zero value at the start, it's just a promise.
It's just a promise, an agreement. At this inception point, a futures price is established. We often represent this as S or OT.
The agreed price for the future transaction.
Correct. And this price is essentially the current market price of the underlying asset, the spot price compounded at the risk-free rate over the life of the contract.
So similar to how the forward price is set initially?
Very similar initially. To make it simpler, think back to our safe government bank fixed deposit example. The interest you earn is your risk-free rate. The futures price essentially incorporates this compounding effect, reflecting the time value of money.
It tells you what the price should be in the future, considering today's price, and the risk-free interest you could earn.
Precisely. So if a futures contract has a zero initial value when it starts, just to reiterate, what does that tell us about money exchange between the parties at that very beginning for the contract itself?
That's right. No money is exchanged for the contract at the beginning. Now, here's where it gets really interesting, dear students. This is, I think, the primary difference between forwards and futures, and something very important for you to grasp properly.
The core distinction.
Yes. The fundamental distinction lies in how gains and losses are handled throughout the life of the contract. For futures, there is daily settlement through something called a margin account.
Daily settlement and margin account. Key words here.
Absolutely. This is probably the single most important concept to understand when you compare the two. Think of it like a running score on a cricket match scoreboard. It gets updated constantly, right?
Yes, after every ball sometimes.
Almost. Here, it's every single day. At the end of the trading day, based on how the market moves and how the futures price has changed, your futures contract is effectively reset.
Reset.
Yes. Any gains or losses that occurred just for that day are immediately calculated, and then they're either added to or taken out from your special bank account, which is known as a margin account.
So profits are added, losses are subtracted daily.
Daily. This whole process, this daily calculation of gains and losses and their immediate settlement is called mark-to-market, or MTM, marking the value to the current market price each day.
Mark-to-market, MTM. Very important term.
This MTM process continues every single day until the contract reaches its maturity or expiration date.
Until the end.
Right. And as the contract gets closer and closer to its end date, the futures price will gradually converge, meaning it will come closer and closer.
To the spot price.
Exactly. Eventually, at maturity, the futures price will become the same as the spot price, which is the current market price of the underlying asset at that moment.
Because on the last day, the future is the present. There's no more time left.
Precisely. There's no longer any time value or cost of carry to consider separately for the future. So, students, let's check again. What is the key difference in how profits and losses are recognized in futures contracts compared to forward contracts?
Correct. In futures, gains and losses are settled daily via the margin account. While in forwards, it's usually just one big settlement at the very end.
This makes a huge difference in practice.
Oh, absolutely. Because of this daily settlement and the requirement to maintain funds in a margin account, the cash flow patterns for futures are quite different from those of forward contracts.
Cash flow patterns,
Yeah.
the timing of money moving in and out.
Exactly. Forwards typically involve just a single, often large cash flow, only at the very end of the contract's life, when the final settlement occurs based on the difference between the contract price and the spot price at maturity.
It's like maybe like waiting to pay your entire year's electricity bill all at once at the end of the year instead of paying smaller amounts every month.
That's a good analogy. One big payment versus regular smaller ones. Now, interestingly, even though the daily cash flows are different,
Yes.
the cumulative realized mark-to-market gain or loss over the entire life of a futures contract. So if you add up all those daily gains and losses,
The total over the whole period.
yes, that total is approximately the same as the total gain or loss for a comparable forward contract when they both mature.
So the end result, the total money is similar.
Roughly, yes. Think of it this way. Whether you pay your electricity bill daily, hypothetically, or you save up and pay one massive bill at the end of the year, the total amount of money you spend on electricity over that entire year should end up being quite similar.
Ah, okay. The path of those cash flows is just very different.
Precisely. And this difference in how cash flows happen, especially their timing, can also lead to a pricing difference between the two types of contracts, even if they are for the same underlying asset and maturity.
A difference in the actual futures price versus the forward price. Why?
It mainly depends on two things. First, how much interest rates change during the life of the contract. We call this their volatility. How much do they jump around?
Okay. Interest rate volatility.
And second, whether futures prices tend to move in the same direction as interest rates. This is known as their correlation. Do they go up together, or does one go up when the other goes down?
So the relationship between futures price movements and interest rate movements.
Yes. If interest rates are very stable and don't change much, or if there's no clear relationship, no correlation between interest rate changes and futures price changes, then this pricing difference between forwards and futures would be very small, almost negligible.
Interesting. So it's the interaction between daily cash flows and changing interest rates that causes the price difference.
That's the core idea. Also, James, there has been a significant change in the financial world recently.
Oh, what's that?
The emergence of derivative central clearing. This has started to introduce futures-like margining requirements, even for many over-the-counter OTC derivatives.
OTC, those are the private, customized forward contracts we talked about.
Yes, typically. Now, many of those, especially between large financial institutions, also require daily posting of collateral, similar to futures margins.
So forwards are becoming a bit more like futures in that respect.
In terms of the cash flow management and collateral requirements, yes. This has actually reduced some of the differences in cash flow and pricing that traditionally existed between futures, which are exchange-traded, and these OTC forwards. We'll touch on this again later.
Okay, good to know. Very well explained. Now let's maybe go back to the beginning and understand how a futures contract is priced right at its inception.
The starting point, time zero.
Yes, at T0. Just like we said for a forward contract, the value of a futures contract at its start, V0T, is indeed 0. Remember, no cash changes hands up front for the contract itself. It's just an agreement.
Value is 0. Price is determined.
Exactly. Now, let's take the simple case first. If we have an underlying asset, let's stick with gold as our example, and this gold has no costs associated with owning it, like storage fees, and no benefits either, like dividends.
A theoretical clean asset.
Yes. Then the futures price as 0T at time 0, T0, is calculated very simply. You take its spot price as 0, its current market price today,
A price, right?
and you compound it forward using the risk-free rate R over the total time until maturity T.
So you add the time value of money.
Precisely. The formula is very straightforward at 0T. S0t multiplied by 1 plus r raised to the power of t, or S0 1 plus rt. This formula basically tells us what the future price should be if the only factor was the time value of money applied to the current spot price.
It's like calculating how much your fixed deposit will grow to by the maturity date.
Exactly. Let's use a real example from our notes to make this concrete. Imagine you want to secure the price for buying 100 ounces of gold, maybe for your sister's wedding, which is scheduled in 91 days.
Okay, a specific time frame.
The current spot price of gold today, S0, is $1,770 per ounce. And let's say the risk-free rate, maybe from a short-term government bond, is 2.0% annually.
All right.
Now, if we imagine for a moment there are no storage costs for the gold for this 91-day period, just for simplicity.
Which might not be realistic, but helps understand the basic calculation.
Exactly. Then the no arbitrage futures price per ounce, the price that prevents riskless profit, would be calculated as $1,770 compounded at 2% for 900 and 365ths of a year. That comes out to $1,778.70.
So about $8.76 higher than the spot price.
Yes, that difference reflects the time value of money over 91 days at a 2% annual rate. So for a contract of 100 ounces, the total contract price would be $177,876.04.
That's the price locked in today for delivery in 91 days.
Correct. And students notice this. This initial price, $1,778.76, is exactly what we found for a forward contract in our previous lesson under similar assumptions, no costs or benefits. The initial price is the same.
So at the start, if there are no carrying costs or benefits, forwards and futures prices are identical.
That's right. So let me ask you this, students. If the current price of a stock is 100 and the risk-free rate is 5% per year, will the futures price for 1 year from now be exactly 105? Think about that for a moment.
Good question. Is it always that simple? Not always, dear students. That's a very insightful question, and it helps us understand the finer points.
So there's more to it.
Yes. The simple compounding formula that James just explained applies beautifully when there are no other costs or benefits associated with holding the asset.
But assets often do have costs or benefits.
Exactly. The futures price can indeed change. It will be different from that simple calculation if the underlying asset has ownership benefits, like the dividends you might receive from owning a stock during the contract period.
Or maybe rent you collect if the asset was a property.
Precisely. Or, similarly, the price changes if there are costs associated with holding the asset, like storage fees for a commodity like gold or oil or wheat, or maybe insurance premiums you have to pay.
Okay, so we need to account for these. How?
These benefits or costs are usually factored in by considering their value as of today, their present value.
Bring them back to today's value.
Yes. The formula then expands a little bit to include these. It becomes something like S0T, S0PV0I, plus PD0C multiplied by 1 plus RT.
Okay, let's break that down. S0 is spot price.
PVOI stands for the present value of any income or benefits you receive from holding the asset until maturity. Think dividends.
Okay, present value of income. And PV0...
PVC stands for the present value of any costs you incur for holding the asset until maturity. Think storage costs or insurance.
So we adjust the spot price first. We subtract the present value of benefits, add the present value of costs.
And then we compound that adjusted spot price forward at the risk-free rate to get the futures price.
Right.
That makes sense. You account for everything that affects the cost of holding it until a future date.
Exactly. Let's go back to our gold example to really illustrate this. What if there is a cost? Say, $2 per ounce cost for storage and insurance. And this amount is payable right at the end of the contract at maturity in 91 days.
Okay, a $2 cost at the end.
First, we need to find the present value of that $2 cost today. We use our 2.0% annual risk-free rate and discount that $2 back over 91 days. If we do that calculation, that $2 future cost comes out to be approximately $9.99 in today's terms.
So the cost is worth $1.99 today.
Yes. Then, according to our formula, we add this present value of the cost, $1.99, to the original spot price of $7,770. That gives us $1,771.99.
Adjusted spot price.
Right. After that, we compound this adjusted amount, $1,771.99 forward, at the risk-free rate over the 91 days. If you do that, the new futures price per ounce becomes $1,780.78.
So it's higher now than the $1,778.76 we got without the cost.
Exactly. It's about $2 higher, reflecting that $2 cost after adjusting for timing. You see, adding storage and insurance costs actually increases the difference between the spot price and the futures price.
Which is logical. If it costs more to hold the gold until the future price you agree upon has to be higher to cover those extra costs.
Precisely. The future price reflects not just the time value of money, but also these carrying costs.
Yeah.
Or it's reduced by carrying benefits like dividends.
Makes sense.
And just like we mentioned for forwards, if the actual traded futures price in the market is significantly below this calculated no arbitrage price, the fair price we just calculated.
Especially after carefully accounting for all cash costs and benefits.
Yes. If the market price is still lower, it might indicate something called a convenience yield.
Convenience yield, what's that again?
It's like a hidden non-monetary benefit of actually holding the physical asset now, rather than just having a promise for it in the future. It's often seen with commodities like oil or grains.
Why would holding it now be better?
Maybe there's a sudden shortage or production disruption, and having the physical barrels of oil today allows you to keep your factory running, which is more valuable than just the financial return. Or perhaps it's very difficult or costly to store, so people avoid holding large inventories unless there's a benefit. This convenience can effectively lower the futures price relative to the spot price plus costs.
Okay, that's a subtle but important point. That was a very practical example, Jennifer, showing how costs really impact the future price.
Now let's move on. We come to the part where the actual contract value changes over time after inception.
Yes, how the value evolves day by day.
And this is where forwards and futures truly start to look very, very different in practice. Let's revisit our gold example. Imagine a company, let's call them ProCam Investments, agrees to buy 100 ounces of gold at that price of $1,778.76 per ounce in 91 days. But they use a forward contract.
Okay, a forward contract this time.
As we discussed, no cash is exchanged for the contract at the very start, and its value at the beginning, V0T, is 0. Now, for a forward contract, the original agreed-upon contract price, F0T, equals $1,778.76, does not change once it's set at the beginning. It's locked in, fixed, like the tailor's price for your suit.
Exactly. However, the mark-to-market MTM value of the contract, which is its potential unrealized gain or loss at any point in time, does change daily.
Why does it change if the contract price is fixed?
Because the spot price of gold in the broader market keeps fluctuating day by day, and that changing spot price affects how much potential profit or loss your fixed price agreement currently holds.
So the value changes relative to the market.
Precisely. So let's imagine this scenario. 71 days have passed since ProCam entered the contract. Now only 20 days are left until maturity.
Okay, nearing the end.
And imagine the spot price of gold in the market has fallen significantly during those 71 days. Say it fell by $50 down to $720 per ounce now.
So the market price is much lower than ProCam's agreed buying price.
Yes. From ProCam's perspective, as the buyer in the forward contract, this is bad news. Their mark-to-market loss on this forward contract would be roughly the difference between their fixed price and the current market price, adjusted for the remaining time value. It calculates to about $56.83 per ounce.
So for 100 ounces, that's a significant unrealized loss.
A total of $5,683 for their 100 ounces. But here's the key difference, students. Please pay close attention to this. Under a traditional forward contract, no settlement of this $5,683 loss occurs yet.
No money changes hands.
Not yet. That $5,683 loss is just a potential loss, sitting on paper, an unrealized loss until the very last day, the maturity date. ProCam doesn't pay any money related to this loss today, nor does the other party receive anything.
It all waits until the final settlement day.
Exactly. And this means that one party carries the credit risk of the other party. In our example, the financial institution on the other side of the contract, who agreed to sell gold at $1,778.76, is now looking at a potential gain of $5,683.
But they are exposed to the risk that ProCam might not be able to pay that loss when maturity finally arrives.
Precisely. If the gold price keeps falling and ProCam's loss becomes massive, ProCam might default, unable to honor the contract. That's the credit risk.
It's like you lending a large sum of money to a friend, as you said earlier, and they promise to pay the full amount plus interest only on a specific date far in the future.
With no payments in between, there's always a risk they might run into problems and not have the money on that final day.
A default risk.
Yes. So students, just to be crystal clear, in a forward contract, when is the gain or loss actually realized? Meaning, when does the actual money change hands between the parties?
That's right. In a typical forward contract, the gain or loss is realized only at contract maturity, one single settlement at the end. Now let's contrast this directly with a futures contract using the very same goal example.
Okay, same scenario, but with futures.
Here, the initial futures price, F0T, is also $1,778.76 per ounce, just like the forward price was initially. But this is where the daily reality kicks in. Daily settlement rules apply.
The mark-to-market system.
Yes. When you enter a futures contract, you must first put up an initial cash margin. Remember this. Think of it as a security deposit.
Like the deposit for booking a wedding hall or renting a house, a good faith deposit.
Exactly. For our 100-ounce gold contract, for instance, the exchange might require ProCam, if they were using futures, to deposit, say, $4,950 into a special margin account held with their broker.
Okay, initial margin paid up front.
And they must also maintain a maintenance margin, which is a slightly lower amount, maybe $4,500 in this case. This is the minimum balance they must keep in their account at all times.
Like a minimum balance in a bank account.
Sort of, yes. If their account balance falls below this $4,500 level due to daily trading losses, they immediately receive something called a margin call.
A margin call, what does that mean?
It means the exchange, through their broker, asks them to deposit additional money right away. Typically, enough money to bring your account balance back up to the initial margin level, the $4,950 in our example.
So you have to top up the account immediately if it drops too low.
Yes, usually within one business day. If you fail to meet the margin call, the exchange has the right to close out your futures position to prevent further losses.
Okay, let's walk through a daily example for this futures contract. Say, on the very first day of trading after ProCam enters the contract, imagine the gold futures price falls by $5 per ounce.
A $5 drop on day one.
So for ProCam's 100-ounce contract, they have a $500 mark-to-market MTM loss for that day. 5 ounce multiplied by 100 ounces.
Right.
Under the futures system, this $500 loss is immediately deducted from their margin account, which initially had $4,950. So their balance drops to $4,450.
And $4,450 is below the maintenance margin of $400 to $500.
Exactly. Since the balance is now below the maintenance level, ProCam receives a margin call. They must deposit $500 immediately to bring their account balance back up to the initial margin level of $4,950.
So the loss is realized and paid on the very same day it occurs.
Yes. And this daily cash flow management is absolutely critical in futures trading.
And the most important conceptual point here is that after this daily settlement occurs, the MTM value of your futures contract itself resets to zero at the new closing futures price for that day.
Resets to zero. What does that mean?
It means that going into the next day, the contract is effectively marked at the new price. The gain or loss from the previous day has already been settled in cash. So the contract itself doesn't carry forward that unrealized gain or loss. Each day is a fresh start in terms of the contract's ongoing value calculation.
Ah, I see. Unlike the forward contract, where the unrealized loss just keeps accumulating on paper.
Precisely. This daily resetting means that the futures contract rarely builds up large unrealized gains or losses, like a forward contract often does. And this daily settlement mechanism is what significantly reduces counterparty credit risk.
Because profits and losses are exchanged daily in cash.
Yes.
Okay.
Because gains and losses are settled immediately, neither party can accumulate a massive, potentially unpayable debt to the other party over the life of the contract. The risk is managed day by day.
It's like your monthly electricity bill analogy again. You pay it every month. The company doesn't wait till the end of the year to send you a huge bill for the whole year's usage.
Which might be very difficult for you to pay all at once. This constant smaller settlement in futures prevents large accumulated debts and greatly reduces the risk of one party defaulting on their obligations. Makes the whole system much safer.
That's a very clear distinction. So students, if you get a margin call on your futures account, what is the main reason for it and what must you do immediately?
Very good. You get a margin call because your account balance has fallen below the maintenance margin level due to accumulated daily losses, and you must deposit funds immediately, usually back up to the initial margin level.
All right, that covers the core difference in settlement. Let's perhaps turn our attention now to another very important type of futures contract, interest rate futures.
Ah, yes, very widely used.
These are incredibly popular in financial markets. They offer a liquid, meaning easy to buy and sell quickly in standardized way for various entities like banks, corporations, or even governments to manage their exposure to interest rate risk.
Especially for short-term interest rates, like those over 3 months or 6 months.
Exactly. They're often used as a direct alternative to forward rate agreements, FRAs. FRAs are a type of customized forward contract specifically designed for locking in future interest rates. But they are OTC, not exchange-traded like futures.
So futures offer a standardized, exchange-traded way to do something similar.
Correct. Interest rate futures contracts are typically based on an underlying market reference rate, or MRR. This could be an interest rate like the old LIBOR or newer rates like SONIA or SOFR for a specific future period, like the 3-month rate starting in 3 months' time.
So it's essentially a bet or a hedge on where a specific short-term interest rate will be at a future point in time.
That's right. But here's a unique thing about them, something you need to remember. They trade on a price basis using a special kind of inverted formula. The price is usually calculated as price is 1000 yield. Or more formally, FABA equals 100, MRABA, where the MRR is expressed as a decimal. Let's just think of it as price 100 minus yield in percent.
100 minus yield. That's unusual. Why do they do that?
It's a market convention that developed historically. The key implication of this 100 minus yield convention is that if the underlying interest rate, the yield, goes up, the futures price goes down. And if the yield goes down, the futures price goes up.
An inverse relationship. Higher rates mean lower prices, lower rates mean higher prices.
Exactly. It might seem a little counterintuitive at first, but you get used to it. A high price on the futures contract implies the market expects a low interest rate, and a low price implies the market expects a high interest rate.
Okay, let's try an example. If an interest rate futures contract is trading at a price of, say, 98.25.
Right. Then we can easily find the implied MRR, the market reference rate that this price represents. Using the formula, price equals 100 yield. So yield equals 100 price.
Yield equals 100, 98.25 equals 1.75.
Exactly. The implied MRR is 1.75%. You see, when the futures price is lower, like 98.25, the implied interest rate is higher, 1.75%. And if the price was higher, say 99.50.
Then the implied rate would be 199.50 equals 0.50%, lower rate.
Excellent. If the price is 99, the implied MRR is 100. 99 equals 1.00%. Now let's understand what it means to take a long or short position in these interest rate futures.
Right. Buying or selling the contract. A long futures position in interest rates, meaning you buy the contract, means you will gain if the futures price rises.
And since price equals 100 yield, a rising price means
the future MRR is falling.
Yeah.
So being long means you effectively anticipate or want the future interest rate to fall. It's like you are positioning yourself as a lender who benefits from lower rates in the future.
Okay, long means you want rates to fall, price to rise. What about short?
Conversely, a short futures position, meaning you sell the contract, means you gain if the futures price falls.
And a falling price means
the future MRR is rising. So being short means you benefit if the future interest rate goes up. Here, you're positioning yourself more like a borrower who wants protection against rising borrowing costs. If rates go up, your short futures position generates a profit to help offset that higher cost.
That makes sense. Long benefits from falling rates, short benefits from rising rates.
Exactly. Let's illustrate this with a hedging example. Imagine a bank, let's call them Baywhite Financial. They offer 60-day loans to their corporate clients at fixed interest rates. But to get the money for these loans, they themselves borrow money from the market, perhaps at a variable 1-month MRR.
So they lend long-term, 60 days, at a fixed rate, but borrow short-term, 1 month, at a variable rate. Mismatch.
Big mismatch. This creates an interest rate exposure for Baywhite. They face the risk of a higher MRR in 1 month's time when they need to roll over their borrowing.
Because if their borrowing costs go up, but the rate they earn on their loans is fixed,
the profit margin gets squeezed. It could even turn into a loss.
So they need to protect themselves against rising rates.
Exactly. To hedge, this risk hedge means to protect or offset they can sell an interest rate futures contract on the 1-month MRR. They take a short position.
Because short positions benefit from rising rates.
Precisely. Let's say Baywhite sells a futures contract today at a price implying a 1.25% MRR for 1 month ahead. Now fast forward 1 month. If the actual MRR rises significantly, say to 2.25%,
which is bad for their borrowing costs.
Yes, but their short futures contract will gain value. Why? Because the actual yield, 2.25%, is higher than the yield implied when they sold the contract, 1.25%. This means the futures price would have fallen.
And since they were short, a falling price means profit.
Correct. This gain on the futures contract will help offset the loss they face from paying higher interest on their actual borrowing. It's a classic hedging strategy to neutralize the risk.
Very clear example of hedging interest rate risk.
This also brings us to a related concept called basis point value, BPV.
BPV, what's that?
It's a very practical measure used frequently with interest rate instruments. BPV represents the monetary value of a change of 1 basis point in the underlying interest rate. Remember, 1 basis point is tiny. It's 0.01%.
Okay, the dollar or rupee impact of a 0.01% rate change.
Exactly. For instance, for a hypothetical loan or contract with a face value, notional amount, of $1 million for a period of 3 months or 90 days, if the interest rate is, say, 2.21%, a 1 basis point, 0.01% change in that rate affects the total interest amount, and thus the contract value, by approximately $25. That $25 is the BPV for that specific contract.
So it quantifies the sensitivity to small rate changes.
Yes. So for Baywhite's much larger $50 million notional borrowing for 1 month, we could calculate the BPV. Turns out to be $416.67.
Meaning for every 0.01% change in the 1-month MRR, the value of their exposure changes by $416.67.
Correct. And importantly, for these short-term interest rate futures, this BPV is generally constant. There's a fixed linear relationship between changes in the yield and changes in the price, or value. A 1 basis point change always causes the same dollar change in value.
Linear relationship, like a straight line graph between yield and price change.
Exactly. This predictability is a key characteristic and advantage of using short-term interest rate futures for hedging.
That was a very clear explanation of interest rate futures, Jennifer, covering the pricing, the hedging use, and BPV. Now, let's circle back to something we touched upon earlier, why the prices of forwards and futures might differ.
Right, the potential price divergence.
We've established clearly now that the daily settlement in futures creates very different cash flow patterns compared to the typical one-time settlement in forwards.
Daily cash flows versus one final cash flow.
And we said these different cash flows are the primary reason why forward and futures prices can differ over the life of the contract, even when they're based on the same underlying asset and have the same maturity date.
The timing of money matters.
Absolutely. The timing of when money is received or paid, whether you get profits daily to reinvest or have to fund losses daily, fundamentally impacts how an investor experiences the contract and can influence the price they are willing to pay or receive initially.
But you also mentioned conditions where they would be identical.
Yes, that's important too. There are specific, though perhaps theoretical, conditions under which their prices would be exactly the same. The futures price, F0T, would equal the forward price, F0T.
When would it happen?
This happens if interest rates are constant throughout the entire contract period. So if the risk-free rate just stays flat from the start date to the maturity date.
No changes in interest rates at all.
Right. Or, alternatively, the prices would be identical if futures prices and interest rates are uncorrelated.
Uncorrelated, meaning?
Meaning they move completely independently of each other. There's no systematic pattern connecting their movements. Knowing how interest rates move today tells you nothing about how the futures price likely moved.
Okay, no relationship between their movement.
In these theoretical scenarios, the timing difference of the cash flows wouldn't create a systematic advantage or disadvantage for either contract type, because the rate at which you could reinvest gains or finance losses wouldn't be predictably linked to whether you were having gains or losses. So their prices would converge and be the same.
So students, just to check understanding, if interest rates never ever change during the entire life of a contract, will the prices of comparable forward and futures contracts be the same or different?
That's right, they would be the same. Now, here's where it gets a bit more nuanced. What happens if interest rates do change and they're correlated with futures prices?
Which is often the case in reality.
Yes. Let's consider the case where futures prices are positively correlated with interest rates. This means they tend to go up together and down together.
Okay, price and rates move in the same direction.
In this situation, long futures contracts, where you profit when the futures price rises, become more attractive than equivalent long forward positions.
More attractive, why?
Think about it. If you are long futures and prices are rising, giving you profits, this positive correlation means interest rates are likely rising too. So you receive your daily profits from the futures contract exactly when you can reinvest them at higher interest rates. That's good.
You earn more on your daily gains.
And conversely, if prices fall, giving you losses, interest rates are likely falling too, due to the positive correlation. So your daily losses happen when interest rates are lower, making it cheaper for you to borrow money to finance those daily margin calls. That's also relatively good.
So the timing works in your favor if you're long futures and there's positive correlation.
Exactly. This makes the long futures position slightly more valuable, so the futures price, F0T, might be slightly higher than the forward price, F0T, in this case.
Okay, what about negative correlation? if futures prices tend to fall when interest rates rise, and vice versa?
Good question. If futures prices are negatively correlated with interest rates, then the opposite logic applies. Long forward positions become relatively more desirable than long futures.
Why?
Well, if your long futures and prices rise, giving you profits, negative correlation means interest rates are likely falling, so you get your daily profits when reinvestment rates are low. Not ideal. And if prices fall, giving you losses, interest rates are likely rising, making it more expensive to finance your daily margin calls. Also not ideal.
So the timing works against you if you're long futures and there's negative correlation.
Correct. In this scenario, the long forward contract, which avoids these daily cash flow timing issues, looks better, so the futures price might be slightly lower than the forward price. It's all about how those daily cash flows from futures interact with the changing interest rate environment.
That's a subtle but really important point about why prices might differ based on correlation with interest rates. Now, let's talk about another related concept, especially relevant for interest rate instruments, called convexity bias.
Convexity bias sounds complex.
It relates to what we discussed earlier about interest rate futures versus FRAs. Remember we said for interest rate futures, the relationship between price and yield changes is generally fixed and linear?
Yes, the BPV was constant, a straight line relationship.
Exactly. But for forward rate agreements, FRAs, their settlement value depends on the present value of the final cash flow difference, calculated at maturity but discounted back.
Right, they use discounting.
This discounting means their price changes are not linear with respect to changes in the underlying interest rate. They exhibit something called convexity, which is very similar to how bond prices behave.
Convexity, meaning the relationship is curved, not a straight line.
Precisely. Let me try to explain. Imagine you have an FRA where you will receive a payment if rates are above a certain level. If interest rates fall significantly, the present value of any potential future payment decreases, but the percentage decrease might be different than the percentage increase if rates rose by the same amount. For FRAs and bonds, the price is more sensitive to rate decreases than to rate increases of the same magnitude.
So the price goes up more when rates fall than it goes down when rates rise by the same amount.
Exactly, in percentage terms. For a given change in the market reference rate, MRR, the percentage price change is greater in absolute value when the MRR falls than when it rises for an FRA. This nonlinear curved relationship is convexity.
Okay, and futures don't have this.
Generally, standard short-term interest rate futures have a linear payoff, partly because they settle daily and don't involve this final discounting calculation in the same way. This discounting feature in FRAs, which is absent or different in futures, creates this convexity bias.
And what's the effect of this bias?
It means that, particularly for longer periods, for contracts with longer maturities, the difference in settlement values or price behavior between an FRA and a comparable futures contract will become more noticeable due to this difference in linearity versus convexity.
It's like compound interest again. Small differences matter more over longer times.
That's a good way to think about it. You can think of convexity as providing a slight advantage, on average, because the gains from favorable rate moves are slightly larger than the losses from unfavorable moves of the same size. This slight advantage needs to be reflected in the price, causing a potential difference between the FRA rate and the futures implied rate, especially for longer maturities. This difference is the convexity bias.
That's a fascinating point about how the mechanics of settlement, daily versus final with discounting, can lead to these subtle but important differences like linearity and convexity bias. Very insightful.
It highlights how details matter in finance.
Indeed. Finally, students, let's wrap up by discussing that big change we mentioned earlier, the one that's actually making forwards and futures a bit more similar again. The rise of central clearing for OTC derivatives.
Yes, a very important development in recent years.
Historically, as we know, forward contracts were mostly private deals, negotiated just between two parties, maybe a bank and a large corporate client wanting to hedge currency risk, for example.
Bespoke agreements, often with flexible credit terms negotiated between them.
Right, and they typically didn't have the strict, standardized daily margining requirements that exchange-traded futures contracts always had.
Which led to that higher counterparty credit risk we discussed.
Exactly. And during times of market stress, like the financial crisis in 2008, it became clear that if one major party involved in many of these private OTC derivative contracts couldn't meet their financial obligations,
If they defaulted.
it could cause a dangerous domino effect, threatening the stability of the entire financial system because everyone was interconnected through these private deals.
A systemic risk.
Precisely. To reduce this counterparty risk, the risk that the other party to a contract might default, regulators around the world, especially after the 2008 crisis, have increasingly pushed for more and more OTC derivatives to be centrally cleared.
Pushing them away from purely private deals into a more structured system.
Yes, what central clear means is that a central counterparty, CCP, a sort of clearinghouse, steps into the middle of the trade.
Like an intermediary?
Exactly. The CCP becomes the counterparty to both the original buyer and the original seller. So instead of Party A owing money directly to Party B from the forward contract,
Party A now owes the money to the CCP, and the CCP owes the money to Party B.
correct. The CCP stands in the middle and guarantees the performance of the contract to both sides. This makes the system much safer because the CCP is usually very well capitalized and manages risk across all its members.
It breaks the direct link of dependency between the original two parties.
Precisely. And crucially, to manage its own risk, this CCP requires futures-like margining requirements from the institutions that clear trades through it, typically the large banks and dealers who handle these OTC derivatives.
So the banks trading these forwards now have to post margin to the CCP.
Yes, they have to post initial margin and variation margin, which is like the daily MTM settlement, often on a daily basis, based on the changing value of their OTC positions cleared through the CCP, very much like futures. So, students, just thinking about this, what does central clearing mean for how many forward contracts are now settled, especially for the large financial institutions involved?
Exactly. Central clearing means that many of these OTC forward contracts, at least for the financial intermediaries involved, are now handled within a system that operates very similarly to how futures margining works on an exchange.
Daily calculations, collateral posting?
Yes. Dealers, who are the large financial institutions acting as market makers and facilitating these contracts for end users, are required by the CCP to post cash or highly liquid securities, like safe government bonds, as collateral.
They have to back their positions with real assets.
Correct. And very often, these dealers then turn around and pass on similar margin requirements or collateral requirements to their own clients, the derivatives end users. These are the corporations, investment funds, or other entities who actually want to use these forward contracts for their business hedging or investment purposes.
So the end user might also face margin calls now, even on a forward contract.
Is becoming increasingly common, yes, especially for larger or standardized OTC contracts. This significant development has, as we hinted earlier, substantially reduced the difference in the cash flow impact between exchange-traded futures and these centrally cleared OTC forwards.
Because both now often require similar daily or frequent margining and collateral posting.
Exactly. And because the cash flow patterns are becoming more similar, any price difference between futures and forwards that used to exist purely due to those divergent cash flow patterns interacting with interest rates has also been significantly reduced.
The playing field is becoming more level in terms of cash flow management and credit risk.
Very much so. For you, as a future investor or a financial professional learning about these instruments, the takeaway is that whether you choose to use exchange-traded futures or centrally cleared OTC forwards, you likely need to be prepared to manage liquidity and maintain sufficient cash or eligible collateral to meet potential margin or collateral requirements throughout the life of your positions.
It's not just about the price, but also managing the cash needed day to day.
Absolutely. And remember to always consider all the associated costs, not just the price, but also the financing costs of holding margin, any transaction costs or fees, and the administrative costs involved in managing these positions and the collateral.
Good practical advice.
Overall, central clearing is seen as a very important step towards making the global financial system more stable and predictable. And the side effect is that it's making these two types of forward commitments, futures and forwards, behave much more similarly in terms of managing risk and cash flows.
Which, in a way, simplifies things, but also emphasizes the importance of understanding margining for both.
Precisely. It reinforces the importance of the concepts we discussed today.
Phew, we've certainly covered a lot of ground today, haven't we, students? Let's quickly recap.
Good idea.
We started by understanding the common foundations of forward and futures, contracts those core principles like preventing arbitrage, the concept of replication, and the importance of the cost of carry.
The building blocks.
Then we dive deep into their most significant key difference, that daily settlement and margin system used for futures. We saw how this mark-to-market process significantly reduces counterparty credit risk, but also creates very different cash flow patterns compared to traditional forwards.
Daily versus final settlement.
We explored how these contracts are priced at inception, both in the simple case and when we account for costs and benefits like storage or dividends. And we saw how their values behave over time, highlighting that critical distinction in cash flow management and risk exposure.
We then looked specifically at interest rate futures.
Yes, with their unique 100 minus yield pricing convention. We saw how they are used for hedging and how they contrast with FRAs, particularly regarding that concept of convexity bias, the nonlinear price behavior of FRAs versus the linear behavior of futures.
Linearity versus curvature.
And finally, we discussed the impact of central clearing for OTC derivatives, explaining how it's making forwards and futures more similar in their operational aspects, especially their cash flow and collateral requirements, thereby reducing some historical differences.
Bringing them closer together in practice.
You've definitely taken a big step today in understanding these powerful and really fundamental financial tools. Remember, building a strong foundation, piece by piece, is absolutely key to mastering finance.
You've reinforced a very important part of that foundation today.
Indeed. And as you continue your learning journey, perhaps mull over this final thought.
Yes, something to consider. The core purpose of derivatives like futures and forwards, fundamentally, is often to manage risk more efficiently. Given that regulatory changes like central clearing have significantly reduced some of the key operational and risk differences between them.
Making them behave more like.
How might future innovations in financial markets, perhaps driven by technology or further regulation, continue to blur the lines even further between what we traditionally call exchange-traded instruments and over-the-counter instruments?
Could they eventually merge in some ways?
What implications might this ongoing evolution have for market structure, for liquidity, for regulation, and for end users like yourselves in the years to come? It's something worth thinking about as the financial world constantly evolves.
A very interesting question for the future. Keep learning, everyone. Keep questioning.
And we'll see you in the next deep dive. Goodbye for now.
Goodbye, students.
A very warm welcome to our deep dive session today, students. It's truly wonderful to have you join us. Today, we're going to explore a topic that is absolutely fundamental for your CFA journey, especially, for those of you who might be new to the exciting world of finance. We're talking about swaps.
That's right.
You see, understanding finance is much like building a very strong house. You need to lay down a solid foundation, construct sturdy walls, and then, of course, add important pillars that hold everything up. Swaps are one of those crucial pillars, supporting many advanced financial strategies. We promise to take our time today, explain every concept clearly, and ensure that by the end of this session, you'll have a rock-solid understanding. We'll build this knowledge brick by brick, patiently and thoroughly.
Absolutely. Our main goal today is to, unravel any complexities, to cut through any complicated financial jargon, and to hand you the essential practical nuggets of knowledge you need to truly grasp swaps. We'll specifically focus on interest rate swaps, which are by far the most common type, and are, widely used in the financial markets. Yeah. And to help you understand them even better, we'll compare them with forward contracts, a concept you might have already encountered in your studies. Think of our session as a friendly classroom discussion, where we simplify everything, making it relatable and easy to understand, just like a good teacher would.
Perfect. So let's get started then. So let's begin our journey right from the very start. What exactly is a swap contract? In its simplest form, a swap contract is defined as an agreement between two counterparties to exchange a series of future cash flows.
Okay. A series of future cash flows.
Yes. Now, what does a series of future cash flows truly mean? Imagine, students, that two families, perhaps neighbors in a bustling Indian colony, decide to regularly exchange different food items. Maybe one family, known for its delectable mithai or sweets, agrees to give a box of sweets to the other family every month. And in return, the other family, famous for its savory namkeen or snacks, agrees to give a packet of savories back, also every month, for a fixed period of time, say, for one whole year.
Okay, so it's a regular exchange.
Exactly. This is not a one-time exchange, like trading a cricket bat for a ball. Instead, it's a picovada, a firm, unbreakable promise for multiple exchanges that happen regularly, like clockwork, on certain pre-agreed dates for a fixed duration.
A pukavada. I like that.
Yeah.
A firm promise.
Yes. The key here The very heart of a swap contract is that phrase, a series of future cash flows. It's not just one transaction, it's many, occurring repeatedly over time, forming a continuous stream of payments or exchanges based on a predefined system. This continuous multi-period nature is what makes a swap fundamentally different from some other financial agreements you might know.
Right.
It establishes an ongoing financial relationship between the two parties, where money flows back and forth based on specific calculations.
An ongoing relationship, okay.
So students, if you had to pick one word, the most important word you hear when we talk about a swap contract, what would it be? Hint. It's about how many times the exchange happens year after year. Any thoughts?
That's a great way to put it, and you're absolutely right. The series or multiple exchanges is key.
Exactly.
Now, to truly deepen your understanding of swaps, let's briefly compare them with forward contracts, which you've likely studied before.
Good idea.
As we've discussed in our previous sessions, a forward contract is fundamentally different. It is an agreement for a single exchange of value at a later date. Think of it like this. Imagine you want to buy a special limited edition cricket bat that will only be released next year, perhaps around Diwali.
Okay.
You go to the sports shop today and agree on the price for that bat right now, say 5,000 rupees. But the actual delivery of the bat and your payment for it only happen on that single specific future date next year. That's it, one transaction, one exchange, and once that single exchange occurs, the contract is fulfilled and effectively ends.
It's one time.
Just one time. So the immediate and most crucial distinction is clear. A swap involves many exchanges, creating a continuous flow of payments over time, while a forward involves just one exchange, a singular event in the future. This fundamental difference is vital to grasp, as it impacts how these instruments are used, valued, and managed in the financial world. Forwards are often highly customized and traded over the counter, or OTC, meaning directly between two parties without a central exchange.
So less standardized.
Exactly. This can make them less liquid and harder to transfer or offset compared to more standardized instruments like swaps, which have become incredibly common and liquid in many markets.
Very well explained. That distinction is key. One versus many. Now, even though they have that significant difference regarding the number of exchanges, interest rate swaps and forward contracts also share some important similarities.
Ah, yes, good point.
Recognizing these common features is just as crucial for your understanding, much like knowing the basic rules of cricket is important before you can understand the nuances of different batting techniques or bowling strategies.
Yeah.
Firstly, both are firm commitments. This means that once you enter into these agreements, you are legally and contractually bound to fulfill your part of the deal. It's not an option to walk away, even if market conditions turn unfavorable to you.
Not optional at all.
Imagine you've promised a sabziwala, a vegetable vendor, to supply him with a certain quantity of fresh tomatoes by a specific date at an agreed price. You are committed to that delivery, whether the market price of tomatoes goes up or down. Your word, solidified in the agreement, is your bond. This non-optional nature is a defining characteristic of both swaps and forwards, distinguishing them from, say, options contracts.
Right, where you have the right but not the obligation. Swaps and forwards are obligations.
Precisely. Secondly, both have symmetric payoff profiles. This is a very important concept. It means that both parties involved in the agreement can either gain money or lose money depending on how the market moves.
Symmetric, meaning balanced.
Exactly, balanced. There's no scenario where only one person can benefit, like buying a lottery ticket, where only you can potentially win big. In a swap or a forward, if one party experiences a gain, the other party necessarily experiences a loss of the exact same amount, and vice versa.
Okay, so it's a zero-sum game between the two parties in terms of payoff from market movements.
Precisely. It's like a perfectly balanced scale. If one side tips up, the other side must tip down equally. This symmetric payoff structure means swaps and forwards are a pure leverage bet on the underlying market variable, be it an interest rate or a commodity price.
And no premium is paid up front, typically, unlike options.
There's the third point. Thirdly, and this is quite remarkable for such powerful financial tools, no cash is exchanged at inception.
Oh, yes.
At the very beginning, when you sign the agreement and formalize the contract, typically no money changes hands. It's truly like shaking hands on a deal or making a verbal agreement without any upfront deposit.
Makes them very capital efficient to enter into initially.
Very much so. Though it's worth noting, as you hinted, that while no cash is exchanged up front, counterparties often require collateral or margin to be posted as the value of the swap changes over time. especially if it moves significantly in one party's favor.
Right, to manage the credit risk.
Exactly, which brings us to the last point. Lastly, both involve counterparty credit exposure.
The risk that the other side might not pay up.
Precisely. This means there's always an inherent risk that the other party to the agreement might not be able to fulfill their promise when the time comes. This could be due to financial difficulties, bankruptcy, or, other unforeseen circumstances.
Like lending money to a friend, there's always that small risk.
It's a bit like that, yes. In a financial contract like a swap, this risk becomes very real, especially if the swap's market value becomes positive for you. You are exposed to the risk that your counterparty might default on their obligation to pay you that positive value. So, while the notional amount isn't exchanged, the potential gain or loss on the swap itself creates this credit risk.
Makes sense.
So students, can you think of one crucial common feature that both a swap and a forward share right at the exact moment you enter into them regarding any initial cash payment? What happens with cash right at the start?
That's an excellent point. It's the no cash at inception that's key. It's truly a handshake agreement to start.
Yes.
And building on that, let's now truly differentiate interest rate swaps from forwards by looking at some critical distinctions. This is a crucial area for your CFA studies and one that often causes a little confusion, but we will make it very, very clear for you.
Okay, the differences.
The biggest difference, as we hinted earlier, is about the fixed rate. A standard interest rate swap has a single constant fixed rate that applies across all its periods throughout its entire life. Imagine you sign up for a fixed-rate internet plan for 2 whole years from your local broadband provider. Your monthly bill for data and services is the same every month for those 2 years, say 500 rupees, regardless of how much other internet service providers change their prices in the broader market.
Okay, one rate for the whole duration.
Exactly. That fixed rate, once agreed upon for the swap, remains constant for the entire duration of the swap, providing perfect predictability for the fixed-rate payer.
Predictability is key there.
Absolutely. Now, in stark contrast, if you were to create the exact same interest rate exposure using a series of individual forward contracts, specifically what we call forward rate agreements or FRAs.
FRAs, right.
Each individual FRA would have a different fixed rate for its specific period. These rates would reflect the term structure of interest rates at the time you enter into the series of FRAs.
So not one rate, but many different rates.
Yes. This means that for each future period, say for the next 3 months, then the next 3, and so on, you would be agreeing to a new, distinct fixed rate based on the market's expectation for that particular period. So going back to our internet example, a series of forwards would be like your internet provider giving you a new fixed rate every month or every quarter based on what the market rates are expected to be for that specific upcoming month or quarter.
I see. That sounds much less predictable than the single swap rate.
Much less predictable. You see, the swap gives you that one predictable rate for the entire long period, which is a massive advantage for planning.
Okay. What other differences are there?
Another important difference lies in the settlement timing. Swaps typically have periodic settlements, for example, every quarter or every 6 months, which occur at the end of each interest period.
At the end.
Yes. This means the actual cash flow exchange, based on the difference between the fixed and floating rates, happens once the interest period has concluded. For instance, if it's a quarterly swap, the payment for the first quarter's interest differential happens at the end of that first quarter.
Okay.
An FRA, however, usually has a single settlement that occurs at the beginning of its interest period.
At the beginning. That's different.
Yes. So the calculation and payment of the gain or loss on the FRA often happen right at the start of the specific period covered by that FRA, based on the difference between the agreed forward rate and the spot rate at that time.
So settlement at the end for swaps, typically the beginning for FRAs.
That's the general convention, yes. This small detail of timing can have significant implications for liquidity management and cash flow planning for businesses.
I can imagine.
So students, what is the main defining characteristic of the fixed rate in a standard interest rate swap that sets it apart from a series of individual forward rate agreements? Think about its behavior over time. Is it constant or changing?
Wonderful. That distinction is so clear now. The constant fixed rate is the hallmark of the standard swap. With these key differences in mind, it begs the question, Why do market participants, especially big companies, banks, and large investors, prefer swaps over managing a multitude of individual forward contracts?
A very practical question.
Yes, there are very practical and strategic reasons for this preference, making swaps a much more efficient and, frankly, user-friendly tool for sophisticated financial management. One major reason, and perhaps the most common application, is matching rate-sensitive assets and liabilities.
Managing mismatches.
Exactly. Swaps are truly fantastic tools for companies or investors to make their financial flows much more predictable and stable. Let's consider a real-world scenario. Imagine a large Indian company, perhaps a major infrastructure firm building roads or power plants, that has taken a substantial business loan from a bank.
Okay.
Let's say this loan is a floating rate loan, meaning the interest payment on it changes every 3 months based on a benchmark rate, like the Mumbai Interbank Offered Rate, MIBOR, plus an additional fixed spread, say 1.50%.
So their payments fluctuate.
Yes, and this kind of variable interest payment can make financial planning incredibly difficult for the company's treasury department, as their monthly outflow for interest is uncertain and can fluctuate widely. It's exactly like having a variable EMI on your home loan, where your monthly payment keeps changing, making it hard to budget precisely for your household expenses.
Very difficult to plan.
Very. To bring predictability to its interest expense, the company can enter into an interest rate swap. In this swap, the company agrees to pay a fixed quarterly swap rate to a counterparty, say 4.00%, and in return, receive the 3-month floating MIBOR from the same counterparty.
So they pay fixed, receive floating.
Yes. Here's where the magic happens, students. The floating rate that the company receives from the swap effectively cancels out, or offsets, the floating rate it has to pay on its original loan.
The floating parts net out.
Precisely. So in essence, the only rate left that the company is effectively paying is the fixed rate from the swap, 4.00% in our example, plus the original fixed spread on its loan, 1.50%.
So their effective rate becomes fixed at 5.50%, 4.00% plus 1.50%.
Exactly. This allows the company to transform its variable rate debt into an effectively fixed rate one, making its future interest payments perfectly predictable. The finance team can now budget with certainty.
Just like choosing a fixed rate home loan EMI for peace of mind.
It's exactly that principle. This stability is invaluable for budgeting, financial planning, and even for satisfying investors who prefer predictable earnings. It takes away a huge element of risk from their balance sheet.
That's a huge benefit. What else?
Another highly significant benefit is the reduced administrative burden.
Less paperwork.
Much less. Imagine the sheer effort involved in entering into, tracking, and managing dozens or even hundreds of individual forward contracts for different periods, each with its own specific fixed rate, maturity date, and settlement procedure.
It sounds like a nightmare.
It would be. Instead, a single swap contract covers a long series of cash flows over an extended term, sometimes many years. Think about your mobile phone bill. Would you rather sign a new small contract every single month with a new, potentially different rate for your calls and data, and then manage separate paperwork for each month?
No, definitely not.
Or would you prefer to sign one comprehensive contract for a year or two
Yeah.
with a fixed predictable rate and just receive one bill each month?
The single contract, of course.
The single long-term contract, which is precisely what a swap provides in the financial world, saves an enormous amount of paperwork, legal fees, time, and administrative hassle for big corporations and investors.
So efficiency is another big driver.
Absolutely. This simplification is a massive operational and cost advantage in managing complex financial positions, allowing Treasury departments to focus on strategic decisions rather than repetitive administrative tasks.
Makes perfect sense. Any other reasons?
Finally, greater liquidity is also a significant factor that contributes to the preference for swaps.
Easier to trade.
Yes, interest rate swaps are generally much easier to trade in the over-the-counter market compared to individual, highly customized forward rate agreements or specific bonds. Liquidity, as you know, refers to how easily an asset or a contract can be bought or sold without significantly affecting its market price. Because swaps are widely used and have become increasingly standardized, it's often much easier for a company or investor to find a counterparty to enter into a swap, or perhaps more importantly, to exit or offset an existing swap position if their needs change.
Flexibility is key too, then.
Critical. This flexibility is critical for dynamic financial risk management. If a company's financial needs change, they can quickly adjust their swap positions, which is much harder with individual bespoke forward contracts.
Right.
So students, if a big company's finance team wants to simplify its interest payments and make them predictable for better budgeting, which financial instrument would they typically choose? Managing many individual forward contracts or entering into one single swap contract, which seems more practical.
That's absolutely correct. The single swap contract is typically the chosen path for efficiency and predictability. Much simpler.
Definitely.
Now that we've built a solid understanding of what swaps are and why they are so widely used, let's move on to a very important and slightly more technical aspect, how a swap is priced.
Okay, the pricing mechanism.
Yes. This brings us to a critical concept called the par swap rate. Understanding this concept is like learning how to calculate the average speed of a vehicle over a long journey. It helps you understand the overall performance and fair value, not just the speed at individual points.
The average rate, essentially.
In a way, yes. The par swap rate is essentially the fixed rate that sets the present value of all future expected floating cash flows equal to the present value of all future fixed cash flows.
Whoa, okay, let's break that down. Present value.
Exactly. What does that truly mean in simple terms? Imagine you're trying to set a single, fair, fixed monthly rent for a house for the next 3 years. However, you know that the market rents for similar houses might fluctuate significantly over those 3 years.
Right, rent can go up or down.
Correct. The par swap rate is that specific fixed rent amount that, when you look at it from today's perspective, makes the total current value of what you expect to pay or receive in fixed amounts precisely equal to the total current value of what you expect to receive or pay in variable or floating amounts.
So it balances the expected values of both sides.
Perfectly balanced. It's the equilibrium point, the perfectly fair value fixed rate for the entire life of the swap right at the moment the contract is initiated. This ensures that at inception, neither party has an advantage and the swap has a zero net value.
Zero value at the start, that's important.
Very important. Now, this concept builds on your foundational understanding of two crucial elements: zero rates and implied forward rates, IFRs.
Yes, zero rates and IFRs.
Let's quickly refresh these. Remember, zero rates are like the interest rate for a theoretical bond that pays all interest and principal only at maturity, with no intermediate coupon payments. They represent the pure discount rate for a single cash flow at a specific future point in time.
Like the pure cost of money for different time periods.
Exactly. Think of them as the building blocks for constructing the entire yield curve. They tell you the value of money received at different points in the future.
Okay, and IFRs.
And then we have implied forward rates, IFRs. These are the market's expectation of future spot rates, derived directly from the current zero rates. The market's guess about future rates. Precisely. They tell us what the market believes a future interest rate will be for a period starting at some point in the future. For example, the 1-year implied forward rate 1 year from now tells us what the market expects the 1-year spot rate to be in 1 year's time.
Okay.
These IFRs are incredibly important because in our swap pricing calculations, they serve as our best estimate for what the future floating rate payments will be.
Right, because the floating rate isn't known in advance.
Exactly. We use these expectations, the IFRs, to calculate the present value of the floating leg of the swap. By discounting these expected floating payments using the appropriate zero rates, we can find their present value, which then allows us to determine the fair fixed rate.
So we use IFRs to estimate the floating side, and then find the fixed rate that makes the present value of both sides equal.
That's exactly the process.
Okay. To make this clear and show you how to truly put these concepts into practice for your CFA exams, let's walk through a practical example directly from your CFA material. Example 1. Swaps as a combination of forwards.
Ah, good. A concrete example always helps.
It does. This example perfectly illustrates how we calculate that all-important par swap rate, step by careful step, just like we would solve a complex math problem on the blackboard in our classroom. First, we're given some essential bond data, the zero rates for 1, 2, and 3 years. These zero rates are our starting point, the foundation upon which we build our calculations. Let's assume these values are 1-year zero rate Z1 equals 2.3960%. 2-year zero rate Z2, 3.4197%. 3-year zero rate Z3 equal 4.0005%.
Okay, I've got the zero rates.
These represent the yield for a lump sum payment at the end of each respective year. Next, we need to calculate the implied forward rates, IFRs, for each future 1-year period.
Right, the market's expectations.
Yes. These IFRs are crucial because they represent what the market expects, the floating rate, like the MRR we discussed earlier, to be in those future periods. We derive these from the given zero rates using a specific formula.
The no arbitrage formula, basically.
Exactly. The general principle is that investing for a longer period directly should yield the same return as investing for a shorter period and then reinvesting at the implied forward rate for the remaining period. The formula we use is 1 plus ZAAA, 1 plus IFRA BA equals 1 plus ZABA.
Looks a bit daunting, but it's logical.
It is. Let's apply it. For the 1 year period starting 1 year from now, which we denote as IFR11, we use Z1 and Z2, so A1 and B2. The formula becomes 1 plus Z1, 1 plus IFR1111 equals 1 plus 034,197. To solve for IFR11, 1 plus IFR111 plus IFR1111 plus IFR1111 equals 1.044197.2, 1.033960.
Okay, doing the math.
This gives us 1 plus IFR111 equals 1.04444536. So the implied forward rate for the 1 year period starting 1 year from now, IFR11, is 4.4536%. This is what the market expects the 1 year interest rate to be a year from today.
4.4536%.
Got it. Now let's calculate the implied forward rate for the 1 year period starting 2 years from now, which is IFR211. Here we use Z2 and Z3, so A2 and B3. The formula becomes 1 plus Z2 day, 1 plus IFR211 plus 1 plus Z33.
Using the 2 year and 3 year zero rates now.
Correct.
Yeah.
Plugging in our values 1.034197 to 1 plus IFR2 1 plus IFR3 0.00005. 3, 1.040005.
Okay.
This gives us 1 plus IFR2 1 plus IFR2 1 plus 1.051719. So the implied forward rate for a 1 year period starting 2 years from now, IFR2 is 5.1719%. This is the market's expectation for the 1 year rate 2 years from today.
5.1719%. Okay, so the expected rates are rising in this example at 2.396%, then 4.4536%, then 5.1719%.
Exactly. These IFRs are essentially the market's best unbiased guesses for future spot rates, crucial for valuing the floating leg of our swap. Now that we have these crucial IFRs, we can find the par swap rate, S3, for our 3 year swap.
The fixed rate that balances everything out?
Precisely. We use the fundamental principle that at inception, the present value of all expected floating payments must equal the present value of all fixed payments. We substitute our calculated IFRs, which represent the expected floating payments in the original zero rates, which we use as discount factors, into our equation. The equation is PV, floating leg, PV, fixed leg.
Okay, let's see the numbers.
Let's break down the calculations step by step. For the floating leg, expected payments, period 1, year 1. The expected floating payment is the current 1 year spot rate, which is Z1 or 2.3960%. Its present value, PV, is 2.3960%. 1 plus Z11 or 4.3960. Its price 1423400.
Okay.
Period 2, year 2. The expected floating payment is IFR11 or 4.4536%. Its PV is 4.4536%, 1.04536%, 1.100034197. Its PV is 5.1719%. 1 plus Z33, 1.1719%. Its PV is 5.1719%. 1 plus Z33 equals 5.1000000 for you 0.045963.
Discounting the third year's expected rate using the 3 year zero rate.
Correct. The sum of the present values of the expected floating payments is 0.02340 plus 0.04908 plus 0.0445963 plus 0.111271.
Okay, so the PV of the floating leg is 0.111271.
Now for the fixed leg, payments of S3. We need to find a fixed rate, S3, that when paid each period and discounted sums up to the same present value. So for each period, the payment will be S3, PV of fixed payment in year 1, S3 1 plus Z1, 1 plus Z1, 1 plus S3 1.02396, PV of fixed payment in year 2, S3 1 plus 0341972, PV of fixed payment in year 3, S3 1 plus 03, 1 plus 03 S3 1.04000053.
So it's S3 times the sum of the discount factors for each year.
Exactly. This can be simplified as S3 1.033960 plus 1.0341972 plus 1.0341972 plus 1.04005. 3.888796.
Okay.
The sum of these discount factors is 0.976597 plus 0.934898 plus 0.888796, 2.880291. Oh, let me recheck that sum. 0.976597 plus 0.934898 plus 0.888796 is 2.8000291. Let me just re-verify the discount factors using the example numbers.
It happens. Double checking is always good. Sometimes the numbers and examples are slightly different.
Yes, apologies, students. Looking at the standard example values, which yield the 3.9641% rate mentioned earlier, the sum of the present values of the IFR should actually calculate out to be approximately 0.11467.
Okay, 0.11467 for the PV of the floating leg.
And the sum of the relevant discount factors, PV factors for each year using the zero rates, would be approximately 2.89269.
2.89269 for the sum of discount factors.
So the present value of the fixed leg is S3.11467. Now we set the PV of the floating leg equal to the PV of the fixed leg. 0.11467 equals S3 2.89269.
And we solve for S3.
To solve for S3 of approximately 0.0396441 or 3.9641%.
3.9641%. That matches the example.
Perfect. So this 3.9641% is the multi-period break-even rate, the par swap rate. It's the fixed rate at which, if you were an investor, you would be completely indifferent between paying this fixed rate and receiving the changing implied forward rates, or receiving this fixed rate and paying the changing implied forward rates.
It balances the deal at the start.
Exactly. It's like the average score needed per over in a cricket match to win it perfectly balances everything out over the entire game, making both sides of the exchange equally valuable at the very start, ensuring no party has an immediate advantage. This is what we mean by the swap having zero value at inception.
Very clear.
So students, why is it absolutely necessary for us to calculate those implied forward rates before we can arrive at the par swap rate? What crucial piece of information do these implied forward rates represent in our calculation? What are they estimating for us?
That's a very insightful question. You see, the implied forward rates are our best estimate for what the future floating interest rates will actually be.
Right.
Without knowing those market expectations for future floating rates, we simply cannot determine what a fair fixed rate should be today to balance out those future unknown floating payments. So they are indeed crucial. They represent the expected path of the floating rate.
Got it. You need the expected floating path to set the fair fixed rate.
Exactly. Now that we understand what swaps are, how they differ from forwards, and how their price, that par swap rate, is determined, let's truly bring them to life with some practical examples.
Yes, let's see them in action.
This is where the theory connects with the real world, solidifying your understanding. We'll start with one of the most common applications: how companies use swaps to transform their exposure.
Like our earlier example with the company wanting predictable payments.
Precisely. Let's look closely at example 2, Ester Inc. Swap to fixed. Imagine Ester Inc. is a very large company, perhaps a major Indian conglomerate, that has taken a substantial loan, let's say $250 million, for a new project.
A big loan.
Yes. The interest rate on this loan is floating, meaning it changes every 3 months based on the Canadian market reference rate, CAD-MRR, plus an additional fixed spread of 150 basis points or 1.50%.
So floating rate plus a spread. Variable payments again.
Exactly. This kind of variable interest payment can make financial planning incredibly difficult for a company's finance team, as their monthly or quarterly outflow for interest is uncertain and can fluctuate significantly with market rates. It's exactly like having a variable EMI on your home loan, where your monthly payment keeps changing, making it hard to budget precisely for your household expenses.
A treasurer's headache.
Definitely. To eliminate this uncertainty and make its interest expense perfectly predictable, Ester decides to enter into an interest rate swap. In this swap, Ester agrees to pay a fixed quarterly swap rate of 2.05% to a financial institution. In return, it agrees to receive the 3-month floating CAD-MRR from that same institution.
So Ester pays fixed 2.05%, receives floating CAD-MRR.
Correct. The notional principal for the swap is CAD $250 million, matching its loan amount, and the payment dates are also aligned, typically quarterly.
Okay, aligned with the loan.
Here's the brilliant part, students. This is where the swap truly works its magic. The floating rate that Ester receives from the swap, the CAD-MRR, perfectly cancels out the floating rate it has to pay on its original loan, also the CAD-MRR.
So the CAD-MRR it receives offsets the CAD-MRR it pays on the loan.
Exactly. So in effect, the only rate left that Ester is actually paying is the fixed rate from the swap, 2.05%, plus the original fixed spread on its loan, 1.55%.
So 2.05% plus 1.5%, that's 3.55%, fixed.
Perfectly fixed at 3.55%. This brilliantly allows Ester to convert its variable rate debt into an effectively fixed rate debt, making its future interest payments perfectly predictable. The finance team can now budget with certainty.
Amazing. Let's see the scenarios.
Let's see this in action with 2 different scenarios. For the CAD-MRR scenario 1, CAD-MRR sets at a higher rate, say 3.75% for a particular quarter.
Okay, MRR goes up.
On the swap, Ester is the fixed rate payer. It receives 3.75%, the CAD-MRR from the swap counterparty, and pays its fixed swap rate of 2.05%. So Ester receives a net payment from the swap of 1.70%. 3.75% received 2.05% paid.
Receives 1.70% net on the swap.
On its original loan, Ester's actual loan payment is 3.75% MRR plus 1.50%. The loan spread kills 5.25%.
Esther's net interest expense.
Yeah.
This becomes its loan payment minus the net amount received from the swap. 5.25% paid, 1.0% received to a 3.55%.
3.55% net expense.
Scenario 2. CAD MRR sets at a lower rate, say 1.25% for a particular quarter.
Okay, now MRR goes down.
On the swap, Esther still pays its fixed swap rate of 2.805%, but now only receives 1.25%, the lower MRR, from the swap counterparty. So Esther pays a net amount on the swap of 1.80%. 2.05% paid, 1.25% received, because its fixed payment is higher than the floating rate it receives.
Pays 2.80% on the loan.
On its original loan. Its original loan payment is 1.25% MRR plus 1.50% spread, pays 2.75%.
Pays 2.75% on the loan. Esther's net interest expense. This becomes its loan payment plus the net amount paid on the swap. 2.75% paid plus 0.80% paid equals 3.55%.
Still, 3.5% net expense, it worked.
Did you see that, students? Regardless of whether the market rate, CAD-MR, went up or down, Esther's total effective interest expense remained perfectly fixed at 3.55%.
That's the magic.
This is precisely what the Kirana shop owner example we discussed earlier was aiming for: complete predictability in expenses. This stability is invaluable for businesses to plan their cash flows, manage their budgets, and achieve greater financial certainty, which is highly appreciated by shareholders and creditors alike. It takes away a huge element of risk from their balance sheet.
Fantastic illustration.
So students, after Esther successfully entered into this interest rate swap, did its overall interest expense become fixed and predictable, or did it still fluctuate with the market conditions? What was the end result for Esther's budgeting?
That was an absolutely fantastic illustration, making it crystal clear how companies achieve predictability.
Right.
But right, once hedged, the expense becomes fixed. Predictable. Now, swaps aren't just for companies managing their debt. Astute investors also use them extensively to manage fixed income exposure.
Using swaps for investment strategy.
Yes. This means they use swaps to adjust their investment portfolio's sensitivity to interest rate changes without having to actually buy or sell large amounts of physical bonds. It's like a seasoned cricket captain adjusting the field placement or the bowling attack to best navigate changing conditions on the pitch, ensuring the team's strategy is optimal.
A strategic adjustment tool.
Precisely. Think about it this way. Receiving fixed on an interest rate swap has a very similar risk and return profile to being long a fixed coupon bond.
Long a bond meaning owning it.
Yes, owning the bond. A fixed coupon bond pays you a set amount of interest regularly. If general interest rates in the market fall after you've entered the swap or bought the bond, the fixed payments you are receiving from the swap or from your bond become more valuable relative to the new, lower market rates.
Because your rate looks better compared to the market.
Exactly. This leads to a gain in value for your position. Why? Because your fixed income stream looks incredibly attractive when other rates are declining. You're still getting the higher pre-agreed rate.
Okay, so receive fixed benefits from falling rates.
Correct. Conversely, paying fixed on a swap is similar to being short a fixed coupon bond, meaning you've sold a bond you don't own, hoping to buy it back cheaper later, or, more accurately, being long a floating rate note.
Pay fixed benefits from rising rates.
Yes. If interest rates in the market rise significantly after you enter a pay-fixed swap, the fixed payments you are obliged to pay become less onerous compared to the new, higher market rates you would otherwise receive on the floating leg, or pay on a floating rate loan.
Wait. If I pay fixed and rates rise, I'm receiving a higher floating rate, so my net payment might decrease, or I might even receive net. That's a gain.
Exactly. Your fixed payment is locked in low, while the floating rate you receive goes up. This results in a gain from your perspective as a fixed-rate payer, because you are locked into paying a lower fixed rate while the market is offering higher floating rates. It's like if you had agreed to buy a certain quantity of rice from a farmer at a fixed price, and then, due to a shortage, the market price for rice suddenly shot up dramatically, you would be gaining because you were paying less than the new, higher market rate.
Okay, that makes sense. Pay fixed gains when rates rise. Receive fixed gains when rates fall.
Perfect summary. Let's take our house rent example and expand it to illustrate this clearly. Imagine you own a house and you've rented it out at a fixed monthly rent for a year. This position is analogous to receiving fixed on a swap.
Okay, landlords receiving fixed rent.
If suddenly the market rents for similar houses in your area go down significantly due to new construction or less demand, your fixed rent income is still coming in at the higher agreed-upon rate. This makes your fixed income much more valuable compared to the new market reality, leading to a gain for you.
Your rent looks good compared to the market. gain.
Right. On the other hand, if you are a tenant paying a fixed rent for a year, this is like paying fixed on a swap, and market rents for similar houses suddenly go up substantially, your fixed payment looks incredibly cheap compared to what others are paying. So you are gaining because you're paying less than the new market rate.
My fixed rent is cheap now. Gain.
Okay. This precise similarity allows sophisticated portfolio managers to actively adjust their portfolio's duration, its sensitivity to interest rate changes, without actually buying or selling large amounts of physical bonds.
Adjusting duration without trading bonds. Efficient.
Very efficient. For example, if a fund manager expects interest rates to fall, meaning bond prices will rise, they might enter a swap where they receive fixed payments.
Because receive fixed gains when rates fall.
Exactly. This receive fixed position would gain value in a lower rate environment, mimicking the returns of owning a fixed rate bond. But it can be executed much more efficiently and with lower transaction costs through a swap. This provides tremendous flexibility for asset managers to quickly adjust their portfolio's risk profile to match their market outlook.
Powerful tool for investors too, then.
Absolutely. So, students, if an investor's strategy is that they truly expect interest rates to fall, and they want to profit from this change without actually buying large amounts of physical bonds, should they enter a swap where they commit to pay a fixed rate or where they commit to receive a fixed rate? Which side do they want to be on?
You're spot on. They would choose to receive fixed, as that position gains value when rates fall.
Excellent.
Great.
Now, let's delve into something that can sometimes confuse people, but is vital for your CFA understanding: the difference between a swap's price and its value.
Price versus value.
While these words might sound interchangeable in everyday conversation, in finance, especially when it comes to derivatives like swaps, they have distinct and very important meanings. It's like the difference between the sticker price of a brand new car you buy today and its resale value after you've driven it for a few years. They're related, but certainly not the same thing.
Okay, that's a good analogy. Sticker price versus resale value.
The swap price is simply what we discussed earlier, the par swap rate.
The rate set at the beginning.
Exactly. This is the specific fixed rate that is determined right at the beginning of the contract at inception. As we calculated in our example, this fixed rate ensures that the initial value of the swap is zero, making it a fair deal for both parties at that moment.
Right, the rate that makes the PVs equal at the start.
Yes.
Yeah.
Once this rate is agreed upon and the contract is signed, this price remains constant throughout the entire life of the swap. It does not change. Like the fixed monthly charge for your long-term mobile internet plan, that 500 rupee rate, remains constant for the entire 2-year duration of your contract, regardless of how market prices for internet change later. That's its price.
Okay, price is par swap rate constant.
Correct. The swap value, on the other hand, is the current worth of that swap contract as market conditions change over time. This is where the fluctuation happens.
Or resale value, like in the car analogy.
Precisely. Just like the actual benefit or saving you feel from your fixed internet plan might change if other companies suddenly change their prices. If all other internet plans in the market suddenly become much cheaper due to new competition, your fixed 500 rupee plan might feel less valuable to you, or you might perceive a loss because you could get a cheaper plan elsewhere now. Similarly, the value of the swap reflects what it would be worth if you tried to sell it or close out the contract today before its maturity. It can be positive for one party and negative for the other.
So value fluctuates, price is fixed.
That's the core distinction. And it is absolutely crucial to remember this. At the very inception, the beginning of the swap contract, its value is precisely zero.
Zero value at inception, we established that.
Yes. This assumes no transaction costs or considerations for counterparty credit risk at that exact moment. This zero value at inception is by design, as the par swap rate is calculated to make the initial exchange perfectly fair to both parties, ensuring that neither party has an immediate advantage or disadvantage. No one owes anyone anything at the moment the agreement is signed.
The fairness is built into the price.
Exactly. Any gain or loss comes only from subsequent market movements or the passage of time.
Makes sense.
So students, just to ensure that this distinction is perfectly clear, at the exact moment you enter a swap contract, right when you sign it, before any time passes or market rates change, what is its value? Is it positive, negative, or something else?
That's right. Its value is zero at inception, because that par swap rate ensures a fair start. Now, while that price, the fixed rate, remains constant throughout the swap's life, the value of the swap can and does fluctuate. Let's talk about how we calculate the actual periodic settlement value, which is the net cash flow that changes hands between the two parties at each settlement date.
The actual money exchanged periodically?
Yes, the formula for calculating this periodic settlement value is quite straightforward. Periodic settlement value equals MRR/SM. Notional amount X, period. Let's break down each part of this formula clearly, step by step.
Okay.
Here, MRR is the market reference rate, which is the current spot interest rate for that particular period.
Huh.
This is the floating rate that is observed and determined at the beginning of each specific interest period for the swap.
The floating rate for that period.
Yes. SN is our fixed swap rate, the constant rate we agreed upon at the inception of the swap.
The price.
Correct. The notional amount is a very, very important concept to understand. It's the principal amount that is used only for calculation of the cash flows, but this amount is never actually exchanged between the parties.
Never exchanged, just used for calculation.
Exactly. It's purely a reference amount, like a scoring unit. Imagine playing a friendly game of Ludo with your friends, where you agree to play for 100 points. You keep score, and at the end, someone wins or loses based on these points, but no actual points or money physically change hands based on that 100 points. It's just for keeping score and calculating who wins or loses by how much.
Ah, okay. The 100 points is like the notional amount. It determines the size of the win or loss, but isn't itself exchanged.
Perfectly put. This is why swaps are so capital efficient, you don't need to transfer a huge principal amount. However, remember that while the notional itself isn't exchanged, it's the basis for calculating the actual cash flows, and your counterparty credit exposure is not on the notional itself, but on the potential mark-to-market value of the swap if it moves significantly in your favor.
Right. The risk is on the value, not the notional.
Yes. And finally, period is simply the fraction of a year for which the settlement is being calculated. For example, 0.25 for quarterly payments, 0.5 for semi-annual payments.
Adjusting for the time period.
So the difference between the floating rate and the fixed rate, multiplied by this notional amount in the period fraction, gives you the actual cash amount for that specific settlement.
Okay. That formula makes sense for the periodic payment.
And the total value of a swap on any given settlement date or any day in between is then the sum of the current settlement value for that period, if it's a settlement date, plus the present value of all remaining future swap settlements.
So current payment plus the PV of all future expected net payments.
Exactly. So it's a dynamic valuation that considers both what's happening now and what's expected to happen in the future, all brought back to today's value using appropriate discount rates.
It keeps changing.
Constantly.
Okay. That's a great point about the total value being dynamic. Now, let's delve into a concept that can sometimes feel a bit counterintuitive, but is absolutely crucial for your CFA understanding. How swap value changes over time, even if our expectations about future interest rates do not change from when we first entered the swap.
Value changes even if expectations don't. How does that work?
This is about the pull to par or pull to forward for the floating leg. Let's revisit example 3. Ester Inc. Swap value and price.
Okay, ISTER again. Paying fixed 2.05%, receiving floating CAD MRR.
Correct. Remember, Ester is the fixed rate payer. At inception, the swap's value was 0. The swap price, 2.05%, was set based on the implied forward rates, IFRs, at that time. For this example, let's assume those initial IFRs were upward sloping, meaning the market expected future floating rates to gradually increase over time, maybe starting below 2.05% but ending above it.
Okay, upward sloping expectations initially.
What happens as time passes, even if those expected future interest rates, the IFRs, still exactly as they were when you entered the swap, the value of the swap to Ester can change. Why? Because the fixed rate, 2.05%, is constant, but it was set to balance out a series of expected future floating rates that were increasing.
Right.
Consider the first period. If the actual MRR is, say, 0.50%, which is lower than Ester's fixed swap rate, 2.05%, Ester effectively pays a net amount.
Pays net in the early periods.
Yes. In the second period, if the MRR is 0.74%, still lower than Ester's fixed rate, Ester again pays a net amount. However, as we move further along the swap's life, and because the original implied forward rates were upward sloping, the expected floating rates for the remaining periods eventually rise above Ester's fixed swap rate of 2.05%.
So later on, the expected floating rate received is higher than the fixed rate paid.
Exactly. When this happens, the present value of the floating payments Ester expects to receive for the remaining life of the swap eventually rises above the present value of the fixed payments it expects to pay.
So the remaining part of the swap becomes valuable to Ester.
Yes, precisely. This is because Esther had locked in future fixed payments at a rate 2.05% that over time becomes more favorable relative to the market's evolving, but in this case unchanged, expectations for higher future floating rates. So Esther realizes a mark-to-market MTM gain on the swap over time purely due to the passage of time and the initial slope of the forward curve.
Wow. So just time passing can create value if the forward curve was sloped?
It can, even though the price 2.05% remains constant. The value of the floating leg relative to the fixed leg shifts as we move closer to those higher expected future rates. It's like you booked train tickets for a long journey a year in advance at a fixed price. If the general train fares for future dates, the implied forward rates, are known to gradually increase over time, your pre-booked ticket, even if its price is fixed, becomes more valuable to you as you get closer to those later, more expensive segments of the journey.
As I locked in a good price for the later, more expensive parts.
Exactly. You're effectively getting a better deal over time compared to what the current market would offer for those future periods.
Fascinating.
So, students, if you were the party paying a fixed rate on a swap, and the market's initial expectation was that floating rates would generally go up in the future, meaning an upward sloping forward curve, would you likely experience a gain or a loss on your swap's value as time progresses, even if those expectations don't change?
Excellent. That's a crucial nuance. You'd expect a gain in value as you move towards those higher floating rates you're receiving. The passage of time itself reveals that gain inherent in the initial forward curve.
Precisely.
And now, let's consider an equally important scenario. What happens if interest rates actually change in the market after you've entered the swap?
The market moves.
Yes. This is crucial for understanding real-world mark-to-market MTM gains and losses, as it represents the direct impact of new market information on your swap position. This is like a sudden change in the weather during your cricket match, a sudden downpour or unexpected sunshine. It will definitely impact the game and require a change in strategy.
Okay, what happens if rates go up?
Let's consider a rise in expected forward rates after inception, meaning after you've entered the swap, the market suddenly expects future interest rates to be higher than initially anticipated. If you are the fixed rate payer, and therefore the floating rate receiver, this scenario leads to an MTM gain for you.
Gain for the fixed payer. Why?
Because the present value of the floating payments you are scheduled to receive from the swap increases, since future floating rates are now expected to be higher, while the fixed swap rate you are paying remains constant. You are effectively receiving more value for the same fixed payment you committed to. I receive more floating, pay the same fixed. Good for me.
Exactly. Imagine you have a fixed monthly subscription for a premium streaming service at a set price. If all other streaming services in the market suddenly increase their prices significantly, meaning floating rates rise, your existing fixed subscription looks much better and more valuable because you're paying less for a comparable service. You have an MTM gain.
Okay, fixed payer gains if rates rise. What about the fixed receiver?
If you are the fixed rate receiver, and therefore the floating rate payer, this scenario leads to an MTM loss for you. In this situation, you are now scheduled to pay more in expected floating payments because rates have gone up, but you still receive the same fixed amount. The net value of your position goes down.
I pay more floating, receive the same fixed. Bad for me, loss. Correct. Now let's consider the opposite. A decline in expected forward rates after inception, meaning the market now expects future interest rates to be lower than initially anticipated.
Okay, rates fall after inception.
If you are the fixed rate payer, floating rate receiver, this scenario leads to an MTM loss for you. You are paying a fixed rate, but the floating rates you are scheduled to receive have gone down, making your fixed payment relatively more expensive compared to what you are getting in return. The value of your receive leg has decreased.
I receive less floating, pay same fixed, loss for the fixed payer.
If you are the fixed rate receiver, floating rate payer, this leads to an MTM gain for you. This is because the fixed payments you receive become more valuable relative to the lower floating payments you now have to make. You're receiving a higher fixed rate, while the market expects you to pay a lower floating rate, which is a very favorable position for you.
I receive the same high fixed, pay less floating. Gain for the fixed receiver. Perfect.
Exactly. Let's apply this to example 4. Fileton Investments. Fileton entered a 5-year receive fixed GBP 200 million interest rate swap, where it receives a fixed swap rate of 2.38% on a semi-annual basis and pays the 6-month GBP MRR.
Okay, Fileton receives fixed 2.38%.
This position is typically taken by an investor who believes interest rates will fall, as it increases the portfolio's duration, its sensitivity to interest rate changes, specifically to benefit from falling rates.
Betting on rates falling.
Yes. If, after Fileton enters the swap, the expected forward rates decline in the market.
Which is what Fileton wanted.
Exactly. Fileton will realize an MPM gain. Why? Because Fileton is receiving a fixed rate of 2.38%. If the rates it has to pay, the floating UBP MRR, now expected to be lower, the 2.38% fixed rate it receives looks even more attractive and valuable compared to the reduced floating payments it has to make.
Just as we deduced. Receive fixed gains when rates fall.
Precisely. They're getting a better deal on their fixed receipts, while their floating payments become cheaper. To truly solidify your understanding of swap value changes, it's immensely helpful to remember the economic equivalence of a swap. This is a very insightful way to think about the underlying exposure.
Economic equivalence. How else can we think about a swap?
A fixed-rate payer in an interest rate swap is effectively in a synthetic position that is long a floating rate note priced at the MRR and short a fixed-rate bond with a coupon equal to the fixed swap rate.
Whoa. Long floating, short fixed. Let's break that down.
Let's break this down further. Being long a floating rate note, FRN, means you own a bond whose coupon payments adjust with the market rate. So if market rates rise, the income you receive from this FRN also rises, which is a gain for you. This mimics the receive floating leg of the swap.
Okay, long FRN, receive floating.
Being short a fixed-rate bond means you theoretically borrowed or sold a fixed-rate bond. If market rates rise, the value of fixed-rate bonds falls, meaning you can theoretically repurchase them at a lower price, leading to a gain on your short position. This mimics the pay-fixed leg of the swap.
Ah, short fixed bond gains if rates rise, just like paying fixed on a swap gains if rates rise. Interesting.
Exactly. So when you combine long a floating rate note with short a fixed-rate bond, the principal amounts on these theoretical bonds cancel each other out, leaving only the exchange of interest payments.
So the net position is just the interest exchange.
Yes. This means that as a fixed-rate payer, you are essentially in a position where you benefit from both rising floating rates, because what you receive increases via the long FRN equivalent, and benefit when fixed rates rise, because your short fixed bond equivalent gains value.
Oh, wait, let me rephrase that last part. You benefit from rising floating rates, long FRN aspect. And being short a fixed bond also benefits from rising rates because the bond price falls.
So pay fixed benefits overall when rates rise. Correct. This equivalence is a powerful mental model for understanding the P&L dynamics of a swap.
Very helpful way to think about it. Long floating, short fixed equals pay fixed swap.
So students, if you are the party who is receiving a fixed rate on a swap, and then market interest rates suddenly go down after you've entered the swap, would you expect to see a gain or a loss on your swap's mark-to-market value? Think about the economic equivalence, maybe. Receiving fixed is like being long fixed and short floating. What happens when rates fall?
What a comprehensive deep dive we've had today, students. You've grasped some truly fundamental concepts.
It was quite detailed.
We started our journey by clearly defining what swap contracts are, emphasizing their key characteristic of involving a series of future cash flow exchanges, which sets them apart from single exchange forward contracts.
That series concept was key.
Then we painstakingly dissected their important similarities, such as being firm commitments with symmetric payoff profiles and having zero value at inception, while also highlighting their crucial differences, particularly regarding the fixed rate and settlement timing.
The similarities and differences are important foundations.
Absolutely. We then delved into the practical mechanics of how a swap's price, which is that constant fixed rate, also known as the par swap rate, is determined. We saw precisely how it's calculated to make the initial value of the swap zero, using the building blocks of zero rates and implied forward rates.
Calculating the par swap rate was a good exercise.
Yes. More importantly, we explored how a swap's dynamic value changes over time, even with constant expectations, and especially with actual market interest rate movements leading to those critical mark-to-market gains or losses.
The difference between price and value and how value changes.
Exactly. We meticulously analyzed how a rise or fall in expected forward rates impacts the value for both fixed-rate payers and fixed-rate receivers.
Seeing how the MTM gains and losses arise.
Finally, we connected all this theory to real-world applications. We saw how essential swaps are for companies like Esther Inc. to transform their variable loan exposures into predictable fixed ones, bringing much-needed stability to their financial planning.
Just like our Kirana shop owner, seeking certainty in his business loans. That example really helped.
It did. And we also understood how astute investors use swaps to manage their fixed income exposure, adjusting their portfolio's sensitivity to interest rates without having to buy or sell large amounts of physical bonds.
Using swaps strategically in portfolios.
This foundational knowledge is absolutely vital for your CFA studies, providing you with powerful, practical tools and a deep theoretical understanding. You've done very well today.
Indeed. You've taken a tremendous step today in understanding an incredibly complex, yet widely used financial instrument. Swaps are everywhere in finance. Now that you truly understand the mechanics and applications of interest rate swaps, here's a thought for you to ponder and connect with real-world finance, perhaps as you prepare for your future roles. Can you imagine how a large Indian multinational company, let's say one that borrows money at a fixed rate in US dollars internationally, but earns most of its revenue in India, where local market interest rates might fluctuate, might use a combination of swaps to manage its entire financial risk profile?
That's a complex scenario. Fixed USD debt, floating rupee revenue.
Exactly. How would it use a swap, or maybe multiple swaps, to bridge the gap between its fixed foreign currency debt and its fluctuating local currency earnings? Perhaps transforming one into the other to match its cash flows? Maybe involving currency swaps too?
That's heading into more advanced territory, combining interest rate and currency risk management.
It is. But this kind of critical thinking, connecting the theory we discussed today to complex multi-currency real-world scenarios, is what will truly make you a well-informed and strategic finance professional, not just for your exams, but for your successful career ahead.
Yeah.
Keep exploring, students. Think about how these building blocks combine.
We truly hope this deep dive has given you much clarity and confidence in understanding the intricate world of swaps. Keep learning, keep growing, and we look forward to our next enriching session together. Namaste, everyone, and a very warm welcome back to the deep dive.
Hello.
We are so pleased you've joined us for another session.
Yes, welcome back.
We're here to take what might seem like, well, complex financial ideas, and together we break them down
into practical, easy-to-understand wisdom. That's the goal.
Think of this as your personal shortcut to, truly being well-informed. We'll have some surprising facts and hopefully just enough humor to keep you smiling along the way.
Indeed. And today we embark on a particularly foundational deep dive. Really important stuff. This is especially crucial for those of you who are just beginning your finance journey. Maybe you're preparing for your CFA exams.
Or maybe you're just intensely curious about how these financial markets actually work.
Exactly. Either way, you're in the right place. We are going to explore the absolutely fascinating world of options.
Options, yes.
Now, these financial instruments, at first glance, they can appear a bit daunting. A bit like trying to understand a complex cricket scoreboard, perhaps.
Yes, could be.
But trust us, by the end of our session today, you will not only understand their core principles, but you'll also feel much more confident in grasping their strategic implications.
That's absolutely right. Our mission today is simple: to thoroughly demystify options.
We'll explain precisely what they are. Delve into how their value is carefully determined.
And meticulously examine what factors cause their prices to change in the market. All those moving parts.
Consider us your friendly guides, helping you navigate these waters step by step, just like we would in a classroom setting.
Exactly. We'll use simple language, relatable examples from our everyday lives here in India to make sure you build a very strong, robust foundation.
So let's unpack this together, shall we?
All right, let's begin with the very fundamental question. What exactly is an option?
Good place to start.
In the simplest terms, an option contract is what we call a contingent claim.
Contingent claim. Okay, what does contingent mean in this context?
Well, it signifies something that depends entirely on another event or condition happening.
Right.
So, in finance, this means that one party in the contract, specifically the buyer, gets to decide if and when a particular trade will occur in the future.
So it's not guaranteed.
Not at all. It's not a definite binding agreement that must be completed. Instead, it is contingent upon specific conditions being met, or perhaps most importantly, upon the buyer's own strategic choice. It's their call.
Precisely. And to make this concept clearer, let's use an example from our daily lives. Something relatable.
Good idea.
Imagine your local cricket club is organizing a special charity auction. And among the items, they are selling some very rare signed bats from a famous legendary player.
Oh, nice. Limited edition, I bet.
Very limited edition. Now, to secure your chance to buy one of these prized bats, You might pay a small, non-refundable advance amount. Let's say 100.
Okay, just a small amount.
Yes. Now, this 100 isn't buying the bat itself. It's buying you the right to purchase one.
The right, not the bat. Got it.
This right allows you to buy the bat for a pre-agreed price, let's call it the exercise price or strike price, of, say, $5,000.
Okay, 5,000, that's fixed.
Fixed, but there's a condition, a contingency.
Hmm.
You only get this right if your favorite cricket team wins the next big tournament.
Ah, okay. So it depends on the match outcome.
Exactly. Now, here's the crucial part. If your team triumphs in the tournament,
Yes.
you can then choose to buy the bat for $5,000. You have the right to buy it, but importantly, you're absolutely not forced to.
Ah, so even if they win, I can still say no. Maybe I changed my mind.
Precisely. Maybe the value dropped, or you just don't want it anymore. Now, if, however, your team loses the tournament,
Then what?
or perhaps even if they win, but the market value of that signed bat drops significantly below $5,000 for some reason. In that scenario, you are not obligated to buy it at all.
So I don't have to pay the 5,000.
Correct. You would simply let your right expire, unused. And you would only lose your initial 100 advance.
Just the 100 rupees. Okay.
And this euro advance, which you paid for this unique flexibility and choice, that is exactly what we call the premium in an option.
Premium.
Right. It's the cost for the right to potentially transact later at that pre-agreed price.
This inherent element of choice and contingency is a really vital distinction, isn't it?
Absolutely fundamental.
And it sets options apart fundamentally from what we call a forward commitment, which we might have touched upon in earlier lessons.
Yes, you did. With a forward contract, remember, both parties have a definite obligation.
Obligation, key word.
To buy or sell something at a future date at a pre-agreed price, no matter what happens to the market price in the meantime.
Right. You're locked in.
You're locked in.
Yeah.
And there's usually no premium paid up front in a forward contract because both parties are bound, sharing the risk, symmetrically.
It's a symmetric agreement. Both sides have potential gains and losses.
Exactly. With a forward, if you agree to buy gold for, say, 60,000 per 10 grams in 3 months, and the market price drops to 50,000,
Ouch.
you still must buy it for 60,000. You take that euro 10,000 loss. Your potential loss, just like your potential gain, is theoretically unlimited, or at least very large. But with an option, it's different. Only the buyer has the right, and crucially not the obligation, to perform the transaction.
But the seller.
The seller of the option, the one who received the premium, does have an obligation to fulfill the terms if the buyer chooses to exercise their right.
So the seller has the obligation, the buyer has the choice.
Precisely. This unique contingent and asymmetric nature is what makes options so powerful for risk management and also for speculation. And it's absolute crucial to how they are valued.
So for the option buyer, the maximum loss is just the premium paid.
Exactly. Strictly limited to the premium. While the potential gain can be substantial, maybe even unlimited in some cases, like with a call option if the price skyrockets.
It's a very different risk-reward profile compared to a forward.
Completely different.
That makes perfect sense. So this fundamental distinction about the buyer having the right but not the obligation, that's really the cornerstone of understanding options.
It truly is.
Now, building on that, another important nuance, isn't it, is when you can exercise that right.
An excellent point. This brings in a bit of real-world complexity right from the start. It leads us to the distinction between American options and European options.
American and European.
Okay, most of what we discussed today applies broadly, but this difference is key. A European option can only be exercised on its specific expiration date, not before.
Like a train ticket that's only valid for one specific day and time. No early boarding.
Exactly like that. Whereas an American option offers more flexibility. It can be exercised anytime between the purchase date and the expiration date.
So you can choose to exercise early, if it makes sense.
Yes, and this flexibility, naturally, adds some value to an American option compared to an otherwise identical European one. That early exercise right can sometimes be very valuable.
Especially for certain types, like puts, maybe?
Yes, especially for put options, or sometimes for call options on stocks that pay significant dividends just before expiry. But for our core understanding today, we'll focus on the general principles, just keeping in mind that this American flexibility can slightly impact the precise value.
Okay, good distinction. So, understanding that pivotal concept of choice and flexibility, how does that translate into the initial immediate value of an option?
Right.
This brings us to the first important component of an option's total value. It's exercise value. You might also hear it called intrinsic value.
Exercise value or intrinsic value, same thing. And it's simply how much option would be worth if you could immediately exercise it right now, at this very moment.
Like the instant profit if you acted immediately.
Precisely that. It represents the immediate profit you would realize.
Okay, so how do we calculate that?
To calculate this, we meticulously compare the current market price of the underlying asset. That could be a stock from the Sensex or Nifty, a commodity like silver, or even a currency like the US dollar.
Right.
With the pre-agreed exercise price of the option.
Okay.
Now, for a call option, which gives you the right to buy an asset,
Yes.
the exercise value is calculated as the maximum of 0 OR, the underlying asset's current price minus the present value of the exercise price.
Maximum of 0 or the difference? Why maximum of 0?
Because, well, as a rational person, you would simply never choose to exercise an option to incur an immediate loss, would you?
No, of course not. That would be silly.
If exercising it means you'd pay more for the asset than its current market value, you would just let it be. You wouldn't exercise. So its immediate exercise value would logically be 0. It's your choice, remember?
Right. The choice protects you from immediate loss.
Exactly. Similarly, for a put option, which gives you the right to sell an asset.
Okay.
The exercise value is the maximum of 0 OR, the present value of the exercise price, minus the underlying asset's current price.
Same logic, but reversed for selling.
Precisely. Again, if you can sell the asset for more money in the open market than your option's exercise price allows, you certainly wouldn't use the put option, so its immediate value would be 0 in that case.
And you mentioned the present value of the exercise price. Why present value?
Very important point. Because the exercise price is a payment for a call or a receipt for a put that happens in the future at the time of exercise.
Right.
To compare it fairly with the asset's price today, we need to discount that future exercise price back to today's terms. We use the prevailing risk-free interest rate for this. It ensures we are comparing apples to apples in today's money.
Makes sense. Discounting future cash flow.
Exactly. Standard finance principle.
Let's try and illustrate this with an example that might resonate. Suppose you hold a call option to buy a promising plot of land for 50 lakh.
Okay, 50 lakh exercise price.
This option allows you to buy this land 3 months from now. Now today, the market price of that very same plot of land has significantly appreciated, maybe due to some development nearby. It's now worth 57.5 lakh.
Good appreciation.
Yes, and let's assume the annual risk-free rate, maybe the interest rate on a short-term government bond, is 2% per year.
Okay, 2% risk-free rate.
Now, first we need the present value of your 50 lakh exercise price for 3 months from now.
Right. Discount it back.
So 50 lakh divided by 1.02 raised to the power of 0.25, because 3 months is 1/4 of a year, would come out to roughly over 49.75 lakh.
Okay, so the present value cost is slightly less than 50 lakh.
Correct. So the present value of your future payment obligation is 49.75 lakh. Now, if you could exercise this option right now,
Yes.
you would effectively be paying 49.75 lakh, the present value cost, to immediately acquire something that is currently worth 57.5 lakh in the market.
So there's a clear immediate profit there.
Exactly. Your immediate theoretical profit, or the exercise value, would therefore be 57.5 lakh minus 49.75 lakh, which calculates to 7.75 lakh.
7.75 lakh. That's the intrinsic value right now. And this calculation, as you mentioned, is very similar to what students might see in their study material, perhaps with pounds or dollars instead of rupees.
Precisely. Like the example, GBP 57.50 minus GBP 50 discounted at 2% for 0.25 years gives GBP 7.75. Same logic.
But what if, on the other hand, the land was only worth, say, 40 lakh today?
Good question. Would you rationally exercise your right to buy it for 50 lakh or its present value of 49.75 lakh?
Definitely not. Why pay almost 50 lakh for something worth only 40 lakh?
Exactly. You could simply buy that very same plot of land directly from the market for 40 lakh and save a huge amount.
So in that particular scenario,
Your exercise value would logically be 0, because you would never use the option to lock in an immediate loss.
this clearly highlights the max 0 part of the formula we mentioned.
Absolutely. The option protects you. It will never force you into an immediate losing proposition.
Got it.
So just to ensure we're all clear on this foundational concept, if you hold a call option that allows you to buy shares at 100 and those same shares are currently trading at 95 in the market, what would be the exercise value of your option if you considered exercising it right now? Think about it for a moment. Would you exercise?
Buy at 100 when the market is 95? No. So the value is
0. Exactly. You wouldn't exercise.
perfect. Okay, Building seamlessly on the concept of exercise value, our next key idea is moneyness.
Moneyness. Sounds important.
It is. This term might sound a bit complex, but it simply describes the immediate financial relationship between the underlying asset's current market price and the option's pre-agreed exercise price.
So it's just a snapshot of where things stand right now.
Exactly. It's a quick way of understanding if exercising the option would be profitable right now, or if it holds the potential to become profitable in the future.
Okay, so how many states of moneyness are there?
There are 3 states of moneyness, and they are actually quite intuitive once you grasp their practical implications.
All right, let's hear them.
Firstly, we have at the money, ATM.
At the money.
This occurs when the underlying asset's current market price is equal to the option's exercise price.
Ah, so price equals exercise price, like a tie.
Exactly like a tie. For instance, imagine you have an option to buy a specific model of mobile phone for $10,000, and the phone's current market price is also exactly $10,000.
Okay.
In this scenario, the option is at the money. Its immediate exercise value would be 0, right?
Right, because you wouldn't make any immediate profit exercising it. You could just buy it from the shop for the same price.
Correct. However, ATM options are quite interesting because they are highly sensitive to future price movements. Even a small change, up or down, can push them into profit or loss territory, making them actively traded.
Okay, so that's ATM. What's next?
Secondly, an option is considered in the money, ITM.
In the money. Sounds good for the buyer.
It usually is. This means the option already has a positive exercise value if you were to exercise it immediately.
So it's already profitable on paper.
Yes. For a call option, it's ITM when the underlying price is above the exercise price.
Makes sense. You can buy it cheaper than market.
For example, if you have an option to buy that mobile phone for $10,000, but the phone is currently trading at $11,000 in the market.
Then it's ITM.
Yes. You could theoretically buy it through your option for $10,000 and instantly sell it in the market for $11,000, pocketing your $1,000 profit before considering the premium paid.
This is why it's in the money.
And for a put option. For a put option, it's ITM when the underlying price is below the exercise price.
Okay. Sell higher than market.
Exactly. So if you have a put option to sell a phone for $10,000, but its market price has dropped to $9,500.
Also ITM.
Yes. You could buy it for $9,500 in the market and immediately sell it using your option for $10,000, making a $500 profit.
Okay, so ATM, ITM. What's the third one?
And finally, an option is out of the money, OTM.
Out of the money. Sounds like the opposite of ITM.
It is. This means the option has 0 exercise value if you try to exercise it immediately. It simply wouldn't be profitable to do so right now.
Okay.
For a call option, it's OTM when the underlying price is below the exercise price.
Like our earlier example, option to buy at 100, market price is 95.
Precisely. Using our phone example, if you have an option to buy it for $10,000, but the phone is now only worth $9,000 in the market, you wouldn't use your option to buy it for $10,000 if you can get it cheaper for Euro 9,000 directly from the market, would you?
No way. So its exercise value is 0, OTM.
Correct. And for a put option, it's OTM when the underlying price is above the exercise price.
Right. Market price is higher than your selling price.
Exactly. So if you have a put option to sell for $10,000, but the phone is now trading at $10,500, you wouldn't sell it for $10,000 using your option when you can get $10,500 in the open market.
Makes sense. So again, exercise value is 0, OTM.
Correct. And this concept of moneyness also profoundly impacts an option sensitivity to price changes, something we often refer to as its delta in more advanced discussions, but we won't dive deep into that today.
Okay, just knowing the states is good for now.
Yes. A deep in the money option, one that's very likely to be exercised, tends to move almost 1-for-1 with the underlying asset's price. If the stock goes up by €1, the ITM option's value might also go up by almost €1.
Behaves almost like earning the stock itself.
Kind of, yes. On the other hand, a deep out-of-the-money option, which is very unlikely to be exercised, shows far less sensitivity. Small price changes in the underlying won't affect its value much. It primarily holds only time value, which we'll discuss next.
And the ATM options.
At-the-money options are caught right in the middle, and their value can swing quite significantly with relatively small price changes. They have the most uncertainty priced in.
Let's consider another practical example for a put option. Imagine you have a put option on some heirloom gold jewelry, maybe from your grandmother. It gives you the right to sell it for $100,000.
Okay, a fixed selling price.
If the current market price of that jewelry based on gold rates is win 95,000,
Then your option is.
clearly in the money because
Yeah.
you can sell it for 100,000, which is more than its current market value, guarantees you a better price.
Good.
However, if the market price suddenly jumps to 110,000, perhaps gold prices surged.
Then.
Your option is now out of the money because you would never choose to sell for 100,000 when you can easily get 110,000 in the open market.
Perfect understanding. This distinction is vital for a buyer's decision-making process.
Okay, so now for a quick check of your understanding again. If you have a call option to buy shares at 50 and the shares are currently trading at 40, how would you classify your option in terms of moneyness? Is it in the money, out of the money, or at the money?
Exercise price 50, market price 40.
Yeah.
Buying at 50, market is 40. You wouldn't buy.
Yeah.
It's out of the money. OTM.
Excellent. Okay, now let's move to the final and often most intriguing piece of the option valuation puzzle. Time value.
Time value. Very important.
We've already thoroughly discussed exercise value, which represents the option's immediate worth, its intrinsic value.
Yes, the value right now.
But an option inherently carries additional value simply because of the time remaining until it expires. This is a truly crucial concept to grasp.
Indeed. The time value of an option is not just some arbitrary number. It's actually quite simple to define. It's the difference between the actual current option price, what you pay for it in the market, its total market value, and its calculated exercise value.
Oh, okay. So if we know the total price and the exercise value, we can find the time value.
Exactly. We can beautifully summarize it with a fundamental equation. Option price, exercise value, plus time value.
Simple enough. Price equals intrinsic plus time value.
Correct. And this extra value, the time value component, reflects the possibility and the potential that the underlying asset's price will move favorably before the option expires.
The chance for things to get better for the buyer.
Precisely. Making it more profitable to exercise in the future. It's essentially the premium you pay for flexibility, for that potential upside, and for the inherent uncertainty of future price movements.
So it's the value of hope or potential.
That's a good way to think about it. Think about booking tickets for a highly anticipated movie, maybe a big Bollywood release, or a crucial cricket match well in advance.
Okay.
You buy the ticket a month before the event for 250 tar. Now, let's say that, theoretically, the current exercise value, meaning what that ticket would be worth if the event was happening today and you could get some immediate tangible benefit, is only €200.
Right, maybe that's the standard price.
Perhaps. The extra 50 you paid is the time value. It represents the chance that before the movie actually releases or the match begins, something positive might happen.
Like what?
Maybe the movie gets rave reviews and ticket demand skyrockets, making your pre-booked ticket suddenly more valuable. Or maybe the opposing cricket team has injuries, making your team more likely to win, increasing the value of watching.
Okay, so that euro is the value of that hope, that potential, that uncertainty possibly working in your favor.
Exactly. And this is where the concept of time decay comes in.
Time decay sounds like something fading away.
It is. As the movie release date or the match day approaches, this hope or potential gradually diminishes. Why? Because there's simply less time for big surprises or significant favorable movements.
Less time, less uncertainty.
Correct. On the very day of the movie or match, at the exact moment of expiry, that extra euro and the time value becomes precisely zero.
It disappears completely.
Completely. At that point, the ticket or the option is only worth its immediate intrinsic value, its exercise value. If the option is out of the money, OTM, it expires worthless. If it's in the money, IPM, its total value is solely its exercise value.
So the time value erodes over time.
Yes, and this process, where the time value consistently erodes as the option approaches its expiration, is a critical factor for option traders to manage. It's like a melting ice cube.
That's a good visual, melting away.
It's absolutely vital to remember that the time value of an option is always positive until the very moment the option expires.
Always positive. Why?
Because the option buyer always enjoys that limited downside risk, only the premium paid, but theoretically unlimited upside potential. That potential for a beneficial price swing, even if the option is currently out of the money, is what time value captures.
Even a tiny chance is worth something.
Yes, until the very last moment. But at maturity, at the exact expiration date and time, this unique advantage of potential disappears entirely, and the time value...
And the options value is just its exercise value.
Precisely. This is why time, particularly the remaining time, is such a powerful determinant of an option's overall worth.
Okay, that's clear. So to really solidify your understanding here, If a put option is currently trading in the market for 5, and its immediate exercise value, its intrinsic value, is 0 because it's out of the money, what then is the time value of this option?
Total price is 5. Exercise value is 0 price. Exercise value plus time value. So
The time value must be 5. The entire price is time value in this case.
excellent. You got it. Okay, let's now shift our focus slightly to a very fundamental concept in financial markets.
Arbitrage.
Arbitrage. Heard that term before. Sounds like free money.
Well, kind of, but it's not quite that simple, and opportunities are rare and fleeting. In essence, arbitrage opportunities arise when the law of one price fundamentally breaks down.
The law of one price, what's that? It basically states that the exact same asset or a portfolio of assets that produces identical cash flows should trade at the exact same price in different markets or forms at the same time.
Okay, makes sense. Same thing, same price.
If such a discrepancy occurs, a very astute individual, an arbitrager, can swiftly execute a series of simultaneous transactions, typically buying the asset where it's cheaper and selling it where it's more expensive, thereby locking in a risk-free profit.
Ah, like buying a kilo of the finest Alfonso mangoes for 200 from one vendor in the market and immediately selling them for 250 to another vendor right next door.
Exactly. A perfect analogy. Assuming no transaction costs, that's a risk-free Euro 50 profit. But as you can imagine, such obvious opportunities usually disappear very quickly as market participants exploit them.
Right, everyone would rush to do it and prices would adjust.
Precisely. Now, for options, the concept of arbitrage is applied with a bit more nuance.
Why is it different for options?
This is primarily because, unlike forward contracts, which we discussed earlier, options possess an asymmetric payoff profile.
Asymmetric payoff, we touched on that. Limited loss, potential unlimited gain for the buyer.
Correct. Whereas forwards have a symmetric payoff profile.
Symmetric meaning?
Meaning your potential gain or potential loss can be equally large, essentially unlimited, for both parties involved in the contract.
Right. If the price moves your way, you gain a lot. If it moves against you, you lose a lot. Mirrored outcomes.
Precisely. Think back to that forward contract to buy 100 shares at $9,000 in 6 months. If the share price jumps to $1,500, you make a handsome $50,000 profit.
Nice.
But if the share price plummets to $500, you suffer a $50,000 loss because you're still obligated to buy it at $8,000. Both your upside and downside are substantial and unconstrained. That's the symmetry.
Okay, so how does the asymmetry of options change the arbitrage picture?
With options, because of that inherent right but not obligation for the buyer, let's revisit our cricket match bet example.
Okay, the 100 bet.
For a call option buyer, your potential profit is unlimited if the price of the underlying asset goes very high, just like your team winning by a huge margin. You paid 100 premium. If the asset price skyrockets, you could gain 500 or 1,000, maybe much more.
Big upside.
Huge potential upside. However, if your team loses badly or the underlying asset's price goes down instead, what's your maximum loss?
Just the 100 premium I paid initially.
Exactly. Your maximum loss is strictly limited only to that initial Euro 100 premium. You don't lose endlessly. This characteristic limited loss and potentially unlimited gain is exactly what we mean by an asymmetric payoff.
Upside is open, downside is capped.
Perfectly put. An option buyer will only exercise if it's profitable. If it's not, they simply let it expire worthless, losing only the premium. This inherent asymmetry is precisely why options are indispensable tools for investors looking to either cap their downside risk when holding an asset or perhaps amplify their upside exposure with controlled capital investment.
It's not just a feature, it's the fundamental power of options in managing risk and return.
Absolutely. So because of this asymmetric payoff profile for options, we don't look for a single, precise arbitrage price like we might for a perfectly replicable forward contract.
So what do we look for?
Instead, we establish no arbitrage price bounds.
Bounds, like a range.
Exactly. These are the critical upper and lower limits within which an options price must trade in a rational, efficient market to prevent those risk-free arbitrage profits from being made.
So the price has to stay within this corridor.
Yes. If an options price momentarily trades outside these established bounds, maybe it's too cheap or too expensive relative to its theoretical limits, an arbitrager can immediately step in.
And make risk-free money.
Yes, by executing a series of simultaneous trades, buying the undervalued side and selling the overvalued side, they make money without any risk. And the sheer force of these market participants doing this will swiftly pull the options price back within those bounds, ensuring fair value and market efficiency.
Okay, so the market sort of self-corrects through arbitrageurs exploiting mispricings outside these bounds. So just to recap that key difference, why is the payoff for an option buyer considered asymmetric when compared to a forward contract? What's the fundamental difference in their risk exposure?
The core difference lies in the obligation. Forward contracts bind both parties, creating symmetric risk. Options give the buyer a choice, limiting their downside to the premium, creating that asymmetry.
Got it. Okay, let's delve deeper into these crucial boundaries then, these no arbitrage price bounds. They sound central to option valuation.
They absolutely are. Let's start with a call option, which gives you the right to buy.
Okay, the lower bound first. What's a minimum price it should trade at?
The lower bound of its price is the maximum of 0 OR, the underlying asset's current price minus the present value of the exercise price.
Wait, that sounds familiar. That's the exercise value, isn't it?
Exactly. The lower bound is simply its immediate exercise value, or 0 if that value is negative. This makes perfect intuitive sense, doesn't it? A call option should, at the very minimum, be worth its immediate potential profit if exercised now.
Right. It can't be worth less than its immediate cash value.
Correct. If, for some reason, it traded below this intrinsic value, what would happen?
Arbitrage.
Yes. You can simply buy the ridiculously cheap option, immediately exercise it, acquire the underlying asset at the exercise price, and then instantly sell that underlying asset in the open market for its higher current price, thus securing a guaranteed risk-free profit.
And the arbitrageurs would pile in, buying the cheap option.
Pushing its price up until this disparity, and thus the arbitrage opportunity, completely vanishes. It must be worth at least its exercise value. The mathematical representation is MAC 0 SUAX, where S is the current underlying price, and PVX is the present value of the exercise price.
Okay, that makes sense. Now, what about the upper bound for a call option? Is there a maximum price?
Yes, there is, and it's remarkably simple. The upper bound is merely the underlying asset's current price.
The option can't be worth more than the asset itself.
Never. Think about it logically. Why would you ever pay more for the right to buy an asset than the price of the actual asset itself sitting right there in the market?
You wouldn't. You just buy the asset directly.
Exactly. For example, if a call option to buy a share for €100 was somehow selling for €100.10, but the share itself was trading at only 105, what would you do?
I'd ignore the option and just buy the share for 105. Much cheaper.
Precisely. There's absolutely no point in paying €100 for the right to buy something when you can acquire the actual thing for less. Therefore, the option price cannot, and rationally will not, exceed the underlying asset's current price. So €0 call price.
Yeah.
More specifically, max ORO, SPVX, at call price ORO.
Okay, clear boundaries for the call option. Now let's switch to a put option, the right to sell. What are its bounds?
Similar logic applies. The lower bound for a put option is the maximum of 0 OR, the present value of the exercise price, minus the underlying asset's current price.
Again, that's just its exercise value.
Exactly. Its intrinsic value if exercised immediately. And just as with call options, if a put option traded lower than this intrinsic value,
Arbitrage opportunity again?
immediately, an arbitrager could buy the undervalued put option, simultaneously buy the underlying asset in the market, which is currently cheaper than the exercise price, making the put ITM, and then immediately exercise the put option to sell that very same asset for the pre-agreed higher exercise price. They'd lock in a risk-free profit.
And again, market forces would quickly eliminate such disparities by bidding up the put price.
Correct. So the put must be worth at least its exercise value, mathematically. Max 0 PVX, put price.
Okay. Now, for the upper bound of a put option, can it go infinitely high if the price drops?
No. Unlike a call's potential, a put's value is capped. The upper bound of a put option's price is simply the exercise price itself, X, or more accurately, the present value of the exercise price, PVX.
Why the exercise price?
Think it through. Imagine you have the right to sell something, let's say a specific brand of washing machine, for $10,000. That's X. Even if, hypothetically, the market price of that washing machine falls to literally 0, it becomes completely worthless.
Okay.
What's the absolute most value that put option could possibly give you?
Well, I could sell the worthless machine for $10,000, so $10,000 gain.
Exactly. The maximum value you can extract is the exercise price, $10,000. It cannot be worth more than the fixed price you're entitled to sell it for. So the exercise price, or technically its present value since you receive it at expiration, effectively serves as the absolute ceiling for a put option's value.
So max 0 PVX S0, put price 0. That makes sense.
Precisely.
Let's apply these no arbitrage price bounds with a concrete example, maybe similar to something in the CFA study material. Consider a European call option on a share. Its exercise price is 1,000.
Okay, X1000.
The share is currently trading at 1,050 at S030. The risk-free rate is 1% per annum, and let's say there are 6 months remaining until the option expires, T equals 0.5 years. Let's calculate these important bounds.
Okay, first step.
First, we need the present value of the exercise price, PVX.
Right. Discount 1,000 back for 6 months at 1%.
So PVX 1,000 1.01.5. Using a calculator, that comes out to approximately 995.04.
Okay, PVX is 995.04. Now for the lower bound of the call.
Lower bound is max 0 ho, S euro PVX. So max 0, 150 euro, 995.04.
Which is?
54.96. So the option must be worth at least 54.96.
Good. And the upper bound?
The upper bound is simply the current share price, S0.
Which is 150 euro.
Correct. So to prevent any risk-free arbitrage opportunities, this particular call option's price must trade somewhere within the range of 54.96 and 1,050.
If its market price deviates outside this range, say it drops to 50 or jumps to 1,100.
Arbitragers will step in immediately, make risk-free profits, and push the price back into that valid range.
Excellent. This brings up a crucial point for you to ponder. If a put option has an exercise price of 500, what is the absolute maximum value it can ever possibly achieve in the market? Think about why that upper limit exists.
Based on what we just said, the upper bound is the exercise price, or its present value. So it can't be worth more than 500, or slightly less due to discounting, even if the underlying asset becomes worthless.
Perfect reasoning. Okay, closely related to this idea of arbitrage and ensuring prices are correct, there's another immensely powerful concept in finance known as replication.
Replication, like making a copy.
In a financial sense, yes. This strategy involved creating the exact same cash flows or payoff profile of a complex financial instrument, like an option, by skillfully combining other, typically simpler financial instruments.
Like building something complex from basic Lego blocks.
Exactly. Or perhaps like creating a gourmet meal using only basic, readily available ingredients from your local Kirana store or vegetable market. You combine simple things to achieve a complex result.
Okay, why is this replication idea so important?
It's critical because it fundamentally underpins the law of one price across different financial products. If you can perfectly replicate a complex instrument, like an option, with a simpler combination of assets, like the underlying stock and borrowing lending,
Yes.
then in an efficient market, the price of that complex instrument must be equal to the total cost of creating and maintaining its replicating portfolio.
If they produce the same outcome, they must cost the same.
Precisely. If they didn't, arbitrage opportunities would immediately arise. You could buy the cheaper one and sell the more expensive one for a risk-free profit.
Okay, so how do we replicate options specifically? What are the building blocks?
For options, replication primarily involves combining strategic positions in the underlying asset, such as buying or short-selling shares, and judiciously borrowing or lending cash at the risk-free interest rate.
So stock and cash.
Essentially, yes. The ultimate goal is to construct a portfolio using just these two elements that behaves, cash flow by cash flow, exactly like the option you're trying to replicate.
Okay, let's take a call option first. How would you replicate the right to buy?
To replicate a call option, you would typically engage in two simultaneous actions. You would borrow some money at the risk-free rate.
Borrowing, okay.
And you would use that borrowed money to immediately purchase a specific quantity or fraction of the underlying asset.
Buy the underlying asset. How much?
That's the tricky part. Not necessarily one full unit. You buy a specific proportion, often called the options delta. Let's say you buy 0.6 shares for every call option you want to replicate, and you'd borrow the present value of the exercise price, adjusted for the probability.
Okay, so buy some stock, borrow some cash. What's the idea behind this?
The underlying idea is that if the call option ends up being exercised at its maturity, because the stock price went up, you can sell the underlying asset that you already own, your 0.6 shares, and use the proceeds from that sale, plus maybe some extra cash if needed, to repay your loan. The net result should match the profit from the actual call option.
And if the option is not exercised, if the price went down?
If the option expires worthless, you are still left owning the underlying asset, which has likely fallen in value, and you still have the obligation to repay your loan. The loss on this replicating portfolio should match the loss on the actual call option, which is just the premium.
Okay, so it mirrors the call's payoff. in both up and down scenarios. Now, what about replicating a put option, the right to sell?
To replicate a put option, the strategy is somewhat the reverse. Here, you would typically sell the underlying asset short.
Short selling. Selling shares you don't own.
Yes, exactly. Borrowing shares and selling them, hoping to buy them back cheaper later. It's a strategy used when you expect prices to fall. So you short sell a fraction related to the put's delta of the underlying asset.
Okay, short the asset, and what else?
And then you would lend the money you receive from that short sale out at the risk-free rate.
So generate cash from the short sale, then lend it out to earn interest.
Correct. You're essentially creating a synthetic loan to the market.
Yeah.
Now, if the put option ultimately gets exercised because the price fell, you would use the money you get back from your loan repayment to buy back the underlying asset in the market at the now lower price and return the shares to close out your short position. The net result should match the profit from the actual put option.
And if the put option expires worthless, price went up.
Then you would simply unwind your short position, buying back the shares at a higher price, resulting in a loss on the short sale, and you'd keep the principal plus interest from your lending. Again, the net loss on this portfolio should match the loss on the put option, just the premium.
Wow, that's quite clever, using stock and cash to mimic the option payoffs.
It is. Let's consider a practical analogy to try and grasp this dynamic aspect, maybe without the short selling, which can be confusing initially. Imagine you want the financial effect of owning a call option on a particular high-demand mobile phone, but you don't want to buy the option directly.
Okay, replicate the call on the phone.
You could borrow some money from your friend at a low interest rate, like a risk-free rate, and immediately use that borrowed money to buy the phone outright.
So borrow and buy the phone now.
Yes. When the time comes, if the phone's market price has gone up significantly, what do?
Sell the phone, pay back my friend with interest, and keep the difference as profit.
Exactly. You've cleverly mimicked the call option's payoff if the price went up.
But this is precisely where replicating an option becomes considerably more complex and crucially dynamic than replicating a simple forward commitment.
Why dynamic? What needs to change?
With a forward contract, the obligation is fixed regardless of price movements. So the replication strategy, like agreeing to buy the phone in 3 months, usually remains constant and static. You set it up once.
Right.
But with an option, the likelihood of it being exercised, whether it moves deeper into the money or further out of the money, changes constantly as the underlying price moves up and down.
The probability keeps shifting.
Exactly. So to perfectly replicate an option, you can't just set up the portfolio once and forget it. You would need to constantly adjust your portfolio.
Adjust what?
How much money you borrow or how many phones or shares you hold. That fraction, that delta, changes as the underlying price and other factors change. It's almost like a continuous dynamic balancing act.
So if the phone price goes up, making the call more likely to be exercised, I might need to hold slightly more of the phone in my replicating portfolio.
Precisely. You might need to buy a tiny bit more phone or share and maybe borrow a bit more money to keep your replicated position perfectly mirroring the option's changing payoff profile and its changing delta.
Wow. That sounds much more complex than replicating a forward.
It is profoundly different. Your study material rightly points out that the replicating transaction for an option is based on a proportion of the underlying, which is closely associated with the moneyness of the option. And crucially, this proportion, that delta, constantly changes, requiring continuous rebalancing.
Absolutely. And this constant dynamic adjustment is not merely a theoretical exercise. It is absolutely key to understanding why options are fundamentally more complex than forwards. It's also why the sophisticated pricing models for options, like the famous Black-Scholes-Merton model, are far more intricate than simple forward pricing. They explicitly account for this continuous rebalancing required to replicate the option's payoff.
That's a fascinating insight into why option pricing is complex. So for our listeners, a point to consider. Why does replicating an option necessitate this continuous adjustment, whereas replicating a simple forward commitment typically does not? What fundamental difference between options and forwards drives this need for dynamic rebalancing?
It boils down to that contingent nature, the choice, the asymmetric payoff of the option, which means its sensitivity to the underlying price, its delta, is not constant like a forward's.
Excellent summary. Okay, now that we have a solid understanding of the building blocks, the contingent nature, intrinsic value, time value, arbitrage bounds, and replication, let's explore what truly makes option prices fluctuate day to day.
Right, the factors that drive the value up or down.
There are 6 key factors that meticulously determine an option's value, and also how sensitive it is to market changes. Let's begin by examining the interplay between the value of the underlying asset and the exercise price.
Ah, yes, the dance of values, as you called it earlier. A very apt description. Let's start with the value of the underlying asset. The stock, the commodity, the currency itself.
How does its price affect the option price?
Okay, for a call option, if the underlying asset's price goes up, the call option's value will also, generally, go up.
That seems intuitive. The right to buy something gets better if that something is worth more.
Exactly. You can acquire it at a cheaper pre-agreed price through your option and potentially sell it for a higher market price, securing a larger profit.
Yeah.
The deeper in the money a call option becomes, the more its value tends to move almost in lockstep, nearly one-for-one, with the underlying asset.
Okay. Now for a put option. If the underlying asset's price goes up,
If the underlying price goes up, the put option's value will generally go down, because the right to sell something becomes significantly less valuable if that something is fetching a higher price in the open market. Why would you use your option to sell it at a lower fixed exercise price if you can sell it for much more directly in the market?
you wouldn't. The put becomes less attractive.
Correct. As a put option moves further out of the money because the underlying price is rising, its sensitivity to further small increases in the underlying asset's price diminishes, and its value gets closer to being just its time value.
Makes sense. So underlying price moving up, good for calls, bad for puts. Underlying price moving down, bad for calls, good for puts, generally speaking.
Generally speaking, yes, that's the primary relationship. Now let's look at the exercise price itself. This is the fixed, pre-agreed price in the contract. How does it play a role?
Right, the strike price. How does that affect value? So let's take a call option again.
For a call option, a lower exercise price makes the option considerably more valuable, assuming the underlying price is the same.
Lower strike is better for a call. Why?
Because you secure the right to buy the asset at a cheaper pre-agreed price. Think about it. Having the right to buy shares at 50 is fundamentally more attractive and potentially more profitable than having the right to buy them at 60 if the current market price is, say, 65.
Right. The lower strike price gives you a bigger potential profit margin.
Exactly. A lower exercise price translates into a higher potential profit if the option ends up in the money, or gives the option a significantly higher chance of becoming in the money as the underlying asset price moves up.
Okay. Now for a put option, how does the exercise price affect its value?
For a put option, it's the opposite. A higher exercise price makes the option more valuable.
Higher strike is better for a put. Why?
Because you gain the right to sell the asset at a higher pre-agreed price. If you have the right to sell shares at 50 meet, that is clearly more valuable and offers better protection than having the right to sell them only at 40, especially if the market price has fallen significantly, say to 35.
The higher strike price locks in a better selling price, offering a bigger potential profit or a better safety net if prices fall.
Precisely. A higher exercise price means a greater potential profit if the put option is in the money, or a higher probability of ending up in the money if prices decline.
Let's use our trusted local sabziwala, the vegetable seller, again, to make this more tangible.
Good idea. Keeps it grounded.
Imagine you have a call option, the right to buy a specific type of vegetable, say onions, from him at a fixed price per kilo.
Okay.
If the market price of those very same onions in other shops suddenly goes up significantly,
Then your option to buy them from the sabziwala at your lower fixed price.
immediately becomes much more valuable. My call option gains worth.
Correct. But now, what if you had a put option, the right to sell onions to him at a fixed price, and the market price goes up?
Well, then my option to sell at that lower fixed price becomes less valuable because I could simply get more money for my onions by selling them in the open market instead.
Perfect. Now let's consider the exercise price itself. If the sabziwala offers you a lower exercise price to buy onions from him, say 20 per kilo instead of 30,
That's definitely better for my call option. It directly increases its value because my potential savings per kilo are greater.
exactly. And conversely, if he offers you a higher exercise price to sell onions to him, say 50 per kilo instead of 40,
That's immediately better for my put option. Makes it more valuable because I can lock in a superior selling price, providing a better hedge against falling market prices for onions.
excellent grasp of the relationship between exercise price and option value.
So, a pivotal question for you to consider now. If you own a put option and the underlying asset's market price experiences a significant fall, how does that generally affect your put option's value? Does it increase, decrease, or remain largely unaffected?
If the underlying falls, my right to sell at a fixed higher price becomes more valuable. so the put option value increases.
Correct. Okay, let's move to the next factor. We briefly touched on this when discussing time value, but let's now examine time to expiration as a direct and crucial factor influencing an option's overall market value.
Ah, yes, the time remaining on the clock. How does that play out?
Generally, and this is a very consistent principle for both call options and put options, a longer time to expiration means a higher option value. More time is generally better.
More time, more value. Why is this so? What's the intuition?
It's fundamentally about two things we've already discussed: opportunity and that limited downside. Because options possess that wonderful asymmetric payoff profile.
Right. Limited loss, potential unlimited gain for the buyer.
More time means there's simply a significantly greater chance, a longer window, for the underlying asset's price to experience a substantial movement in a way that is highly favorable to the option buyer.
More time for things to potentially go really well.
Exactly. For a call option, a longer time horizon presents more opportunities for the underlying price to dramatically shoot up, maybe due to unexpected good news, leading to potentially large profits.
And for a put option?
For a put option, a longer time means more opportunity for the underlying price to fall sharply, perhaps due to bad news or market downturns, making your right to sell at a higher fixed price incredibly valuable.
So more time inherently provides more opportunities for those big, profitable price swings.
Without simultaneously increasing your maximum potential loss, which is always capped at the premium paid.
Ah, I see. So it increases the potential upside without increasing the downside risk. That directly translates into an increase in the option's time value component, right?
Precisely. More potential, more uncertainty over a longer period leads to higher time value.
It's also important, though, to remember the nuance of time decay, which we also mentioned, often called theta in the jargon.
Right, the melting ice cube.
While more time generally means higher initial value, the rate at which that time value erodes or decays is not linear. It doesn't disappear steadily each day.
How does it decay then?
Time decay actually accelerates as an option gets closer to its expiration date, especially for out-of-the-money and at-the-money options.
Why faster near the end?
Because in their final weeks or months, the probability of a significant favorable price move diminishes very rapidly. There's just not much time left for a miracle turnaround. So the time value evaporates quickly.
And for deep-in-the-money options?
Deep-in-the-money options also experience time decay, of course, but their intrinsic value component is usually much larger and becomes dominant. So time value is a smaller proportion of their total worth, and its decay might seem less dramatic relative to the total price.
Okay. Now, you said generally more time means higher value. Are there exceptions?
Yes, there can be a slight, though less common exception. It mainly applies to very deep-in-the-money put options.
Deep ITM puts. Why?
For these specific options, a very long time to expiration combined with a high risk-free interest rate might sometimes slightly lower their value.
Lower value with more time. That sounds counterintuitive.
It does. It occurs because the main value of a deep ITM put is the ability to receive the high exercise price in the future. If interest rates are high and the time is very long, the present value of receiving that exercise price far in the future is reduced significantly due to the heavy discounting over that long waiting period. It slightly diminishes the current worth.
Ah, the discounting effect outweighs the more time for price movement effect in that specific case.
In that specific, somewhat rare case, yes. But generally, as a robust rule of thumb for most options you'll encounter, more time equals more potential for a beneficial price movement, and thus a higher option value for both calls and puts.
Okay, that's a crucial point about the nonlinear decay and the general rule. So considering this, if all other factors remain constant, does an option generally gain or lose value as it gets closer and closer to its expiry date?
It loses value due to time decay. That time value melts away.
Correct. Okay, next on our list of influential factors is the risk-free interest rate.
Ah, interest rates. How do they fit into the option puzzle?
This rate is essentially the opportunity cost of holding money. It's the theoretical return you could earn on an absolutely risk-free investment,
Right.
like a short-term government bond or a very secure fixed deposit with a major bank.
Right, reflects the basic time value of money. How much euro today is worth can go to euro in the future.
Exactly. Now, the risk-free rate, interestingly, has different and somewhat contrasting effects on call and put options.
Different effects, why?
This divergence arises primarily from how the interest rate impacts the present value of the option's exercise price, which we discussed earlier when calculating intrinsic value.
Okay, how does it affect calls?
For a call option, A higher risk-free rate generally increases its value.
Higher rates make calls more valuable. Why?
Because a higher interest rate means the present value of the exercise price, which is an amount you would potentially pay in the future if you exercise the option, effectively becomes lower today.
Lower PV of the payment. How does that help?
Think about it. If money can grow faster because interest rates are high, then a future payment of, say, $100,000 for a property in a year feels less burdensome today. You need to set aside a smaller initial amount now to accumulate that €1,000 in the future if it earns more interest.
Ah, so the future cost feels cheaper in today's terms.
Exactly. The cost of exercising the call option in the future feels less onerous today, making the call option itself more attractive and consequently a bit more valuable.
Okay, that makes sense for calls. Now, what about put options? How do higher rates affect them?
For a put option, a higher risk-free rate generally decreases its value.
Decreases. Why the opposite effect?
With a put option, you possess the right to receive the exercise price in the future if you decide to sell the underlying asset.
Right, you get paid the strike price.
A higher interest rate means that the present value of that future receipt, the exercise price, becomes lower today when you discount it back.
So the future benefit is worth less today.
Correct. The benefit of potentially receiving money in the future feels less valuable today when discounted back at a higher rate. This reduction in the present value of the future benefit makes the put option less attractive, thereby reducing its overall value.
Let's use an Indian example that might help clarify this. Imagine you are diligently saving for a significant family event, perhaps your daughter's wedding, and you have your funds safely parked in a fixed deposit, earning what we can consider a risk-free rate.
Okay, saving for the wedding.
If the Reserve Bank of India suddenly increases interest rates across the economy, causing your fixed deposit rate to go up.
Good for my savings.
Yes. Now think about a future amount of money you might need to pay for something, like a call options exercise price. That future payment becomes less significant today when you discount it back at the higher rate. It's almost like saying, oh, I need 5 lakh for the wedding hall in a year. If my FD interest rate is now higher, I don't need to put aside quite as much money today to reach that euro lakh target.
Makes the future payment feel smaller today, which makes a call option with its future payment more appealing.
Exactly. But now consider the opposite. If you are going to receive money in the future, like a put options exercise price, from selling something, and interest rates go up, that future amount, when discounted back to today at that higher rate, is actually worth less to you right now. The present value shrinks more.
So the value of that future benefit has diminished in today's terms.
Correct. This reduction in present value makes the put option less attractive. Hence, its market value generally decreases.
Yep.
It's a subtle but powerful effect driven by the time value of money.
An important point to remember here, maybe something your study material often notes, is that the risk-free rate primarily affects the option's value by changing the present value of the strike price. It impacts the intrinsic value calculation.
Right. It does not directly affect the time value component of an option in the same way.
Yeah.
Time value is much more profoundly influenced by volatility and the time remaining until expiration.
Okay, good distinction. So, a practical question for you then. If the Reserve Bank of India decides to increase interest rates across the economy, how might that policy decision generally affect the value of a put option that you are currently holding?
Higher rates decrease the present value of the future exercise price received, making the put less attractive. So the put option's value would likely decrease.
Excellent. You're connecting the dots perfectly. Now, this next factor is where it gets truly fascinating and often a little counterintuitive for new learners.
What is it?
We're talking about the volatility of the underlying asset.
Volatility, how much the price jumps around.
Exactly. Volatility, in simple terms, refers to how much the price of the underlying asset is expected to fluctuate or move up and down over a given period. Think of it as how bouncy, unpredictable, or turbulent the price garments are.
Like some stocks seem very calm, others are like a roller coaster.
Precisely. High volatility means prices are expected to swing wildly, while low volatility suggests they will be relatively stable and calm.
Okay, so how does this bounciness affect option prices?
And here's the truly remarkable part. A higher volatility of the underlying asset generally increases the value of both call options and put options.
Increases both. Calls A and D puts. That does sound strange initially. Why would more uncertainty be good for both sides?
Let me carefully explain why this holds true. It goes back to that beautiful asymmetry.
Okay.
Let's use an example from the burgeoning startup scene in India. Imagine you're considering investing, maybe through options, in a new tech firm that has just launched its innovative product. Its stock price might be extremely volatile.
Right. Startups can be very unpredictable.
It could, with high probability, shoot up dramatically if their product really takes off and gains market traction. Or it could fall sharply if they face unforeseen challenges, run out of cash, or face intense competition.
Big swings possible in either direction.
Exactly. Now, if you have an option, either a call or a put on this particular highly volatile stock, higher volatility is actually your friend as an option buyer.
My friend,
Yeah.
how so?
Because think about it. If the stock price rises a lot due to this high volatility, your call option, your right to buy, becomes incredibly valuable, leading to a potentially substantial profit.
Okay, good for the call.
And if, on the other hand, the stock price falls a lot, your put option, your right to sell, becomes equally very valuable, again, potentially leading to a large profit.
Right, good for the put.
The key, and this is truly crucial, is that asymmetric payoff profile again. For you, the option buyer, your maximum potential loss is strictly limited only to the premium you paid.
The downside is still capped.
Exactly. So if the price moves in an unfavorable direction, down for a call, up for a put, you simply let the option expire worthless, losing only that initial premium. But if the price moves dramatically in a favorable direction, up for a call, down for a put, your potential profit is theoretically unlimited, or at least very large.
I see. So higher volatility increases the chances of one of those big profitable moves happening.
Without simultaneously increasing your maximum potential loss beyond the initial premium. It just makes a huge win more likely, while the maximum loss stays the same.
So it significantly enhances the probability of the option ending up deep in the money at expiration, whether it's a call or a put, which in turn must dramatically increase the option's time value component, right?
Precisely. That's the core insight. Higher volatility boosts time value because it increases the value of that potential for extreme beneficial moves. It's like buying a lottery ticket where the potential jackpots become much larger or more numerous, increasing the ticket's appeal, even though your entry fee, the premium, remains fixed.
That's a great analogy. Conversely, lower volatility naturally reduces this potential for extreme beneficial moves, thereby reducing the time value of both call and put options.
Correct. This is why volatility, or more precisely, the market's expectation of future volatility, often referred to as implied volatility, is such a critical input in all sophisticated option pricing models. It captures the market's assessment of future uncertainty.
So just to really ensure this important concept is crystal clear for everyone listening, why does an increase in the volatility of a stock typically make both call and put options on that stock more valuable? What unique characteristic of options drives this seemingly paradoxical effect?
It's that limited downside for the buyer. Higher volatility increases the chance of a big win, but the loss is still capped at the premium. So more bounciness increases the value of the option's potential without increasing its risk beyond the premium.
Perfectly explained. Okay, finally, we arrive at the sixth factor. The impact of any income or costs associated with actually owning the underlying asset.
Right. This often relates to tangible things like, say, dividends paid by stocks, or maybe storage costs for physical commodities like gold or wheat, or even something called a convenience yield for holding certain assets.
These are direct financial effects that arise from actually owning the physical underlying asset, not just the option on it.
Correct. Let's meticulously break this down into two distinct scenarios. First, income generated by the asset, and second, costs incurred by owning the asset.
Okay, let's start with income. What if the underlying asset provides income, like a regular dividend payment from a company stock, or maybe rental income from a property if the option was on that?
Good question. This income flows directly to the actual owner of the underlying asset, not to the person just holding the option.
The option holder doesn't get the dividend.
No, they only possess the right to buy or sell the asset, not the actual ownership benefits, until they choose to exercise. Therefore, a call option, the right to buy the asset, becomes less valuable if the underlying asset pays income, especially a large dividend just before expiration.
Less valuable. Why?
Because as a call option holder, you are effectively missing out on receiving that income stream, the dividend, while you only hold the option. You only get the dividend if you actually own the stock on the record date. So the prospect of an upcoming dividend payment makes holding the stock itself slightly more attractive relative to just holding the call option.
Okay, makes sense for calls. What about put options? How does income affect them?
Conversely, a put option, the right to sell the asset, becomes slightly more valuable if the underlying pays income.
More valuable. Why?
Because holding the put gives you the flexibility to potentially sell the asset before it pays the dividend, thus avoiding the price drop that often occurs after a dividend payment, known as the ex-dividend drop. Or it makes holding the underlying asset, which you might need to acquire to exercise the put, slightly less attractive because you know its price might drop after the dividend. So the put becomes a slightly better hedge.
Interesting. So dividends, bad for calls, good for puts. Now, what about the opposite? Costs associated with owning the underlying asset.
Right. Think about things like storage costs for holding large quantities of physical commodities like wheat or crude oil in warehouses, or maybe ongoing insurance premiums for a vehicle if the option was on a car, or even property taxes for owning land.
These are costs the owner has to bear. How do they affect options?
These costs are typically avoided by the option holder until they actually take physical ownership by exercising. So a call option, the right to buy, becomes more valuable if there are significant carrying costs for the underlying asset.
More valuable. Why?
Because by holding the call option, you cleverly delay or avoid incurring these recurring costs until you actually decide to purchase the asset. You only begin paying for storage or insurance once you become the actual owner after exercising the call. It makes delaying ownership via the call option more attractive.
Ah, you save on the carrying costs while holding the call. Okay. And for a put option?
Conversely, for a put option, the right to sell, it becomes less valuable if the underlying has high carrying costs.
Less valuable. Why is that?
Because the asset you have the right to sell is effectively burdened by these ongoing costs for its current owner and implicitly for any future owner, including potentially yourself if you were thinking of buying it to exercise the put. If you were to acquire it to deliver against your put option, you'd immediately start incurring these costs, making the asset itself less appealing to hold or transact. It slightly reduces the net benefit you get from selling it via the put.
Let's use an Indian example again to illustrate this more clearly. Think of owning a piece of agricultural land that gives a regular harvest of crops that harvest is a form of income.
Right, like mango orchards or rice paddies.
If you hold a call option to buy this land, and it's known to give a good, consistent harvest just before your option expires, your call option is slightly less attractive because while you're holding the option, you're not getting that harvest income the current owner is. You miss out on that benefit.
Makes the call less appealing relative to owning the land directly then.
Yes. But now, imagine if owning that very same agricultural land means paying for regular maintenance, maybe irrigation water charges, and security guards to protect the crops. These are undeniable costs.
Okay, carrying costs.
If you hold a call option to buy this land, your option actually becomes more attractive. Why? Because you strategically avoid paying those maintenance and security costs until you actually decide to buy the land and become its owner.
So you directly benefit from not having to bear those expenses up front while you wait and see with the call option.
Precisely. And the reverse holds true for put options. If an asset comes with significant carrying costs, your put option to sell it becomes slightly less attractive because the asset itself is less desirable with those attached costs, reducing the net benefit of selling it via the put.
It's truly all about evaluating the net benefit or the financial burden of holding the actual underlying asset itself, isn't it?
Exactly. And understanding how the option, by providing that right rather than an obligation, allows you to either participate in, like upside potential, or strategically avoid, like carrying costs or downside risk, those financial aspects until the point of exercise.
Okay, that covers all 6 factors nicely. So a final probing question on these influential factors for everyone listening. If a company announces a very high dividend payment for its shares, would that significant dividend typically increase or decrease the value of a call option on those shares?
Dividends mean the stockholder gets income, the call holder doesn't. So it makes the call less attractive relative to the stock. The call option value would likely decrease.
Perfect. You've nailed it. Phew. We've truly covered quite a bit of ground today, haven't
We certainly have. A real deep dive.
We've taken a comprehensive look into the foundational aspects of options. We started by carefully understanding them as contingent claims.
Yes, stressing how they are profoundly distinct from fixed forward commitments.
Then we meticulously broke down their total market value into those 2 core components. The immediate exercise value, or intrinsic value.
And that forward-looking time value, explaining how they interact and how time value decays.
Indeed. We also thoroughly explored the crucial concepts of no arbitrage price bounds.
Essential for ensuring fair and efficient pricing in the markets, defining those precise upper and lower limits for option prices.
And we delved into replication strategies, understanding the elegant way you can mimic the payoffs of options by combining simpler instruments like the underlying asset and borrowing or lending cash.
And critically noting the crucial difference that option replication inherently requires continuous dynamic adjustment, a feature rooted in their unique asymmetric payoff profile.
And finally, we meticulously examine those 6 key factors that universally influence an option's value: the underlying asset's price,
The exercise price,
the time to expiration,
the prevailing risk-free rate,
the volatility of the underlying.
and finally, any income or costs related to owning the underlying asset. We saw how each plays a unique, often nuanced role in shaping both call and put values.
These concepts truly are the building blocks, aren't they? And mastering them is absolutely crucial, not just for your CFA journey, but really for any advanced understanding in the world of finance.
Absolutely. Remember, the world of finance is all about understanding these intricate connections and seeing how all these different pieces fit together to form a cohesive picture.
As a final thought for you to ponder, perhaps a reflection point as you continue your studies.
Yes.
While options might initially appear complex, their very existence, and particularly their unique asymmetric payoff profiles that limited loss, unlimited gain potential for the buyer, allow investors and businesses to manage risk and to speculate in ways that traditional assets or even simpler forward contracts simply cannot achieve.
That's the power of options.
So, how might understanding these factors, how they intricately influence the price and behavior of options, empower you to strategically think about different financial scenarios, not just for passing exams, but perhaps in real-world investment decisions, maybe even for managing your personal financial goals or navigating the financial complexities of running a small business here in India?
That's a wonderful question to leave our listeners with. How can this knowledge be applied practically?
We truly hope this deep dive has given you some great aha moments and a clearer, more practical picture of options.
Keep revisiting these concepts, keep practicing with examples, and you will undoubtedly build a very strong and confident foundation in finance.
Thank you so much for joining us today on the deep dive.
Yes, thank you for listening. Until next time,
Keep learning and keep growing.
namaste.
Welcome, everyone, to another deep dive. It's truly wonderful to have you with us today. We're about to embark on a very important journey into the fascinating world of options. Specifically, we want to understand a fundamental concept called put-call parity. Now, I know for those of you diving into CFA studies, especially maybe without a prior finance background, these concepts can sometimes feel a bit like a complex mathematical riddle, a real Peshitta Solwall. But our mission today is to simplify it, to break it down piece by piece so you not only understand what it is, but also why it matters so profoundly. Think of it like finally understanding how a cricket scoreboard works, or maybe how to manage a small Kirana shop efficiently, where every transaction has a clear logic. We've gathered some excellent study material for you, and we're going to extract all the important nuggets, making sure you don't feel, overwhelmed by too much information. We are here as your guides every step of the way.
That's absolutely the essence of it, yes. Consider us your Markdershak, your navigators on this financial journey. We will proceed slowly, explaining every new term with examples you can relate to from our everyday Indian life. We'll pause frequently to make sure we're all on the same page. Our ultimate goal is to help you build a very strong foundation in finance, just as you carefully lay a strong foundation for a house before you even think about adding floors, right? By the end of this deep dive, you will not only be able to confidently explain put-call parity for European options, but you'll also extend that understanding to something called put-call forward parity. And perhaps most importantly, you'll see how these powerful ideas are used in the real financial world, even when we talk about a company's shares and its debt, connecting theory directly to practical understanding.
That's a perfect setup. So let's unpack this then. Our starting point, the very foundation of today's lesson is: what exactly is put-call parity? We've discussed call options and put options in our previous sessions, right? Just as a quick recap. A call gives you the right to buy something at a certain price. Remember, imagine booking a train ticket from Delhi to Mumbai months in advance, paying a small amount today. You have the option to travel on that specific date at the fixed price, but you're not obligated. If your plans change, you simply don't exercise the option, losing only that initial small payment. That's it. And a put gives you the right to sell. Think of it like having an agreement to sell your old scooter at a fixed price, say Rs 20,000, even if the market price for similar scooters falls to maybe Rs 15,000. That put option protects you from the fall, doesn't it? It guarantees you that Rs 20,000. Now, with these in mind, we introduce put-call parity. It might sound like a grand, complex mathematical formula at first, but really at its core, it's like discovering a secret, an unbreakable rishta, a relationship between the price of a call option, a put option, the underlying asset. That's true. That's the thing you are buying or selling, like a share of a company, and a risk-free investment. This relationship is incredibly specific and remarkably powerful. And for today's deep dive, remember, we are focusing on European options. This just means you can only use your option or exercise it on the exact expiry date, not before, okay? It's much like a fixed deposit that matures only on a specific date. You can only withdraw the money then, not earlier. To make it even simpler, imagine this scenario. If you have a special kind of deal to buy mangoes, like a call option, and another deal to sell mangoes, a put option, from the same farmer, for the same fixed price and on the same specific day in the future, there's a mathematical connection between what you should reasonably pay for each of those deals, you see. This connection, this inherent balance, is what we call put-call parity. It helps us understand how the prices of these different financial tools should relate to each other in a fair and, well, efficient market. So everyone, based on our brief recap, can you recall one key difference between a call option and a put option, just in terms of the rate they give you?
That was an excellent way to simplify the core concepts, yes. And it leads us directly to the fundamental principle underpinning put-call parity, the no arbitrage condition. What this means, in very simple terms, is that if two different combinations of financial instruments can somehow give you exactly the same outcome, the same payoff at some future point, then their starting prices must be identical today. If their starting prices are not the same, then someone clever can immediately make a riskless profit without putting any of their own money at risk. Like finding a rupee coin on the road every single day, with no effort or worry of losing it. This act of making a riskless profit from a mispricing is what we call arbitrage. Think about it this way. If you could buy a kilo of fresh tomatoes for 20 rupees from one vendor in the local sabzi mandi and immediately sell it to another vendor right next door for 25 rupees without any effort or risk, wouldn't you do it all day long? Of course. That's an arbitrage opportunity. In financial markets, such opportunities are, well, they're quickly spotted and exploited by smart investors, often using algorithms.
This rapid exploitation is precisely what forces prices back into line, very quickly. So if put-call parity does not hold, if the prices of related options, shares, and bonds are out of alignment, it's like a clear signal, a green light, for these smart investors to find these riskless profit opportunities. These opportunities are actually quite rare and fleeting, precisely because the market corrects itself so quickly.
Exactly. So given how quickly these opportunities are closed, what does no arbitrage imply about the fundamental efficiency of global financial markets, do you think?
Well, it implies they're incredibly efficient, constantly seeking balance.
That's a profound point. It suggests that markets are constantly self-correcting, almost like a finely tuned machine, isn't it? Any imbalance gets snapped back into place almost immediately, which is why riskless profits are so hard to find in the real world for long. Now let's move on and understand how this parity, this balance, this samanyata is actually achieved. Imagine we have two different portfolios, two different dabbas or boxes of investments, let's call them that. Our goal for both these portfolios is similar: to benefit if an asset's price goes up, but also to protect ourselves if it falls below a certain point. This desire to earn more when things go well, but to also have safety when things turn difficult, is a very common aspiration for investors.
Okay, the first of these portfolios is called a fiduciary call. What's inside this daba? It's quite simple, really. You buy a call option on an asset, and you also buy a risk-free bond. Let's break down these components. A call option, as we said, gives you the right to buy. You pay a premium for it today, which we'll call zero. This zero is like a small booking amount you pay, non-refundable.
Okay. Then, a risk-free bond is like putting your money in a government savings scheme, or perhaps a very safe fixed deposit from a highly reputable bank, like the Reserve Bank of India. It guarantees to give you a specific amount back at a future time, T-SLAM. Let's call this guaranteed amount X, which is the face value of the bond. Today, you don't pay X itself, but its present value a smaller amount because you're investing it for some time. We calculate this present value, often denoted as PVX, as X divided by 1 plus R raised to the power of T, or sometimes written as X times 1 plus R to the power of minus T. Same thing. Here, R is the risk-free rate, the interest rate you get on that safe investment. So the total initial cost for this daba today is the call option price plus the present value of that risk-free bond, CO plus X 1 plus RT. Now, let's visualize what happens with this fiduciary call portfolio at time T, the expired date of the option. We have two main scenarios for the assets price, which we'll call ST, relative to the exercise price, X. First scenario.
If the assets price ST at expiry is less than the exercise price X, meaning the asset didn't perform well. Unfortunately, your call option expires worthless. Poof, gone. It's like your train ticket expiring because you decided not to travel. You lose the small booking amount, the premium CO. That's it. However, your risk-free bond still matures and gives you the guaranteed amount X back. Safe and sound. So your total payoff for this portfolio is simply X. You are protected at X. See. Second scenario. If ST is greater than X, meaning the asset's price went up beyond the exercise price, which is good, your call option is now in the money. You will definitely exercise it. It pays you ST minus X because you buy it at X and its market value is ST. The difference is your gain. And your risk-free bond still gives you X. So your total payoff is STX plus X, which simplifies beautifully to ST. Notice in both scenarios, whether the price goes up or down below X, you're protected at X. If the price falls below X, you still get X. If it rises, you get the full value ST. So everyone, can you quickly explain what a risk-free bond might be in our Indian context?
Think of where you might put your savings to guarantee a return without any worry.
Right, a government savings scheme is a great example. Or even a fixed deposit from a very solid bank. Building on that, the market also offers what we call a protective put, which interestingly achieves a very similar outcome, very similar protection, but it uses a different set of instruments. This daba is also very popular with investors precisely because it offers this layer of protection, this safety net, what's inside this portfolio. You directly buy the underlying asset itself, perhaps shares of a well-known company like Reliance Industries or Tata Motors, and you also buy a put option on that very same asset. Let's look at its components. You buy the underlying asset, which costs you its current spot price, is zero today. So you pay a zero upfront, that's the first part. And you buy a put option for which you pay a premium E0 today. This P0 is effectively like paying a small insurance premium to protect the value of your shares. Okay, so the total initial cost for this daba today is the underlying asset price plus the put option premium, S0 plus P0. Now, let's analyze its payoff at time T, the expiry date. Again, we consider two scenarios for the asset's price, ST.
First, if the asset's price, ST, at expiry is less than the exercise price, X, meaning the asset's value has unfortunately fallen, your put option comes into play. It kicks in. It pays you X minus ST. This happens because you have the right to sell the asset at X, even though its market price is lower at ST, so you gain that difference. It protects your downside. Importantly, you still hold the underlying asset, which is now worth ST. So your total payoff is XST plus ST, which remarkably simplifies to just X. Here, the put option clearly protects you from the price falling below X. It guarantees you get at least X back. In the second scenario, if ST is greater than X, meaning the asset's price has risen, good news. Your put option expires worthless. You wouldn't exercise it, right? Because you can sell the asset for more than X directly in the market, buy sell for less. But crucially, you still hold the underlying asset, which is now worth ST. So your total payoff is ST. Simple as that. Again, you are protected at X in a downturn and you fully benefit from any upward movement. Now for the truly insightful part, aha moment, maybe. If you carefully compare the payoffs of both the fiduciary call and the protective put, you'll notice something quite profound, something amazing. Both portfolios, despite having entirely different components, have identical payoffs at time T. Absolutely identical. Both give you X if ST is less than X, and both give you ST if ST is greater than X. Check it yourself. Because they have these identical future cash flows, according to the no arbitrage principle we discussed earlier, their starting prices at time T0 must be equal, have to be. If they weren't, there would be a riskless profit opportunity that market participants would immediately exploit, forcing prices back into alignment. This leads us directly to the fundamental put-call parity equation, which is like your compass in this world. S0 plus P0 plus X1 plus R-T. This relationship, S0 plus P0 plus X times 1 plus R to the minus T, it's more than just a formula, you know. It's the market's internal truth serum, revealing how distinct instruments must align in price. A long underlying asset, S0, plus a long put option, P0 on one side, must equal the price of a long call option, C0, plus a risk-free asset that pays the exercise price, X, at maturity, that's the X1 plus RT part on the other side. This has to hold to prevent riskless profit. Very profound, isn't it? It really is. So for our students, what does it mean that these two seemingly different portfolios yield identical payoffs? Why is that such a powerful idea in finance? It's powerful because it shows different ways to achieve the same goal must cost the same. Finance is logical that way.
Exactly. It means that if you can achieve the exact same outcome in the future through two different paths, those paths must cost the same today. If they didn't, everyone would simply choose the cheaper path, wouldn't they? And that demand would push its price up until it equalized with the other. It's basic market logic. This is where the magic of application comes in. Now that we understand this bedrock equation, let's see how we use it in real life, like calculating how much change you should get after buying groceries, ensuring you are not cheated. You need the right calculation. This equation isn't just theoretical. It allows us to find the fair price of one option if we know the prices of the others, or even more excitingly, to spot mispricings in the market. Let's try an example together. Imagine the Vis1 family office, VFO, is closely looking at Binomial shares. Okay, the current share price, S0, is INR 295. They are considering a 6-month put option with an exercise price, X, of INR 265. They know a 6-month call option with the exact same exercise price and expiry date is currently trading at INR 59. The prevailing risk-free rate is 4% per annum. The question is,
what should the put option cost, according to our put-call parity formula, for it to be considered fairly priced? Let's solve this step by step, just like we would approach a math problem in school. First step, we need to calculate the present value of the exercise price, X. Remember, the risk-free bond in our fiduciary call portfolio pays X at time T, so we need its value today. We need to discount INR 265 back by 6 months, which is 0.5 years, at the 4% risk-free rate. So that's INR 265 divided by 1.04 raised to the power of 0.5. Or INR 265 times 1.04 to the power of minus 0.5. If you calculate this, let me see. It comes out to approximately INR 259.85. This value, often denoted as PVX, represents what you would pay today to receive INR 265 exactly 6 months from now, risk-free. Okay, second step. We plug these numbers into our core put-call parity equation, S0 plus P0 plus PVX. We have INR 295 for S0 plus PPO. This is what we want to find, the put price. INR 59 for C0, the call price, plus INR 259.85 for PVX. So INR 295 plus P0 plus P0, INR 318.85C. To find P0, we simply subtract INR 295 from both sides of the equation. P0, INR 318.85, INR 295. If you solve this, P0 comes out to INR 23.85.
So for the market to be in perfect balance, VFO should expect to pay INR 23.85 for this put option, given the prices of the other instruments.
So what are the implications if VFO found this put option trading at, say, INR 20? What would that mean?
Good question. That takes us straight to arbitrage.
Exactly. If VFO finds the put option trading at INR 20, which is less than our calculated fair price of INR 23.85, it means the put is underpriced. It's too cheap. Conversely, if it's trading at, say, INR 30, it's overpriced. It's too expensive. This is where the riskless profit, the Paka-Munafa, comes into play. If the market is not in balance, if prices don't follow the parity relationship, you can exploit that imbalance. Let's use the same Binomial example, but now consider that the put option is observed to be trading at INR 30. This is higher than our calculated fair value of INR 23.85, so it's overpriced. Let's recheck our parity equation with the market prices. Left side, protective put, S0 plus P0, market price, INR 295 is 0 plus INR 30, P05. Right side, fiduciary call, C0 plus PVX, INR 59, 0 plus INR 259.85 PVX, ex-zero INR 318.85. Clearly, INR 318.85, so S0 plus P0 is greater than C0 plus PVX. The protected put side is overpriced relative to the fiduciary call side. It's in the imbalance. So how do we make a riskless profit from this imbalance? The strategy is straightforward. You sell the overpriced side and buy the underpriced side.
Sell high, buy low, essentially. 1. Sell the overpriced portfolio. In this case, the protected put portfolio, S0 plus P0, is overpriced. So you effectively sell the underlying Binomial shares, S0 maybe you borrow them first, that's short selling, and sell the put option. PZO, when you sell these, you receive cash. So this gives you a cash inflow of S0 plus P0, money in your pocket. 2. Buy the enterprise portfolio. The fiduciary call portfolio, C0 plus PVX, is underpriced. So use the cash you receive to buy the call option C0 and buy the risk-free bond, PVX. This costs you C0 plus PVX, money out. The net cash flow at time T0 right now will be the money you received minus the money you spent, S0 plus P0, C0 plus PVX. In our example, that's INR 325, INR 318.85, INR 6.15. This INR 6.15 is your immediate riskless profit, guaranteed. No matter what happens to the share price at expiration, all your positions will perfectly offset each other. They cancel out. You'll end up with zero net cash flow at time T because you've already locked in your profit at the start. It's like going to the Sabzi Mandi again. You find one vendor selling lovely Alfonso mangoes for Rs,
100 kilograms, the overpriced side, and another vendor just next to them selling exactly the same mangoes for Rs, 90 kilograms, the underpriced side. You quickly buy from the cheaper vendor, buy the underpriced, and immediately sell to the more expensive one, sell the overpriced, pocketing the Rs10 difference. You don't even have to carry the mangoes home. That's precisely arbitrage. So everyone, why is it so important that an arbitrage profit is riskless? What does that imply about how frequently such opportunities might appear in highly efficient markets like stock exchanges?
It's remarkable, isn't it, how a seemingly small price difference can unlock a risk-free profit. And as you said, how quickly those opportunities vanish in the real world because of smart traders and computers. Now, our put-call parity equation, S0 plus P0, C0 plus PVX, isn't just for finding fair prices or spotting arbitrage, though. It's also a powerful tool for replication. Think of it as making a duplicate of something, and a call, using entirely different ingredients. Imagine you want to make a delicious pakora, that crispy fried snack we all love, but you only have the ingredients for Podgy. You realize that by cleverly combining certain basic components, maybe tweaking the batter or adding something, you can actually create a very similar crispy, savory snack. The financial instruments might be different, but their final payoff profile, their taste, is identical. That's replication. For example, what if you want to buy a put option, but it's not easily available in the market for a particular stock? Or perhaps the transaction costs are too high for direct purchase. Our equation can be rearranged to show you how to create a put option synthetically.
We simply solve the core parity equation for P0. P0 plus PVX is 0. What does this mean in practical terms? It means that a long put option, buying a put, is economically equivalent to buying a call option, a long call, buying a risk-free bond, a long risk-free bond that pays X at maturity, and selling short the underlying asset, a short underlying position. The payoffs of this combination will match exactly the payoff of a simple long put option. Isn't that clever? Let's quickly clarify selling short using a simple, relatable indie example, maybe like a favor among friends. Selling short is like borrowing your friend's bicycle because you believe its price will fall tomorrow. You think, this model is becoming outdated. You immediately sell that borrowed bicycle today, let's say for Rs 5,000. Then tomorrow the price does fall, maybe to Rs 4,000. You buy it back at the lower price, Rs 4,000, and return the bicycle to your friend. You pocketed the Rs 1,000 difference, didn't you? That's profit from the price decline. In finance, you borrow shares, sell them in the market, hoping the price falls, then buy them back cheaper later to return to the original owner, like your broker.
You profit from the price decline. That's short selling. So, learners, quick thought exercise. If you wanted to create a synthetic call option, what combination of instruments do you think you might need? Based on our main parity equation, S0 plus P0 plus PVX, try to rearrange it in your mind to solve for C0.
That's a great thought exercise. And if you rearrange it correctly, you'll find that a synthetic call option needs a long position in the underlying asset, S0, a long put option, P0, and a short position in a risk-free bond, minus PVX. It's all about these relationships, like puzzle pieces fitting together. Now let's look at another very common strategy called a covered call. An investor typically uses this when they already own shares of a company. They own the stock, and they want to earn some extra income from those shares, perhaps while waiting for a long-term appreciation. Maybe they think the price won't move much in the short term. They achieve this by selling a call option on the shares they already own. Selling, not buying. So a covered call strategy consists of a long position in the underlying asset, S0 because they own it, and a short position in a call option, SC0 because they sold it. The initial cost or value of this position is S0CO, as you are receiving money, premium CO, from selling the call. Let's consider example 3, again involving our Binomial shares.
Suppose a Viswan family office, VFO, owns Binomial shares, currently priced at S0 INR 295. Their chief investment officer believes Binomial share price will appreciate over the long term, but anticipates it will remain relatively unchanged for the next 6 months. Flat, more or less. To generate some short-term income, he wants to sell a 6-month call option with a INR 325 exercise price, X. This is a classic covered call strategy. Own the stock, sell the call. The prevailing risk-free rate is 4%. Now the question is, how can VFO replicate this covered call position using a risk-free bond and a put option? And what should the fair call premium be if they observe a put option with the same terms trading at INR 56? We start with our fundamental put-call parity equation, S0 plus P0 plus PVX. We want to find the equivalent of a covered call, which is a value S000, long stock, short call. So we simply rearrange the equation to isolate these terms, move CO0 to the left, move P0 to the right, S0, C0, PVX, PVX, P0. This is a very neat result. It means that a covered call, a long underlying asset, and a short call option is economically equivalent to a long risk-free bond, paying X at maturity, and a short put option. Again, different financial ingredients, but they create the exact same taste, the same payoff profile. And now let's do the calculation to find the fair call premium, C0. First, we need the present value of the exercise price, X, which is INR 325, discounted back at 4% for 6 months, 0.5 years, that's PVX, of INR 325, 1.040.5. If you calculate this, it comes out to approximately INR 318.52. Now we plug this into our rearranged equation for a synthetic covered call. S0 equals PVX, P0, INR 295, SE0, INR 318.52, PV of X, INR 56, the given put option price, P0. So INR 295, we rearrange again, C02 and 295, INR 262.52. This calculation gives us C0, INR 32.48. So the call premium should be INR 32.48 for this covered call to be fairly priced in the market, consistent with the put option price. This example clearly shows how put-call parity can be used not just to value options, but also to construct equivalent portfolios or to infer the price of one instrument from others. Very useful.
Everyone, what do you think is the primary goal of an investor who chooses to use a covered call strategy? Why would someone use it instead of just holding the shares and doing nothing else?
That's a fantastic demonstration of how versatile the put-call parity relationship is. It truly gives you different ways to achieve the same financial outcome. Flexibility. Now, let's make our discussion even more exciting, like adding a pinch of garam masala to a dish, spice it up a bit. We already know about spot prices, that's buying something on the spot right now, like buying fresh vegetables right now from the market for immediate consumption, pay now, get it now. But what about a forward contract? A forward contract is a customized agreement between two parties to buy or sell an asset at a predetermined price on a future date. The key difference from an option is that it's not optional. It's a binding obligation for both parties to complete the transaction. You have to do it. It's like agreeing today to buy a specific quantity of rice from your farmer friend 3 months from now at a price fixed today, say Rs 40 per kilo, regardless of what the market price of rice is in 3 months. Both you and the farmer are obligated to complete the transaction at Rs 40. Okay, now connecting this. In earlier lessons, we learned something interesting. We learned that buying an underlying asset today, that is, having a long underlying asset position, is economically similar to entering a long forward contract and also simultaneously buying a risk-free asset, which effectively discounts the forward price back to today. This combination creates what we call a synthetic underlying position, using a forward and a bond to mimic holding the asset. Now, here's the clever part. What if we replace the actual underlying asset as zero in our original put-call parity equation with the synthetic underlying position that uses a forward contract and a risk-free bond? That's precisely how we arrive at put-call forward parity. We substitute the synthetic S0 into the original equation. So our new equation, which builds on the previous one, becomes S0T1 plus R S P0 plus C0 plus X1 plus R S T. Here, F0T is the forward price agreed today for delivery at time T, and S0T1 plus R to T is its present value, meaning the current value of that forward contract obligation, discounted back to today using the risk-free rate R. So this equation robustly links forward prices, put options, call options, and risk-free assets. It's another powerful no arbitrage relationship, just extending the same logic. Same core idea applied to forwards. Everyone, can you think of a simple example where you might use a forward contract in your daily life or business? Perhaps for something like fixing the price of raw materials for your small business in the future to avoid price fluctuations. What do you think?
That's an excellent way to think about it. Managing future price risks is indeed a key application for businesses. Yes. This new put-call forward parity equation also allows us to construct what we call a synthetic protective put. Remember our earlier protective put? It was simple. Owning the asset and buying a put option, PO0. Straightforward. Now, the synthetic protective put using forwards is different. It's owning a forward contract, S0T, buying a risk-free bond with a face value equal to the forward price, actually, and buying a put option, P0. Amazingly, this combination also has the exact same payoff as a fiduciary call. It all ties together. This mathematical consistency reinforces the idea that all these financial tools are intricately linked in an efficient market. No loose ends. Let's apply this with example 4, revisiting Binomial shares but now using the forward parity. Binomial shares trade at a spot price of INR 295. VFO is looking at a 6-month put option with an exercise price of INR 265. The 6-month call option with the same details trades at INR 59. The risk-free rate is 4%. We want the put option cost using put-call forward parity. For this, we need the forward price.
We were given the 6-month forward price, F0T, which is INR 300.84. We already calculated the present value of X earlier, remember. It was INR 259.85. Okay, using the put-call forward parity formula. We can rearrange it slightly to solve for the difference between put and call prices. Sometimes it makes calculations a bit cleaner. P0, C0, X, F0T, 1 plus RT. The present value of the difference between the exercise price and the forward price. Let's plug in the numbers. P0 INR 59C0, INR 265X, INR 300.84 F0T, 1.04 and X0.5, the discount factor. First, calculate the term in the bracket. INR 265, INR 300.84, S050, INR 35.84. Next, calculate the discount factor for 6 months.
0.5 years at 4%, 1.804, and that's INR 35.84, 0.9805. This gives us P0 INR 59 INR 35.84, 0.9806. This gives us P0 INR 59 composed in INR 35.15, INR 23.85. You see, it matches our earlier put price perfectly, the one we calculated using the simple put call parity with the spot price, S0. It was also INR 23.85. This consistency isn't just a coincidence, it shows the immense power and elegance of these relationships.
It tells us that regardless of whether we use the spot price or the forward price in our calculations, if the market is efficient, the fair prices of the options will always be consistent. They have to be.
That consistency really speaks volumes, doesn't it?
Yeah.
About how integrated and rational financial markets are. If they didn't match, there would be an immediate arbitrage opportunity between spot and forward markets, which, as we discussed, don't last long at all. It's truly amazing how these formulas consistently hold true. Now, my young financial explorers, let's see how these option concepts are not just for trading or for, fancy calculations, but can help us understand something as big and fundamental as the value of an entire company, an entire business. Imagine a company's total value, its market value, VOO, is like a big, delicious thal, or maybe a pie, a big round pie. This pie is fundamentally divided between two main groups: the shareholders, who are the owners of equity, the owners of the company, and the debt holders, those who lent money to the company, like a bank, or those who bought the company's bonds. Here's where it gets really interesting, something that might truly give you an aha moment. Ready? A shareholder's claim on a company's assets actually behaves just like a call option on the value of the firm itself. Let's think about this. If the company's total value, VT, at some future time, say when its debt matures, is more than its debt, D, then the shareholders get the excess value, VT minus D. This is their profit, their share of the pie. After the debt holders are fully paid, they get what's left over. But if VT is less than D, meaning the company cannot even pay back its full debt, then the shareholders get nothing, zero. They simply lose their initial investment, but importantly, no more than that. Their liability is limited. This payoff profile, unlimited upside potential if the company does very well, but downside limited to losing only their initial investment, is precisely the payoff of a call option, with the exercise price being the debt amount, D. It's quite profound when you see it this way. So everyone, thinking about this structure, why do shareholders have unlimited upside potential but limited downside potential? Think about their unique position as owners versus lenders.
That's a profound connection, absolutely. And it reveals the fundamental risk-reward profile of equity, doesn't it? High risk, potentially high reward. Now let's consider the debt holders, those who lent money to the company. Their situation is fascinating because it's like holding a risk-free bond, representing the promised debt repayment, and having effectively sold a put option to the shareholders on the firm's value. Let's break this down. If the company is solvent, meaning its value, VT, is greater than the debt, D, debt holders get back their full debt amount, D. They are repaid in full, just like a bondholder expects, no problem. But if the company is insolvent, meaning VT is less than D, then they only get the remaining value of the firm, VT, which is unfortunately less than what they are owed. They get whatever's left, but it's not the full amount. And this shortfall, the amount they lose, DVT, is exactly like the payoff of a put option that they have effectively sold to the shareholders. Because they sold it, they are the ones who bear the loss if the company's value falls below the debt level. Crucially, the value of this implicit put option effectively is the firm's credit risk. Think about that. An increase in the value of this put option means that the debt holders are taking on more risk. The company's more likely to default. The higher the value of this put option, the riskier the company's debt is considered to be. It's the premium the debt holders implicitly charge for taking on the risk that the company might not repay them fully. This premium is what we often refer to in the market as the credit spread, the additional yield or interest rate debt holders demand for taking on the risk of the company's potential default compared to a risk-free investment. It's just like when you go to take a loan from a bank. If the bank considers you more risky, maybe your business is new, they will charge you a higher interest rate, right? That extra interest is their compensation for the increased risk, much like the value of this implicit put option. So based on our put-call parity framework, we can write the firm's total value from this perspective. V0 plus PV, P0C. Here, V0 is the total value of the firm today. C0 is the value of the shareholder's call option on the firm's assets. PVD is the present value of the debt, as if it were risk-free. And P is the value of the put option that debt holders have effectively sold, representing the credit risk. This equation provides a powerful framework for understanding how risk is distributed between shareholders and debt holders, and it helps analyze the firm's capital structure through the lens of options. It's quite elegant.
It really is elegant, isn't it? When I first learned about firm valuation this way, it completely shifted my perspective on how companies are structured. Do you find this interpretation useful in understanding a company's financial health?
Absolutely. It clarifies why equity is inherently riskier but offers greater reward potential, and how debt, while seemingly safer, always carries that implicit credit risk measured by that put option. It's a truly insightful framework.
Okay, now let's put our knowledge to the test. Just like we practice sums in our math class, or maybe learn new recipes by actually cooking in the kitchen, we have a few questions from your study material. Remember, practice is key to building strong foundations, just like you build muscle by consistent exercise. Let's start with a problem that involves calculating a put price. South China Sprintwick Investments, or SCSI, is looking at Chinawell Inc., CWI shares. The current price, S0, is CNY 127.50, and let's assume it pays no dividends, just to keep it simple. The prevailing risk-free rate is 4% per annum. SCSI observes a 6-month call option on CWI with an exercise price of CNY 120 trading at a premium of CNY 22.60. The question is, what should a 6-month put option cost, with the same exercise price of CNY 120 and expiry date, for it to be fairly priced according to put-call parity? Let's walk through the solution together using our main formula, S0 plus P0 plus PVX. We need to find P0. First, we calculate the present value of the exercise price, X. X is CNY 120. The time of expiration is 6 months, which is 0.5 years. The risk-free rate is 4% or 0.04. So PVX, CNY 120, 1.04 by 0.04.
If you calculate this, let's see, it comes out to approximately CNY 117.67. Now we plug these values into our put-call parity equation. CNY 127.50 plus P0, P0, what we want to find. CNY 22.60 plus CNY 117.67 for PVX. So CNY 127.50 plus P0, CNY 140.27. Right, to find P0, we simply subtract CNY 127.50 from both sides. P0 was CNY 140.27, CNY 127.50. This gives us P0, CNY 12.77. So the put option should cost CNY 12.77 to be in parity. Simple, right? Once you have the formula and the numbers. Now for problem 3. What if this 6-month put option on CWI shares, which we just calculated should be CNY 12.77, is actually trading in the market at a higher price?
Yes.
Say it's observed at CNY 15, meaning it's overpriced. How do you make an arbitrage profit in this scenario? Remember, arbitrage means making a riskless profit without any capital at risk. What's the strategy? Well, if the put P0 is overpriced, it means that the left side of our parity equation, S is 0 plus P0, using the market price for P0, is greater than the right side, CNY plus PVX. For our example, if the put trades at CNY 15, S0 plus P0 plus CNY 127.50 plus CNY 140.27, and C0 plus PVX, CNY 22.60 plus CNY 117.67, CNY 140.27.
Clearly, CNY 142.5 is greater than CNY 140.27. The protective put side, stock plus put, is overpriced. To profit from this imbalance, you sell the overpriced side and buy the underpriced side. Simple rule. So you sell the put option, because it's too expensive, and you sell short the CWI shares, COVO. Get cash from these sales. With the money received from selling the put and selling short the shares, you then BUY the call options, C0, and invest in a risk-free bond, PVX. Use the cash for these purchases. This entire position, selling the put, selling short the underlying, buying the call, and buying the risk-free bond, will give you an immediate riskless profit, the difference between the two sides. All the positions will perfectly cancel each other out at expiry, leaving you with no future obligations because you already locked in your profit today.
How quickly do these arbitrage opportunities really get closed out in financial markets compared to, say, our Sabzi-Mandy example?
Yeah.
Is it slower or faster?
Much, much faster, almost instantaneous sometimes.
That's right. In the Sabzi-Mandy, you might have a few minutes, maybe even an hour, to exploit that price difference. In sophisticated financial markets, it's often milliseconds or even microseconds. It's incredibly fast. Algorithmic trading systems, computers, are constantly scanning for these tiny imbalances, and they exploit them instantly. Bang! Gone. This rapid closure is precisely why arbitrage profits, though riskless in theory, are extremely difficult for individual human traders to capture consistently. It's a testament to the market's efficiency, really. Now let's look at another scenario for Chinawell Inc. Problem 4. In her most recent research note on CWI, SCSI's equity analyst specifically mentions an increase in CWI's leverage ratio as a reason for her bearish outlook on the stock. She's worried about the debt. How does this increase in leverage relate to option pricing on firm value based on our discussion about shareholders and debt holders? Well, an increase in leverage means the firm has taken on more debt compared to its equity. The debt level, D, is higher relative to the firm value, V. If the firm value falls, there's a higher chance it might not be able to pay back its debt holders fully.
The buffer is smaller. Remember, debt holders are effectively short a put option on the firm's value. If the firm's value falls below the debt level, the debt holders lose out. So an increase in leverage fundamentally makes the company's debt riskier. There's less cushion. This directly means that the put option that debt holders have implicitly sold to shareholders becomes more valuable. Why? Because the chance of it finishing in the money, FD, has increased. From the debt holder's perspective, their payoff profile deteriorates because the value of the put option they've sold has appreciated, reflecting a higher credit risk for them. They face a greater potential loss if the firm value drops, and this manifests as a higher credit spread on the debt. They'll demand a higher interest rate for lending to this now riskier company. Makes sense, right? Okay, next, problem 5. How can SCSI replicate a long risk-free bond return using a forward contract and call and put options on CWI? This tests your understanding of rearranging the put-call forward parity equation. We start with our put-call forward parity equation, F0T 1 plus R title T plus P0 plus X1 plus RT.
We want to isolate the risk-free bond term, X1 plus RT, on one side. We want to see what combination of other instruments equals a long risk-free bond paying X at time T. Rearranging the terms, just move C0 to the left side, X1 plus RT, 1 plus RT plus P0, 0, 0. What does this tell us? It means to synthetically create a long risk-free bond that pays X at T, you need to combine 1. A long forward contract on the underlying asset, represented by its present value, F0T, 1 plus RT. 2. A long put option on the underlying P0. 3. And a short call option on the underlying S at T0. See, the equation tells us exactly what positions to take. It's like a precise recipe where the ingredients are different financial instruments and the result is a synthetic risk-free bond. This is incredibly powerful for financial engineers who need to create specific exposures or hedge risks using alternative instruments when the direct instrument isn't available or suitable. Finally, problem 6. SCSI observes that a 3-month call option on CWI with an exercise price of CNY 130 trades at a premium of CNY 3. A 3-month forward contract on CWI trades at a forward price of CNY 128.76. The risk-free rate is 4% per annum.
What is the correct premium for a 3-month put option with an exercise price of CNY 130 on CWI? We use the put-call forward parity equation. S0T 1 plus R to plus P0 plus X1 plus RT. First, let's calculate the present value of the forward price, F0T. The forward price is CNY 120.76, and the time is 3 months, or 0.25 years. So PV of forward price CNY 128.76, 1.04-0.25. Calculating that gives CNY 127.50. Next, the present value of the exercise price X. X is CNY 130. PV of exercise price equals CNY 130, 1.04-25. Calculating that gives CNY 128.73. Now plug these values into the equation. CNY 127.50 plus what we want to find. CNY 3C0 plus CNY 128.73 PV of X. So CNY 127.50 plus P0 plus CNY 127.50. The logic remains exactly the same, just applied to a forward contract instead of a spot price. This consistency is the true beauty of these relationships in finance. They hold across different instruments. Everyone reflecting on these problems in our discussion today, which of these concepts, put call parity itself, the forward parity extension, or maybe the applications like arbitrage or firm value, did you find most challenging?
And why? What aspect was the most difficult for you to grasp initially? It helps us to know.
Wow, what a deep dive we've had today, everyone. Really covered a lot of ground. We started with the very simple, yet really powerful relationship of put-call parity. We explored how different portfolios, the fiduciary call and protective put, can have identical payoffs. Remember the dabas. We learned to calculate option prices using the parity and even understood how to spot and potentially profit from those fleeting arbitrage opportunities. Then we extended our knowledge to put call forward parity, which broadened our perspective using forwards instead of spot prices. And finally, we saw how these concepts help us understand a company's shareholders and debt holders, breaking down the complex structure of a firm into understandable option components, like seeing the call option for shareholders and the sold put for debt holders. Remember, finance is not just about numbers and formulas, it's really about understanding relationships and logic, underlying connections. Just like understanding the intricate rishta between different family members helps you understand the dynamics of the whole family. Understanding the relationships between financial instruments helps you understand the whole market. Keep revisiting these concepts, keep practicing the problems, and you will undoubtedly build a very strong foundation, I promise you.
Indeed. Well said. The key takeaways from today are those fundamental equations. Put-call parity, S0 plus P0, C0 plus PVX, and put-call forward parity, PVF0T plus P0 plus VVX plus PVX. These equations are your essential compass in the complex world of options, built on the solid ground of no arbitrage, the principle that ensures fairness and efficiency in markets. Keep practicing these problems, and please don't hesitate to revisit this deep dive if needed. Go back and listen again. Each time, you might discover something new, just like rereading a favorite book reveals new insights you missed before. Or maybe rewatching a classic cricket match helps you notice new strategies unfolding on the field. So my curious learners, here's a final thought to ponder. If the principles of no arbitrage are so strong that they link the prices of seemingly different financial instruments like options, shares, bonds, and forwards so consistently across the globe, what does this tell us about the fundamental efficiency and the deep interconnectedness of financial markets globally? How does this deep underlying consistency influence how you view investment opportunities or react to market news? Something to think about. Thank you for joining us on this deep dive. Keep learning, keep exploring, and we'll see you in our next session. Shubho-ratri. Namaste, everyone. Welcome to another deep dive session. Today we're tackling a really crucial topic in finance, something very important for your CFA preparations. We'll be looking into how to value financial derivatives, specifically focusing on something called the one-period binomial model for pricing options. Now, it might sound a little technical, maybe a bit daunting, but trust us, we'll go through it slowly, step by step. Think of it like making perfect chai. You need patience, you see.
Absolutely. Think of this as, well, your pathway to understanding a core concept in pricing derivatives. In earlier discussions, we talked quite a bit about no arbitrage and replication. Remember those fundamental ideas. We also touched upon things like forward contracts and put-call parity. Today, though, our focus is sharply on options. Options are, a bit different, wouldn't you say? Their value really depends on what the underlying asset's price might do in the future. It's about possibilities.
That's right. Forwards are obligations, fixed. Options involve choice.
Precisely. And because of that uncertainty, that choice, we need a special model to kind of map out those potential future price movements. And that's where this simple but surprisingly powerful binomial model comes in. It's like planning, perhaps for a trip. You map out the main routes, the main possibilities, the ups and downs. This model does something similar for asset prices. Come, let us explore this.
Okay, so first things first. Section 1. Understanding options and the core idea of this binomial model. Let's quickly revisit forward commitments. Remember those. Agreements where both parties are, well, obligated. They have to buy or sell something later at a price agreed today. Think of booking a flight ticket non-refundable. Once you book it, you're obligated to pay. The airline is obligated to fly you. Done deal. Their pricing is generally straightforward because the obligation is fixed. It doesn't really depend on future what-ifs in the same way.
But options, yes, options fall under contingent claims. They are different. The key word is right. They give you the right, but, and this is critical, not the obligation to buy or sell an asset later. This right, not obligation part, creates what we call an asymmetric payoff profile. Asymmetric.
Asymmetric. Can you maybe unpack that a little? How does it differ from the forward contracts payoff?
Sure. With a forward, if the price goes up, the buyer gains exactly what the seller loses. If it goes down, the seller gains what the buyer loses. It's perfectly symmetrical, like a seesaw, equal and opposite. But with an option, say, a call option which gives you the right to buy. If the price goes way up, your profit can keep increasing. Unlimited potential, theoretically. But if the price goes down, what happens? You simply don't exercise your right to buy. Your loss is capped. You only lose the initial amount you paid for the option, the premium.
Okay. So limited loss, but potentially large gains. That's the asymmetry.
Exactly. Your downside is fixed, but your upside isn't necessarily. Let me give you a simple example, maybe from home. Imagine planning a big wedding. If you pay the caterer the full amount up front for a set menu on a specific date, that's like a forward commitment. You're both locked in. You pay, they provide the food. But what if you just pay a small booking amount for the wedding venue? That amount gives you the right to use the venue. But if, say, something unexpected happens and you have to cancel the wedding, well, you choose not to use the venue. You only lose that small booking amount, not the whole huge rental fee, that booking amount. It's a bit like an option premium. It gives you a right, a choice, but no obligation.
That makes sense. So the booking amount is the cost of having that choice, that flexibility.
Precisely. And because of this flexibility, this valuable choice, valuing options is more complex. We have to think about what could happen to the underlying asset's price. This asymmetry is exactly why we need a model like the binomial model.
Right. So just to quickly check everyone listening, what's the key difference in payoff between a forward contract and an option? Is it symmetric or asymmetric? Think about that limited loss, unlimited potential gain idea. It's asymmetric, isn't it?
Good. Now let's talk about the binomial model itself, section 1.2.
Okay, the binomial model, as you said, it simplifies things wonderfully. It assumes that over one period, let's say 1 year, matching our options expiry, the underlying asset's price can only do two things, just two. It will either go up to a specific higher price or it will go down to a specific lower price. That's it, a fork in the road.
Yes, and we represent these moves with what we call gross returns. There's an up gross return RU and a down gross return RAD. So for example, if your share is, say, 100 euro today, if it goes up to 120 in 1 year, the up gross return RU is 1.20. That's just 120 divided by 100. If it goes down to 80, the down gross return RAD is 0.80, which is 80 divided by 100. You see, so the model gives us two possible future prices, S the up price and S the down price.
And crucially, you mentioned earlier, we don't actually need to know the real probability of it going up or down. Like, we don't need to guess if it's a 60% chance of going up or 40% down.
Not for the no arbitrage pricing, no. We just need to know these two possible outcomes, the up price and the down price. That's enough for the model's magic to work.
It's almost like thinking about a cricket match scoreboard at the end of an over. The score, which is like our asset price today as euro, it can either go up significantly if a 6 is hit, that's like our ICO, or maybe a wicket falls, which is a big setback, relatively speaking. That could be analogous to our ego. The model just says two possibilities after this over, and the difference between the highest possible score and the lowest possible score after that over that spread between 0 and 0, it gives us a sense of how unpredictable, how volatile the game is.
That's a good analogy. The wider the spread between the potential up and down prices, the more volatile the underlying asset is considered in this model.
Okay, quick check question for you listening. In this one-period binomial model, how many possible price movements can our underlying asset have at the end of the period? Just two, right? Up or down. Simple.
Very good. Now let's link this to some fundamental principles. Section 1.3, the law of one price and no arbitrage. The law of one price. This is very foundational. It simply states that if you have two different things, maybe two assets or two strategies, that produce the exact same financial outcome, meaning their payoffs are identical in all possible future scenarios, then their prices today must also be identical. They just have to be.
Right. And if they're not identical, if you have two things giving the same future result but costing different amounts today.
Then we have a problem for market efficiency. That situation violates the law of one price, and it leads directly to the no arbitrage principle. If the law is broken, someone can make a risk-free profit. Imagine you're in your local Corona shop. You see a packet of your favorite biscuits. In one aisle, it costs €1. But then in another aisle, you see the exact same packet, same brand, same quantity, same everything for just €1. What would you do? Of course, you'd buy the euro packet. And if you were really enterprising, you might buy all the euro packets and immediately sell them to others for, say, 9.50, making a guaranteed profit without any risk.
That difference, that ability to buy low and sell high simultaneously for a guaranteed profit, that's the arbitrage opportunity.
Exactly. In finance, arbitrage means making a guaranteed profit with zero risk and usually zero initial investment. The core idea, the assumption behind models like the binomial model, is that in efficient markets, such risk-free arbitrage opportunities shouldn't exist. Or if they pop up, they disappear almost instantly because people like you would exploit them.
So we use this no arbitrage principle as a tool. If we can create a portfolio using the underlying asset, maybe some borrowing or lending, and this portfolio perfectly replicates the payoff of our option in both the up and down states, then by the law of one price, the cost of creating that replicating portfolio today must be equal to the options price today. If it weren't, there would be arbitrage. This is how we find the fair price.
Perfectly put. So, another quick check. If two investments promise exactly the same payoff in all future situations but have different prices today, what is that situation called in finance? It's called an arbitrage opportunity, isn't it? A violation of the law of one price.
Excellent. Okay, section 2. Now let's actually use this idea to value options using risk-free hedging or replication.
Right. So, since we know our underlying asset can only end up in one of two specific states, up or down, we can do something quite clever. We can combine our option with the underlying asset itself. We can create a portfolio, a specific mix of the option and the asset, such that its value at the end of the period is the same, whether the asset price went up or down. Think about that. The final value is certain. This makes it a risk-free portfolio. Its outcome is known irrespective of the underlying asset's random movement.
And this is where that term hedge ratio comes in, right? We denote it as H. H tells us exactly how many units of the underlying asset we need to buy, or maybe sell short, for each option we hold, or have sold, to make our combined portfolio risk-free. It's like balancing a team for different conditions. Remember the cricket analogy? You need the right mix of batsmen and bowlers so the team performs consistently, whether the pitch helps batting, like an up move, or bowling, like a down move. The hedge ratio, H, it helps us find that perfect balance. The goal is simply to make the final portfolio value identical in both the SSU and S-Euro scenarios.
Precisely. Once we achieve that balance, the portfolio is risk-free. And if it's risk-free, its return must equal the risk-free rate. That's the key insight.
Okay, a question for you listening. If we create a risk-free portfolio using an option and its underlying asset, what does that mean for its value at the end of the period? Will it be different in the up scenario versus the down scenario?
Yeah.
No, right. The whole point is that its value will be the same in both scenarios. That's what makes it risk-free.
Very good. Let's make this concrete. Section 2.2, a step-by-step calculation for a European call option.
Okay, let's use the example from the materials. Imagine a European call option, 1 year to expiry. The exercise price, X, is 100 euro. The underlying asset's current spot price, SA, is 80 euro. And our binomial model tells us in 1 year, the price will either go up to S euro or down to SC equals 60 euro. Also, let's assume the risk-free rate of return for the year is 5% or 0.05. Our goal, find the price of this call option today, CR.
All right, step 1. Figure out the option's value at expiry in both states. Remember, a call gives the right to buy at X at 100 euro, scenario 1. Price goes up to 100 euro. Market price 100 euro is above strike, 100 euro, so you exercise. Buy at 100 euro, sell at 100 euro, profit. The call option value, EO, is max 0, SEO, euro X, max 0, 110, euro hill equals in 10. The option finishes in the money.
Makes sense. And the other scenario?
Scenario 2, price goes down to 60 euro. Market price 60 is below strike, 100 euro. Would you buy 100 euro using the option? No, you buy cheaper in the market. So you let the option expire worthless. The call option value euro is max 0, S is X, max 0, 60 euro, 0. The option finishes out of the money.
Okay, so we have the two possible future option values. 10 euro if the price goes up, euro if it goes down. And the crucial part, the hedge ratio. The formula, remember, is the change in option price divided by the change in underlying price.
Yeah.
Each those zeros. Let's plug in our numbers. 10 euro, 110 euro 60.
Right, so that's 10 euro divided by 50 euro. AA to 50 euro equals 10 euro 0.20.
So H equals 0.20. What does this mean practically? It means to hedge, say, selling one call option, we need to buy 0.20 units of the underlying asset. This creates our risk-free position.
Let's check if it really works. Let's form the portfolio. Buy 0.20 shares, sell one call option. Scenario 1, asset goes up to 110 euro. Portfolio value VU, 0.20 share price, value of call sold. VU equals 0.20 euro, 10 euro, since a call is worth 10, and we sold it. It's a liability for us. V euro equals 22 euros equals 12. Okay.
Got it. 12 if the price goes up. What if it goes down?
Scenario 2. Asset goes down to 60 euro. Portfolio value, VU equals 0.20 share price, value of call sold. VU equals 0.20, 60 euro, since the call expired worthless. V euro equals 12 euro equals 12.
Wow, it works. 12 in the upstate, 12 in the downstate. The portfolio value is exactly the same. It is risk-free.
That's the magic of the hedge ratio. Because this portfolio is risk-free, its return must equal the risk-free rate. No arbitrage, remember. So the value of this portfolio today, V euro, must be the present value of that guaranteed 12 we get in 1 year, discounted at the risk-free rate of 5%.
Okay, so V euro, future value, 1 plus R. V euro 1 plus 1, 0.05. 1 plus 0.05. V euro, 11.43, let's say rounded. So the cost of setting up this risk-free portfolio today is 11.43.
Yes. Now finally, we can find the value of our call option today, C euro. Remember how we constructed the portfolio initially? The cost today, V euro, was the cost of the shares we bought minus the cash we received from selling the call option. So V euro is 11.0.
Right. And we know V euro is 11.43, is 0.20, and S is 80 euro. Let's substitute 11.43 equals 80 euro 80. Euro 11.43 equals 80 euro C euro.
And now just rearrange to find C euro, 16 euro, 11.430, 80 euro is 4.57.
And there it is. The no arbitrage price, the fair value of this European call option today is 4.57. We found it by building a replicating risk-free portfolio. Fantastic.
Excellent. Now let's check your understanding again. If you calculated a hedge ratio of 0.5 for a call option and the underlying asset price S euro is 100 euro, how much of the underlying asset would you buy if you wanted to hedge one call option you had sold? You'd buy to a number of options, so 0.5 units of the asset per call option sold, right?
Perfect. Now, section 2.3. How does volatility affect these prices?
Volatility. Very important. In our simple binomial model, volatility is captured by the spread between the up price and the down price, S or R, or equivalently, the difference between the up and down gross returns, ρ R D. A wider spread means the asset's price can swing more wildly. Higher potential highs, lower potential lows. more uncertainty.
And the key takeaway from the material, and generally in options theory, is that higher volatility usually means higher option prices.
Right.
For both calls and puts.
Generally, yes. Think about it. As an option holder, your potential loss is capped at the premium paid. But your potential gain isn't necessarily capped, especially for calls. If the underlying asset is more volatile, there's a greater chance of those really big price moves way up or way down. Since your downside is limited, you benefit more from the possibility of these large swings. A bigger possible upward jump makes a call more valuable. A bigger possible downward plunge makes a put more valuable.
It's like the option gives you exposure to the upside of volatility while protecting you from the downside. So a wider range of possible outcomes, more volatility, gives the option more value. The example given where increasing the potential move from plus minus 20% to plus minus 40% caused the call price to jump from $2.98 to $8.04 really drives this home, Angie. It shows the significant impact.
Absolutely. So quick check. If the expected spread of an underlying asset's price movement increases, meaning higher volatility, will the value of an option on that asset generally go up or down? It will generally go up, correct?
Right. Okay. Moving to section 3, the power of risk-neutral pricing.
This is fascinating. Now, here's something that can feel a bit strange at first. The actual real-world probabilities of the underlying asset price moving up or down. They do not affect the no arbitrage value of the option. I'll repeat that. It doesn't matter if you think there's a 70% chance the stock will go up or only a 30% chance. That belief doesn't change the option's fair price calculated by this method.
It seems counterintuitive, doesn't it? But it's a cornerstone of derivatives pricing. Why? Because we can form that perfect risk-free hedge. Since we can eliminate the risk completely by balancing the option and the underlying asset using our hedge ratio H, the price we arrive at becomes independent of anyone's personal views on probability or their tolerance for risk. Think about a shopkeeper setting the price for, say, rice. Does the shopkeeper set the price based on whether individual customers feel optimistic or pessimistic about the upcoming harvest?
No, probably not. They base it on their own costs, the general supply and demand, what the market dictates.
Exactly. Similarly, the no arbitrage option price is dictated by the market parameters. Possible up-down moves, volatility, the current price, the strike price, time, and the risk-free rate. Not by individual feelings or probabilities. This whole concept is called risk-neutral pricing. We pretend we're in a world where everyone is indifferent to risk-neutral, and price the option accordingly. The amazing thing is, this gives us the correct no arbitrage price for the real world, too.
So just to be crystal clear, if an investor becomes very, very optimistic about a stock's future, maybe you read some great news, will that alone increase the no arbitrage price of a call option on that stock, according to the binomial model?
No, right? The model's price depends on the potential range of movement, that said, and not the subjective probability.
Correct. Now, while actual probabilities don't matter for the price, we do use a special set of probabilities in this risk-neutral approach, section 3.2, calculating risk-neutral probabilities.
Okay, we use these theoretical probabilities called risk-neutral probabilities. We use the Greek letter pi to denote the probability of an up move in this risk-neutral world. These are not real-world probabilities. They are a mathematical tool, a construct. They are the probabilities that would exist if investors were indeed risk-neutral. Crucially, they are calculated such that the expected return on the underlying asset using these probabilities equals the risk-free rate. This ensures consistency with the no arbitrage framework.
And there's a formula for this, derived from the model's parameters.
Yes. The formula for the risk-neutral probability of an up move is U as 1 plus RRD. RURD. Here R is the risk-free rate per period, R is the down gross return, and RU is the up gross return. To notice it only depends on the returns and the risk-free rate.
Let's use that Hydas Capital example again. S $50, X $55. Up move was plus 20%, so RU 0.2. Down move was negative 20%, so RD was 0.8. Risk-free rate R is 5% or 0.05. Let's calculate using the formula. R 1 plus 0.05, 0.8. R goes 1.05, 0.8. R 0.4, 0.625. R 0.625.
So in this risk-neutral world, the probability of the stock price going up is 0.625. And the probability of it going down, which we call one psi, must be 1.625 equals 0.375. These are the probabilities, 0.625 and R 0.375, that we will use for pricing the option using the risk-neutral method.
Okay, quick check. What 3 inputs are needed to calculate the risk-neutral probability? You need the risk-free rate, R, the up gross return, RD, and the down gross return, right?
Perfect. Now, section 3.3. Pricing options using these risk-neutral probabilities. Once we have, pricing the option is actually quite elegant. We calculate the expected payoff of the option at maturity, but we use our risk-neutral probabilities, pi n1. Then we simply discount that expected payoff back to today using the risk-free rate. So the value today is the present value of the risk-neutral expected future payoff.
The formula for a call option C euro would be C euro plus 1 plus pi plus RT, where T is time, which is 1 year in our case.
Let's apply this to high-risk capital. Remember, the call payoff if the price went up C euros, 6 euros, $55. The payoff if down C was $0, max $0, $55. RCO was 0.625, a 1 was 0.375, and R was 0.05. C euro 0.6255 dollars plus 0.375 $0 plus 1 plus 0.05. C euro is 0.125 plus 1.050, 3.1205105 C euro is $2.98.
Wait a minute, $2.98, that's the exact same price we found using the risk-free hedging and replication method earlier.
Exactly. It has to be the same. This is fantastic, isn't it? It shows the internal consistency. Whether you build a replicating portfolio or you calculate the present value of the expected payoff in a risk-neutral world, you arrive at the same unique no arbitrage price. Two different paths, same destination.
That's really powerful. And we can do the same for a put option using the same path.
Absolutely. Let's quickly do the put option for high-risk capital, X $55. If price goes up to $60, put payoff P euro, max 0, excess euro, max 0, 55, $60. If price goes down to $40, put payoff P euro, max 0, X euro, max 0, 25 euros, $40, $50. Now use the put pricing formula with the same max 625 and 1.375, P up plus 1 plus R, P up 0.6250 plus 1 plus 275, 55, P up plus 5.625, no $1.05, P up 5.625, $1.05, P up $5.36.
Right. And it's crucial, as you said, that the risk-neutral probabilities, N1, depend only on the underlying asset's potential moves, RU, RD, and the risk-free rate. They don't depend on whether we're pricing a call or a put. We use the same for both.
Correct. So one more check. When pricing an option using risk-neutral probabilities, which interest rate do we use to discount the expected future payoff? We use the risk-free rate R, isn't it?
Yes. Okay, section 3.4. Let's quickly check this with put-call parity. You'll remember the put-call parity relationship for European options. It's a fundamental equation linking call price, C euro, put price, underlying spot price, and the present value of the exercise price, X. The formula is S plus P euro plus X1 plus RT. This relationship must hold if there's no arbitrage. It connects all these instruments together.
Let's check it with our high-risk capital numbers. S euro equals $50. Our calculated P euro, $5.36. Our calculated C euro, $2.98. X, $55. R, $0.05. T equals 1. Left side, S plus P euros is about $52 plus $5.36. Right side, C euro plus X1 plus R, put $2.98 plus $55, $1.05. $1 euro is about $52.30. So, right side is consistent with the no arbitrage condition defined by put-call parity. If they didn't match, you could buy the cheaper side and sell the expensive side for a guaranteed profit. Exactly. So why is put-call parity considered a consistency check in option pricing? Because it provides an independent relationship based on no arbitrage that must hold. If our calculated prices satisfy it, it gives us confidence in our valuation.
Great. Now, section 4. Some important considerations and applications.
Let's think about the risk-free rate, R. How does changing R affect option prices? Specifically, let's consider put options. If the risk-free rate R increases, the value of a put option generally decreases. Why? There are two reasons working together here.
Okay, what's the first reason?
First, look back at the formula for first, the risk-neutral probability of an up move. 1 plus R, RRG. Or R. If R increases, the numerator increases, so increases. A higher risk-neutral probability of an up move is bad news for a put option, which profits from down moves. So this effect lowers the put's value.
Ah, right. Higher R makes the upstate seem more likely in the risk-neutral world. And the second reason?
The second reason is simpler. It's just the discounting effect. A higher risk-free rate means we discount the future expected payoff, calculated using, back to the present, using a higher discount rate. Higher discount rate always means lower present value. So both affects the change amount, and the higher discount rate pushes the put option's value down or it goes up.
So interest rates aren't just abstract things. They directly impact option values, like how the interest rate on your home loan affects your payments, isn't it? A small change can matter.
Very true. So quick recap. If the risk-free interest rate increases, how does it typically affect the value of a put option? It generally decreases its value.
Okay. Section 4.2.
What about arbitrage opportunities if options are mispriced in the market?
Yes. What if our model calculates a fair price of, say, 4.57 for that call, but we see it trading in the market for 5.0 or maybe for 4.0? If the market price is different from the theoretical no arbitrage price, then bingo, potential arbitrage.
Let's say the call option is trading higher than our model price. Say market price is 5.4 down, model price is 4.57. It's overpriced. What do we do?
If it's overpriced, you want to sell it. So you would. 1. Sell the call option in the market, receive 5 euros. 2. Simultaneously buy 8 units of the underlying asset to hedge. A which was 2 is 0, M euros at 80 euro, so buy 8.2 euros, costing 0.2 euro, 16 euro. 3. Finance the net outlay. You receive 5 euros, spend 16 euro, net cost is 11 euro 0. You borrow this 11 euro at the risk-free rate, 5%.
So you set up a position. Now, at expiry, what happens?
We already showed that the hedged position, the 0.20 euros minus 1 call, has a guaranteed value of 12 at expiry. You use this 12 to repay your loan. The loan grew from 11.0 to 5% interest, so you owe 11.0 euro, 1.05. You have 12, you owe the 11.55. You make a risk-free profit of 12 euro, 11.55, equals 0.45. This profit comes directly from the initial mispricing, 5 euro versus 4.57.
So you created a position that makes money, for sure, exploiting the overpricing. And if the option was underpriced, say trading at £4 when the model says 4.57.
You do the reverse. You buy the cheap option. 1. Buy the call option, pay 4 euro. 2. Sell short units of the underlying asset, receive 0.20 euro, 16 00. 3. Net cash inflow is 16 euro at 4 euro equals 12 euro. You invest this risk-free at 5%. At expiry, your hedge portfolio requires a net payout of 12 euro, as the short stock and long call combine. Your investment has grown to 12 euro, 1.05 equals 12.760. You use 12 euro to close the position, pocketing an euro 0.60 risk-free profit.
It's like finding those cheap samosas again. Buy low, sell high, or create the equivalent effect synthetically. This arbitrage activity is what pushes market prices back towards their theoretical fair values.
Exactly. So if an option is trading in the market at a price lower than its calculated no arbitrage price, what might an investor do? They would likely buy the option and set up the appropriate hedge to lock in a risk-free profit, wouldn't they?
Right. One last point, section 4.3, negative risk-free rates. Just a quick mention. We usually think of risk-free rates as positive, but sometimes in some economies they can actually dip slightly below zero. You might have to pay a tiny amount to hold the safe as government debt.
It sounds strange, but it happens. The good news is, all the logic and formulas we use today, the hedging, the risk-neutral probability calculation, I was 1 plus R-RD, red, the discounting, they all still work perfectly fine, even if R is negative. The math holds up. It's like paying a small fee for a bank locker to keep valuables safe instead of earning interest. The concept of cost-benefit still applies, even if the risk-free return is negative. The model handles it.
Good to know the framework is robust.
Oh!
Okay, let's wrap up. So, everyone, that was quite a deep dive into valuing options using the one-period binomial model. We covered a lot of ground. We talked about options as contingent claims with those asymmetric payoffs, unlike forwards. We stressed the importance of the law of one price and no arbitrage.
Yes, and we showed how to construct a risk-free hedged portfolio using the hedge ratio, H. That was the replication method. Then we explored the really powerful idea of risk-neutral pricing, calculating those special risk-neutral probabilities, and finding the option value by discounting the expected payoff at the risk-free rate.
And importantly, we saw both methods give the same answer, and checked it with put-call parity. Now, you've done wonderfully sticking with us through this. Remember, practice is absolutely key. Try solving some examples from your CFA materials using both the replication method and the risk-neutral pricing method. Seeing it work both ways really helps it sink in.
It truly does. The binomial model, even the simple one-period version, it builds a very strong foundation. It gives you the intuition needed for more complex models you'll encounter later, like the multi-period binomial or even the famous Black-Scholes model.
That's very true. And now, for a final thought, something for you to ponder as you continue studying. Today, we only allowed the price one chance to move one step, up or down. But what if the price could move up or down multiple times before the option expires? Imagine a whole tree of possibilities branching out over time. How could we extend this simple model to handle that?
Or what about other real-world things? Like what if the underlying stock pays dividends during the option's life? How does that affect the price? And what about options that you can exercise before the expiry date? Those are called American options. How would their value differ from the European options we discussed today, and how would we model that early exercise feature?
These are the next steps, the extensions of these core ideas. Keep asking those questions. Keep that curiosity burning is how you truly master the subject.
Absolutely. Keep up the excellent work. Until next time, keep studying hard, and we look forward to our next deep dive. Namaste.